We'll see if maybe they're the outperformer in the pharmaceutical trade, how that shows up in the overall Swiss market, and not to mention the Danish one as well, Guy. Looking forward to how the market open shows up.
Yeah, Swiss market's going to be interesting. Danish market's going to be interesting. Pharma stocks are going to be interesting more broadly. There's all kinds of factors to throw into the mix here. We'll see in a moment just how this goes. Here we go. Time for the opening trade. Let's show you some numbers. Let's give you an idea, particularly of how that SMI trade is going to work its way through. Switzerland singled out, it seems, in terms of the negative story surrounding trade. 39% is the tariff that's going to be applied. FTSE's going nowhere in a hurry. We'll just kind of park that one for the moment. Stock 600 down by 0.3%. The CAC's got a few pharma stocks in it as well. We'll see what Sanofi does this morning. We'll work our way through that one. We were talking about Euronext a little bit earlier on. DAX could take a little while to get open as well this morning. We've got a few car stocks that we need to fold in. The IBEX is out of the gate down by 0.5%. It's quite a negative story emerging here in Europe. Remember, we've still got a long way to go today. We've still got payrolls to work our way through. ISM's coming up a little bit later on the manufacturing front out of the United States as well. I mean, the one market I'm going to watch this morning is the SMI. It's not open yet. We are getting a reaction, obviously, in the Swiss franc. We'll see how that market opens in a moment. We'll see how the pharma sector opens in just a moment as well. Val, talk us through that story. What is happening with the sector narrative?
Well, it's no surprise that we do have healthcare at the bottom of the basket when it comes to your sectors. As a sector, it is down some 1.5%, the worst performing sector so far in this morning's trade. Only one sector in the green at the moment, the rest 19 in the red. But when it does come to the single stocks, the one pointing out to me is Novo Nordisk, down some 4%, one of the worst performers so far in the few moments of trade. We also have real estate, utilities, and banks being at the bottom end of the basket. So perhaps it just feels like a risk-off day to me.
A risk-off day, absolutely. A couple of winners, though. We should talk about IAG, for example, and that's the earnings numbers that came out this morning, higher by about 1.7%, and that's going to be a crucial one, although I'm not seeing that in the early kind of volume movers. Maybe that'll show up for a moment.
I just want to check stock exchange holidays today. We got a little email earlier on, which I didn't check this morning. Guess which market's closed today?
Oh,
Is it the Swiss market?
Yep.
Oh, no. How are you going to talk about Roche now?
How am I going to talk about any of this now? The Swiss market's closed. How did we miss that one?
But we're getting a couple of read-throughs in some of the other pharmaceutical stocks when it comes to the Euro stocks. So Novo Nordisk, AstraZeneca, Sanofi, certainly trading with a lower bid, as you point out this morning, Val.
Yeah, with healthcare underperforming. I mean, this was a theme we saw in yesterday's session as well. Eli Lilly took a hit on the back of this letter that Trump sent to drug makers on lowering their prices for the U.S. So this theme does seem to be running into the European session.
Okay. Switzerland, I have nothing else to say. We're done.
Now you're done. You're done with the show.
I'm A, embarrassed that I missed it, and B, slightly shocked that I don't have a narrative to focus on when it comes to what is happening with this farm space. But Novo's getting hit and whacked pretty hard.
Well, some of the, the ones that are listed on the Euro stocks are very much getting hit. So this is absolutely a narrative to pay attention to. But again, first day of the month, not really kicking it off strong. That Friday feeling certainly showing up in these markets. You've got the perfect guest to digest what's going on and how we can perhaps move forward. Nancy Curtin, CIO at Alti Tiedemann Global, joins us around the table. Nancy, we've been talking for months about tariffs. We're talking all morning about pharmaceutical tariffs, and there's certainly letters about what the Swiss market is going to talk about. Do tariffs matter at the end of the day when we're talking about how to trade this market?
Well, first of all, look, I think the tariffs are going to come in around the 15 to 17% mark. That's a far cry from the 40% effective tariff rate if you included the trade war with China that we were looking at April 2nd. So that's number one. Number two, tariffs raise money. So let's not forget that. There's a lot of mayhem and chaos and uncertainty that comes with tariffs. But there's about $25–30 billion coming into the Treasury coffers every month. Multiply that by 12, $300 billion. Add a couple of years on that, you can begin to raise some money in the United States, which is not such a bad thing. And in addition to that, in these trade deals, and by the way, we've had 7 of them at the moment, the dominoes seem to be rolling over, countries have committed, deployment remains to be seen, to spend a lot of money in the United States. If you just take Japan and the EU, I add up to more than $1.5 trillion now. Remains to be seen what actually happens here. But there's some good sides to tariffs as well. I want you to think about it in the context of maybe there's a bit of a wealth shift from the rest of the world to the United States.
How long does that last? Is that ultimately a tactical move, a short-term 2-year end tactical move, or is this something that's going to last the next 10 years?
Well, of course, you have changes in administration, you have changes in policies, these so-called trade deals, or, I don't know, written on a napkin and, 5 pages and MOUs and subject to negotiations. So these are not comprehensive trade agreements. We'll have to see what actually happens over the next couple of years. But I think the U.S. will probably look to make part of these tariffs more permanent because they are raising money and because access to the U.S. market is attractive. So where that comes, past the Trump administration remains to be seen. But I think if you look back what Biden did, he pretty much validated the tariffs that Trump had put into place when he came into office. So let's see.
Okay. Let's put all of that to one side, because I'm not sure any of all of that matters. And here's the reason why I say that. The S&P is trading on 22 times, 22 and a half, I can't remember what the exact number is. And that's tech. Does anything else matter for investors right now? I've got the Fed, I've got all the stuff that Val gets excited about, non-farm payroll numbers, all this kind of stuff. We've got tariffs, we've got all of this stuff to fold in.
You sound like Dan Ives over at Wedbush.
But it doesn't matter. No, but it doesn't matter. Okay, I'm not making a call on whether or not this is justified. I'm just saying at the moment, that's where the story is. And as long as that narrative continues, I have to be invested in these stocks. If I'm not invested in these stocks, I'm going to underperform my benchmark. That's the trade.
Well, let's first look at 22.5 times. Okay,
Yep.
That's 7 stocks that traded a weighted average of 35 times. Okay, and the rest of the market that trades at 16.5. And remember, the U.S. market today, operating margins are kind of 12 to 14%. That's a far cry from where they were a decade ago. So looking back on a PE multiple 10 years ago, I don't know, is that really applicable? So again, I put that out there. However, markets trade on the outlook for economic growth and earnings. And here I think the story's pretty good in the United States. Yes, probably a slowdown this year from where we were in 2024. But look, the consumer's still in good shape. There's a huge amount of wealth, $170 trillion of net worth in the States. I just put that out there, 650,000. I know there's a disparity in that number, but 650,000 per household is pretty interesting relative to the rest of the world. You've got Gen AI happening, right?
Yep.
And that's an improvement in productivity. And it could just be that investment spend, CapEx, surprises on the upside. The I of that little formula actually surprises. It's been pretty moribund. Take a look what the tax bill has done. Huge benefits from the tax bill. Bonus depreciation, 100% expensing of R&D. Combine that with Gen AI. I see those numbers went up in the last couple of days. And then the commitments on the part of countries and companies to invest. Let's keep an eye on this. As I said, it could just be that we see investment spending surprising the upside. Remains to be seen. There's a lot of mayhem and chaos, but I think that may just be the surprise that people aren't focused on.
Nancy, I want to talk a little bit about your estimated number for tariff revenue, which I've heard people talk about as well, this $300 billion a year. Can you talk to me about, given you seem very positive on U.S. assets, who is paying that tariff revenue, and is it essentially, does it matter at the end of the day who's paying it, or is it just going to be diversified, across the supply chain, so it's not necessarily the exporters or the importers taking the hit?
Look, that's a great question, and I think the answer remains to be seen. We don't know. But our sense is, first of all, tariffs is one time, so it's not a permanent, persistent price increase. Even Chair Powell's talked about that. Our sense is could well be that the cost increases from tariff get dispersed across the supply chain. So what I mean by that, the exporters take some, the importers take some, the distributors take some, the retailers take some, the consumer takes some. And so the actual impact on the end consumer, which had been the concern, may be less than feared. Now, we'll have to see. We saw in the PCE number yesterday, we saw an increase in furniture, apparel, other things. Costs are going up on the good side. But remember, you know, of the PCE number, 70% is services, 30% is goods. So goods prices could come up. I'm really focused on what's happening in the service economy. U.S. is fundamentally a service economy. So, you know, I think there are some counterbalancing things we have to watch. We won't know for sure. I think Chair Powell did the right thing. Let's wait and see how these tariff increases impact inflation in the United States. But I don't see it as being persistent over time.
So it seems like, you know, we've obviously gotten a lot more clarity on the tariff picture from the Trump administration. He's passed this tax and spending bill already. It seems like a lot of his agenda is done. Maybe the big questions out there about deregulation. Is there any other agenda topics you're watching out for?
Well, with Trump, I mean, every day's a new day. I think, does that man ever sleep? You know what I mean? I mean, just so much comes out every day. But you mentioned deregulation. That's positive, right? What do we have? We've got slashing the SLR ratio. That's good for banks, good for lending. We already saw an increase in dividends, a commitment to buybacks for the major central banks. So that's positive. You know, we have commitments and deregulation for the energy industry, LNG, and you saw very, very big purchases the EU has agreed to buy. And then I don't know what, you know, the AI action plan means, and genius and clarity on the crypto side, but it's clear that innovation is not going to be heavily regulated. Let me put it that way, right? You know, that 90-page and all these pillars and so on and so forth, you know, details lacking. But I do think Trump isn't just about making sneakers and sort of shoes and stuff. He also has a keen eye on innovation and protecting that IP in the States, and that's probably positive as well. So deregulation, good for growth.
Well, it's fascinating you talk about deregulation because Val and I do some stock mover hits in the morning and sometimes for or early morning U.S. television and radio. And it feels like in the last couple of weeks specifically, Val, tell me if I'm getting this right, there has been a lot of M&A news, a lot of consolidation, a lot of deals that have not happened 6 months ago, to the point that we're not even calling it M&A Monday anymore. It's M&A Tuesday, Wednesday, Thursday, sometimes Friday. Talk to us a little bit about the risks around some of that, though, because the consolidation here is happening from bolt-on acquisitions, et cetera, but they're not happening, they're not IPOing. Figma was the exception yesterday, not the rule. Is that a mismatch that the market needs to pay attention to?
Look, 2025 began with the view that we would see animal spirits and M&A and IPOs pick up. Okay, then we went smack into Liberation Day and all that died, and you know, people stopped doing deals, or at least they postponed them, and the markets, you know, almost went into a bear market, et cetera, as you well know. But I think more recently we are seeing some interesting IPOs certainly coming out of the tech sector, and they are trading well. I mean, I saw that one yesterday, it's kind of crazy, but and we are seeing a pickup in M&A. So we think what's happened is these are deals that had already been in the pipeline, paused because of April and the uncertainty in markets, and just right back on again. Now, look, M&A is typically good for the market. You're paying a premium for a company. You're consolidating an industry.
Yeah.
You give a company the ability to think about how can I save costs through integration, become a more dominant player, maybe pricing power. So M&A is no bad thing for industries. It does remove more stocks from the market, and I think one of the things that we feel strongly about at Alti Tiedemann is that we have both public and private markets. Remember, you know, the U.S. market is, what, 4,000 if you look at, you know, small, mid-cap, large-cap. Right, it used to be 10,000. So, you know, private markets are really interesting for us as well. So we're not just in the public markets, which obviously are more concentrated.
Nancy, great to see you. Thanks for stopping by. Very nice to see you.
My pleasure. Yeah.
Nancy Kirk, CIO at Alti Tiedemann Global, joining us on these markets. Let's talk more about the moves that we're seeing. Certainly the pharma sector, Swiss are closed. I've got that point now. The Swiss market is closed, but there are pharma stocks trading elsewhere. So let's start off there. Chloe, what you got?
Good morning. Yeah, let's start with the big story of the day. So Trump sending those letters to drug makers and asking them to lower drug prices. That has having quite a bit of impact, actually, on the pharmaceutical sector across Europe. We've got AstraZeneca, GSK, Novo and Sanofi down. Novo Nordisk taking the biggest beating there, almost down 4%. Moving on to IAG. So IAG is the parent company of British Airways, and it reported earnings that were quite positive. So sales and profit beat estimates this morning. It is up 2%. It did note that it was cutting its forecast for capacity growth due to engine issues and also air traffic control strikes. But overall, it seems the market is focusing on those earnings, those positive earnings. Moving on to another earnings story with Campari, the drinks company is up almost 9% this morning. Its profit also beat estimates, and analysts said that increasing marketing spend was kind of a proof that it was very positive about the third quarter. And then finally, another positive stock this morning is Melrose. So Melrose makes components for civil and military aircraft, and it reported positive earnings this morning as well. It is up almost 8%. It's seeing really growing momentum with that defense space. So we've got shares up 7.3% at the moment with Melrose.
All right, Chloe Melly from our equities team, we thank you so much walking us through some of those early movers as well. Coming up on the program, we're going to go right back into the earnings story. Of course, that's going to be a crucial one. IAG cutting its projection for capacity growth this year, citing challenges around aircraft engine reliability, as well as air traffic control issues. We dig into the earnings from the British Airways parent company next. Stick with us. This is Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news wherever and whenever it happens. I'm Anne-Marie Hordern in Alberta, Canada, and this is Bloomberg.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
All right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talk with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Ottawa, Canada, and this is Bloomberg.
Welcome back. You're watching the opening trade. We are, let's call it 18 minutes into the market session. And as you can see, we have a fairly negative story on our hands this morning. We certainly saw a rollover in the stock story yesterday, particularly in the United States as we came towards the back end of the session. That's now being replicated here in Europe. There's obviously some big macro events coming up, the main one being non-farm payrolls. That will drop a little bit later on. We've got plenty of other things we need to be focusing on as well. It's the 1st of August, so you want to bear that in mind too. But we do have some earnings that I think are probably worth spending a little bit of time talking about. IAG, owner of British Airways, Iberia, etc., out with numbers this morning. And as you can see, the stock is a little higher. This as it reported revenue for the second quarter that beat estimates, but the company has cut back on its projection for capacity growth for this year. Let's talk to Bloomberg's managing editor for space and aviation, Benedict Campbell. Benny, what are they saying about the demand story? Because everybody's watching this very carefully, particularly on the North Atlantic.
Well, that story looks intact, and that's something that we've really heard from a number of airlines this week. IAG is the last one to report. We heard from Lufthansa, we heard from Air France earlier this week, and the overall message is that right now things are actually looking pretty good. People are still traveling, particularly from the US into Europe. Remember, the weak dollar is helping a lot of tourists come over here. The picture's a little bit more murky going the other way. Fewer people going to the US, particularly at the back of the plane. But if you've invested in your premium product like Air France, if you have a robust business class like IAG, like British Airways, then you're actually in a pretty good position. So that's really helping the outlook.
Benny, we also had an update from the IAG CEO saying he's still interested in TAP Portugal. What's the latest on that?
Well, there is a little bit of consolidation still going on in the European space. Not too many assets up for grabs, but TAP is one of them. That's the Portuguese carrier. The government is the owner. They want to put that up for sale. And it's an attractive asset, particularly for IAG, because they own Iberia, they own Vueling, so they could strengthen their position into the Latin American market. But they're not the only ones. Air France, KLM, they've also said they're interested, as has Lufthansa. So it'll be very interesting to see how this plays out. We know that some airlines have bought other assets. Lufthansa bought ITA in Italy. Air France just recently bought a stake in SAS in Scandinavia. So there is still some of that much overdue consolidation going on, and TAP, one of the very last remaining items.
Benny, talk to us a little bit about London Heathrow. I mean, I feel like this week we've had some issues when it's come to technical glitches, a brief grounding of flights as well, but now they're proposing a £49 billion going. Will it ever happen?
Probably you and I will never fly off that new runway. If I'm going to wager that guess. I mean, these projects, as you say, huge, 49 billion. The runway alone, just north of 20 billion. These are fiendishly complicated projects. They take much longer than anyone expects, unless you live in Qatar or Saudi Arabia, where they seem to be able to pump these out in 5 minutes. But over here, these things take longer, they're overdue, they're overcost. This is something that I've written about for the better part of 20 years. This is the latest plan. So I'm going to be a skeptic and say we'll see something happening, because Heathrow does need that extra capacity if they want to maintain their lead in Europe vis-a-vis places like Frankfurt, like Charles de Gaulle in Paris, and particularly vis-a-vis airports like Istanbul or Dubai or Doha in Qatar. But these things, as I said, will take time, and whether a government has the stomach and really the stamina to see it through over a long period of time, that's the open question.
Benny, we've seen a series of airlines out with numbers over the last few days. What is the aggregate takeaway from the European space, and fold in the US space for that matter as well? Is the consumer still spending money? Is there still demand for the travel story that has buoyed these stocks over the last few years? Is there any kind of cracks in the armor of that narrative?
If you break it down a bit, it's the affluent consumer that is spending. Those are the people at the front of the cabin, people who buy business class tickets for leisure travel, people who buy premium economy. The softness is in the back of the cabin. We heard this from the US carriers, particularly on the domestic market. That's a difficult market right now. We've also heard it over here from Lufthansa, from Air France, and so on. So front of the cabin's doing well, back of the cabin less so. Lufthansa also said that people are booking later So it's very difficult to sort of get a sense of where the demand picture is because there's just not much of a sense. People are booking late, people are booking shorter, both in terms of duration and where they're going. So there are some shifts there, but we're probably in a slightly better place now than we were a couple of months ago when there was open panic in the industry and a lot of downgrades. We're through that now, but the rest of the year, if you look closely into the releases, and IAG said something similar today, saying there are some cracks in the picture. Overall, it's looking okay, but we need to be very careful in terms of maintenance of aircraft, in terms of demand at the back of the plane. So it could really go either way, but right now, the glass is sort of half full, and if you look at how the stocks have done, that's probably the view of investors as well.
Bloomberg's managing editor of Space and Aviation, Benedict Campbell, walking us through the aviation story. We thank you so much. He, of course, will bring us those updates as we have them. Let's go from the aviation sector to the pharmaceutical sector, where companies around the world are receiving letters from President Trump about the cost of medicine. He's demanding drug makers charge the United States while other countries pay for new medicines, and has given them 60 days to comply. For more, we're joined by Sam Fazeli, who leads our research at Bloomberg Intelligence. We thank you so much, Sam, for making time for us this morning. Can you just walk us through the logic and ultimately the impact of this?
Yeah, sure. I mean, the logic is pretty straightforward. Everybody believes that the U.S. is paying so much more for medicines than the rest of the world is. And even the companies admit that. Of course, they say that a lot of this is because a lot of the innovation happens in the U.S. So we're waiting to see how the U.S. can actually implement this. And of course, we have this letter now from President Trump, which has got 4 elements in it. And you've got a couple that are pretty straightforward. First one saying, get this most favored nation pricing, which would mean much lower prices in the US, to Medicaid. We believe that's already the case. Provide direct purchasing of medicines at that price. The pharma companies have admitted that that's a good idea, and they're trying to do that. Then there's 2 elements in the middle that really surprised me, and honestly, I don't know how you can actually implement that, which are return the increased profits you get from other countries if you manage to raise your prices there to the US. Well, what's the legal basis for that? And how is that ever going to be implemented? And then, of course, the 4th element is guarantee lower prices on newly launched drugs. There's a positive there, because that means you don't have to lower the prices on the current existing drugs. So at the end of the day, what is the legality of all this? We'll have to wait and see.
Sam, the Swiss market is not open. I'm going to reiterate that, mainly for my own embarrassment. But why is Roche not on the list?
Well, I mean, I think Switzerland seems to have not done a deal with the US yet. You've seen that potential 35% tariff that's been talked about. I think that's the number that I saw. There's been so many different tariffs being announced on different countries. That doesn't seem to exclude pharmaceuticals. So maybe that's the point there, that they want to get the conversation. Okay. But Roche is also...
Sam, I'm just going to jump in. We are having some small connection issues with Sam Fazeli. We'll try and rectify that for the next conversation we have with him. Anyway, Sam Fazeli, Bloomberg Intelligence, senior pharmaceutical analyst. There's a few issues with this pharma story that comes out of the Trump administration. He tried it in the first Trump administration. Other presidents have tried it as well. This is a tough thing to do. So we'll see whether or not there's any success. Maybe when the Swiss market opens, we'll find out.
This is officially turning into a Monday story, at least for the Swiss market. But he was making the point that there is a trade deal here as well, or a trade dynamic to be keeping an eye on. Novartis, however, is on the list, and that's another major Swiss pharmaceutical. So we're going to get an angry letter from Roche after this conversation.
I can't work out. One of them reports in dollars and one of them reports in Swiss francs. I can't remember which way round.
Maybe that's the reason.
Maybe that is the reason. Anyway, we'll carry on the market coverage next. We've got a European market. It's a little softer this morning. We'll carry on the coverage of that. Ex-Switzerland. This is Bloomberg.
applications have been received positively both in Kenya and UAE, and we are optimistic that we should be able to open the office in the fourth quarter. We think the Middle East have deep capital sources. It has strong logistics for trade, and it is a strong center for investment. And we are seeing increasingly the global GDP is increasingly becoming overweight in Asia and Middle East. So that linkage with the middle income segments growing in India and China, they will provide a very strong market.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars.
Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
This is the opening trade. 30 minutes into today's session, we are seeing a sell-off on our hands. It's the first day of a new month. It is also a Friday. It is also, several markets are closed across the board. But the ones that are open, we are seeing a pain trade here, down about 1% when it comes to Stock 600. The DAX is the underperformer. Well, it kind of traded with the CAC as well, down almost 1.5% in today's session. Not exactly kicking off the new month with a bang, guy.
Absolutely not. Let's take a look at the internals, figure out what is happening here. Higher 79, lower 449. That's the story. As you can see, the market definitely weighted to the downside. Volume's actually a little bit light. Let's talk about some 52-week highs, 52-week lows, and figure out what is happening there as well. Give you some names and numbers. IAG, the airline sector, up positive this morning on the back of its numbers. It's up by nearly 2%. Erster up by 1% as well. GEA Group unchanged, but at a 52-week high. The lows are probably more the interesting story this morning in terms of the narrative that we are watching. And here, take a look. Novo Nordisk, pharma space, down by nearly 4%. That's a 52-week low for Novo Nordisk. It is rolling over. I think it's out of the top 10 in terms of the most valuable companies in Europe. I should also point out that I've resolved the Roche issue. It's Genentech. Genentech is acquired by Roche, as a result of which it is on the list and Roche is not. It is the proxy for Roche on that list coming out of the United States. But look at Sanofi. It is tracking lower as well. Zealand Pharma is tracking lower. The pharma space is seeing a series of 52-week lows today. Val, that is the narrative. That's what we're watching very carefully, even if the Swiss aren't here. What have you got?
Well, here's what else you need to know this morning. Amazon shares tumbled in extended trading after it said operating income will be weaker than expected. The company has invested huge amounts in AI infrastructure, and although second quarter revenue jumped 13%, it trailed sales growth by its cloud rivals. On the flip side, Apple shares jumped in late trade after the iPhone maker beat expectations on a number of key metrics, including its closely watched iPhone and China sales. President Donald Trump unveiled a slew of new tariffs that boosted the average U.S. rate on goods from across the world, forging ahead with its turbulent efforts to reshape international commerce. According to Bloomberg Economics, the average U.S. tariff rate will rise to 15.2% if rates are implemented as announced, up from 13.3% earlier. And lastly, shares of Daimler Truck are falling this morning after the company lowered its outlook for the year, pointing to weaker sales in North America, where tariff-related uncertainty is causing buyers to postpone orders for new trucks. Guy?
Valerie, thank you very much indeed. You've got a market this morning that I think has been driven over the last few days by the earnings story, and I'm wondering kind of how we fold all of this in this morning. Is what we're seeing today is there any earnings in there this morning? It doesn't feel like it. This doesn't feel like it's an earnings-driven market for the first time this week. And I'm wondering ultimately kind of where we go with that. Is it a tariff story? And if we're back to tariffs, kind of how do we price that in, considering the lack of uncertainty? We thought we had certainty, but in reality, actually, I'm not sure there is the certainty. It doesn't feel like it's black and white on the certainty story this morning. And then you've got all of the macro data to fold in as well, which I think is equally as confusing. So what is the narrative this morning? Is there a narrative? Is there an overriding narrative that we need to think about?
I think it's officially summertime. It's August 1st.
I'm up for that.
It's a Friday.
Yeah.
You're off next week.
The Swiss are off.
Yeah, the Swiss are off. Guy's going to join them in the Alps. But I genuinely think that's what it is, because I think we're now waiting here for margin compression, earnings, and the kind of tariff numbers that we've seen from Ford, that we're seeing from Mercedes, from BMW, from all of these kind of concrete numbers that are coming from the companies themselves that have hesitated to give us that clarity because I don't think they had it, frankly. I think that's where it comes from. So now it is a more quantitative operation.
Well, look, now we got the tariffs. Now we sit here, on our hands waiting for it to show up in the economic data.
Yeah.
And whether it ever actually does, if you want to take the bullish case, or whether we see it today in non-farm payrolls, whether we see a drop in the participation rate, a shoot up in the unemployment rate, that would be a first hint that maybe tariffs are starting to impact margins and these companies are starting to lay off workers.
Yeah, it feels early for that. That certainly wouldn't tie up with what we've seen in terms of the narrative coming out of the corporate reporting season. But I think, to your point, I think it's going to take a little while for a little bit of clarity to resolve itself, to present itself. Let's talk about kind of where we are. Have we got some more certainty? Do we know where we are? Ali Radisson, Director of SEC Newgate and former advisor to UK Business and the Business and UK Trade Secretary, joining us now on the line. Ali, thanks first of all for getting up early for us. Secondly, we're here. It's the 1st of August. How much clarity do we have? Do we have significantly more certainty than we had yesterday? How much certainty do we have as to what the tariff picture actually now looks like?
Morning. I think we have clarity about where things might go, but not when it's exactly going to happen. And that's what we keep seeing, is sort of things being kicked down, the can being kicked down the road effectively, because we have sort of some top line numbers about where sort of countries' upper baseline rates will be. But we also now have another sort of 6 to 7 day extension for Mexico. It's up to 90 days. And basically, I think what Donald Trump has sort of, some might say he's given some time to sort of adjust to the new upper sort of tariff sort of ceilings. But ultimately, actually, it's more about possibly giving some extra time for countries to negotiate sort of concessions. And B, for some of those countries that he's announced deals with in the last sort of couple of days, we have a few headline commitments, but it's basically, here's a baseline rate, and we might get some more exemptions as we carry on negotiating. So the picture is still pretty varied all around.
The question we're trying to now answer is how long does this take to show up in the data? Is it showing up in the data? What evidence are you seeing that this is having an effect?
I don't think we're seeing a huge impact yet, because so many businesses are trying to figure out how long they can wait to make sort of absolutely big decisions effectively. And so you're seeing a sort of the staggered impact, or the staggered nature of the tariffs themselves is having a staggered response from companies ultimately. I think where you're starting to see it bite is probably not so drastically, but also, I think we're in this sort of picture increasingly of stagflation, where it's not showing up in the inflation numbers yet, but the economy is not taking off either, because you've got all this sort of uncertainty leading to paused investment decisions, paused hiring decisions, paused decisions on wages. So you've got this sort of a middle of the road approach to, we're not going to react just yet because we want to see what the final outcome is. And by the way, can we negotiate some further exemptions on a sort of sector by sector basis?
Ali, given your former position as advisor on trade, is there other ways outside of tariffs that maybe Trump could use in order to, claim success on this manufacturing renaissance that he wants? Are we being a bit naive that thinking that perhaps his trade policy is done because his tariff policy is mostly set?
Yeah, I mean, that's an interesting question. If you look at the White House kind of websites, they love to publish headline stories about kind of investment decisions, a lot of which actually are probably already happening. But certainly he's sort of trying to claim credit for any kind of announcements about sort of onshoring, reshoring. There's the big question mark around kind of his regulatory policy. So his argument, in addition to the one big beautiful bill that was sort of passed recently, which the tariff is trying to offset because there's a huge amount of spending in that legislation, is he's trying doing loads of executive orders around kind of deregulation to sort of say, listen, it's not just about increasing tariff revenue in terms of impacting business. We're trying to deregulate to get the economy moving again as well.
Ali, you mentioned tariff revenue there. We just had a guest on the show saying that what she's penciling in for an annualized tariff revenue is around $300 billion. Is that similar to where you stand?
Yeah, it's certainly similar to the numbers that you hear the Commerce Secretary, sort of Howard Lutnick, talking about, although I'm curious to see the actual numbers, not just the declarations in terms of what's coming in. Now, keep in mind, there is a possibility that some, if not a lot of that tariff revenue actually gets sort of paused and not potentially rebated, because there is a court case that is pending. We had hearings yesterday here in Washington, which basically says that all the countries, President Trump's country-by-country tariffs, the legal basis for that is unconstitutional. And then effectively, if it may go to the Supreme Court, but if basically the appeals and or the Supreme Court upholds that, a lot of that tariff revenue gets rebated. So I think the picture is pretty muddy at the moment.
Well, Ali, it's Crady in London. Walk us through the timeline of that. Court cases aren't famously exactly speedy ventures. What kind of timeline for our financial audience can we expect in terms of clarity on that front?
Yeah, so ultimately, initially, this was a ruling from the International sort of Trade Court that effectively in New York, that basically said the legal basis that Trump has used is unconstitutional. That was then immediately paused on appeal, and it's gone to the Court of Appeals. Now, I think we're probably talking, even though it's doing it on an expedited basis, 1 to 2 months. And so there's some people that say, well, maybe that's why some countries, like, for example, India, have not given out because they're waiting to see if some of it gets paused. I think we're talking about if it goes all the way to the Supreme Court, keep in mind that I'm sure that President Trump has other legal basis in his arsenal to use, but we're potentially talking about, let's say, up to about sort of 60 to sort of 70 days.
Ali, talk to us a little bit about the rate here, because I think there's a background concern. It's not consensus at all, but there is a question here about whether Donald Trump changes his mind over the remainder of his term at some point with some of these rates. Yes, we're at 15% right now, broadly speaking, with some of the major partners, but at one point we were at 70%, 50%, even 30% for some of their partners. What is a cost-prohibitive rate in the tariff universe?
I think, the differential going up for baseline tariffs for a lot of trading partners, the EU, Japan, South Korea, from 10 to 15% is probably still just about manageable in terms of absorbing it and maybe sort of passing some of those costs on to consumers. But for a lot of the other sort of countries, I mean, you look at Switzerland, it's 39%. A lot of that is prohibitively expensive. Now, I think it depends on which sectors are also hit on top of that. And what I mean by that is it's not just the baseline rate that I think that a lot of businesses are worried about. It's the sectoral layering of tariffs. So we still have, for example, tariffs on pharmaceuticals and semiconductors to come. And I think if a lot of those tariffs start to stack, you're getting up towards potentially sort of, let's say, the 30-40% sort of baseline. That starts to really have an impact in terms of particularly on large volumes of orders coming through with the U.S.
All right, Ali Redison, Director of SEC Newgate. We will leave the conversation there. We thank you so much for your time and waking up super, super early for us out of Washington, D.C. Coming up on the program, we're going to take a look at the European bank earnings this week, what they kept up with their U.S. peers, plus a court case right here in the U.K. We're going to dive into the details next. Stick with us. This is Bloomberg.
single best investment opportunity you see in the world, regardless of industry or geography. Why? And again, how are you making it available to your clients?
I think there's no question AI is going to impact everything we do. The opportunity to take great companies and use AI is going to transform. Also, the issue of jobs. What do we do with jobs? Because there's no question, you look at things that are customer service oriented, and the AI is so much more efficient. As we look at across all these different opportunities, what we really like is data centers in the U.S. And, the one thing that we know is that AI is just going to create this enormous demand for data and this even growing opportunity for cloud computing. So for us, owning data centers for 20, 30, 50 years, we're going to have a limitation on power in the U.S. There's no question over the next 20 years, the technology will change for chips. It'll become more competitive, and NVIDIA may not be the only major provider. So I think you're going to have a big technology refresh over the next 20 years. But the one thing we know is you're going to need data centers, you're going to need power, you're going to need cooling to support all this growth in the cloud. So we look at them as long-term bonds.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onim, only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
This is something that we can absorb and will absorb and is explicitly implied to our profit outlook for the rest of the year.
We welcome the agreement. We hope it's going to be in force as soon as possible. And ideally more a matter of weeks than a matter of months.
The main thing is that uncertainty tapers off. And then if it is something around these kind of levels, it should intrinsically be manageable.
This provides certainty. And actually, that's something that we value because we can plan on certainty.
Although we start to getting some agreements on tariffs, we know there's not an overwhelming support for some of these agreements, and we have to be careful to see really what's going to be the impact on the economy.
There's positives, there's more negatives. We have more certainty, for example, on automobile, a lower rate, on airplanes, which are excluded. There's still uncertainty regarding, for example, wines and spirits or pharmaceutical products.
We look at some of our clients, whether they're Western or developed economy companies or companies operating throughout the emerging markets, they're just holding off on their investments to see where's it going to come out.
Well, it's certainly more negative than the situation we had at the beginning of the year when we didn't have this issue on the table. My sense is that this is a lesser evil. We need to be in a position where 3, 5, 10 years down the road, we're in a position to strike better deals with the U.S. than the current one.
Some of the CEOs we've been talking to from across Europe speaking about the 50% trade deal struck between the EU and the US. There still seems to be a sense that has exposed Europe as being weak. And that's something that the US recognizes now. I think there was a great line I've seen in one of the pieces. It's now something that the rest of the world now recognizes. It has been a big week for earnings. We've had an awful lot coming into us this week, trying to kind of separate out what is kind of earnings story, what is a margin story, what is a trade tariff story. I think it's a really interesting exercise to go through, and we continue to do that. Leading some of that effort has been Craig Trudell, who leads our autos autos coverage, and tariffs have been a big story there. Jenny Serrain comes to us from the finance team, which she leads. This week has largely been positive for banks. Trying to kind of fit it all together and trying to get an overall picture, I think, is really hard. But having you both here on set probably gives us some great clarity. Craig, let's start with kind of the auto sector. Really confusing, I think. Like Daimler's the latest one out this morning. Daimler Trucks cutting guidance after the tariff fallout has hit its sales line. We've seen, I think, a mixed picture coming through from Europe this week and over in the United States as well, I think. Pull it all together. What do we now know? It's the 1st of August. We've got an idea of what the tariff story looks like. What does it mean for the auto sector?
Yeah, I think for Daimler Truck, the difference in how one orders trucks from this company is much different from a regular Joe sort of going into a showroom, right? What they're saying this morning is that their customers have been putting off orders. So this is something that even as we see, some potential for relief, we just heard all these CEOs talk about certainty and sort of solidifying. Okay, now we at least know what we're going to be paying.
Yeah.
This is going to sit with this company for months to come because their customers already have been waiting on that certainty, and this is going to have an effect of sort of sitting with this company for some time. I think what we saw across this sector was no one really was spared, right? I mean, even Ferrari this week, I think everybody was expecting them to sort of rise above the tariff story. Their stock got hit to the tune of like 12% yesterday. I don't think it's necessarily a tariff story there in terms of what freaked everybody out, but this has been a kind of a depressing earnings season, in short, for the auto sector.
Yeah, it's been a depressing earnings season, even for the major U.S. automakers, who in some way you could argue Trump is trying to protect with these tariffs. How do you weigh up the impact to U.S. automakers versus what we've heard recently about Trump having an eye on the EPA, the Environmental Protection Agency, who does a lot of regulation when it comes to miles per gas, and then as well as, the size of the cars that you can have on the road. Is that something that could be a possible tailwind for the auto industry after all this?
I absolutely think there's going to be real relief and it's going to be shared, right? Where you'll have the German car makers having free reign to make all those SUVs that they make down in the South and sell as many of them as they want, not have to worry about sort of offsetting some of those with more electric vehicles to please California, because to your point, it's going after the EPA rules, going after fuel economy rules, which are separate, going after California and their ability to regulate. There will be, at the same time, I do wonder how much, as you take that pressure off to improve the environmental capability of vehicles sold in the U.S., how are you now going to sort of improve the standing of the U.S. to export more vehicles as part of these trade deals and boost exports, if what you're now making is just more gas guzzlers that the rest of the world is not demanding.
And frankly can't fit on their roads,
Indeed.
As we were talking about earlier this week.
Yeah, I think parking spaces are not built for big American cars here in this country.
Craig, let's talk about two other trade deals that were still left to be figured out, Mexico and Canada. Now, a lot of this is under the USMCA, so problem solved, sort of. But the 35% rate on Canada is crucial. A 90-day extension on Mexico is crucial. Walk us through how that connects to the auto industry and what potential repercussions there are.
Yeah, I mean, we were talking this morning about, the idea that there's real irony in that, you would think that GM, Ford, and Stellantis would have, at least be on somewhat stabler footing. But GM, sort of quietly under the radar, is one of the biggest importers. Part of that is from South Korea, which there will be, 15% tariffs now on those vehicles. But these companies are hugely reliant on Canada and Mexico. It is still the case that the U.S. government, when you go into a showroom in the U.S. and go to buy a car from, say, GM, and you look at the sticker on the window that says, how much of the content in it is local, that Canada is included in domestic content. So, this is something that has been sort of taken for a given for decades, that, Canada is okay. Suddenly it's not, right? And that is proving to be hugely impactful to these companies' bottom lines, where Stellantis, GM, and Ford, they're talking about billions of dollars of earnings this year that they will not bring in because of these tariffs. And a lot of that has to do with the fact that, yes, they're bringing in some finished vehicles from Canada and Mexico, but also their parts supply chains in North America are highly interconnected.
Yeah, a fascinating one as well. Craig Trudell, we thank you so much from the auto space. Bloomberg's Jenny Serane's, of course, also here. And there's an auto connection to the banking sector that we're going to make in just a moment. But I want to kick it off with the earnings story, because we're talking about trade deals, we're talking about volatility, we're talking about uncertainty in one of Europe's key kind of industries. Walk us through how that shows up in banking. Is everyone just thriving off the chaos?
There's a little bit of that, yes. So, I mean, across the board this quarter, we saw all of these banks reporting really strong results in their trading businesses. And so that's a direct impact of, the Trump trade, really driving volatility, really driving activity. You didn't have anybody staying on the sidelines. These clients were out there wanting to get positioned, wanting to get hedged, and banks were making a lot of money off of that. But at the same time, when we came into this year, every bank CEO we talked to was really excited about the resurgence of deal activity, and this would finally be the year we saw M&A come back. And that really, we've started to see a little bit of a pickup, but that really hasn't materialized in the way that these bankers promised it would. And so I think that's where you kind of see the downside of these tariffs is, just as we heard about from the auto sector, as we heard about at the beginning of all these other CEOs saying, there's just all this uncertainty, I just need to sit and wait. That's, a banker's worst nightmare. And so they want these guys kind of getting off the sidelines, getting back in the deal arena. And they're still very hopeful that that could turn around in the second half of this year and really, bring their investment bankers some good Christmas joy. So we'll see.
Christmas seems like a very long way away. Let's not get ahead of ourselves here too much. After the market closed today, we get this court ruling out of the UK Supreme Court relating to auto finance. Takes us back into Craig's world. We've talked to a series of banks this week, and they're all kind of just on tenterhooks waiting to see what the result is. What are we anticipating here? How significant could this be? What's the market saying about what the likely outcome of this is going to be?
So I think, folks really don't know. So it's up to these judges. And so at the end of today, yes, we will hear if these UK banks are all on the hook or if they're not. There's lots of different estimates rolling out there. The banks so far have set aside about £2 billion. But there's a lot of estimates that say it could be a lot bigger than that. And so after today, once we know the ruling, whether or not the judges rule in favor of the lenders or in favor of the consumer, we'll know if they have to set aside even more.
This is about mis-selling of auto finance.
Yes, that's exactly right. So for years and years here in the UK, whenever you bought a loan, there was a good chance that you were also paying a commission that often wasn't disclosed to consumers. And so that's what the judges are basically deciding was whether or not that was, in the letter of the law, essentially. And so if they decide no, it wasn't, then these banks will be on the hook for many billions of dollars more. And if they decide in favor of the lenders, I think we'll see some pretty solid movement out of these bank stocks on Monday.
And we'll get that Monday morning.
Yeah, so I think the stocks will largely move on Monday morning.
Jenny, great stuff. Thank you very much indeed. Craig, great stuff. Thank you very much indeed. Jenny Serene, Craig Shadell. Thank you. The autos and the banking sector. And we merged the two right there at the end, Val.
Well, let's look forward about what we have. There's still a lot of data points to come today. Even in Europe, we have Eurozone CPI at 10 a.m. And then the focus does shift to non-farm payrolls at 1:30. Consensus estimate is sitting at 104K with the unemployment rate to tick up to 4.2%. We also have ISM manufacturing at 3 p.m. And then lastly, consumer sentiment out of the UMich with some attention on the inflation expectations readings from that.
So also, earnings, I'm not going to be here next week, but I'm told that earnings are going to be a big feature of the landscape next week. So it continues. We're not quite through it yet. There are a few, actually, Jenny's still here, so we should probably ask her about this too. Commerzbank is out with numbers next week. What are we looking for there?
I think, the big thing we always want to know about with Commerzbank is how they feel about M&A.
Yeah. UniCredit more specifically.
Yes, and how they're, positioning themselves to maybe defend against that, or are they softening to that idea at all?
Okay, well, I think we're going to talk to the CEO next week, so we'll find out more about that. But we're almost done. The weekend is almost upon us. The Swiss are already on holiday. I'm going to bring that up again because, obviously, I feel I should. The Weekender, though, is here. A Superman movie. Who's going to see that? Anybody going to see that? Formula One Grand Prix. That's Craig's world. I think he's going to be watching that. Sure. Yeah.
And the last Oasis show in London.
Is it?
Yeah.
Hey, they're quite good.
They're on tour for a while, but, the London fanfare might be coming to an end.
Okay. And then there's the Lions game, 11 o'clock Saturday morning. We've already won the series, but I'm going to be watching that first thing on Saturday morning. We're going to be getting up early, making sure that we're there. So that's my weekend pretty much.
I feel like the Superman movie isn't getting enough love, to be completely honest.
Are you going to go?
No, but that's not a Superman thing. That's a movie theater thing,
audience, isn't it?
I guess. I don't know. Isn't Hollywood global? Who knows?
Yeah, I feel like I've watched over the course of my life. I feel like I've watched many Superman movies.
Been too many.
You can never have enough.
And that's.
I'll go back to the cartoons instead. Right?
Okay, fine. We'll focus on Oasis. Anyway, the Bloomberg Weekend newsletter will be out. You can catch that as well. Enjoy the weekend, folks. This is Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything.
Okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
Tariff Day. President Trump sets a 10% minimum global rate and outsized levies on Canada and Switzerland. Mexico gets a 90-day reprieve. Well, Trump's tariffs extend a global stock sell-off into a 6-day as the narrative shifts away from earnings. Plus, big tech divergence while Apple reports its fastest quarterly revenue growth in more than 3 years, but there's a cloud over Amazon. Now, of course, the picture is, well, we look at what the markets are saying, and there's a little bit of concern on what all of these tariffs mean longer term. Now, there's been this global stock sell-off extending into the 6 days. It's actually the longest losing streak since September 2023. Again, President Trump once again boosting tariffs for imports across the world. Now, we'll, of course, delve into exactly what this means. There is growing concern, I would say, in the markets that the levies could weigh on economic growth, but also fuel inflation, and that's starting to overshadow some of the optimism that we saw from AI-driven stocks that's really buoyed some of the mega-cap technology stocks. And then the other story we're watching out for is, of course, the Swiss franc edging lower after Trump slapped a 39% levy on the country's exports to the U.S. The picture in Europe is one of caution, extreme caution for the moment, with the CAC 40 and the DAX down some 1.5%. Apple reporting its fastest quarterly revenue growth in more than 3 years. Meanwhile, Amazon projected weaker than expected operating income. You can see Amazon down 7.4% pre-market. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, President Trump's tariff day has finally arrived. The U.S. president has set a minimum 10% levy on global imports, at least 15% on countries with trade surpluses with the U.S. The higher rates will come into effect on August the 7th. Now, Trump's efforts to reshape global trade have overshadowed big tech earnings. More on Apple and Amazon a little bit later with our Amy Thompson. But ahead of today's tariff deadline, agreements were definitely reached with a handful of trading partners, including the UK and the EU. Canada has had its rates increased from 25 to 35%. Switzerland has been slapped with 39%. So we're still waiting to hear whether the 90-day truce with China will be extended. Mexico Ohio has been given a further 90 days to negotiate. So let's bring in our expert panel. Michael Metcalf, head of macro strategy at State Street Global Markets, our trade czar, Brendan Murray, and then in a second, we'll get to Amy also to talk about some of the tech stocks. Brendan, I mean, it's just hard to keep up, right? If you break it down in terms of countries, it's a little bit more belligerent maybe than we thought it would. But then industries, a lot of questions marks on pharma and the like.
Yeah, exactly. So the big word that we've heard over the past couple of months from companies to politicians to basically everybody who's watching these markets is uncertainty. And I'm not sure that we got any more certainty today. We have this multi-tiered tariff system that's going to be put into effect next week. So there's a bit more time there. So the shocker from Switzerland, they're going to have to go back and negotiate that down over the next 7 days, or it's going to really hurt them. India is also coming out one of the big losers in this so far, but that just suggests that there's more negotiating to do, more uncertainty, and more leverage that Donald Trump is trying to apply to these big economies.
Michael, there's an assumption that actually the president wants a deal. I mean, what if we were wrong? What if actually a little bit of chaos, as long as it doesn't impact the markets, not too much, is not that bad?
Yeah, I think that explains the reaction that we've had so far today, because there was an assumption that we would get to this deadline and finally uncertainty would be lifted. Hasn't been, and of course, look, markets have been very positioned, investors have been very positioned for good news. Allocation to equities are at their highest level since the financial crisis. So there's just no room for any uncertainty to continue, and that's why we're seeing an adjustment today.
I'm surprised at how the markets have been behaving, because by and large they've ignored a lot of the uncertainty. Is it because they thought it'd be fixed, or because it's just too difficult to read because there's also then second and third round effects? Well,
I think the challenge with it's been quite binary, and it's been very changeable, and so I think you basically just trade on what you can actually see. And look, right now, if the effective tariff rate does eventually land at 15%, that's probably not as bad as it could have been, because that's the other thing as well, is that at various points in this chaos, the effective tariff rate could have been as high as 20 or 25%. So, it's a 15% tariff is bad news, but it's better than what it could have been.
Switzerland. Brendan, what's Switzerland doing?
Yeah, Switzerland thought they had a deal on President Trump's desk just a few weeks ago. It's hard to, it's perhaps the EU deal changed the dynamics there, and that looked less attractive to the U.S. after they got Brussels to agree to what they agreed to. That seems to be one of the potential reasons why that couldn't get over the finish line. But they obviously were confident that they were there, but they didn't get and they actually got a higher rate than they were originally assigned. So it's going to take some tough negotiating back in Washington for them to resolve that.
Brendan, I mean, the narrative has now shifted to the EU didn't negotiate hard enough. I mean, they didn't even bring up services, which they could have, and that would have hurt. So I don't know whether it's, the right way to negotiate with Donald Trump is to stand up and actually threaten, maybe like what Mark Carney did, or whether, the assumption of we just need to keep him calm, move it on, and then it'll settle in 2-3 years is the right way.
Yeah, exactly. I mean, I think that's one of the big lessons that we're seeing coming out of this latest stage of Trump's trade wars is that where is the retaliation? What form does it take? It's not taking the traditional kind of we'll just hit you back with the same level of tariff, but we could see it evolve into something like the code word is diversification. We'll just go do smaller trade deals with other countries and try to diversify away from the U.S. That could be one strategy we see countries sort of team up, to do trade amongst themselves if this big tariff wall is going up around the U.S. economy.
Michael, how are exporters actually dealing with this? So does it automatically, even just in the U.S., we don't know whether it hits inflation maybe more than it hits growth?
Yeah, so actually so far, I mean, I think that the tariffs we've seen so far have definitely been passed through to the U.S., but they're not having as bigger impact on consumer goods as we thought they might have done. And there's some nice papers done on the first round of tariffs, which actually suggested that much of the tariff gets absorbed by the retailer margin and doesn't get passed on as much as we think. And I think that's been borne out by the data so far.
Okay, so where do you look in the markets for it to make sense? I don't know whether it just needs to play out, whether there's a lot of data out of the U.S. today.
Yeah, well, look, I mean, the labour market obviously is going to be key for the Fed, but I think also the fact that we haven't had the pass-through on inflation so far is also really important for the Fed. And I think, actually, if that continues, which we think it might for the next couple of months, then soft labour market data really opens up the possibility for further Fed rate cuts.
So where do you see opportunities in the markets right now?
Well, so the thing that might help markets right now, actually, is the idea that if you do get bad economic data, Fed pricing is going to come in quite quickly, I think, and that will provide a support. So you know, I think there's probably opportunities at the front end of the U.S. rates market, but then also potential for weaker dollar as well.
But it has the added complication of Donald Trump, you know, going after Jay Powell every day. So I don't know whether that means that he's even more reluctant to cut rates.
Yeah, I mean, look, quite rightly, the Fed is defending their independence. But I think if you start to get soft payroll, you know, softer labour market data in payroll, because there are many other pieces of evidence that suggest the labour market is softening. It's just not there in the unemployment rate yet. If you get validation from the unemployment rate, then the Fed can quite rightly just point at the data and use that as a rationale for easing.
Brendan, I mean, could we see the U.S. being friendlier to China than Switzerland?
Yeah, that's a good question. The Secretary Bessent and Ambassador Greer came out of those talks earlier this week. I wouldn't say in a celebratory mood, but it was more kind of somber and resigned to the fact that this is the process they're going to have to go through with China now, that it's going to be regular conversations, incremental progress, that rather than, you know, kind of immediate sort of trade deals. But yeah, I think it's that's the million-dollar question is how does China play into this matrix that Trump has created, and can Trump punish allies and still get them to work with him in his efforts to you know, isolate the Chinese economy and reduce reliance on Chinese imports.
And yesterday, Brendan, I mean, you know, copper was reeling because we thought that the tariffs would be on all of the copper imports, and actually half of them were basically exempt, so we saw a massive shock move. I mean, could we see the same with certain industries?
Yeah, I mean, well, I mean, you know, they can add to those sectoral tariffs down the road if they, you know, they did what they did this week in a surprise, but they can add products onto those. The pharmaceuticals, the semiconductors, all of these other sectoral tariffs are going to start rolling in over the next week or two, and that's just going to add another layer of complexity. What was missed yesterday was the court hearing where the judges were casting doubt on the legality of Trump's reciprocal tariffs. So that's a whole nother, that throws us into a whole nother arena of uncertainty as to whether he'll even be able to use these over the long term.
Okay, thank you both for joining us. Michael Metcalf from State Street Global Markets and our Brendan Murray. Now, Apple reporting its fastest quarterly revenue growth in more than 3 years. The result, of course, topping estimates after demand picked up for the iPhone and products in China. Meanwhile, Amazon projected weaker than expected operating income. The outlook leaving investors searching for signs that the company's huge AI investments are paying off. Well, joining us now is Amy Thompson, our tech, media, and telecoms team leader for EMEA. So, Amy, as always, thank you so much for joining us. Let's start with Apple. What drove the beat?
Yeah, I mean, there were a few things. There was some tariff buying. The iPhone 16 series did better than expected, but the big surprise was China. They returned to growth in China for the first time in 7 quarters this time. And I think a lot of that was down to iPhone sales there, you know, surprisingly doing a lot better. They've been really suffering versus local competitors like Huawei the last several quarters. And the Mac lineup did really, really well. I think the Air ended up being the most popular laptop in China this time. A lot of that was driven by a subsidy program that China rolled out that basically incentivized people to trade in old electronics and get new ones, so that boosted everybody.
That's so interesting. What about, I mean, what is the state of the Amazon Web Service? I mean, again, this is the arms race, basically, for data center capacity, like the thing we all need.
Yeah, I mean, I feel really bad when this happens to companies because Amazon's AWS unit grew 17%. It hit the numbers that the street was looking for, but the whisper number was much, much higher this time. If you look at how Microsoft and Google did, they were both growing at 30+%. So that really left investors and analysts asking, you know, what gives? We're in the middle of an AI boom. compute is the most valuable resource there is, why isn't the biggest cloud provider cashing in on this more?
Do we know why?
Well, Andy Jassy said that they need to build more data centers. They can't keep up with demand. Finding enough electricity for those data centers is a problem. And he also made some comments about making it more efficient for companies to actually run these AI programs and use them.
So interesting. Amy, thank you so much, as always, for joining us. Amy Thompson, they're in charge of tech and media for EMEA. Now, coming up, Mediobanca reports higher profits as the Italian lender seeks to fend off an unwanted takeover by rival Monte dei Paschi. We'll be speaking exclusively to the Mediobanca chief executive. That's next, and this is Bloomberg.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Jemana Bersachi in Tehran, and this is Bloomberg.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question.
Great question. I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Welcome back, everyone. Now, Mediobanca reported higher profit today after setting aside less money for loans turning sour. Now, it comes as the Italian lender seeks to fend off an unwanted takeover by rival Monte dei Paschi. Well, joining us now is the Mediobanca chief executive, Alberto Nagel. Mr. Nagel, as always, thank you so much for joining us. So let's start. I mean, there's various, operations that could go on in Italian banking. You're still waiting, for example, for Generali to decide whether they'll accept your offer to swap Mediobanca's Generali stake for control of its private banking arm, Banca Generali. Have you had any interactions or any assurances from Generali that they will go for it?
Good morning, Francine. Thank you for having me in your show today. We have had a number of interaction with them. So basically, we received from them documentation regarding their existing agreement, a distribution agreement with Banca Generali. We reviewed them, and we have sent them a proposal about extending in the longer term this agreement, giving also exclusivity for our distribution network. So now we wait for their feedback, and we hope that they're going to give us a feedback within the 6th of August, so that we can call at that point, if their feedback is positive, our AGM, so to give to our shareholder the possibility to decide on this transaction. So our aim is to give to our shareholders all options that are adding long-term value to the bank. On one end, we have our 3 years plan, which is over-delivering on targets and financial performance. On the other end, we are also putting on the table this option, which is very interesting because it's going to create a clear leader in wealth management, not only in Italy, but in Europe, because combining Mediobanca and Banca Generali, we will have a clear leader at European level.
So just to be clear, you don't have any indications from Generali yet what they think about the deal?
Yes, they are working on reviewing our proposal, and we have asked them if they can give us a feedback in time so that we can call a general meeting so that our offer on Banca Generali can be on the market before the end of Monte Paschi offers. Again, in order to give to our shareholder all options to decide.
So again, you're talking about the August 6th. Is this you mentioned yesterday that you may actually, bring forward to August 21st this investor meeting that was previously delayed. Why is it so difficult to have a firm date?
Well, because we have delayed the AGM because there are shareholders of Mediobanca which are also shareholders of Generali, and they wanted to have more info and feedback from Generali about what Generali thinks about this transaction. So we took our time in order to table this offer to Generali, which we sent a couple of weeks ago, and that's why we are waiting for their response next week so that we can be on time to call an AGM by the 21st of August.
Okay, well, Alberto Nago, let's talk about the other deal that's been on offer. So Monte Paschi has basically offered to buy Mediobanca, and the chief executive was on this program a couple of weeks ago, and he said that you probably won't stay in the job. In fact, he said firmly you won't stay in the job if he's successful. What's your response to that?
My response is that my position is the least important. What we are taking care of today is the interest of the shareholder. And the transaction which is on the table from Monte Paschi has been judged by our board totally inadequate in terms of financial content and industrial content. So it's not about me, it's about the offer that we have to discuss.
And where do you think a lot of stakeholders are on that? The CEO, Mr. Lovaglio, indicated that he'll see an offer already as successful, even if he only gains about 35% of Mediobanca. What would you do if the bid only reaches that level?
Well, a threshold of 35% is not customary, and is a sign of weakness, because if you are sure to get to control, like many other bids, you put a minimum of 50+1 shares to get the control. If you put 35%, is because you want to get to de facto control of Mediobanca, which is also contrarian to the narrative of Monte Paschi, because Monte Paschi financial bid is built on use of DTA, the deferred tax asset, and this DTA, as you know, can be used only if they get to 51% of Mediobanca. So it's a bit of a contradiction between their narrative and the condition they set.
But what would you do and what can you do, again, if the bid only reaches that acceptance level?
Well, we are, as I said, delivering or over-delivering on our strategy. Our strategy is a strategy where we are focusing more and more on wealth management and IB capital light. On top, we have also worked at Banca Generali transaction. So for our shareholder, according to our view, there is no match between Mediobanca standalone plus Banca Generali and the possibility to be part of a group of Monte Paschi at 35%, which is something that you have never seen in the financial environment, where a company to do synergies, to control, has to get to 2/3 and then make a merger to extract the synergies of a transaction, which is one of the reasons why we do transaction of M&A.
How big is the probability that Monte Paschi actually gets Mediobanca at the end of the day?
Well, this is up to our shareholder. No, we are, as I said, recommended to look carefully at the content of Monte Paschi bid, because financially it is a discount to our market value. No, as Monte Paschi is half of our market cap, this transaction is construed where basically our shareholder should get 60% of the combined entity, but not pay the premium. So this is something that, honestly, a long-term shareholder of Mediobanca should not accept.
The Italian government, which is Monte Paschi's largest shareholder, has indicated support for Lovaglio's effort to buy Mediobanca. Have you had since discussions with the government?
With the government, we are interacting because every single month because of our activity and also the Golden Power procedure, which was terminated with a positive outcome for us. So the government is having a stake in Monte Paschi and is having an important representation in the bank. They wanted to create a third pole in Italy. They wanted to start with BAMI, but as you know, BAMI was then under the takeover bid of Unicredit. So they changed program, and that's why we have this offer on the table. No? For us, this does not make sense financially and industrially, but it's common that the government is intervening in banking consolidation. We have seen this in Spain. We have seen this in Germany. We are seeing it in Italy, on us, on Unicredit. So it's a new standard, and we have to be used to this and take care of this. It's something that is happening.
Do you think the Italian government has more influence actually on banking M&A than in other countries, given the example you also mentioned with Unicredit? And is that appropriate?
Well, if you see what is happening in Germany and the barrage that Unicredit is having on Commerzbank, or what is happening on BBV, on Sabadell, with then the follow-up of EU intervention to limit this influence, I won't say that in Italy we have a more important one. It's similar to other countries, and it's a new fact. I don't think that is going to help the consolidation. We are going to have a stronger banking group in Europe with this kind of intervention, but it is what it is, and we have to start from this.
How different do you think the Italian banking landscape will be in December of this year, in the next 6 months?
Well, I think that some consolidation has already taken place, and this makes sense because we have seen BPER buying Sondrio. We have seen Illimity being bought by Ifis. So more to come, even if I would say that the two leaders are big enough to abstain from doing more deal in Italy, so I think other transaction may happen I would say in the second tier. So basically the one of BPER, Monte Paschi, Mediobanca, if we can do the transaction with Banca Generali. So definitely we'll see fewer bank and more consolidation in the months to come. We need also, in doing this, to take into consideration the government intervention.
Alberto Nago, thank you so much for your time today. That was, of course, a Mediobanca chief executive talking about Italian banking and Mediobanca. Now, in other news, Kering set to award a €20 million sign-on bonus to Luca De Meo when he takes over as chief executive in mid-September. Now, the luxury company told shareholders it's compensating De Meo for giving up part of his long-term remuneration when he left his previous role as Renault chief executive. De Meo faces an uphill task to turn around Kering, which earlier this week reported another plunge in sales at Gucci as shoppers defected from its largest brand. And Bridgewater Associates founder Ray Dalio has sold the remainder of his stake in the hedge fund and left its board. Well, Bloomberg understands that Bridgewater bought the remaining shares. Separately, a source says that the Brunei Investment Agency, a sovereign wealth fund, has invested in the company, giving it nearly a 20% stake in the firm. The move by Dalio ends a leadership transition that started more than a decade ago. Coming up, much more on President Trump's tariffs barrage and what it means for Switzerland, the EU, and major corporates. That's next, and this is Bloomberg.
You've said 25% last year, I believe, of Google's code is AI generated. You have over 180,000 employees right now. Is it half that in the future?
I expect we will grow from our current engineering base even into next year, right? Because it allows us to do more, right? I think the opportunity space is also increasing. I just view this as making engineers dramatically more productive, getting a lot of the mundane aspects out of what they do, allowing them to spend on higher value-added tasks. But that means it's an accelerator. People will be able to do more, which means maybe we'll create new products, and hence we will need more people. At least in the near term, to me, it looks like we will expand engineering velocity, and that doesn't mean we're constrained in what we will do. We'll end up doing more as a company as well.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. Tariffs Day, President Trump sets a 10% minimum global rate and outsized levies on Canada and Switzerland. But Mexico gets a 90-day reprieve. Trump's tariffs will extend a global stock sell-off into a 6th day as the narrative shifts away from earnings. Plus, big tech divergence. Apple reports its fastest quarterly revenue growth in more than 3 years, but there's a cloud over Amazon. Now, earlier this week, the European Union accepted a 15% tariffs on most of its exports to the United States, including automobiles. While averting a full-blown trade war, Bloomberg Intelligence estimates that the decision could cost EU car makers 2.5 billion euros. Now, let's bring in Bloomberg Intelligence's Chief Content Officer, Tim Craighead. Tim, I'm so happy to see you because, first of all, you have some great facts, and you're blowing my mind with Switzerland and coffee, which we'll get to in a second. But from a corporate earnings perspective, what's the overall impact for Europe?
So our equity strategy team has been calculating something on the order of a 4 percentage point hit to earnings. That's the bad news. The good news, if you want to take it this way, is that if you look at the Stock 600 consensus earnings expectation, it's dropped about 5% since April 1st. A lot of that's now embedded in the numbers. And, we've got questions looking ahead of how much pre-buying was there, things along those lines. So what will be the hangover in the second half? But at least current estimates are showing down 4, 5, 6%.
So I need to ask you about, the industries, because there's a lot of question marks about pharma, maybe, wine and spirits, but you also have some great facts, the quirky, crazy stuff about tariffs.
Yeah, well, probably the quirkiest one, which we're looking for how this will feed through, is you think about coffee and consumer products. Switzerland, I was talking to Duncan Fox, our food and beverage analyst. Switzerland is the 3rd largest exporter of coffee to the U.S. They bring it in, they process it. Think Nespresso, think Starbucks. They've expanded their U.S. footprint dramatically. Now there's a 39% tariff. Now, granted, they've got a manufacturing base around the globe, including the U.S., but there is an export business there. So that's interesting.
I did not think that Switzerland was exporting so much coffee, but you're right. Well, we all drink Nespresso and the like.
Yeah. And, you think autos.
Yeah.
Volvo and Porsche are the ones that manufacture almost 100% of their product in Europe and export it to the U.S. To the degree that there's, a 15% tariff, that's not great, but it's a lot better than 25 or 30%. So they get a bonus relative to where expectations had gone. interesting to think about BMW and Mercedes. They export 185,000 SUVs from the U.S. to Europe. Maybe there's a reciprocal thing there where there's an extra bonus for them. Those things have yet to be determined, but certainly the auto industry is getting off less bad than what was expected.
So interesting. Tim, thank you so much. Tim Craighead, their Chief Content Officer at Bloomberg Intelligence. There's also a really cool thing that we have that you should check out on our Bloomberg, on the website, which is a tariff tracker. I love it because you kind of can play around with it and look at, for example, luxury or spirits and see how they get hit almost in real time. Now, some within the EU have criticized the deal with the U.S. as unbalanced. Joining us now is Elvire Fabry, Senior Research Fellow in Geopolitics of Trade at the Jacques Delors Institute. Elvire, thank you so much for being with us today. Could the EU, I mean, this is all about tactical positioning, right? It's like playing chess, but on steroids. Could the EU have negotiated a better deal? I know there's a lot of anger in certain parts in Europe that they didn't mention services. I mean, if you look at how much, services, American services, U.S. services, Europe buys, it feels like there could have been more of a negotiation.
Of course, we could have confronted much more forcefully the U.S. We have the trade instruments for that. And you have in mind that we even have the anti-coercion instrument. But the EU is in a very special position compared to all the other trade partners because we have our hands tied, because we need to keep the US support for security matters and the US support for Ukraine. So this is only an initial phase in the confrontation. We don't have to consider that this is a full deal that is settling all the new conditions for bilateral trade. We will have a second phase when we will get to talk more about the digital sector. And at least for the Europeans, it's a way to win time, to provide some clarity to the business sector, and some clarity that is quite limited because it will remain pretty unstable. So yes.
Elvire, I was going to ask you that. I mean, the concern actually with these tariffs is that, they're negotiated, but then it could change in 2-3 weeks. We saw copper yesterday. We thought it was one thing, and then actually parts of it were exempt, and so the price really dropped. Are you going to see negotiations like this or tariffs being taken off parts of either industries or specific products?
We can expect Trump to change tariffs in the coming weeks. Exactly. On the European parts, there won't be continuous negotiation because what the Commission wants is precisely to have that stability. There remain many details that need to be clarified in the negotiation, rule of origins, notably, and because the Chinese components in some exports will be more carefully looked at. But we can expect Trump to raise tariffs for any geopolitical additional reasons. So at least for the moment, we have a little more stability. We see the landscape of tariffs beyond what has been negotiated between the EU and the US, providing a more clear landscape. But we don't even know what are the rules if some countries succeed to rebalance their trade with the US. Will it mean that the tariffs will be nullified? Or they could go back to the previous situation or not. Those tariffs are there to stay for long, and they will rather continue to increase. And one question that was precisely very clear, mentioned by the previous speaker, is that we're not focusing enough on the impact that it has on all the US affiliates that are in the EU and that are relying really on. That will be strongly exposed also to those tariffs.
Yeah, Elvire, I mean, are we underestimating the second and third round effects? I know Tim Craighead, our Chief Content Officer, was talking a little bit about, for example, the fact that Switzerland, which I'd never thought about, was an exporter of coffee because of Nespresso. Are there going to be industries that will be, very hard hit without us realizing it?
Yes, because it's not only a macro analysis that we need to have. We need to have an analysis by sector, by companies, and the companies, they know pretty well what is the share of the exports to the US and how they can if they have the ability to diversify quickly or not. This impact will be very different if it's the product that they export can be substituted, or if it's the U.S. consumers. And when we talk about U.S. consumers, it's also U.S. firms really need to have access to that product. And when we get to the discussion on the pharmaceutical sector, this will be very tricky because some products will be could need to be differentiated if they really need it for the U.S. consumption.
Elvira, talk to us a little bit about what you're expecting to come out of China, but also India. You could be in a situation where China gets a better deal than actually some of the U.S. allies.
Yes, for the moment we see that Trump is very cautious with China. China had a very strong retaliation position, and in a way, Trump is facing China via a sort of proxy strategy, rather pressuring third countries, avoiding transshipment, avoiding de-dollarization. He's pressing hard on Brazil because Brazil is increasing its link with China. And Trump is rather increasing that strategy than facing really China. And we could even expect him to have to negotiate a certain deal rather similar to the one that he signed in 2020 with China, accepting some kind of investment in sectors that he doesn't care about, like the green technologies in the US, and confronting China on others. And increasing the export control requirements, not only in the U.S. markets, but also with trade partners. And that was something that was mentioned in the EU-US deal. And that continues to be clarified. It's only on the agenda. It hasn't been clearly specified.
Elvira, thanks so much for joining us. Elvira Fabry, they're a senior research fellow at the Jacques Delors Institute. Now, President Trump will impose, as we've been saying, a 39% tariff on imports from Switzerland, one of the steepest levies globally, threatening to leave the country's key exports reeling. Now, let's bring in our Western Europe economy editor, Zoe Schneeweiss, also, frankly, an expert on Switzerland. Zoe, why has Switzerland been hit so hard?
So this came as a complete surprise to the Swiss. The reason for this is Switzerland's huge surplus with the U.S. If you rank the U.S. Trade deficits with other countries, the Switzerland ranks number 12. It's at $38 billion. So that obviously is a big number, and that's mostly due to pharma. We know that pharma is one of the things that Trump targets, and Switzerland just got the short end of the stick here.
So what has been the response of the Swiss government?
The Swiss government has voiced great regret. Overall, Swiss, as we know, usually hold back quite a bit. Lobby groups have been more vocal. One lobby group described the tariff as dangerous. Another one called it arbitrary and irrational. The timing for the Swiss is very unfortunate with this August 1st. It's Swiss National Day, so really the Swiss should be out celebrating. And overall, the government, the government isn't even together today. They're off at 20 different locations giving speeches. Swiss feel very strong about that National Day. So we've got reporters all over the ground in Switzerland, and we will be keeping you updated on anything they say. But at the moment, the Swiss just have been quite restrained, and just that great regret is that big takeaway from Switzerland.
Yeah, and Zoe, I have to say, like, it's a small country with a mighty exporting power. So you have Swatch Group, you have Richemont, you have Novartis, Roche. You also have coffee. I mean, I've been told it's one of the biggest coffee producers because of an espresso, or coffee exporters because of an espresso.
Yeah, half of the money that Switzerland makes is because of exports. So, and they always describe themselves as a small, export-oriented country. So this obviously is a huge blow. What we've heard from negotiators is that they're still continuing to talk with the U.S., and obviously these tariffs only kick in on August 7th. So the Swiss, like some other countries that didn't actually get deals, will be hoping that there will be some kind of solution, and that 39% isn't the last word.
Zoe, thank you so much, as always, for your fantastic reporting with you and the team. Zoe Schneeweiss there. And the good thing is that actually every week there is a new tariff deadline. So today's August 1st, and then now we look onto August 7th. Coming up, as the EU looks to exempt possibly wines and spirits from Donald Trump's tariffs, we speak to the European Confederation of Independent Wine Growers. That's next, and this is Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
A Bank of England rate cut is back on the cards this month after a pause in June in a divided vote. And markets will be listening to Governor Andrew Bailey for clues on the path ahead as the UK economy cools and uncertainty lingers.
Interest rates are not on autopilot. They cannot be.
Tune into Bloomberg for live coverage of the BOE decision and press conference. It all starts Thursday at 12:30 p.m. on Bloomberg. Context changes everything.
This is something that we can absorb and will absorb and is explicitly implied to our profit outlook for the rest of the year.
We welcome the agreement. We hope it's going to be in force as soon as possible. And ideally more a matter of weeks than a matter of months.
The main thing is that uncertainty tapers off. And then if it is something around these kind of levels, it should intrinsically be manageable.
This provides certainty. And actually, that's something that we value because we can plan on certainty.
And although we start to getting some agreements on tariffs, we know there's not an overwhelming support for some of these agreements, and we have to be careful to see really what's going to be the impact on the economy.
There's positives, there's more negatives. We have more certainty, for example, on automobile, a lower rate, on airplanes, which are excluded. There's still uncertainty regarding, for example, wines and spirits or pharmaceutical products.
We look at some of our clients, whether they're Western or developed economy companies or companies operating throughout the emerging markets, they're just holding off on their investments to see where's it going to come out.
Well, it's certainly more negative than the situation we had at the beginning of the year when we didn't have this issue on the table. My sense is that this is a lesser evil. We need to be in a position where 3, 5, 10 years down the road, we're in a position to strike better deals with the U.S. than the current one.
Now, some of the chief executives there we've been speaking to giving their take on the EU's tariff deal with the U.S. Now, one sector that has been hit by U.S. tariffs is the European wine industry. The EU is holding talks with Washington about an exemption for wine and spirits, similar to that agreed on aircraft parts. Now, with us this morning, Samuel Mas the president of the European Confederation of Independent Wine Growers. Semyon, thank you so much for joining us. I mean, the winemaking business at the moment is really reeling. It's climate change, it's tariffs, it's healthier, reduction, I guess, in consumption. How does it survive?
Yeah, so we are facing so much differences since a very long time, and you can add also climate change, which have a huge impact on our market because of reduction of production and stuff like that. And we have to change and adapt. So currently the situation and the uncertainty with the market is, striking us a lot. And this is very bad for, I represent family-owned businesses all across Europe. And this is very bad for us, this uncertainty, and even more when you have a perennial crop like vines. That takes time. You cannot change over time, every year. So yeah, it's very hard to adapt right now and to see how we can face the reality of this uncertainty with new tariff coming up.
Yeah, what happens with the tariffs? So will they have 15%? We were expecting an exemption. Are there any conversations going on that could lead to some kind of moratorium or an exemption for wines?
So we are really looking for this exemption. What we know so far is that we are not on the top of the list for what we know, but what we expect is to get on this list to get 0% on top of what is already existing, because we already have tariff for the US exportation or importation for them. But yeah, we will get this exemption, and also what other person told before, the impact will be huge also on the US market, because the import of wine is intertwined in the US market, and this will affect also US consumer, but also US businesses.
But is there room for negotiation? And is your confederation, for example, also lobbying Brussels?
Indeed, we are very involved with the rest of the sector to try to make sure that we will be exempt. What we see so far is a response from the EU in our favor, but the problem is it's too political for us to know exactly where it will happen, and even more with the current US administration. So it's very hard to see what will happen, but we really hope that exemption will be applied to us in our sector, because this will affect a lot.
Can the wine sector actually absorb 15% tariffs? Can that extra cost be passed on?
No, we already, since the last 10% that we have for a few months now, we find an agreement with our importers to say that, okay, both of us will take a part, so 5% for the importer, 5% for us. But already, like we mentioned, we have an increase or an inflation in terms of, price of the bottle, price of the cork, price of everything. So it's very hard for us to impact our margin, and this could affect a lot of independent growers like I represent all across Europe. Like I said, it's very small scale family businesses representing a very traditional culture, I would say, in a sense, and this is affecting a lot, and this could impact a lot of young farmers starting in this business also. And yeah, this could have a huge impact, and so that's why we try to exempt and get sure that we don't get that.
Yeah, Semyon, have a lot of the wine growers that you represent, as you say, are family-owned. Have a lot of them front-loaded to actually ship to the US before the tariffs took place?
Yes, indeed. What happened in the end of 2024, because we are very close to our importers, it's something that is happening for a long time. We can easily say that, like the UK, the US market, it's a mature market in the sense that the US consumer know how to consume wine, and they really enjoy European wine, and they want to find this diversity since it's still in their table, I hope, but I think it's the case. And so that's why it's also hard for us to understand what is going on, but yeah, it's very political. And so doing that will impact that a lot. So yes, definitely.
Semyon, overall, in 3-4 years, do you think that Europe will produce less wine because there's just not enough demand? It's too costly.
Indeed, actually, there is a lot of factors involving the reduction of production. The first is, but I think it's also linked to the economy of the wine sector. As you know, and pretty well for yourself, the Bordeaux is pretty well impacted, Rhone Valley, but you have also other countries in Europe impacted. Italy and Spain also are facing difficulties in terms of economy. And you can see right now an inversion of the pyramid of the age of the producer, because they are aging a lot. And so it will be hard and harder for young farmers or other people to take over their farm and their vineyard, because it's not going to be easy for them to go back in a business that don't make any income.
Yeah. Samuel, thank you so much for all of those thoughts and for joining us this morning. Samuel Mas,
you're welcome. Thank you very much.
President of the European Confederation, thank you, of Independent Wine Growers. Now, IAG, the British Airways parent company, reported revenue for the second quarter that beat estimates. It's cut back its projected capacity growth this year, blaming problems with jet engines and air traffic control. Now, let's talk to Bloomberg's managing editor for space and aviation, Benedict Kamel. Benny, thank you for joining us. Is this a sign of robust demand for air travel?
Yes, IAG really had a good set of numbers out today, and they were the last of the big European and indeed the global airlines reporting. We heard from Air France this week, we heard from Lufthansa, we heard from the US companies last week. So overall, the picture is actually fairly positive, particularly if you look at sort of the front of the aircraft, the more expensive seats, so everything from sort of premium economy to business to first. We heard from Air France, for instance, saying that their La Première, which is their new first-class offering, that was doing very well. We've heard similar comments from Lufthansa. And then today from British Airways parent IAG, the transatlantic route is still intact. There was some concern a couple of months ago that particularly people going from Europe to the US might have second thoughts going into the US because of the cost, but also the disruption potentially at the border and so on. That doesn't appear to have played out quite as dramatically as people might have thought a couple of months ago. So right now, we're in a good place for the industry. The demand is there, and particularly the expensive seats are still selling.
So Heathrow has also, Benny, today proposed $49 billion expansion. Will it actually, sorry, £49 billion expansion. Will it ever happen?
Well, that's a very good question. These mega projects, if you think about high-speed rails, if you think about this one, the one thing that is certain is that they are always delayed, they are always over budget, and in the end, some of them happen and some of them don't. Heathrow is under considerable pressure here to upgrade its game. We only heard this week, it wasn't at Heathrow directly, but it affected them. We had an outage of the system, and there are airports around the world in the broader region. If you think about Istanbul, if you think about Doha, if you think about Dubai, far ahead in terms of what the kind of capacity they have to offer. The system, the runway, the terminal at Heathrow, all of that is aging and they have to do something about it. But this is obviously a huge amount of money, £49 billion. That's for the entire project, not just the runway. But the runway is a considerable part of that. But getting these projects through is politically very difficult. It's difficult because you have to move houses, you have to move motorways. So will it ever happen? That's a very good question. You and I probably won't see that day.
Okay, I mean, we're both planning to be here forever, but okay. Thank you so much, Benny Kamel. There were the very latest on Heathrow, our managing editor for space and aviation. Now, the Cleveland Fed President, Beth Hammack, will be on Open Interest at 2 p.m. London time. That's going to be a great conversation on inflation, growth, and, of course, all of these tariffs, especially on August 1st, the deadline for the tariffs. Tune in to that. Up next, Bloomberg Brief, and this is a Bloomberg.
Money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Why is Baltimore so important to you?
It's our state's largest city. And if your state's largest city is not thriving, your state can't thrive. And that is just a mathematical equation, because the only way this is going to be Maryland's decade is if it's Baltimore's time. And so that's why we did focus on things like being able to extend the Orioles lease and make sure the Orioles could be here for 30 years. It's the reason we focus on things like the Preakness and keeping the Preakness in Maryland for generations to come. While we've invested in the convention center, the reason we focused on housing and getting rid of the vacant housing, the reason we focused on violent crime. And now Baltimore is having amongst the most precipitous drop of anywhere in the country when it comes to homicides and non-fatal shootings and carjackings and auto thefts. So if you can have Baltimore thriving, your state is going to thrive.
So if somebody's watching this and they're not from Maryland, but they want to know a little bit about Maryland, what would you encapsulate in a paragraph or two about what people should know about the state of Maryland?
I would say Maryland really is American miniature. You tell me what you want to do. And no matter where you're standing in the state of Maryland, I can tell you where to have a world-class experience within 2 hours. We're the home of innovation. We're the home of Johns Hopkins University, the home of the NSA, the home of NIST. We have so much to offer in the state of Maryland, and I think it's one of the reasons that people are so excited about the growth trajectory we're on.
All right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
It's 5 a.m. in New York City. Good morning. I'm Danny Berger with your Bloomberg Brief. Here's what you need to know on this Friday. The new tariff list unveiled. U.S. rates on goods across the world set to rise to the highest level since the 1930s. Jobs Day in America. Traders await the data for the latest clue on where the Fed goes from here. And a mixed bag for tech. iPhone sales lead Apple to strong results, but Amazon underwhelms. So you take all of those things together, and it's a pretty negative start to the trading session for your futures this morning. We are weakening as we go on. S&P down nearly 1%, NASDAQ 100. That underperforms with, again, Amazon, some disappointment. Valerie Teitel will walk you through those individual names in a moment. We are on track for a 4th consecutive day of losses. And by the way, before we had those losses, we were hitting all-time highs. So here you go. Here's your start to August, maybe not the summer you had planned. Meanwhile, for this bond market, it was stronger data yesterday, and it is all eyes to jobs at 8:30 a.m. Eastern. We're lower by a basis point on the front end. 10-year, 30-year yield, those that'll change. Expectation for today, by the way, is 104,000 added and a 4.2% unemployment rate. Let's get you those stocks on the move this morning, including the big tech. With that is Valerie. Hey, Val.
Good morning, and Danny, happy Friday. Happy Payrolls Friday, too. Yes, let's start in big tech with Amazon out with results after the bell yesterday. Some disappointment when it comes to its guidance around the AWS, its cloud service businesses. I think this gives a good reflection, Danny, of if a company can't back up this CapEx spending with a solid core business, it seems to get punished in trade. So Amazon down some 8%. Over to Apple, it was a bit rosier picture. They beat in iPhone sales for the previous quarter and gave some solid guidance for the quarter ahead. They also had some color on their tariff costs. They noted that their current quarter tariff costs are around $1.1 billion. It seems like investors don't mind that big number. The shares of Apple are up 1.5% in pre-market trade. Lastly, let's end with Coinbase. This was another earnings report. Coinbase being the largest U.S. crypto exchange. They did see a decline in revenues disappointing estimates, and that's due to the fact that there was lower volatility volatility in crypto assets. So Coinbase down some 11%. But note, Danny, this stock has rallied over 50% to start the year. All this optimism around the deregulation in the crypto industry, a lot of optimism has been baked into this stock. Danny.
Valerie, thank you very much for that. We'll catch up with you later this hour. Also in this hour, a great show for you. We're going to talk trade with Nico Fitzroy of Signum Global Advisors. Veronica Clark of Citi will join us on the jobs report. And finally, Joel Kalina of Wedbush will join us to talk about those big tech results. But our top story this morning, President Trump sets a 10% minimum global tariff. Imports from countries with trade surpluses with the U.S. will face duties of 15% or higher. Bloomberg's Brendan Murray leads our global trade coverage. He joins us now. Brendan, I don't even know where we start. So many different figures coming out. What has been your big takeaway from the flurry of trade announcements we've had over the past 12 hours?
Yeah, it's a real patchwork of different tariffs with two real baselines, the 10% and the 15%. The 15% is going on about 65 countries that have those big trade disparities with the United States. Some of the standouts, there was a big surprise for Switzerland, a 39% tariff. India, as we've seen over recent days, is getting the 25%. Canada is getting a tariff of 35% on non-USMCA items, up from 25%. So I think what we're seeing is the president following through on some of these pledges that he made, that if you don't do a deal with us, then you're going to get you're not going to get the most favorable rate. And he's using geopolitics in this as well. There's a sense that what he's trying to accomplish with geopolitics is getting the tariff treatment more and more. So there's a lot of fine print yet to go through. The negotiations are going to continue. These tariffs don't kick in until August 7th. So there is time for countries like Taiwan that thought they were going to get a deal over the deadline day today, but they didn't. They got 20%. So there will be more tariff trade negotiations in Washington over the next week or so that will tell us a lot about how this is all going to affect the global economy.
Yeah, I think Terry Haynes put it well on your point about geopolitics, Brenton, that this isn't a trade war. It's a war that's using trade and tariffs as its tool. What does that mean for countries like India, for those like China, or even Brazil, where geopolitics or personal grievances are at play? What are the requirements that this Trump administration wants to see? What is the bar for getting a deal done?
Yeah, it's the Trump administration saying, I will hurt you economically if you don't try to meet me somewhere in the middle between issues like the Russia's war in Ukraine or the domestic political situation in Brazil that you referred to, and with China as well. There's this still outstanding deadline of August 12th where tariffs snap back to much higher rates if they don't announce an extension of that. We would expect the president would do that. He had some nice things to say about how the talks went in Stockholm earlier this week, but we still haven't seen that from the president, and that's another big cloud hanging over the trade uncertainty is what happens next with China.
Hey, Brendan, thank you very much for your coverage all this week. That is Bloomberg's Brendan Murray. Let's stay on trade. And Nico Fitzroy of Signum Global Advisors writes, framework deals like the EU, are good for markets, but leaves real economy problems for industries. I'm pleased to say that Nico joins us now. He's a senior analyst and partner at Signum. Nico, so now that we have this list of trade tariffs, can we put it all behind us and move on, or where does tension still exist?
Yeah, I think with Trump, it's never really possible to put it all behind us and move on. I think if you look firstly at the tariffs that he has outlined over the last few hours, those have been kicked down the road in terms of implementation until August 7th. So we have another week of negotiations and trying to get deals before that. But also, if you look at the deals that have been agreed in the last few weeks, there are significant areas of uncertainty within those deals. It's still not clear, for example, with the EU and South Korea around the extent of agricultural export access for U.S. exporters. If you look at the EU deal in particular, there are loads of areas that still need to be ironed out in terms of exemptions to those tariffs. And a previous deal that was agreed, the UK being an example, that took 7 weeks from the announcement of the deal till the announcement of full implementation, i.e. there was still ongoing negotiations around that for many weeks afterwards. So I think we can't put this all behind us, even though we have had announcements. The implementation of it is still down the road, and even the deals that have been made will still require negotiations for minimum a few weeks, possibly a few months in many cases.
But Nico, I love this point you make that for the markets, it's a good thing that we have these tariff rates. It's the uncertainty we've been calling about that we can finally get some of that certainty. But as you note, for businesses and for corporations, it's not that simple. From some of the clients that you've been speaking to, where do they go from here? Are they still in a moment of being frozen, trying to understand how to negotiate, or do they just push forward?
Yeah, so I think one of the key thing, I mean, markets, this is always a key thing, but also for corporates trying to make decisions around investment, the key thing really is to know exactly what the tariff level is going to be for a prolonged period of time. Without that certainty, it's really difficult to make any decisions. And so the reason it's better, I suppose, to have a 15% base tariff for some of these countries or a 10% tariff in some cases, is that you then know that's what you're looking at over at least the next few months, hopefully the next few years, and you can make decisions based around that. So that certainty is useful because it gets rid of the volatility and it gets rid of the worst case scenario, which, in the case of the EU was 30% tariffs or even 50% tariffs. So by eliminating that worst case scenario and providing certainty, it's potentially a positive. But of course, we are still looking at much, much higher tariff levels that we've had in recent years. And I think the most remarkable thing over the last 6 months is how Trump has completely transformed perceptions of what is an acceptable level of tariffs. 15% base tariffs are now the level at which countries are agreeing deals with the US. If he'd said that 6 months ago, that would have seemed like a worst case scenario. That's now in many cases seen as a best case scenario because the alternative is 30%, 40%, whatever, much higher. So yes, I mean, certainty is good, clarity is good, but undoubtedly the real economy in many cases is going to suffer as a result.
It's such an excellent point that we were all anchored to a much higher level of tariffs, Nico. But some of the randomness of what we got yesterday, I think has struck people, specifically for places like Switzerland, where no reason is given for 39% tariff. What did you make of that?
So I think there were a few countries like India and Switzerland that over the last few months there had been hopes from the US side, I think in particular, of getting a deal over the line. I think what Trump has often done is threaten much higher tariffs in order to try and extract concessions when a deal is potentially close to completion. So I think in terms of Switzerland and India would be another example, I think Trump is probably still hoping for a deal and he's probably still hoping to extract concessions. And the reading of that may be that's why he's threatened these higher tariffs against some of these countries, rather than he wants to see Switzerland hit with a massive tariff permanently over the rest of his term, say.
Well, Switzerland's certainly hoping for a deal as well. Nico, so wonderful to catch up with you. That is Nico Fitzroy of Signum Global Advisors. A masterclass as always. Now let's get you some other top stories that are trending on the terminal this morning. Goldman Sachs credit strategists are urging clients to hedge risks. The yield premium on global investment grade notes have tightened to their lowest since July 2007. Goldman economists still expect the Fed to cut interest rates by 25 basis points in September, October, and December. Bridgewater founder Ray Dalio has sold the remainder of his stake in the hedge fund and left its board. A Bloomberg source says that Bridgewater bought the remaining shares. The source also said that Brunei Investment Agency, a sovereign wealth fund, invested in the company, giving it a nearly 20% stake in the firm. And TSMC's stock is reigniting concerns about the euphoria surrounding AI that it may be overheating. The price gap between the firm's ADRs and its Taiwan-listed shares surged to its widest level in more than 16 years. The ADRs trade at a premium due to not being included in the U.S. indexes, but are not usually at this wide of a gap. Coming up, President Trump demands that drug makers slash their U.S. prices. That sends shockwaves through the pharma industry. We'll have more on that next.
to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
This is your Bloomberg Brief. I'm Danny Berger in New York. European pharma stocks are taking a hit this morning. Drug makers have received letters from President Trump demanding that they will charge the U.S. what other countries pay for new medicines. U.S. drug makers also falling in the trade. For more, we are joined by Bloomberg health reporter Ashley Furlong. Ashley, what does this all mean? What does the Trump administration want from this industry?
So Trump wants what he's long been calling for, which is lower US drug prices. And the rest of the world does pay much less for their drugs. And Trump wants to peg US prices to those prices. How he's actually planning on doing that is initially through Medicaid, and then he wants to move that to all new drugs that are launched on the US market, Medicare, Medicaid, and through insurance-based systems. So that would be pretty significant for the industry, and we have seen the stocks down this morning in Europe. But what's also quite interesting is that the hit hasn't been potentially as significant as we might have expected in terms of those shares being hit.
Well, I was going to ask about that in specific, Ashley. How much of this, because I'm looking at some of the U.S. drug makers, they're down, but not hugely, down 0.5% for Eli Lilly, Pfizer down just more than 0.5%. How much of the reaction, what we're seeing, is the tariffs being implemented on Switzerland, and that also a method for really damaging some of these drug makers and trying to get them to the negotiating table?
Exactly. There's a lot of questions about whether this is just about getting drug makers to the negotiating table, and potentially if this is also about pushing European countries to lower their drug prices. And what's also on the table is whether drug makers will take the government to court around this. So previously, during Trump's last term, he proposed something very similar, and that was blocked by the courts. So there is a question around whether this actually might even be able to be implemented, or whether this is a threat to sort of extract further concessions from the industry.
What does that mean in terms for drug prices in Europe if something like this does go through?
So the expectation is that drug prices might increase in Europe, and they are low across the region, and that would be significant for health budgets, which don't actually spend that much on medicines comparatively to the US. But it would also come up with a lot of pressure from European governments who say that they can't spend more on medicines at the moment. So there's a lot of questions about whether that actually will happen, and whether Trump will be able to push drug makers to extract those concessions from European governments.
All right, Ashley, thank you very much for that latest. That is Bloomberg health reporter Ashley Furlong. And we are wrapping up a big week in tech earnings. Shares of Apple are higher in the pre-market this morning by 1.75%. It reported its fastest quarterly revenue growth in more than 3 years. CEO Tim Cook spoke on the earnings call saying, quote, "We saw an acceleration of growth around the world in the vast majority of markets we track, including Greater China and many emerging markets." Joining us to break down those earnings is Valerie Titel. Val, what was the takeaway from Apple?
Look, a beat for their iPhone revenue coming in strong, not just in the U.S., but also in China. They also gave some positive guidance, Danny, for the current quarter, which seemed to have been cheered by investors. Now, most people were looking at Apple as maybe a sign that tech is in some way being hit by tariffs. We did hear from the CEO that they expect the current quarter tariff bill to reach $1.1 billion. But they did try to convince investors that their beat in iPhone sales wasn't just driven by pull forward by those customers trying to front run tariffs. They did give a number. They estimated that around 10% of their iPhone sales revenue for the previous quarter came from that front running of tariffs. It looks like from the market reaction, the market is pretty happy with what it heard from Tim Cook and the bottom line of these results today.
Yeah, again, Tim Cook saying only 1 percentage point of that 10% overall growth coming from the pull forward. So that was Apple. Investors cheering that. Amazon, a different story, Valerie.
A different story for Amazon. They, in some way, started to spook investors' fears that maybe this CapEx spending on AI isn't paying off or isn't paying off as quickly as they would like. When it came to their Amazon Web Services, this is their cloud business, they did not give very decent guidance in the previous quarter. Revenue from the cloud business also was not as strong as expected. Now, Danny, this might be kind of a tale or a tell for those other firms, other Mag 7s who are really investing heavily in AI. If they don't show current investors that that's having already an impact of their bottom line, it's something the stock could be punished for. And that's what we're seeing with Amazon today. Now, note that their cloud business, it does trail behind Google's cloud business and Microsoft's cloud business. But I think the fear is now that they're losing their footing in that very competitive market.
Valerie, thank you so much for that. Bloomberg's Valerie Teitel. Coming up, President Trump's tariff blitz. We're going to have more on that and what else are making headlines this morning. We're going to break down your front page news this morning as U.S. futures fall nearly 1% after that tariff list, after some of the disappointment from Amazon earnings. This is Bloomberg.
With the new world reorder, it means that there will be regional clusters of excellence. It will be regional clusters of great companies. And so it's okay to be number 2, because you could be number 2 in every single region and still command that premium. Because today we talk about AI, we talk about data, we talk about processes that's going to be very specific to industries, specific to countries, specific to regional challenges that needs to be built and addressed. And therefore, the good of it is that now it's not just going for that one company and overpaying for that company until the returns goes to zero. It's actually about finding regional champions, which could also be huge category leaders for us as funds as well. And I think it's actually good for the world to have multiple pots of excellence that can be localized to its own needs.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onim, only on Bloomberg.
Right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talk with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
Earnings season is here.
The earnings are front and center. The slew of results already out.
Are tariffs going to eat into margins?
Bloomberg is first to break the numbers.
JP Morgan, Citi, Wells Fargo, Bank of America, Goldman, Morgan Stanley.
I'm getting my spreadsheets ready.
With the smartest insights.
It's going to be a can-kicking situation.
Expectations are relatively low.
The market is looking for confirmation of that growth narrative.
Continuing coverage on Bloomberg. Context changes everything. It's Jobs Day, and Bloomberg has the report under surveillance.
It is definitely a stagnant market.
Everybody's looking for a slowdown in job creation.
You're seeing a tightening in parts of the labor market.
Today, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
Jobless claims have just hung in there.
This is a hot report. It's definitely going to be taken with notice and optimism from this administration.
The July Jobs Report, today on Bloomberg.
You're watching Bloomberg Brief. I'm Danny Berger in New York. Let's take a look at the front pages this morning and what is making headlines across the top papers. And I should say, basically everybody on their front page is running with the new tariffs. With Donald Trump, the president, announcing a new slew of rates, the baseline rate will remain unchanged at 10%. Countries with trade surpluses with the U.S. will get 15%. Tariffs on Canada will be increased to 35%, but there are USMCA exempt goods. But Mexico gets a 90-day reprieve. China also gets that reprieve as well. Next up on the Wall Street Journal, big tech's AI spending spree. Google, Microsoft, Amazon, and Meta are all set to spend nearly $400 billion this year on capital expenditures. Morgan Stanley projects $2.9 trillion in spending over the next 3 years on chips, servers, and data centers. On the other end, nearly 100,000 workers at the companies have been laid off since 2022. And on the Washington Post, an exclusive on the Smithsonian's Natural Museum of American History to removing references to President Trump's 2 impeachments from an exhibit display. A temporary label including content about Trump's impeachment had been on display since September of 2021. Now the exhibit notes only 3 presidents have seriously faced removals. All right, let's get a look at currency markets this morning because there is an impact from what we saw of a 39% tariff on Switzerland. You can't see it now, but the Swissy, if we can pull that up, the Swissy is weaker by about 0.5% versus the dollar. It's notable because usually that is a currency which is seen as a haven in times of stress. That's not what's happening. Instead, you are seeing a dollar which continues to rise. This morning, the dollar, Bloomberg dollar spot, is up by 0.2%. Is it a reemergence of the exceptionalism, of U.S. exceptionalism? We are on track to see the strongest week for the dollar since September of 2022. It's a revival that's also accompanied new highs in equity markets, although that has taken a breather. Okay, coming up, economists forecast 104,000 jobs were added in the U.S. in July. Citi's Veronica Clark will be joining us next. This is Bloomberg.
cidade estava sitiada.
Nisso eu começo, eu tremia, não sabia o que fazer.
Foi a mais terrível que eu passei na minha vida.
Eu temo, né, que o Brasil se torne, num futuro próximo, um narco-estado.
Porque no final, tudo é dinheiro.
People back home there, they are suffering. And someone is driving a Range Rover with their money.
Where is my money?
I think she's a scam up to now.
It's some of the world's most desperate people who are getting ripped off.
Repeat after me. I am a winner.
I didn't know how big it was. I didn't really understand what I was getting myself into.
If you tell me you have a vision of being $1 billion business, then you're going to have to do what it takes. And if you're not going to do that, everybody's going to suffer.
Una batalla a muerte.
Money can do a lot of good. It can really transform people's lives, but it can also hurt them.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
It's 5:30 a.m. in New York City. Good morning. I'm Danny Berger with your Bloomberg Brief. Here's what you need to know on this Friday. The new tariff list unveiled. U.S. rates on goods across the world are set to rise to the highest level since the 1930s. It's Jobs Day in America. Traders await the latest data for clues on where the Fed goes from here. And a mixed bag for tech. iPhone sales lead Apple to strong results, but Amazon underwhelms. Well, here is your start to August, probably not the one you were hoping for. We're on the lows of the future session this morning, down by 1% for the S&P. The NASDAQ goes down to 1.1%. We have seen stocks hit all-time highs this week, only to now track for a fourth consecutive day of losses. The S&P also ended the day negative yesterday. Mixed results from both Apple and Amazon. Apple does better pre-market, Amazon does worse. Yields yesterday were higher after another round of stronger data, but payrolls will dominate the narrative today. 104,000 is what we're expecting, a 4.2% unemployment rate. Mike McKee will break that down in just a moment. But first, let's look at some of the stocks moving underneath the surface. Here with that is Valerie Teitel. Hey, Val.
Good morning, Danny. Let's start there in the big tech. As you were mentioning, disappointment for Amazon. Those shares are down nearly 8% in pre-market trade with some weak guidance when it came to revenue numbers for their Amazon Web Services. That's their cloud business. Now, how that stacks up with the beat that we heard from Alphabet on their cloud business and the beat from Microsoft is starting to spook investors. Why Amazon isn't seeing that kind of growth, even though you could argue they are investing and spending just as much as the other Mag 7. Let's stay in Mag 7, move on to Apple. A bit more of a positive picture here, Danny, with the beat in iPhone sales coming in strong in North America and in China. We're seeing Apple rise 2% so far in pre-market trade. Also some language when it comes to their tariff impact, their current quarter tariff impact. They're guiding at $1.1 billion. It seems investors are not spooked by that big number this morning. Apple shares in the green. Lastly, I want to head over to Europe. We did have quite decent declines in U.S. pharma stocks yesterday on the back of Trump threatening or at least pressuring these companies to lower drug prices in the U.S. We have seen many of the European drug makers in the red. The big one, AstraZeneca, down 3.3%. Novo Nordisk down also more than 4%. Now note that, Danny, these threats do come alongside the sector waiting for these sectoral tariffs on pharmaceuticals. So not only do we have the tariff threat, but we have the U.S. president pressuring these companies to lower prices, which is seen as not good for these companies' valuations. Danny.
Valerie, thank you very much for that roundup. Valerie Teitel. Now let's get back to our top story. President Trump sets a 10% minimum global tariff. Imports from countries with trade surpluses, meanwhile, in the U.S. will face duties of 15% or higher. Joining us now is Bloomberg's D.C. breaking news editor, Kasia Klimanshitska. And Kasia, a lot to sort through. What is the takeaway from the past 12 hours?
Good morning. Indeed, Danny, a massive announcement from the White House yesterday, just hours before this deadline that President Trump set. And he said, indeed, the lowest possible tariff is 10%, mostly for the countries that sell to the U.S., less than they buy from the U.S. Now, for other countries, it is 15% or even more. For example, for Switzerland, for Swiss watches, Swiss chocolate, it will be a 39% tariff. For countries that were in talks with the U.S. or managed to strike a deal, like Japan, the European Union, South Korea, is 15%. Most of those tariffs will kick in on August 7th. But President Trump also said that more announcements are coming, announcements on specific sectors, for example, semiconductors or chips, pharmaceuticals, lumber, and other products. So perhaps more to come, and tariffs are already up.
Kasia, thank you very much. Bloomberg's Kasia Klimanshinska. Now, along with today being the tariff deadline, it's also a big day for data. It is July's job report that comes at 8:30 a.m. New York time. Economists are forecasting 104,000 jobs were added. Joining us for What to Watch is Bloomberg's Michael McKee. Mike, what are you looking out for?
Well, I have a little bit different list than yours. We all start with the same number of jobs, but as the news changes, we look at different things underneath the hood in the report. Obviously, we're looking at the 104,000 jobs. Are we going to get a low number like that? Wall Street, interestingly enough, for the first time since March, is looking for a stronger report than the economists that we survey. They're looking at this point for 120,000. We'll see if it turns out that way. But then the private jobs number is something to watch for, because last month we got 147,000 jobs. It was a surprise beat, but 74,000 of those were in government, and that should reverse. A lot of that's probably seasonality, and of course the Doge people have been going through and firing everybody in Washington. So we'll see how many private sector jobs are created. The unemployment rate is also something that everybody is watching down at the Fed. It's not so much the level. If it goes up to 4.2%, they're not going to panic. It's the speed at which it starts to rise. You get to 4.5% by September, then there's going to be a lot more pressure to cut rates. The other final thing that you want to look for perhaps is labor force size. How many people are in the labor force? Because we've got this immigration issue. There are two questions. One is the labor force shrinking because nobody's coming in. We're not getting any immigrants at this point who are joining the labor force. And two, are a lot of people staying home, even if they're here, not looking for jobs because they're afraid of being arrested and deported. If that's the case, if the labor force size is shrinking significantly, then the unemployment rate might not rise as quickly, but it makes it harder for companies.
All right, Mike, thank you very much for breaking that down, that labor force participation, a very interesting point. Thank you so much. And of course, Mike will be breaking down the data later today, 8:30. Also, Mike will be speaking a conversation you do not want to miss with the Cleveland Fed President Beth Hammack. That's at 9 a.m. on Open Interest. Joining us now, though, around the table is Veronica Clark, U.S. economist at Citi. She expects payroll growth to slow to about 100,000 in July. Veronica, great to see you this morning. Thanks for joining.
Thanks for having me.
So you're about around consensus. Is there any reason to believe that there could be a wide deviation either to the upside or downside today?
Yeah, absolutely. I mean, we've seen consistent strength in these jobs numbers. So in that sense, you know, we won't necessarily be surprised if we get another strong reading. That has been the trend. But there are a lot of fundamental reasons to think that job growth should be slowing. A lot of idiosyncratic issues, I think, also starting to impact the data maybe as soon as this July number. You know, there have been changes to, immigrant, work status for recent immigrants. That could start to impact data as soon as July. Of course, this seasonality issue that Mike McKee mentioned, that seems to have to do with education, maybe shifts in the timing of school years. Of course, the government job loss and such, maybe that happens more in the fall, but a lot of reasons to think that there could be downside to this reading.
I mean, the thing is that very reasonable people can look at the data we've gotten so far and come away with two completely opposite pictures. On one hand, it is a resilient jobs market. On the other hand, there are cracks that are starting to form that will come up to the surface.
Yes.
Where do you stand on this?
I think I'm more worried about the cracks. It is still true that the headline numbers are strong. They've been really resilient. Of course, payroll job growth. We do know that maybe that has some measurement issues. Chair Powell even mentioned this on Wednesday. We could see those revised lower in the official revisions we'll get later this summer. The unemployment rate, though, has been incredibly steady. It's been in this low 4.0, 4.2% range. Part of that, though, does, I think, have to do with falling participation. That has limited, how high unemployment will go. If you do look at something like continuing jobless claims, those are at new highs, would suggest that there has been a further pullback in hiring, and maybe the unemployment rate should be even higher. The reason that participation dropped in June actually was a really large exit of people being discouraged. So you've just given up looking for work. That doesn't speak to strong labor market to me.
In terms of the labor force participation in immigration, it's already been quite high numbers of deportations in this country and sort of the self-deportation. It's not as high as the Trump administration wants, but are we about to enter a period of a supply shock in this labor force, and what exactly does that look like?
Yeah, it's really hard to know how much has already been presented in the data. A lot of it will depend on how well is it being captured in these surveys, how well are people answering the government survey. And so I think there's maybe been some of that. We would, of course, get more worried if there were to be even bigger deportations. In the next couple months, there's something in the order of 800,000 workers who came within the last couple years who might lose legal work status. That sounds like a big number, but there might be other legal means that they could be working. It's just really hard to know at this point.
We also had a challenger job cut announcements yesterday that was much higher in July, a 140% increase year over year. And it was the tech sector that led with the most cuts announced, more than 13,000. Is this starting to have a real impact of these tech companies saying, we're shifting our workforce, and that means a reduced workforce as we concentrate on AI?
Yeah, those challenger numbers are interesting. They're really hard to base any kind of forecast on, but they're interesting to watch maybe for dynamics, if there's a consistent trend. They do job cuts by reason, and there was a big increase in job cuts because of AI in that July number. So that is interesting to watch. I do wonder if so far that AI story has had more to do with low hiring. If someone does leave, you're not replacing them. Maybe AI is improving productivity there and not so much on the job cuts. It could be a more dramatic story if it's changing, but 10,000, that's still small in terms of the overall labor market.
Veronica, there's so much to grapple with, and while you're here, we have to talk about what we got yesterday, about the various tariff announcements. It looks like the average level will be something around the highest since 1930s. It's a market that perhaps is shrugging it off. I mean, we are down this morning, but because we were anchored to a much higher level, as we start to get these numbers in, how do you sort through what the economic impact is? How do you even begin trying to calculate it?
Right. It's really difficult, and as economists, what we want is a historical scenario that we can base our forecasts on, and we don't have that in this episode. This is a very different economy than the 1930s, of course. So we'll have to see how it plays out. I think the market is maybe a bit dismissive because we haven't seen a ton of impact on the economy so far. To that, I think I would say it's just too soon, and there has been so much uncertainty around the tariff rates themselves. Businesses have inventory that maybe they're drawing down. You're waiting as long as you can to get more clarity on the tariff rate. Are they actually going to go into effect? Are there court orders that are going to walk some of this back? That you're going to wait as long as you can to raise prices or shift production schedule. But if these tariff rates, are what we're going to be facing in the next year or so, I imagine we're going to see a bigger impact on prices and activity.
But I guess the question is whether it's just a slowing of growth, whether it's just cooler and we kind of bump along, or whether it looks something more pernicious. How do you decide where the kind of where the split leans towards?
Right, we're coming down right now that it could be a more gradual slowing. Of course, so we are coming from an economy that was already gradually slowing going into this year. Probably has to do with rates that are restrictive. We see that weakening in sectors like housing. The easiest way that we're trying to think about the tariffs is that it's a tax increase, right? So what, as a share of GDP, is the revenue raised from these tariffs going to be? And if that acts like a tax increase, what does that do to the economy? Something like 1% on GDP. Maybe the drag is even a little bit less than that, just a couple tenths. Obviously, not all domestic consumers or companies are paying for this. Some will be, exporters paying for it too. But we really don't know. We're going to be bad at forecasting this.
I think that is very humble of you to say, and I think that is the case for literally everyone. Veronica, so wonderful to have you on. Thank you so much for joining. That is Veronica Clark of Citi, and again, that data for jobs drops at 8:30 a.m. Eastern. All right, let's get you some other top stories now trending on the terminal this morning. Goldman Sachs credit strategists are urging clients to hedge risks. The yield premium on global investment grade notes have tightened to their lowest since July 2007. The economists at Goldman still do expect the Fed to cut rates by 25 basis points in September, October, and December. Bridgewater founder Ray Dalio has sold the remainder of his stake in the hedge fund and left its board. A Bloomberg source says that Bridgewater bought the remaining shares. The source also said that the Brunei Investment Agency, a sovereign wealth fund, invested in the company, giving it a nearly 20% stake. President Trump has been meeting with heads of major U.S. banks to discuss monetizing Fannie Mae and Freddie Mac. Bloomberg sources say that this could include a major public offering of stock. J.P. Morgan's Jamie Dimon and Goldman's CEO David Solomon have met with him at the White House. Fannie and Freddie have been under government conservatorship since the 2008 financial crisis. Coming up, Apple and Amazon round out the big week in big tech earnings. Joel Colina of Wedbush Securities joins us next. This is Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
As Bloomberg's global financial correspondent, I get to meet the people shaping the way money flows around the world. And I want to bring you with me. Now we're playing.
Yep, now we're playing. First and foremost, I am a capitalist. The capitalist system is the best system in the world. There isn't another one that works as well.
Citigroup moves $4 trillion a day.
5.
Wall Street used to be a place.
I love all these new Wall Streets. Y'all Street, Wall Street South.
Now it's more of an idea.
The optimism here is infectious.
You think our New Yorkers are negative?
Yes.
Anything that trains people to understand probabilities and just think through things with a greater degree of nuance is a service to humanity.
I hope you survived the day.
I did. It was a busy day.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
This is Bloomberg Brief. I'm Danny Berger in New York. Shares of Apple rising in the pre-market after strong third quarter results. Joel Colina of Wedbush Securities writes, quote, long-term uncertainties around Apple's competitive positioning feel like they remain as high as ever. Without AI being a part of the narrative in a meaningful way, the bears will continue to think that multiple has more downside than upside risk. I'm pleased to say that Joel joins us now, Managing Director of TMT Strategies at Wedbush. Joel, so a lot to pick through. We also had Amazon earnings, but let's just stick with Apple for just a moment. The results were strong, and we had a Tim Cook who said only 1 percentage point of Apple's 10% overall revenue growth came from a pull forward in sales. How much trust do you put in that number and the ability of Apple to continue the growth that we saw?
Yeah, that's good morning. Thanks for having me. Yeah, that's the $1 million question, right? Like, obviously, Cook sounded pretty confident on that number that he threw out on the call. But I do think it's pretty hard to kind of quantify that type of number and say it with really any sort of conviction. So I think we'll see maybe as kind of this year progresses in terms of the pull forward effect. But again, for Apple, as you kind of mentioned, and people are fully aware, it's probably the #1 stock that mutual funds are underweight. It's been a hedge fund funding short for the better part of the last 5+ years. So, I mean, positioning expectations were extremely low heading into the print. And you know what? Revs came in up, top line beat 9.6%. Buy side was at around 6% beat. China grew 4%, which obviously is a big focus of the narrative there as well. And Cook did his best to kind of support and pump up the AI narrative on the call, threw out a lot of buzzwords. But the reality is, until AI becomes a meaningful part of the narrative and the story for Apple, and there's tangible revenues attached to it, I think the stock's just going to sort of languish kind of in the near to medium term.
Well, we made clear that they're really trying to reorganize things to put the emphasis on AI. But Joel, when there are reorganizations in companies, what tends to happen is talent jump ship. And they're especially more likely to jump ship if big old fat paychecks are being dangled in front of them from the likes of Meta. How much longer? What does that mean for the timeline? If Apple is losing a lot of the talent in order to get the AI push done that they need?
Yeah, that's a great point as well. I mean, you go back to earlier this year, Mark Zuckerberg, when he did his podcast circuit, in January, February, he was very adamant that this year is critical for AI. And he's obviously flexing his muscles as much as he can, not just for the company's CapEx commentary, which is massive, especially for 26, but yeah, poaching talent and giving out sort of pro athlete, multi-strat type of pay packages to engineers. And they're not messing around. And obviously Meta's poached a ton of talent from Apple. So as you said, that timeline's getting pushed out, and which makes you think for Apple to kind of take this seriously, we're going to see some sort of splashy M&A. I know my colleague Dan Ives, who's been on top of this trend probably earlier than most, he's thrown out Perplexity, and as have others. So people want to see something sexy here from Apple, and they got to figure it out.
Well, maybe we got something sexy from Amazon, but maybe it was too much. I mean, they're still spending over $300 billion, at least they did in the quarter, on capital expenditures. Joel, it's been fascinating to look at this market decide what is okay in terms of spending and what is not. We decided it was not okay in terms of Amazon because some of the results didn't show up for AWS. But Joel, is this a company that should pull back on spending? If they don't keep up the pace, even if their earnings aren't great at this moment, doesn't it mean that they will be losing out?
Yeah, I think sort of the jury's out on that, but you make a great point. Yeah, Amazon's free cash flow, I think, came in around break even, and kind of the street was closer to $8.2 billion. So that's an issue, especially when AWS came in at 17% growth. Meanwhile, Azure put up 39% growth. Google was in the 30s as well. So they are trailing their peers significantly here, and it's not coming through in the numbers. And sort of the stock's going to definitely just kind of chop around here, if not downside risk. And that's the $1 million question. Why is AWS not growing faster? They're clearly spending. They can't afford to kind of pump the brakes on spending either, given what their peers are putting up. But it sort of begs the question, what is happening with AWS specifically? Are they losing share? Are they investing in the wrong areas? And then sort of Amazon overall, it's just a lot hairier of a story than Meta, Microsoft, Google, and NVIDIA. You have the retail portion, their exposure to the consumer, outsized exposure to tariffs as well. So there's just always been a lot of moving parts for Amazon, and hence it's probably going to kind of languish and be firmly, 5 out of 6 in terms of the mega cap rankings, at least in terms of positioning goes.
Joel, you talk about this idea that they need to keep up with the spending. And at what point do we just see these companies spending for the sake of spending, trying to one-up their competition, keeping up with the Joneses? Joel, the logical conclusion of that is that someone just takes it too far, or multiple companies take it too far. When we don't quite yet know what the payback is going to be from all these investments, what are the risks in that?
Yeah, the risks are sort of a repeat of what we saw 20, 25 years ago. I was a little bit too young to kind of have my finger on the pulse back then. But I mean, yeah, that's a real risk. We've had recent reports where Microsoft's been moderating on their CapEx spend. We've had reports, Stargate is also kind of trying to figure out their spending regarding some of the pledges that they made earlier in the year as well. Again, it's sort of one of those things, time will be the jury of how this all plays out. But again, look at even Reddit this morning. Stock's up 15% in the pre-market, and they were talking that AI is really boosting their performance. We heard the same from Meta, as well as some other kind of companies as well. So if there's tangible, evidence being, provided that AI is driving performance, it's driving revenues, companies will spend. And I think Microsoft and Meta, a couple nights ago are proving that. And until that sort of goes pear-shaped, I think you'll see the spending continue.
All right, Joel, thank you so much for getting up early and joining us this morning. We really appreciate your time. Joel Kalina of Wedbush Securities. Coming up, we are in the thick of U.S. earnings season. We're going to get big oil results on deck. Lizzie Burden is going to show you what you need to know with your trading diary. That's coming up next. This is Bloomberg.
The most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. And we're here, where the action starts in Sydney. And in Tokyo, get ahead as the global trading day begins. The Asia Trade, weekdays only on Bloomberg.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Bringing you up-to-the-minute energy news whenever and wherever it happens. I'm Joanna Bersecci in Vienna, and this is Bloomberg.
This is Bloomberg Brief. I'm Lizzie Burden in London. Let's take a look at what's ahead today. Before the bell, we're going to get earnings from Exxon and Chevron. Then at 8:30 a.m., we'll get the July payrolls report. And then at 9:45 a.m., we'll get S&P PMIs ahead of that US ISM manufacturing data at 10 a.m. New York time. Let's also check in on your micro movers. We have Amazon shares slumping in pre-market after investors got spooked by that company profit outlook and cloud growth figures. Meantime, Apple delivering, that stock rising in the pre-market after posting a growth rebound. And we have Coinbase shares plunging on disappointing revenue driven by lower sales volumes. A look at your macro movers as well. We have S&P futures pointing south as we head towards the Wall Street Open. The Bloomberg Dollar Spot Index is up 0.2%. July, of course, the first monthly gain for the dollar since President Trump returned to the White House. And you're looking at your 10-year at 4.38 as we head towards that jobs report. All important later on in the day. But that's it for Bloomberg Brief. I'm Lizzie Burden. Surveillance will take it from here. This is Bloomberg.
is a nice confluence between the long-term investor and what we're trying to do. We have an operating principle that's in our handbook, take the long view. When we went public, we put a timeline up on the screen for the whole company in an all-hands meeting. And that timeline went from founding to 100 years out. And the IPO was one dot in 1 year on that timeline. And we tried to orient the employees to, this is a wonderful event, this IPO, but it's a moment in time on a very long journey.
This is a company that you want to exist in 100 years.
We do.
Wall Street doesn't think in...
No, they think in like hours. Yeah. And what I've learned of Wall Street, and particularly Wall Street investors, when they say they are long-term investors, that means they'll keep your stock for like a month. There has been one instance where I did something that was just for short-term stock, and I felt so bad about it that I don't think I'll do it again.
What was that?
There was one quarter, a few quarters ago, we were not going to beat the quarter. We were going to probably just hit it, and so far we beat every quarter. So we were all like, wait, what? Our perfect record. We're like a 4.0 student that is going to get a B for the first time. This is not good. And I decided that for a short period of time, at the end of a lesson in our app, we would show 2 ads instead of 1. Turns out that by itself was good enough to beat the quarter, but it's bad for the product. It's not good. After that, I never doing that again.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Alberta, Canada, and this is Bloomberg.
The US has a dynamic economy, a strong labor market, and it will outperform a lot of peers.
There are sufficient signs of weakening.
You see consumers cutting their spending back, but continuing to get jobs.
Job growth is slowing down. You could see a bigger slowdown starting even in the next jobs report.
Unemployment rate has been the most important data point you get, for a while now.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning. Welcome back to Bloomberg Surveillance. Deadline day coming in with a bang, a flurry of new tariff announcements roiling stocks. Meanwhile, a blockbuster week of tech earnings revealing some divergence in the American exceptionalism story. And the true test is in the data. The July jobs report dropping about 2.5 hours from now. A quiet, just end of summer month. Anne-Marie, welcome back. We learned a lot overnight about a final tariff rates as well as a slew of different trading partners and how they're dealing with that. How much remains to be seen?
A lot remains to be seen. I mean, these are writ large the highest tariff rates we've seen since the 1930s. Across the board, everyone's going to have a 10% minimum. Then for a number of countries, it's 15% or higher. So we've seen the Trump administration do. Most of these trading partners who thought 15% was going to be a bad deal, that's actually become the base case for a good deal. Then there's a number of partners I'm focused on because in the White House statement, it talks about how these rates for a slew of partners like India, like Switzerland, will go into effect in 7 days. So even in this final deadline that the president said is best and final, they're giving some of these trading partners, I'm thinking of Switzerland right there, top of the board, 39%. April 2nd, Switzerland was 31%. I think they're still giving some of these partners some wiggle room.
Well, that's the idea of August 7th being the time when it actually goes into effect. The wiggle room, the negotiations. What's your sense of how much they are ongoing when it comes with partners like Taiwan, like Switzerland, who you just mentioned?
I think they are ongoing, and they even say that in this readout. They will still engage with a number of countries that they are dealing with right now that they had a number of these trade talks. I was in Switzerland, though, in June, and what I heard from the top trade negotiator was they were given assurances by Secretary Besson and Ambassador Jamieson Greer, who will be joining us this morning, that as long as they were still talking in good faith negotiations, they wouldn't snap back to that April 2nd tariff rate. And it looks like today they are.
And even then some. And markets are having a little bit of a digestion issue. Danny Berger joining us this morning. John's off. And I have to say, I look at what's happening in equities this morning. How much of this is nervousness about the tariffs and how much is this just a top blowing off after pretty blockbuster types of results?
And how much of it is Amazon disappointment and this narrative that tech can keep spending and we're going to just keep cheering the CapEx, that is now seriously being challenged. I think it is all of the above, but it is a serious reappraisal this morning of if that spend can continue and if that's a good thing for these companies. If they aren't showing up and showing a real return on their AI investment, are we really going to allow them to spend that way? But if there is a pause in spending from the likes of Amazon because they're being punished, do they then fall behind? It turns into a really complicated narrative for them.
Being punished for not beating enough. And that, I think, is something that we'll have to come back to. Also, just adding to the deluge, the fire hose of different story narratives this morning, we also have a jobs report. Otherwise, we would have come in and it would be Jobs Friday as we get the non-farm payrolls report for the month of July. And Danny, this to me is going to be really key after a real question of how much the Fed is really going to be able to cut rates at all this year, let alone twice.
The onus is on the next 2 months of data because we had a Fed that did not move, because we had a Fed that cracks are now appearing. Very logical people can look at the labor market data we've gotten at this point and come up with two completely different narratives. On one side, it is a resilient economy and it is a labor market that is strong. On the other side of things, it is real cracks that are showing. It's real concern about things like AI replacing jobs. It's a labor force that has declined a lot in participation. And are we going to see a supply shock? It is two very different outcomes with very different consequences for policy.
And with Jay Powell basically telling us this week, the main number he's looking at is the unemployment rate. So how important is that going to be when it comes to the markets and they're trying to basically price in when the first rate cut is going to be? 2 CPIs, 2 job reports before the next Fed meeting, and the president is expecting a September rate cut. Got all that? A real slow summer. In markets, you can see just a little bit of digestion issues with equities near futures near their session lows as we head to the open. 1% decline ahead of the open for the S&P. The dollar is on track, or just had its best performance, its biggest strengthening going back to 2022 for the month of July. You could see yields just creeping a little bit higher ahead of that jobs report. Right now, coming up this hour, Sebastian Page of T. Rowe Price, his new tariff rates send stocks lower. Tom Forte of Maxim Group on the diverging outlooks from Apple and Amazon, and Michael Puglisi of Wells Fargo looking ahead to that payrolls report. We begin this hour with our top story, President Trump announcing sweeping new global tariff rate hikes. Bloomberg's Brendan Murray joins us now for more. Brendan, what's the latest, and what's the latest on how fungible some of these rates still are?
Yeah, it's this. I think what we're seeing now are the more clearly are the broad contours of President Trump's America First trade agenda. We've seen, if you compare them to the April 2nd reciprocal tariffs that he announced, they've come down a fair bit. We've got a two-tier baseline system. Essentially, you have about 70 countries with this base of 15% and going up to 41%, and then you have everybody else who gets 10%. So you're looking at you're looking at more assurance, but not exactly a system that's designed for an efficient way to look at how global trade is going to be conducted when you have all of these various tariff lines. It's going to be difficult for businesses to sort out. We're in the heart of the shipping season right now, so you're heaping this on the logistics industry. So it's going to be, and I agree with Anne-Marie, some of these rates that like Switzerland got and India received, those deals didn't get over the line. You could throw Taiwan in there as well. They're at 20%. They thought they were going to get a deal. They're an important semiconductor exporter. So these next 7 days, I think you're going to see some deal making still to be made if they can get it before these rates kick in on August 7th.
So August 1st, the deadline. August 7th, kind of the new deadline. Bloomberg's Brendan Murray, thank you so much for being with us. We'll catch up with you later this morning. Here's a view on Wall Street. Sebastian Page of T. Rowe Price rating. I'm bullish on macro and fundamentals, but cautious about valuations and sentiment. Optimism is priced in. Sebastian, I am so glad to say joins us this morning. Happy Friday, I guess. It's quite a deluge. What a week indeed. What a day. I wonder how much what we're seeing in markets right now is because of high valuations where we've been versus tariffs and some speculation about what that could mean for economic growth.
Yeah, I was thinking about this earnings season, and as a philosophical question, is it still a surprise if everybody expects a surprise? You know, coming in earnings season, everybody was saying the earnings are going to be good. So you're seeing some of that unfold. I like to say a wise person once told me that happiness equals reality minus expectations. So look, Stock prices are up 30%, Lisa, in 3.5 months. The price earnings ratio is at 22. Meme stocks are back. Crypto's rallying. That's what I'm worried about. I'm not worried about the fundamentals so much.
So this feels more like a top blow-off to you than it does real assessment of some sort of greater pain as a result of policy. Is that correct? Do you think that we are overestimating the ramifications of tariffs on both corporate profitability as well as growth?
You know, just listening to the opening of the show today, it just makes it look like tariffs drive the entire U.S. economy, right? We talk as if tariffs drive the entire U.S. economy. They don't. Goods subject to tariffs represent 9% of GDP. So there's a 91% of GDP that matters. I don't want to minimize the impact, but tariffs don't drive the entire U.S. economy. The consumer is doing just fine. Hey, we have fiscal spending that in our minds is going to be stimulative. And look, you have strong earnings. You know, we could get another 10% earnings growth for the next 12 months. We just had Q1, 13% year over year. The beat rate right now on sales this quarter is 80%. The 10-year average is 64. So there's more to the economy and markets than tariffs. I know it doesn't sound like that this morning.
Has Trump conditioned the markets, though, to digest a higher tariff rate?
Yes. Look, you can see it in April. An analyst sent me a chart of a trade uncertainty index, and he overlaid the S&P 500. And it was just the entire market was trading on the trade uncertainty index. You could get all that data on
So the
Bloomberg.
uncertainty is actually worse than the policy.
I think this is what was going on in April, right? When the market crashed and then recovered. Right now, the market is becoming more desensitized to tariffs. And to me, that makes sense. I just go back to the bottom line. I do think that the fundamentals are strong enough to sustain earnings growth. But at the same time, look, last week in our asset allocation committee, the B word came up. And it's starting to come up on your show as well, the bubble word. Now, no one on our committee thinks that we're about to pop a bubble, but we're discussing questions as to whether are we in the run-up to a bubble. And you have all these little signs that are starting to show.
And that maybe makes us more vulnerable to accidents. I was speaking with Julian Emanuel of Evercore earlier this week, who pointed to what happened in copper as an example of this. A VAR shock happens because we're unprepared for tariff changes on copper. Given how high asset prices are, even if the economy are not tariffs and tariffs are not the economy, are we now more vulnerable to announcements that might cause fissures we didn't expect?
Danny, I think that's the word, is vulnerable. With a price earnings ratio of 22. By the way, it's not a good timing indicator, but if you look at, what the tail risk looks like historically when the price earnings ratios are higher than 20, you do see a higher probability of a meltdown. You also have a higher probability of a melt up, which is interesting. In fact, if you look at stocks, how they do when you're at an all-time high for the next 12 months, they average like 10%. It's really not bad, but the tails, the extreme events, melt up, melt down, are much fatter. The probabilities are higher than usual.
Well, I guess kind of the irony is if it is a bubble that's growing, the best thing you can typically do in those periods is go long. So is that what you would be doing right now, Sebastian?
So we're weighing the fundamentals against those rising valuations, and we end up at neutral between stocks and bonds, but we're long diversification. So markets are showing historically high levels of concentration. We're a little bit worried about that. And we're short duration, short interest rate sensitivity, positioned for potential upside surprises on inflation. We've been running really low month over month on inflation for the last 4 or 5 months. But the one-year swap that the traders are pricing in, it's at 3.5.
So are you leaning into the American exceptionalism story or leaning out? Because it seems like the rest of the market is leaning in, and you're suggesting maybe it's time to look the other way.
Look, long term, we're leaning in. It's just fundamentally, it's a more dynamic economy. But as a tactical trade right now, we're looking at international value. We are long international value in small and mid cap. A couple of weeks ago, I had an analyst show me a relative valuation dashboard between the Russell 3, so the entire U.S. stock market, and the rest of the world. And I was convinced the numbers were wrong. because the margins were higher outside the U.S. than in the U.S. It was 20 versus 15. The earnings growth was higher outside the U.S. and the ROE was higher, 13 versus 8. So it's getting ready to yell at the analysts. I never yell at analysts, but the numbers, Lisa, the numbers were technically correct. He was just showing me median numbers, not weighted average numbers. So there are plenty of stocks in the small and mid and value sectors outside the U.S. that have lower valuation, say 14, 15 range versus 19, and that have better fundamentals. So that's what we're playing right now. And there's momentum in that trade as well.
Sebastian Page, wonderful to see you, even as you rage at your analyst. Sebastian Page of T. Rowe Price. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Lizzie Burton. Lizzie.
Hey, Lisa. President Trump unleashed his latest round of tariff announcements just hours before his August 1st deadline. Most countries are facing a baseline 10% tariff rate, but Trump slapped 35% tariffs on Canadian goods not covered under the USMCA. The new tariffs will take effect August 7th to give U.S. Customs and Border Protection time to prepare. Elsewhere, Apple shares are trading higher in the pre-market, the company reporting its fastest quarterly revenue growth in more than 3 years, with revenue rising 9.6% to $94 billion. Strong iPhone sales and a rebound in China helped beat estimates despite a projected tariff hit. And shares in Amazon are falling in the pre-market. The online retail giant projecting weaker than expected operating income. It's also trailing the sales growth of its cloud rivals, leaving investors wondering whether its huge investments in AI are actually paying off. CEO Andy Jassy said it's very early days in AI and that the company's efforts to lower the costs will draw more customers over time. And that's your Bloomberg Brief. Lisa.
Thank you so much, Lizzie. Coming up next, we're going to be talking about reshaping global trade.
We have made a few deals today that are excellent deals for the country. You know, we're taking in literally trillions of dollars for the country. They have to pay a fair rate. That's all. It's very simple. All we want is fairness for our country.
Scott Lincecum of the Cato Institute coming up next. And later, we will be catching up with U.S. Trade Representative Jamieson Greer. This is Bloomberg.
Going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance. A softer tone to end the week. 3 days of losses if this holds. Right now, we're seeing futures near session lows. Welcome back as we do parse through a slew of information. NASDAQ futures down 1.1%. Russell 2000 really interesting this week, down 1.5% this morning in futures. Just simply as we gauge what exactly the strength in the economy is, what kind of hit could come from this. Under surveillance this morning, reshaping global trade.
We have made a few deals today that are excellent deals for the country. You know, we're taking in literally trillions of dollars for the country. This is making our country very rich and respected again. 1 year ago, we were a dead country. Now we're the hottest country in the world. They have to pay a fair rate. That's all. It's very simple. All we want is fairness for our country.
Here's the latest. President Trump announcing a slew of new tariffs set to take effect on August 7th. Bloomberg's Jack Fitzpatrick joins us now from Washington. Jack, some of the highlights, how much of this is part of an ongoing negotiation?
It seems like that's a significant aspect in this. When you look at some specific anecdotal points on what came out yesterday, it does seem that there's evidence that, there's criticism that some of these numbers are arbitrary. I'd say it points more toward the political strategy of Donald Trump and the geopolitical strategy of Donald Trump. When you look at particularly high numbers for some goods from Canada, where he was frustrated about the flow of fentanyl over the northern border, the high rates for India, the high rates for South Africa and Brazil. It's not just a static moment where the president sets rates and says, on the merits, these are absolutely my numbers. President Trump likes to be the person who people come to seeking a deal. So while this is a big step toward understanding where he places countries and where he wants the tariff rates, it does not seem like we're anywhere close to the end of negotiations with plenty of countries around the world, because that's the way President Trump works.
Jack Fitzpatrick, thank you so much for that. Bloomberg's Jack Fitzpatrick will be joining us later in the hour. Joining us now is Scott Lincicome of the Cato Institute. Scott, we got a lot of numbers overnight. We're still parsing through them. We're still trying to figure out how many of them are actually going to stick. When clients call you up this morning, what are you going to tell them?
That I don't know the answer to when it's all going to end. And I think that's the problem. If you have perpetual negotiations, uncertainty prevails, regardless of what the numbers on the paper say. As of today, we now have dozens of new tariff rates. But as just mentioned, maybe those are just negotiating positions. Maybe they're going to change within the next week. But then maybe they change again in the next month. And that's a really, really difficult environment for globally connected companies, multinational supply chains, and particularly small businesses with one supplier trying to figure out their orders for next year. That's a really tough spot to be in. And so I think the continuing narrative throughout the fall is going to be trade policy uncertainty. And, of course, much higher U.S. tariffs on average than we've seen in 100 years.
Scott, when you look at the markets, though, it does look like they view these next 7 days as negotiations to be ongoing with a number of trading partners. Is that what you are telling clients? Because the markets certainly think so.
Well, I certainly think that in the case of a few of these countries where there were reports that deals were very close, Switzerland, I think, being a good example, I think there is the chance that those are going to change in the next few days and that these rather absurdly high tariffs are going to come down a little bit. But at the same time, that's good for markets. It doesn't do a lot for the actual businesses operating in these environments. You are not, taking comfort that maybe the rate's going to change when you're trying to plan a business. And so, and at the end of the day, going from 39% to 25% is cold comfort for a business that's going to be eating that cost or trying to figure out if they can pass it on to their customers here in the United States.
We still have federal courts, though, deciding whether or not these emergency tariffs using IEEPA are even legal. What happens if the courts say this is all illegal?
Yeah, that's the other big uncertainty issue right now. These trade deals are all under the International Emergency Economic Powers Act, which is being litigated at the Federal Circuit and elsewhere in the United States right now. Oral arguments yesterday went very well for the plaintiffs, meaning that they're optimistic this law or the tariffs themselves could be shot down. If the Supreme Court agrees with that on an expedited basis, all of this stuff could go away this fall. And importantly, all the trillions of dollars that President Trump brags about coming into the government might need to be refunded to importers over the months that follow. So a lot of uncertainty there, too.
A lot of uncertainty just everywhere, Scott. Also in the executive order last night, it made clear that this is a White House that plans on continuous monitoring of the trade partners for any violations. What is your understanding, Taz, what the bar would even be for a violation and what the reaction might be from the White House if it deems it so?
Yeah, and I think that's the other big story of the fall is compliance, because you're now talking about, we went from a U.S. trade system that was really simple. There was one rate for most of the world. You didn't care exactly where a product came from or what it contained. And now you have dozens of tariff rates for dozens of different countries. You have to worry about the metals content. You have to worry about it as Chinese content. And if you mess that up, you might be getting a call from the Department of Justice or the Customs Department, or if you're a country and your trade balance doesn't suddenly change, you might be back negotiating with an angry President Trump and a higher tariff rate. So all of those compliance issues, those are another cost for business, and it's another thing governments are going to have to deal with for the next long while.
Well, it speaks to things like the transshipment of understanding how many parts come from China and whether that's changed. Scott, do we even have the tools? Does global business have the tools to accurately track and analyze where these different products are coming from and what rates will apply to them?
Well, yes and no. So simple products, yes, you can track those things. You only have one supplier. It only has a few parts. But really complex things like aircraft and autos and where there are 3 tiers of suppliers, thousands of different companies in the supply chain from all over the world, accurately tracking that stuff, accurately determining the aluminum content or how much comes from China, particularly given how much intermediate goods China exports to the world. That's a Herculean effort. Something I did back in my old job for pretty simple products like washing machines. And even that was pretty darn difficult. Doing this for complex manufacturers, man, good luck.
Just real quick, Scott, why do you think a lot of market participants are shrugging this off as less relevant than they might have believed it on April 2nd?
Yeah, I think 2 things are, one, expectations. A lot of this is now baked in. You know, back in April, I just don't think many big investors thought we would ever get these big global reciprocal tariffs. So part of the shock in April was simply a big surprise. That's now been baked in. But the other big thing is we always have to remember the United States is a massive $30 trillion services economy, mainly driven by companies that aren't directly affected by goods imports. So you can do a lot of damage in the goods import sector without causing the S&P to crash or whatever. Now, that doesn't mean it's not going to be painful for a lot of companies, and particularly smaller ones. But it doesn't mean that you're going to have a crash or even a recession. It just means you're going to grow a little slower, you're going to be a little poorer, prices are going to be a little higher. So that's not good, but it doesn't mean Armageddon.
Scott Lincicome of the Cato Institute, thank you so much for being with us this morning. Have a great weekend. And there is this feeling that a lot of people are looking to the underlying strength of the economy, Danny, and that's the reason why the jobs report becomes so important.
Right, and if there already are cracks and maybe lay on top of that some of the tariffness, does it become something that the Fed needs to deal with, and then the whole conversation changes?
Did you just say tariffness?
Tariffness, sorry, I invented a new word. It's a Friday,
fantastic.
why not?
I'm sorry, I like that. It's sort of this new adjective. Coming up, Tom Forte of Maxim Group on a tale of 2 earnings reports from big tech.
you've said 25% last year, I believe, of Google's code is AI generated. You have over 180,000 employees right now. Is it half that in the future?
I expect we will grow from our current engineering base even into next year, right? Because it allows us to do more, right? I think the opportunity space is also increasing. I just view this as making engineers dramatically more productive, getting a lot of the mundane aspects out of what they do, allowing them to spend on higher value-added tasks. But that means it's an accelerator. People will be able to do more, which means maybe we'll create new products, and hence we will need more people. At least in the near term, to me, it looks like we will expand engineering velocity, and that doesn't mean we're constrained in what we will do. We'll end up doing more as a company as well.
Right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
2 hours away from the jobs report, stocks taking a little bit of a breather after seeing, for the NASDAQ in particular, 14 record highs in the month of July. Today, the NASDAQ futures are lower by 1.1%. S&P futures near session lows, around that 1% decline. Russell 2000 actually taking it a little bit more on the chin, the 1-2 punch from possibly disproportionate damage from the tariffs that have been announced, as well as the Fed and what the Fed does after they get those data at 8:30 a.m. Eastern. Meanwhile, when you take a look at the bond space, you do see yields just creeping a little bit higher the long end. Yesterday, it did seem like we got better than expected data on the jobs front. Jobless claims came in better than expected. We also saw a little bit of resilient inflationary pressure, all focused very much on what happens in 2 hours. 30-year yields have bled higher over the past month by almost 20 basis points, 4.93%. And if you bleed it through the currency space, this to me is really compelling. The best month for the dollar going back to 2022. How much is a pain trade? How much is something continuing? Today we are seeing ongoing dollar strength, but just marginally, 114 on the euro versus the dollar. 3 hours from the cash open, here are your morning movers with Danny Berger around the desk with us. Danny, what you looking at?
Well, it has to be big tech, right? Apple is the one that's doing better this session, not by a huge amount, 1.7% in the pre-market. Its fastest quarterly revenue growth in more than 3 years, easily tops estimates, also outperforms in China, a real bright spot. A lot of positivity on the call about AI improvements and lack of pull forward because of tariffs. Meanwhile, Amazon to the downside, basically just not growing as fast enough as its rivals. Sure, you can beat, but if you're not putting up numbers and you're 40% for your cloud growth, like we saw from Microsoft, this is what happens. Just a 17% growth for AWS, leaving investors saying, hey, is it worth it, the big spend you're doing? Meanwhile, Coinbase down 11%, weaker trading volumes. There was a drop in volatility for crypto, if you can believe it. So that's why those earnings suffered, down 11%.
Yeah, when it's just off and to the right, you just don't have that much volatility. It's just one direction. On our radar this morning, we will be getting more back to the tech story, but President Trump announcing sweeping new tariff rates on dozens of U.S. trading partners. The tariffs range from a 10% baseline to as high as 41%. The move raising the average tariff rate to over 15%, which is 6 times higher than a year ago, raising questions on, will this stick, Emery?
That's the big question. Are these going to stick for countries like India, for countries like Switzerland, for countries like Taiwan, which all these trading partners were in negotiations with Secretary of Investment, Commerce Secretary Howard Lutnick, and Ambassador Greer, who we're going to be speaking with. And the fact that they gave this wiggle room of 7 days, now the new deadline potentially for some of these countries is August 7th, is the final moments potentially of concessions we are going to see from some of these countries. And when you look at concessions we've already seen, remember when the European Union was ready to sign a deal at 10%? Well, then Trump was able to get 15% in terms of the baseline tariff when it comes to the EU. Is he trying to do that sort of negotiation negotiation with a number of these countries.
There was another story yesterday, and you hinted at this in our conversation with Scott Lincecum about the appeals court, the federal court, to a panel of 11 judges that heard arguments from the government about the legality of using IEEPA in order to execute this type of tariff rate. And there was massive skepticism by those judges. How realistic is it that this gets overturned entirely and kind of upsets the apple cart when it comes to these negotiations?
Well, potentially, because legal experts are talking about how this is the purview when it comes to IEEPA for Congress, not the executive branch. The other thing I would note, though, even if the courts come down and say you cannot use IEEPA, when you're looking at a bunch of these tariff rates, the president still has, under his discretion, using USTR or the Commerce Department, a host of different orders he can do, whether it's a 232 sectoral tariff, to go after some of these countries and trading partners. So even if IEEPA, they were to come out and say this is illegal, there are other ways the president can enact his tariff agenda.
Meanwhile, global credit spreads tightening to their lowest level since 2007. Add that to some of the record highs that we've seen in big tech. Strategists at Goldman Sachs urging caution and warning against complacency. They were talking about credit spreads, but you see this from Michael Hartnett, also from Bank of America, saying that there could be a bubble, particularly in big tech, with valuations having risen so far.
But part of what that's done is created this really interesting market dynamic. I mean, IG corporate bonds have had higher total returns and lower volatility than treasuries. You look at something like a Microsoft, it's now rated more highly than US government debt and has a huge cash output. It's making a lot of people really question long-held assumptions about what's a safe asset. But when you do that, you pile into some of these assets, you pile into credit. And again, as Sebastian was saying from T. Rowe Price, does that make you more vulnerable to shocks? The fundamentals can be okay, but if something upsets you, are you just ill-positioned for that?
And, you know, to that point, there was a really compelling story about TSMC, the Taiwan Semiconductor Manufacturing Company, and that the ADRs in the United States are trading at an unprecedented premium at a higher level than what you see in the mainland of Taiwan. And how much of this is because in the United States, its tariffs are on the sidelines, it's big tech to the moon, and that's what you see in the valuations.
It's what you see in the valuations, but then what happens when you get someone like an Amazon this morning who disappoints, again, beats but disappoints, if that can be a thing. The bar still is really high to meet some of these prices that are being traded right now.
Yeah, we're going to get to the big tech story in just 1 second. Just crossing moments ago, President Trump truthing this morning about Jerome Powell, saying this: Jerome Too Late Powell, a stubborn moron, must substantially lower interest rates now. If he continues to refuse, the board should assume control and do what everyone knows has to be done. So continuing that jawboning of the Fed official, coming right before we get jobs numbers. He's seen the number. How much does this sort of indicate something?
Well, what stands out for me here is the line, the board should assume control. It comes after, for the first time more than 3 decades, we have these double dissenters at the Fed coming out and saying, actually, we see the economy different than the chair sees, and we think there should be cuts immediately. And of course, I'm talking about Michelle Bowman and Christopher Waller. So I think that is what's interesting now. The president is, once again, yes, attacking the chair, but he's recognizing that it is a deliberative body, and now he's calling into question the board, saying the board should assume control. I mean, everyone gets a vote, but basically putting more pressure, I think, on other members of the FOMC.
Yeah, and hearing from Scott Bessent yesterday that they do plan on announcing someone later this year in terms of a possible replacement to Fed Chair Jay Powell. Watch this space. We'll talk about it more coming up. But back to earnings. Apple reporting its best quarter in over 3 years as iPhone demand picked up worldwide, including in China. Amazon shares, meanwhile, falling after reporting the tech giant underwhelming cloud growth. Joining us now is Tom Forte of the Maxim Group. Tom, how bad really was Amazon versus just not absolutely moonshot, blowing out expectations like some of the other tech giants?
Yes, I definitely think that Amazon was a victim of expectations. Had the company reported before Microsoft instead of after, we might be talking differently without downplaying investor concerns about the competitive landscape in cloud computing and artificial intelligence. But I do see the market's reaction to Amazon as more a reflection of high expectations than poor performance. Sales and profits were better for the quarter, and if you look at the ranges for the outlook for next quarter, they were better as well.
So, Tom, before we get to Apple, there is this issue of what the constraint is for Amazon's AWS, their cloud computing unit, which has really been their main profitability driver. Is it just capacity? Is it that they can't build out quickly enough to meet demand? Or is it that they are losing share, that they don't have the same kind of AI advancement that, say, the Googles and the Microsofts have?
Yeah, so I would argue that it's more about capacity. So Microsoft is working closely with OpenAI. Amazon's working closely with Anthropic. Amazon is the market leader as far as market share. Google, to their credit, and Microsoft, to its credit, are growing at faster rates off smaller bases. But I would argue that of those choices, it's more about capacity than necessary market share.
Tom, how do you understand whether we reward these companies or punish them for the capital expenditures that they're doing? Is there a hint of that in Amazon, that they're spending too much to justify what isn't as strong growth as the other Mag 7 and big hyperscalers?
Yeah, so I think the beauty of Andy Jassy as CEO versus Jeff Bezos is Andy's found a way for the company to continue to generate strong profits and free cash flow and invest. So I think that if we were talking about a Jeff Bezos-led Amazon, there would be kind of ebbs and flows of investment spending. Andy has figured out a way to unlock sustained profitability, even with heightened investment. And I think Amazon, both under Bezos and under Jassy, has investors' trust that the investments will ultimately pay off, including for artificial intelligence.
And then there was Apple, Tom. And one of the more interesting things that Tim Cook said on the call was that he thinks only 1 percentage point of the 10% growth in revenue was due to a pull forward effect. Tom, is that even measurable? How much faith do you put in that number?
Yeah, so if they looked at their sales trends in April as it pertained to iPhones and Macs and discerned that consumers hearing all the chatter on tariffs bought ahead of concerns that tariffs would raise the prices of those products. And as you pointed out, it contributed to about 100 basis points of growth on a 10 percentage point growth. So I think that pull forward was a factor. The concerning thing to me in Apple's results is that they're acknowledging that they're behind on artificial intelligence. The good news is they're taking action. They're raising their CapEx, which is much more modest versus Amazon. And they even hinted at strategic M&A, which I thought was highly unusual for Apple.
Is it a little too late, though, when it comes to what Apple's doing in terms of AI, given the fact that we see Meta basically go in, take their top talent, and leave Apple still struggling?
Yeah, I don't know that I would say it's too late. It's definitely late. So the good news is now we know that we should expect an elevated Siri next year, enhanced by artificial intelligence. That was a question mark even into the developers conference recently. I think Apple has shown a consistent ability to play catch up. They're not always first, but they're best. Maybe they won't be the best in AI, but certainly they could be better than what they are today.
Does this show you the fact that Apple is saying that potentially it's going to have to look elsewhere for AI, that they're just changing their strategy for a company that we know loves to build in-house?
I think they're saying that everything's on the table. So I don't think they're saying, hey, we're going to lean into strategic M&A, unlike we've done in the past. I think that they're going to pull every lever they can to materially enhance the artificial intelligence experience on their products. That's how I view that statement.
Tom Forty, this past week has been about American exceptionalism driven by big tech, and we've certainly seen some blockbuster results. We're quibbling with the details about Amazon, but still a pretty solid set of numbers. And I just wonder, when you have the likes of Michael Hartnett over at Bank of America talking about a bubble in tech stocks and a valuation that just seems to have gotten over the skis, even of all of the optimism that you saw in the earnings, what's your response?
Yeah, so if you looked at the peer set for Apple, the PE went to about 35 times from closer to 28 times between last quarter and this quarter. So I think there's a lot of high expectations in big tech that they're going to land the plane, or however you want to think about it, when it comes to both tariffs, AI investment, and getting a return on that AI investment. So as a longtime follower of the industry going back to '96, having survived the dot-com bubble, I do think that there's a lot of high expectations, and it's reflected in the big PE multiples you're seeing in big tech.
Tom Forte of Maxim Group, thank you so much for that. Really appreciate your insights. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief. Let's head over to London with Lizzie Burden. Lizzie.
Hi, Lisa. President Trump is escalating his campaign to pressure pharmaceutical companies to lower drug prices. In letters sent to the world's 17 largest drug makers, Trump insisted that the companies immediately lower what they charge Medicaid for existing drugs. He also asked them to guarantee that future medicines be launched and remain at prices on par with what they cost overseas. Elsewhere, Chevron delivered better than expected results and raised its cash flow outlook after boosting oil production to a record. Adjusted second quarter profit came in at $1.77 a share. That's 6 cents higher than the median forecast. However, the company warned that crude prices are in danger of falling this year due to supply increases from OPEC and its allies. And billionaire Elon Musk donated over $45 billion to his super PAC in the first 6 months of this year. The new donations put Musk among the top political donors in the US. The filings show that despite his public feud with President Donald Trump, he continued to give to super PACs benefiting Republican majorities both in the House and the Senate. And that's your Bloomberg Brief. Lisa.
Thank you so much, Lizzie. Up next, we'll be counting you down to the payrolls report.
If you look at the bigger picture data, the best indicators of the balance between supply and demand in the labor market are the unemployment rate and the vacancies to unemployed workers. And both of those have been flat for a year, even though job growth has been somewhat tepid.
Michael Puglisi of Wells Fargo joining us next as we do count you down to that payrolls report at a time where we found out from this week that Jay Powell looks at the unemployment rate as the most important economic indicator. This is Bloomberg Surveillance.
You missed it on Bloomberg Insight.
Losing a few people is not actually that unusual. These companies are constantly pulling people, in both directions. The real question is, can it turn around Meta's fortunes? It's about who is leading in terms of adoption, in terms of B2B use cases, B2C use cases in different countries. And we're seeing Chinese companies certainly making a strong showing across many of those fields, even if, I would say that the US is still generally in the lead. But what we've seen at the company level and at the product level is actually that continued decoupling. So I think it's a pretty safe bet that is going to continue to be the case.
Not to bring up the past, but you've criticized Sam Altman. I'm just wondering whether you've made peace with Altman on the back of that drama.
So we haven't actually interacted since the time. I'm sure at some point soon we'll end up at the same event, and the AI world is pretty small, but no, haven't had a chance yet so far.
Don't miss Bloomberg Insight live weekdays.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question. Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
and 43 minutes until the jobs report. Right now in markets, a little bit of softness in futures as we look to some of those earnings reports. In question, just have elevations gotten a little high, particularly in the big tech sphere. S&P futures lower by 1.1% near session lows as we blow off a pretty darn good week and month ahead. Meanwhile, people looking at what's going on in the currency space, dollar experiencing its biggest one-month rally going back to 2022, building on that just a touch today, 114 versus the euro, and yields just climbing a touch ahead of that payrolls report with a real question about just how much strength it will show given the data that we've gotten so far this week. Under surveillance this morning, counting down to that jobs report.
Job growth is slowing down. If you look at the bigger picture data, the best indicators of the balance between supply and demand in the labor market are the unemployment rate and the vacancies to unemployed workers. And both of those have been flat for a year, even though job growth has been somewhat tepid. You could see a bigger slowdown starting even in the next jobs report.
Here's the latest. Investors counting down to July payrolls in less than 2 hours' time. Bloomberg survey median asked estimate coming in at 104,000. Michael Puglisi of Wells Fargo joining us now. And before we get to the jobs estimates, I wanted to gauge your opinion of how much weakness there really is under the hood. We got another Truth Social post from President Trump this morning where he called on Fed officials to overrule Jerome Powell, saying that too late, Powell, a stubborn moron, must substantially lower interest rates now. If he continues to refuse, the board should assume control and do what everyone knows has to be done. Michael, I'm just wondering, do you think that this economy requires a rate cut based on some of the cracks that some people have pointed to in the labor market?
Well, good morning. And no, I don't think so. I don't think the Fed is there yet. When you look at the labor market data, there's certainly some stuff to be concerned about, right? The breadth of hiring has been pretty narrow over the past few months. Consumer sentiment on the labor market, when you look at things like the percent of people saying jobs are plentiful versus jobs are hard to get, has deteriorated. But generally speaking, I think that there are a lot of signs the labor market has stabilized this year. The unemployment rate was 4.1% in December. It's 4.1% today. You look at jobless claims, JOLTS, ECI, all of them pointing to, I think, some stabilization in the labor market. And meanwhile, on the inflation side, you're sitting at 2.8% on the core PCE deflator, probably some upside risk from here because of the tariffs. And so, no, I think there's a case to be made that the Fed needs to be nimble going forward and ready to cut rates in case there's a deterioration in today's data or in future months, but probably not yet. I don't think it was necessary at this meeting.
Yesterday, David Seif of Nomura was on with John and Lisa, and he was talking about now that we have these two dissenters, a more willingness to see governors dissent on the board, it's going to bring an end of decades of de facto Fed dictatorship by the chair. Do you agree with that? Are we potentially entering a more deliberative and debate amongst the Fed when it comes to rate decision and monetary policy?
No, I don't think so. I mean, I think the chair is, of course, the most important member of the FOMC. They're always going to carry the most weight. But, you know, as I've watched Chair Powell over the past 7 years, I think consensus building has been one of his greatest skills when it comes to trying to trade off between board members, regional Fed presidents, who at different points in the cycle have had different opinions. And we've seen that many times back to 2018, 2019, when the Fed was under some pressure to cut rates, during the pandemic, the initial takeoff, last fall's cuts. And I think the chair's job in some ways is trying to build that consensus across 19 different members who all have very different views sometimes, particularly when you're at a key inflection point in monetary policy or in a moment like now where the dual mandate is a little bit in tension between downside risk to labor market and upside risk to inflation.
Well, Chair Powell told us what he's looking at today. He said the main number you have to look at right now is the unemployment rate. If that's the determinant of monetary policy, what in the data is he seeing that he thinks that's the main number we should all have our eyes peeled at 8:30?
Right. So when you think about the employment report, traditionally you think of the NFP number, right, and you see that slowing down. That can be a worrisome sign. But what I think that the Fed, and I certainly agree with this, is trying to figure out right now is how much of a slowdown in non-farm payroll growth is because of a slowdown in labor supply. Obviously, as you've seen, a lot less immigration into the United States over the past 6 to 12 months. So to some extent, you would expect job growth to be slowing in 2025 because of that supply-demand dynamic, but that does not necessarily mean that demand and supply are getting out of balance. Whereas the unemployment rate, while not perfect in terms of measuring that, should come a lot closer to telling you how are labor supply and labor demand in balance. And so far, so good this year. And I think that's been corroborated by initial jobless claims, continuing claims, and some other data like that.
Hey, Michael, if I can just go back to one thing you said about Powell being the consensus builder, and we continue to see that. I'm kind of struggling to see where the consensus was in this last Fed report. He didn't really seem to include at all the two dissents into his viewpoint of going forward, even going so far as to say, hey, we are looking at tariffs. We are looking through tariffs because we're not talking about hiking. Is there a risk that there could be some real concerns, but it's being brushed off by the chair and many market participants as just political?
No, when I go back and listen to what Chair Powell was saying, he talked about downside risk to the labor market quite a bit, right? And in fact, it was a year ago, pretty much today, where the Fed had a very similar dynamic. They had not cut rates yet. They met in July. They decided to sit on hold. And then they got a couple weaker labor market readings. And what did they do? They reacted to that. And so if that's what happens, let's say today we get a much weaker reading, unemployment rate rises, we come back in a month, it tells a similar story, then it would not surprise me at all to see that nimbleness from Chair Powell and the rest of the committee who did not want to cut rates, to see them initiate a rate cut in September. I mean, bear in mind, the June SEP, which is now about 6 weeks old, it did still signal 2 rate cuts by the end of this year, but that was conditional on an unemployment rate rising to about 4.5% or so. And so if it stays flat, then I think that the median on the committee, at least my guess would be, they're not going to be quite there yet in the near future.
How much more difficult is it going to get to understand where this labor market is going, Michael? On one hand, you have the labor force participation. You have a shrinking force, but might be hard to gauge depending on just how robust some of these surveys are and people's willingness to answer the surveys. And on the other hand, you have things like the Challenger's job report talking about tech being the bulk of layoffs that we've seen. How difficult, with these big macro trends coming in, is it going to be to gauge a real shift in this labor market?
Yeah, it's really hard, right? I mean, that is just the challenge of economic data generally, even in good times, even when the economy is not volatile, even when there's not big policy challenges or issues with data collection. I mean, consider how in real time we're attempting to measure the total number of employment, the total amount of employment in the United States for July, and it's the morning of August 1st, right? I mean, that's very real-time data. And I think some of those challenges, what they do, it's not that it makes the data more accurate or less accurate, it just creates more volatility, more noise, a little more susceptibility to revisions. And I think what it requires is just trying to take the totality of the data, right? So for example, we talked about the unemployment rate. I think that's 1A today when thinking about it. But you want to look at other things. You want to look under the hood at the breadth of hiring. You want to look at the prime age employment population ratio. We want to look at jobless claims and JOLT and all these data and try to take that totality of it and form an opinion on where are we at right now with this labor market in the cycle.
It's August 1st. I have to keep reminding myself that. Michael Puglisi of Wells Fargo, thank you so much. The totality of data has turned into a whisper number, I believe, of 120 in a range potentially of 0 to, what, 170?
I mean, really reasonable people can look at this market and come up with 2 different ideas of where we are. I have to say, a whisper number being a little bit more strong is something we haven't seen in a while. So I think it's this continued expectation that we are resilient, that the numbers will show up strong. Hopefully that won't break, but what happens if it does with stocks at all-time highs and credit spreads at the tightest since 2007?
Yeah, what does it mean to break? Coming up next, Priya Misra of JP Morgan, former senior White House trade advisor Kellyanne Shaw, Ares Management Chief Executive Officer Mike Arrighetti, and Sarah Wolf of Morgan Stanley as we count you down to that jobs report in a very busy morning.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
How much does the geopolitical volatility emanating from the United States perhaps undermine the bull case for Mexico? Is that a scenario you've plotted out?
structurally speaking, we do still have a very positive view in Mexico. On the macro side, it is a very attractive investment geography for the U.S. Mexico is hugely competitive in terms of costs. The wages in Mexico are much more competitive than the wages in China. So why would the U.S. companies not take advantage of that?
And this structural cost advantage is going to lead Mexico to continue to contribute to the growth of U.S. as well. The value chains, the supply chains are so integrated that Mexico has to play a continuing role in the further development of the U.S. And U.S. is growing very healthily, very nicely. It will benefit Mexico this way or that way. It will benefit Mexico.
Mexico for BBVA is, a source of resiliency of earnings, and it generates and complements the diversification that we have from the footprint. But there's another topic that is very important, which sometimes we don't focus a lot about, and why we're so convinced that Mexico is going to continue to do well, which is the leverage in the country. Because the leverage in the country is only 33%. And when you've seen Mexico grow and BBVA grow in Mexico, structurally speaking, the leverage is so low that just a little bit of growth in the leverage is going to be able to support that bull case in Mexico. So that's why we're structurally positive in Mexico.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Bull market. I like the fact equal weight S&P is getting involved with tech.
Tech is helping the stock market quite a lot.
If you look at what's driving markets, the Mag 7 are driving about 1/3 of overall market action. The market is pricing in some idea that you are going to get that broadening of the AI benefits.
Clearly, the companies that are succeeding in the markets today and seeing investor dollars flow into them are those that have a clear AI strategy.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning. Welcome back to Bloomberg Surveillance and to the start of a new month, starting that new month, that new week with a new slew of tariff rates and possibly a new deadline, causing some turbulence in stocks that have already gotten to pretty high valuations ahead of a key labor figure coming out in 90 minutes time this morning. We are seeing a little bit of a softness in futures as markets turn ahead of that key payrolls report. You could see the weakness really accentuated in the Russell 2000, but also in big tech. NASDAQ futures lower by 1.3% after, I guess, a disappointment, maybe just not hurdling that high bar highly enough from the likes of Amazon. Meanwhile, in the bond space, a real sense that there is enough resilience in this labor market to prevent the Fed from cutting rates. You can see yields higher across the long end, front end a little bit softer as you do get job owning from the Fed, and you bleed this through. What we're seeing in the currency space, it has been a rip-roaring month, the month of July for the dollar, with the strongest performance going back to 2022. Sort of continuing that today, but really just fluctuating there. The euro kind of going nowhere versus the dollar, 114. Meanwhile, what we're seeing today is this question of what is a deadline? Anne-Marie, is August 7th the new deadline?
Well, it's self-imposed, so deadlines can definitely move, especially if they're self-imposed. And we've seen this story before with the Trump administration with these deadlines. They are fluid. So now with this executive order coming out, this statement, I'm looking at the fact sheet now, they're saying that in 7 days, on August 7th, basically, that is when these rates you're seeing on your screen right now will come into place. And everyone's been talking about Switzerland because the rate now is even higher than it was in April 2nd. April 2nd was that shock and awe. The market seems to be digesting this a little bit more, but what we have in place is what the president promised on the campaign trail: 10% baseline tariff around the United States, 15% or higher on certain trading partners. Key is, in this fact sheet, several countries have agreed to or on the verge of agreeing to meaningful trade deals, which is why everyone thinks we are still in negotiating mode when it comes to this White House.
And Danny, I'm really struck by the fact that we are seeing some softness in equities, but it seems more attributed to just where we're coming from than, say, some of these announcements. And it raises this question, as we were talking to Sebastian Page, how much do tariffs actually affect stock valuations given how dependent this economy is on services?
Well, they affect you if you're Ford, but Ford is much smaller than, for example, an Amazon or a Microsoft. But the thing is so much of the confidence of this market had been built up around this idea that Trump chickens out. I don't know how we look at yesterday and still have that narrative and still have that idea that Trump is going to back off of things, because it is clear he is not. I think Terry Haynes put it well, that this is not a trade war. It is war with trade being used as a tool. Trump is not afraid to put these tariffs on. Perhaps more what we're trading on is that other countries will chicken out. This idea that other people will back off and get us to a lower rate.
And potentially the other companies will struggle more with these tariff rates than the United States. And that's why it is important to look at the actual data coming out, and really highlights July's non-farm payrolls number, expected to be somewhere in and around 104,000, with a higher whisper number ahead of that. That's the reason why I found this Truth Social post so interesting from President Trump this morning, Anne-Marie, coming out and saying maybe the rest of the board should take control if too late Powell doesn't cut rates. It raises a question. If he has seen the data, does he not like said data?
Well, I think that's the question, right? If he's seen the jobs report, is it a bad number or a good number? He's saying the board should assume control and do what everyone knows has to be done. He's really leaning on the two dissenters we saw this week coming out. It already is a deliberative body. The board already agrees. But once again, not just John Bowden, the Fed chair, but also leaning on other members of the FOMC to maybe come out, voice their concerns, and be a dissenter. This is going to be a very important payrolls report. Then we have one more, and then it's the September rate decision. And the president this week said, I hear they're going to cut rates in September. Well, will they? Depends on this data.
And we are expected to hear more from the dissenters in terms of just how much they are going to lean into potential weakness in the labor market. Coming up this hour, Priya Misra of J.P. Morgan, with stocks extending a 3-day losing streak. Former senior White House trade advisor Kellyanne Shaw with President Trump unveiling new global tariff rates, and Sarah Wolf of Morgan Stanley counting down to payrolls. We begin this hour with stocks dropping as President Trump boosts global tariff rates and investors await U.S. payrolls. Priya Misra of J.P. Morgan writing this: I think risk assets are priced to perfection and vulnerable to any further slowdown. Priya joins us now. Priya, so good to see you. Thank you for being here. This kind of piggybacks on what we heard from Goldman Sachs, pointing to global credit spreads at their tightest going back to 2007. Do you think that this is overly complacent because there is weakness in the economy, or just because they have gone too far, too fast?
So I think there's an element of that valuation point. If you look at risk premiums across the board, interest rate vol, credit vol, equity vol, all extremely low. I think the view is the economy's been resilient so far. We're getting certainty. Now, I would argue the market might be a little complacent on certainty. We're still in that negotiation phase. We still don't know the sectoral tariffs. But I think there's hope that, well, we kind of know the tariffs and companies can adjust. And so the resilience stays. I think this soft landing is essentially what's priced in, and then the Fed's going to cut. Well, this all starts to shake a little bit if the economy slows down, but the Fed is nervous around the inflation risks. And that's what we heard from Chep out. I think the bar for them to cut it has actually increased in the last few months. And if the market gets a whiff of that, you're not getting the rate cuts that you wanted. You might have that stagflation actually show up in the data. I think that's where risk assets, those risk premiums should rise. You know, I think credit spreads, you have to be really careful. High-grade companies, I think with very high, pretty high operating margins can absorb a lot of this. We just don't know how much will the margins compress versus how much do they pass on. And so I think, you have to do the research, and there's sectors we like. We still own credit spreads. We are, though, moving up in quality, because I think some companies are going to struggle. They're going to struggle to pass it on. Then they're going to, that's going to hurt their margins. And then they're going to have to start laying off. That's when this thing becomes more than just soft landing and you start to worry about a slowdown. So far, the data has been okay, but I would argue we're operating under 10% effective tariff rate. Last night's announcement, what we've seen over the last few weeks, that's moving closer to a 20% number. And that's not a shock value of 20%. We've just sort of drifted to that 20% number with uncertainty, I think, still at a fairly high level. If that weighs on what companies are doing, what households are doing, I think that's what worries me, that we haven't seen the economic impact of that 20% effective tariff rate.
We've had more than one person on the show this morning saying we won't really see that much of impact, though, because this is a services-based economy, that goods matter less, that in an overall picture, the tariffs, something at 15%, isn't going to have an outsized impact. What would you say to that?
So I think there's some element to that, absolutely. And that's why business cycles have been longer, as you know, the world is effectively moving to a service economy. Here's the issue with that. If companies do try and pass on some of this, the tariffs, real disposable income starts to go down. So do I cut my service consumption because I'm going to have to pay more for the goods that I do need? Yes, my consumption basket's not 80% goods, but if I'm paying more for those goods, I'm going to cut back on services. Maybe I cut back on discretionary services. I still have to live somewhere and I have to pay rent. Do I cut back on vacation spending? So I do worry that the consumer, unless wages start to pick up, that's the key. So beyond the unemployment rate that we're absolutely going to watch today, I think more than the payroll number, it's that wages. We're seeing absolutely no signs of wage pressure. That would make me a little more comfortable that consumers may be able to continue to spend on services. But if wages continue to be around here, which is our sense from the quits rate, not just from the payroll report, but across the board, we're seeing a low hire, low fire market. I think in that case, consumers start to cut back on other things. There are already real personal consumption expenditures. The first half of this year, 1%. What was that number in the second half of last year? 3%. So there has been already a reduction. If that continues, I think then it's going to spill over. I'm not talking about a recession, but you have to worry about, does growth get closer to zero from that, sub-trend 1.5% to 2% rate? And I think that, in my mind, is not priced into risk assets. To our earlier discussion, it's also not priced into rates. So I think owning some duration here makes a lot of sense.
What would that look like if it was priced in? How should we be trading if we are to incorporate that?
So I think it depends on how much are we slowing. If you're just slowing to the unemployment rate at 4.5 or 5, the Fed can get close to neutral. Now, what is neutral? We need a lot more time to debate that. And I think there's a wide range of views, 3 to 3.5. So that's a 10-year closer to 4%. If you're telling me this is actually slowing to the point where the Fed has to get into accommodative territory, they're cutting what the president actually is asking for them to cut. I don't think we're getting there. But if the data supports it, at that point, you're looking at much further declines in rates. That is a tail risk scenario. It's not our base case. But we're thinking the 10-year should be closer to 4 or a little below 4 rather than this 4.5 level. So I think that's where you've got that value of hedge. We're not seeing that sell America trade. That was a big concern. I think the last time I was on, I was saying, I don't know about correlations. Correlations are back. The Fed's telling you they'll react. We know the reaction function. It's the economic outlook that's extremely uncertain.
The president says the board should assume control if Jay Powell won't cut rates. We know it's a deliberative body, but do you expect more dissenters?
I think if the dual mandate gets more intention, so if you get the inflation numbers ticking up higher, as service inflation doesn't fully offset goods inflation, and the unemployment rate starts to rise, I think it's quite possible we get dissents, but I think it's not necessarily political. I think there's a narrative that the dissents were all political, that they're all just trying to audition for the next Fed chair. I think there's an economic debate here. That is the unemployment rate. If there's tension between the two, which side of the mandate do you give more importance to? So I would expect, yes, if the stagflationary shock, that 20% effective tariff rate is what we're living with, I think you'll see more dissents unless the data tells the Fed clearly. If it's a slow grind to a rise in the unemployment rate and inflation picks up, I think you'll see more dissents for good reason. And that's what the Fed should be doing. It's a committee. They should debate it, and then maybe they start to cut but not commit to a cutting cycle, because they can just start the process and the end point might be more open.
What's the pain trade today after we get this data? If the data is too hot or if it's too cold?
I think the too cold, I don't know, because at that point the market might say, oh, the Fed's going to cut. What if you get a 50,000 on payrolls and a 4.2? The Fed's going to say, okay, the growth in jobs is slowing, but so is the labor supply. And that's worrying, because that means things are slowing down, but you're not getting those rate cuts. I suspect a lot more truth socials posts on that, maybe more dissents. So that's one. And then inflation. You get a pickup in inflation in 2 weeks' time. That's another form of pain trade where every market's going to say, okay, maybe now we're seeing the economic impacts of that 20% tariff.
I can guarantee that whatever happens, we will be getting more Truth Social posts. Priya Misra of JP Morgan, wonderful to get your thoughts. Thank you so much. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Lizzie Burton. Lizzie.
Hey, Lisa. President Trump unleashed his latest round of tariff announcements just hours before his August 1st deadline. Most countries are facing a baseline 10% tariff rate, but Trump slapped 35% tariffs on Canadian goods not covered under the USMCA. The new tariffs will take effect August 7th to give US Customs and Border Protection time to prepare. Elsewhere, Exxon reporting second quarter earnings that beat analyst estimates. Robust oil production from the Permian Basin and Guyana cushioned the impact of lower crude prices. Exxon sees continued growth and plans to, quote, create value through acquisitions. And the end of an era. Ray Dalio has sold the last remaining stake of his in Bridgewater Associates and left the hedge fund's board. Dalio first announced his succession plan more than a decade ago, but didn't fully hand over the reins until 2022, when he transferred his voting rights to its board of directors and stepped down as one of its 3 co-chief investment officers. Dalio founded the firm back in 1975. And that's your Bloomberg Brief. Lisa.
Thank you so much, Lizzie. Up next, reshaping global trade.
We have made a few deals today that are excellent deals for the country. You know, we're taking in literally trillions of dollars for the country. They have to pay a fair rate. That's all. It's very simple. All we want is fairness for our country.
Joining us next will be former senior White House trade advisor Kellyanne Shaw to translate. And next hour, we'll be speaking with U.S. Trade Representative Jamieson Greer, fresh off navigating all of these trade conversations with some insight there. This is Bloomberg Surveillance.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything.
An hour and 14 minutes until that key payrolls report. Right now, we are still reeling from a slew of data, a slew of tariff numbers, and a slew of earnings reports from a number of big tech behemoths. All of that bled through the markets, and you could see a futures softer, down 1% off some of the lows earlier this morning, S&P. Meanwhile, just kind of flat in the currency space. Euro dollar going nowhere, 114 after a blockbuster month. The biggest monthly gain for the dollar going back to 2022. Yields grinding just a touch higher as people try to parse through the inflationary ramifications plus potential pressure pressure to cut rates under surveillance this morning, reshaping global trade.
We have made a few deals today that are excellent deals for the country. You know, we're taking in literally trillions of dollars for the country. This is making our country very rich and respected again. 1 year ago, we were a dead country. Now we're the hottest country in the world. They have to pay a fair rate. That's all. It's very simple. All we want is fairness for our country.
Here's the latest. President Trump revealing a new tariff rate set to take effect on August 7th, or rather many tariff rates. This boosting the average U.S. tariff rate to above 15%. Bloomberg's Jack Fitzpatrick joins us now from Washington. Jack, it's been tough to really understand all of the different rates. They're all over the map. What's the latest on what we know and how firm it is?
Well, we know it's not terribly firm, or at least that's how it's being interpreted. Already today, we've seen a comment from the president of Taiwan saying he thinks that 20% tariff rate is temporary. Understanding President Trump's approach to negotiations, it is fair to say that there are going to be more talks. There are going to be countries coming to him. He really prefers to have people coming to him seeking, if not handouts, a better deal than they've gotten. And of course, there were some surprises, some negative surprises when you look at the 39% rate for Switzerland that Swiss officials took as surprisingly negative. So there is certainly an expectation that there will be more discussions. Overall, I'd add to that, if you're trying to suss out how much uncertainty there really is, the skeptical tone from the justices on an appeals court, a federal appeals court, about Trump's legal ability to do these tariffs with his emergency powers adds to the uncertainty. And of course, there's the China question with the current truce running through August 12th and then perhaps being extended. So there's a lot of information there. There's a whole table of tariffs.
For running through all.
But there's also plenty of uncertainty and an expectation that things could change going forward.
A new table and possibly a new timeline. Bloomberg's Jack Fitzpatrick, thank you so much for running through all of that with us. Joining us now is former senior White House trade advisor Kellyanne Shaw. Kellyanne, is the new deadline August 7th?
Good morning. Thanks so much for having me back on. I think the deadline is August 1st. Customs really needs about a 7-day period to try to effectuate some of these tariff rates, to update the HTS, to give notice to importers. Like, this buffer is actually just necessary for logistical reasons. But that said, there's no real deadline, meaning countries can come to the president and request to have a lower tariff rate either 3 days from now, 3 months from now, or 3 years from now. And the president has said that he's willing to talk and to see what can be done if countries are willing to either lower their tariff and non-tariff barriers or invest in the United States, which is another option that Japan proved is on the table.
Perpetual negotiation is what it sounds like. Kellyanne, I'm shocked by Switzerland. They had a 31% tariff rate designated April 2nd. Then during the reprieve, it was 10%. Now they were at 39% when I thought they were on a cusp of getting a deal. What is going on with this trading partner?
Yeah, the number one question I heard was what happened to Switzerland as soon as these rates came out. And to your point, there had been rumors of a deal that had basically been in hand. But the way that these negotiations had been unfolding is that USTR, Commerce, and Treasury were negotiating a package and then presenting them to the president for his final seal of approval. And in many cases, that involved him picking up the phone and talking to various world leaders to see, is this really your bottom line? And so it could be that the president had a similar conversation with his Swiss counterpart that didn't go particularly well. But when you look at that 39%, that's almost triple Switzerland's European cohort. Clearly something went off the rails. And I do expect that whatever beef between the U.S. and Switzerland may have unfolded, as soon as that de-escalates, we'll see that rate come down.
And this is a country that's in the top 5 when it comes to foreign direct investment in the United States. So for certain countries, are you viewing August 7th as potentially the new deadline for a country like Switzerland?
Well, again, I don't think that there's really a deadline here now. I do think that the Swiss are probably pretty panicked at the moment about this 39% tariff rate. So I would expect that we would see some progress potentially in the next couple of days on that deal. But there are a couple of other deals that the president hinted at yesterday in those comments. We haven't seen a deal with Taiwan. We haven't seen Thailand or Malaysia. There are other trading partners that have been in active negotiations. And so we could, between now and next week, see some of those deals announced and those tariff rates slightly adjusted.
Kellyanne, when this conversation first started earlier this year, one of the real concerns was that there would be retaliatory tariffs for various nations, or that various nations would try to band together to try to get something or some sort of concession from the U.S. That hasn't happened at all. What do you make of the lack of reaction from some of these trading partners and just more concessions?
Yeah, what's been really interesting is that we're talking about tariff rates somewhere between 10 and 25% on average that the U.S. is now imposing on all of its major trading partners. That is really a transformative way to manage the U.S. economy. We haven't seen tariff rates like this in almost 100 years. And so this idea of our trading partners just accepting those rates has been pretty interesting to watch. And you saw Ursula von der Leyen over the summit in Scotland this weekend saying that she accepted the president's premise that this relationship between the U.S. and the EU had been unbalanced, and that the EU was willing to then agree to this 15% tariff, and same for Japan and South Korea. So we haven't really seen the pushback we thought we might from some of our trading partners, which goes to show just how broken the global trading system was to begin with, where countries are actually falling in line with the president's vision of just higher tariffs from the U.S. side. It's pretty incredible to watch.
They fall in line, but how much of this just results in just a little bit of trading less with the U.S. and some of these global partners looking elsewhere?
Well, we'll have to see. And that's certainly the point that a lot of our significant trading partners are making, that if the U.S. is not open for business, we're going to go elsewhere. We'll go to China. We'll find other markets to diversify. But we'll have to actually see how this plays out. And even on the private sector side, for companies who've been waiting with bated breath for a bit more certainty on the tariff landscape, I think it's going to take several weeks to absorb and understand what these tariff rates really mean, how that impacts supply chains. And then again, for our trading partners, whether or not they want to continue doing business with the United States or not, I think we're going to see that play out over the next several weeks and several months. I don't think this is an overnight decision, but clearly there has been buy-in to the fact that the old way of doing trade didn't work. And so there is a search for a new path. And if this is it, the president will have hit it out of the park. If not, we'll see something else emerge over the next several months and years.
The advice a couple of weeks ago was to grab a beer and just wait. Right now, Kellyanne, what's your advice to corporate clients?
Yeah, I think the time for the beer may have come and gone. I think some of these tariff rates are going to be a bit stickier, just in terms of this global 10% to 15% baseline on most of our trading partners, with some elevated rates, 20% in Asia. And then there are some outliers, like we talked about with Switzerland and others, which we may see adjustments on. But I do think you can now start to see a bit of a clearing in the path in terms of what some of these tariff rates might look like. But the other side of the story we don't know about is what concessions our trading partners may have made. And for many of these trading relationships, it's not just the tariff levels that matter, it's these non-tariff barriers that can be the difference between doing business in an economy and not. And we haven't seen the text of these deals that have been announced, what concessions, again, may have been made. And I think we need a bit more certainty there before we're really going to see businesses moving in this new direction.
Former senior White House trade advisor Kellyanne Shaw, thank you so much, and have a wonderful weekend. Maybe not pounding beers, but pounding Red Bulls and Celsius.
Yeah, as long as those Celsiuses aren't high noons. What I was so struck by what Kellyanne Shaw said just there is the fact that these deadlines don't really matter. And the fact sheet basically says that. You can come to us with a new trading deal if you have one. So we could be talking about this for the next 3 months or the next 3 years.
What were we saying about certainty and whether we were getting any certainty? We'll be talking about that throughout the show. Coming up, though, don't miss this, a fantastic guest that we have, Ares Management Chief Executive Officer Michael Arougheti, on the shifting private capital landscape after reporting earnings. That's just ahead.
Okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talk with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Bringing you up-to-the-minute news whenever and wherever it happens, I'm Matt Miller at the Circuit de la Sarthe in Le Mans, and this is Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Just 1 hour from the third biggest story of the day, evidently non-farm payrolls, at least for now, but it will become the main event as people try to understand exactly what ramifications that figure has on Fed policy. Right now, a bit of softness after earnings that disappointed from Amazon in particular. S&P futures lower by 1%. You could also say perhaps a little bit of a top blow-off given such high valuations. Euro dollar not doing much of anything after a blockbuster month for the dollar, the strongest monthly gain going back to 2022. Yields creeping higher. 2 hours away from the cash open. The morning movers is where it's at. Danny, what are you looking at?
I'm looking at Eastman Chemical this morning. Chemical company is always interesting just because of their exposure to so many parts of the economy, down 12.5%. It reported yesterday it was a miss, basically saying it's the challenge of the macro environment, that there's caution because of the tariff landscape. Then there was Exxon. They reported this morning it was a beat, and there you see shares just under 1%. Yes, there were lower oil prices, but they offset some of that with robust oil production from the Permian Basin and Guyana. Finally, Figma, the IPO that has finally arrived, shares up 20%. They have surged 250% since they IPO'd. It values the design software firm at $56 billion, so maybe some hope that IPOs are returning this year.
Yeah, it's really interesting to see all the IPOs that have come out actually perform better than they have in previous years. There just haven't been that many of them, so it raises a question. Talking about that in just a bit. On our radar this morning, the top story, President Donald Trump unveiling new tariffs, boosting the average U.S. rate on goods across the world to 15.2%. The new tariffs take effect after midnight on August 7th. Don't miss our conversation with Jameson Greer, the ambassador who's been really working through all of this, Anne-Marie.
Absolutely. He's at the negotiating table for all of these deals, and some of these deals that they didn't quite get to the end there, like Switzerland, like Taiwan, like India. And I think that's really where we want to focus on. What happens in the next 6-7 days with these countries that their tariff rates have gone up, like Switzerland, since April 2nd, even though they've been in constant communication. And the Swiss trade representative told me in June negotiations were going well, and she was given reassurances by Bessent, by Greer, that as long as they were in good faith, they would get an extension of the deadline. And clearly, they did not, unless August 7th is the new deadline.
Well, and then it also raises the question of when are negotiations finished? Or are they constantly ongoing? President Trump sending letters to 17 of the world's largest drug makers demanding they charge the U.S. what other countries pay for new medicines. The president giving the companies 60 days to voluntarily comply and threatening action if they don't. Those shares are falling across the board, although you could argue that those like Novo Nordisk have been hit by other things, like the disappointing performance of their weight loss drug. We'll get into that in a bit, but a tale of two tech earnings. We do want to talk about what we got last night. Apple reporting a strong revenue beat and a rebound in iPhone sales, saying, no, it's not just a bringing forward of demand. Meanwhile, Meanwhile, Amazon's profit guidance and cloud growth falling short of street expectations, and this really raises the issue. How much, Danny, is there going to be a penalty for companies that are not effectively using spending that is just not mounting and mounting among the 4 tech behemoths?
But we still don't even know how effective that spending is at this moment. People have kind of been hailing Meta. Oh, look at Meta. It's such a great example. They spent a lot, and things like ads are getting better. More people are using Instagram. The problem is the type of AI they were using was kind of the older kind. It wasn't the generative AI that everybody's piling into. So you have this moment still where they are trying to one-up each other in terms of spend, and we still don't have exactly what the implications of that is going to be and what the use case is going to be. And I think in the Amazon earnings, you see the nervousness to make sure that it really shows up.
If you feel this year, like all of this has been a lot of just complicating noise, and you want to just take a look at what is actually going on the ground that doesn't really move as quickly and doesn't have the same kind of whipsaw from headlines that some of the public markets do, we got to look at alternative asset management, which is really what so many different investment managers have been talking about, is the alternative to this whipsaw head-spinning world that we've been talking about all morning. Ares Management, a global alternative investment manager with over $570 billion in assets under management, reporting second quarter earnings today, highlighting solid financing growth, momentum, and seeing the market come back to life. Joining us now, I'm so pleased to say, is Ares Management CEO Michael Arrighetti. Thank you so much for being here with us. I want to start with this idea that you did a really solid performance, despite the fact that LBO volumes were materially lower than last year, and there's this expectation that deals were going to pick up in the second half because of trade certainty. Well, have we gotten that certainty to really kickstart that type of corporate activity?
Yeah, I think there's a misconception that alternative asset management is just driven solely by M&A and private equity volumes. But when you really zoom out and you say, what is going on in the private markets? We are active in digital infrastructure, real estate, private credit, asset-based finance, and really a broad cross-section of the global economy. So if you look at our quarter, we put $27 billion to work this quarter in a very subdued deal environment. What's happening now in the private markets is there's a huge need for liquidity solutions and refinancing. If you look at private equity as one example, there's about $3 trillion of private equity that's been invested that needs to get returned to investors, and about $1 trillion of new capital that needs to get put to work. So there's this huge imbalance. And so one of the things that private market providers like us are doing now is really coming in with creativity and innovative solutions to try to buy down that installed base of private equity. So we're not really reliant on deal volume. Obviously, we love it when the markets are ripping, but when they're not, it's still pretty good.
Does that mean that the lesson you learned from this period of when things are backlogged, and again, just given the breadth of the success in your earnings, that you need to de-emphasize some parts of the business that are more sensitive to M&A, that have more of a cyclical type of attribute to them?
I don't know if we want to de-emphasize. I think part of what we have tried to build is a business that provides solutions through cycles to our investee clients, whether they're private equity sponsors or large corporates, and our investor clients. And the only way that we could do that is to diversify the product set geographically, where we invest in the capital structure, what returns, what the structures are. So ideally, what you want to have is a business which we're demonstrating that can perform regardless of the market environment.
Well, part of the diversification was also things are uncertain in the U.S., to Lisa's point. Is that period over? Is certainty restored? Is it time to hit the go button again on deals?
You know, it's always great when I come on the show because you go to bed and you're like, oh, we're going to have this really nice, calm conversation about how certain things are and how deal volumes are going to pick up, and then we get a new headline. And as you said, Lisa, I think you have to try to find the signal through the noise. And when we look at our portfolios around the globe, the fundamental performance is still really strong. There's a lot of liquidity in the markets. There is a lot of pent-up demand to transact. We saw that in June. I think once we got the tax bill done and we saw some certainty on tariffs, the market really picked up. So I don't want to say that one headline on one day is going to knock us off course, but yeah, I think there's a real pent-up demand for M&A. Corporate M&A is picking up. Private equity pipelines are picking up. So I'm still optimistic.
What does that optimism look like throughout the year? What is your expectation when we get something that does look back to normal, that does see this pipeline that's being built up really be put into force?
I think on the private market side, you have to appreciate that the structure of the capital actually has a timeline on it. And so one of the things that people need to understand is just the weight of money in the private markets requires transaction activity. And so that $3.2 trillion that I mentioned, half of it is over 5 years old. And there's a desire to get that money back to investors to get the gears moving again. And so even if you don't have M&A, people are going to be looking for ways in the secondary market, for example, to do transactions. So I think you're going to continue to see the weight of the money and the time constraint push companies into the market. And I think on the corporate side, there's a desire to grow too. We did see corporate M&A pick up dramatically even in the last week. I'm sure if you talk to the sell-side bankers, they'll tell you the level of pipeline activity is picking up dramatically. So, I can't quantify what that looks like, but if June was an indicator, and we get some stability here, I think third and fourth quarter could be pretty robust.
You mentioned the tax bills behind us, tariff uncertainty, potentially some of it behind us. You see a lot of signal, less noise coming from that. And then there's this idea of deregulation. Is that what's pushing potentially some of this M&A?
I think there's absolutely a tone. And it's funny, you saw pre-Liberation Day, January, February, just the exuberance with the new administration, pro-business, deregulation, and you saw people come off the sidelines dramatically, and then we took a pause. Now that we've digested, you're beginning to feel that again. So I don't want to say that the animal spirits have been unleashed, but the confidence that the administration wants to push transaction volume is pro-business and focused on dereg, I think, is going to be a catalyst for sure. Yeah.
When you talk, I hear an economy flush with capital. I hear an economy that has plenty of access to financing. I hear that financing is not tight in any capacity. We're talking about tightest spreads in the global credit market and public markets going back to 2007. Do you think it is appropriate to start talking about more accommodation from the Fed, or do you think that that's problematic given what you're actually seeing on the ground with some of the companies that you're investing in?
Everything that we're seeing says that the economy is on stable footing. We're seeing continued growth. As an example, we reported earnings in our publicly traded BDC, 13% year-over-year EBITDA growth. And those companies, while levered, have actually digested the higher cost of capital pretty well. So to your point, we're living in a higher rate environment. The plumbing is working. Nothing's broken. Almost every liquid market is near all-time tights. So it doesn't feel necessary to take a more accommodative stance. I think tariffs will be inflationary. I know that there's an argument that some people put forward that it won't be, but to the extent that they will be and the economy continues to grow, that would argue for rates to stay higher for longer, or at least to see a slower trend down.
So, Mike, in this quarter, you had really robust fundraising coming from a variety of sources, but part of that was wealth, too. We're in this environment right now where there's an expectation that the Trump administration is going to open up 401ks to some private assets. You've seen some of your peers, KKR, Blackstone, Blue Owl, already set up partnerships with 401k providers. Is that something you're looking at as well? Yeah, we're probably the number 2 or number 3 player in the wealth channel right now. We raised about $6.3 billion in wealth product alone this quarter. Close to half of our AUM is in permanent capital vehicles right now. The 401k conversation is an interesting one. I am a huge believer in increasing access to alternatives to the individual investor, whether that's directly or in the retirement market. There's no reason that an individual shouldn't have the same access to alternative assets that institutional investors do. The 401k question, I think, is reason for enthusiasm. If you look at the size of that market and the solutions that are already there, that market for forever has really been fee first. And when we talk about fiduciary duty to the retail investor in defined contribution, it's what's the cheapest solution that I can get? And I don't think that that's the way that you want to be, shopping for investment solutions. It is a complicated set of circumstances in the sense that you still have to get through the executive order, which we haven't seen, although we expect to come. Then we need to see rulemaking. There's going to be a whole flurry of class action lawsuits, I'm sure. We're going to have to get plan sponsors comfortable with the idea, and then we're going to have to demonstrate that we can deliver excess return net of new fee agreements to the investor that
get them excited. So we're enthusiastic. We have product that's already geared and ready to go into that market. We have had significant dialogue with potential partners in that market. So if and when that time comes, I think you'll probably see us, jump in, just given our leadership position there. But we're being a little bit more tempered in our enthusiasm.
Yeah, it's interesting to hear some of that caution because other people have decided that this is off to the races for getting that involved in the 401k. And part of the criticism that comes up sometimes is you're going to get players that dump their worst assets in there. And then that brings with it more regulation and hurts the industry as a whole. Is that a real concern?
Yeah, I've heard people say that is not the concern. I think one of the significant transformations we've seen in wealth from prior versions is you are getting the largest brand name managers around the world that are coming into this market with institutional quality product. We're not going into these markets because we have to. We're going into these markets because we want to. And so there's really no motivation or incentive to do that. So I don't really understand that. But one of the things I always try to say to our people and even to our investors in the research community, when the 401k market opens, similar to just the wealth market opening, it doesn't have a transformational impact on what we can do as a manager. I'm just now taking assets that otherwise would find their way into an institutional fund and putting them into somebody's 401k. That's exciting because it now increases accessibility, it opens up new fundraising markets, it diversifies our business, but it doesn't give me a new product to then go into the market and deliver value to my customer. So we're excited about it, but until we get to a world where we're feeling like we're constrained in our ability to raise capital in other channels, I have tempered enthusiasm. If you look at our fundraising this quarter, we had our second largest fundraising quarter on record. We raised about $26 billion of capital this quarter. The fundraising has not been the challenge, I think, for most alt managers. It's really, can I find great quality things to invest in? And so the idea that we're going to continue to bring more capital in, it has as much possible risk as it does opportunity.
Michael Arrighetti, Ares Management, Chief Executive Officer. You've reported earnings. You go on vacation now?
Monday.
Okay. Well, a lot of people are hoping to do the same. Thank you so much for being with us this morning. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Lizzie Burton. Lizzie.
Hey, Lisa. President Donald Trump ramping up his attacks on Fed Chair Powell. The president posting on Truth Social this morning, quote, Jerome Too Late Powell, a stubborn moron, must substantially lower interest rates now. If he continues to refuse, the board should assume control and do what everyone knows has to be done. Elsewhere, shares of Moderna are falling in the pre-market after the company lowered the top end of its revenue forecast for the year. Meanwhile, its second quarter loss came in narrower than expected as cost-cutting efforts offset waning sales of its COVID shot. The CFO saying, quote, I hope it shows investors that we're being financially disciplined. And President Trump making some renovations at the White House, building a new ballroom. The 90,000 square foot space with seating for 650 people will cost an estimated $200 million. The president said that he'll pay for the project along with donors. And that's your Bloomberg Brief. Lisa.
Thank you so much, Lizzie. Up next, risks to the labor market.
The unemployment rate is still relatively low, but Chair Powell said more than once to a number of questions he thought the risk to the labor market was the downside. We're expecting a 95,000 headline gain, so a step down in the headline gain.
About 45 minutes until that non-farm payrolls report. Sarah Wolf of Morgan Stanley joining us next.
I think with the new world reorder, it means that there will be regional clusters of excellence. There will be regional clusters of great companies. And so it's okay to be number two, because you could be number two in every single region and still command that premium. Because today we talk about AI, we talk about data, we talk about processes that's going to be very specific to industries, specific to countries, specific to regional challenges that needs to be built and addressed. And therefore, the good of it is that now it's not just going for that one company and overpaying for that company until the returns goes to zero. It's actually about finding regional champions, which could also be huge category leaders for us as funds as well. And I think it's actually good for the world to have multiple pots of excellence that can be localized to its own needs.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Michael McKee in Victor, Idaho, and this is Bloomberg.
Trying to understand the weakness this morning. Is it because of the tariff rates, or is it just because people are exhausted from so many record highs and such incredible exuberance around American exceptionalism? Right now, it's just taken off a little bit, down about a 1% on S&P futures. Really, the dollar has been the story over the past month, given the fact that we've seen such a huge strengthening, a sort of reversal of what we had seen in the first half of the year. Yields just marginally higher, with a whisper number for that non-farm payrolls report in 40 minutes time of 120,000 jobs. Under surveillance this morning, risks to the labor market.
The unemployment rate is still relatively low, but Chair Powell said more than once to a number of questions he thought the risk to the labor market was the downside. And I think that's the concern. We're all looking for signs of which way is it going to break. We're expecting a 95,000 headline gain. So a step down in the headline gain. But if we think about the details, really details that are going to be no softer really than June.
Here's the latest. The labor market in focus as non-farm payrolls drop at 8:30 a.m. Eastern. Bloomberg survey expecting 104,000 jobs added and employment ticks slightly higher. Joining us now is Sarah Wolf of Morgan Stanley. Sarah, thank you so much for joining us. What would be considered a good number and what would be considered a bad number?
I think to Jonathan's point, it really is going to depend on the unemployment rate. So even if we get 50,000 payrolls with an unemployment rate that stays at 4.1% or barely edges up, maybe markets will get a little bit spooked at first, but that's not enough to get the Fed to move. We would really need to see a meaningful move higher in the unemployment rate, as Chair Powell mentioned, perhaps something closer to 4.3%. That would be above the consensus expectations for 4.2%.
Where are you seeing the bulk of the hiring and how much does that matter, right? We've seen, for example, healthcare comprising a huge part of a lot of the job gains over the first half of the year. There was the government employment that's sort of been one of the big wild cards. How important is the composition in this particular report?
Well, we definitely want to see good breadth in job gains because that indicates overall health of the economy. To your point, we were seeing a lot more concentration in healthcare and government. In the last report that we got for June, most of the job gains surprisingly came through state and local employment. And that's one of the reasons why overall payrolls are expected to slow quite a bit from last month. Can we sustain that amount of state and local jobs? Likely not. And so that's going to step down quite a bit. But we're looking at the underlying details, in particular manufacturing jobs. Are we starting to see the trade spillovers weigh on the manufacturing sector? We have not seen that to date yet. And then also looking at other sectors that are related to the trade war, so retail, transportation, and warehousing. We really want to be watching these sectors closely because we're all holding our breath to wait and see how bad the trade disruptions will be on the real economy. And so far, we've seen some slowing, but nothing that's flashing signs of red.
Well, the other potential drag and impact to this labor market has been immigration and just the supply of labor, Sarah. Part of the reason that the numbers themselves have been de-emphasized and we've emphasized the unemployment figure. How much do you expect it to show up? How do we understand what the impact has been at the moment of more deportations, be it self or otherwise, and what's to come?
We're already seeing it in the data. If we look at the labor supply numbers and labor force participation rate, that's been coming down. And it's one of the key reasons the unemployment rate has been staying at 4.1%. Demand is slowing, but also supply. And so what Chair Powell said back on Wednesday was that this creates downside risks to the labor market because we're not just losing supply, we're also losing demand. And so if supply were to start to steady, that deceleration in demand could very easily start to push up the unemployment rate. If we look at the immigration numbers at whole, it's been a massive slowdown. Last year, we were having over 3 million in net immigration. That number is coming in roughly a quarter of that pace this year. And it could come in even lower if we do see that meaningful ramp up in deportation. So it really hits both ways, where it's helping keep the unemployment rate low in the labor market type. But one of the spillover risks is that if you can't hire lower skill, lower education workers, you also cannot hire higher skill, higher education workers for those same projects. So think about construction, for example. Research finds where when you have stricter immigration policy, not only does it weigh on lower skill jobs because you can't start these construction projects, but also higher skill jobs because you don't need general contractors, for example. So we could start to see those types of spillovers as well.
Sarah Wolf of Morgan Stanley. Sarah Wolf of Morgan Stanley, thank you so much for being with us. Right now, the expectation, the survey has 104,000 jobs. The whisper number, I love the whisper number. It makes me feel like I've got to go like 120,000. People are expecting the upside surprise given some of the beats that we've seen in recent economic data points.
It's like it's a secret what Wall Street thinks.
Exactly.
Don't tell anyone. You have to say it underneath your breath.
There's a ticker on the terminal, but carry on.
No, but it's true. It is a more robust figure because we've come to expect that. Do we need to start to expect the opposite of that? Part of that has to do with the labor force participation, I think, that number getting lower and lower, but how much can we brush it off of as that versus something that represents actual weakness?
Yeah, and there's a real question of how policy really goes into this. And Anne-Marie, we're going to be looking for any further truths. I'm sure there will be them. There already have been some this morning.
Right. The president is really now going after the entire Fed board, saying that at some point they're just going to have to overrule the Fed chair, even though we do know it's a deliberative body. We saw 2 people dissent. Maybe the president is trying to say, anyone else want to maybe be Fed chair? This is your moment to dissent.
Yeah, and is there an economic justification for it? Coming up, we will be talking about that, getting the numbers. Nadia Lovell of UBS, U.S. Trade Representative Jamison Greer. Do not miss that conversation after the tariffs that were announced overnight. Stephanie Roth of Wolfe Research and Mike Collins of PGIM Fixed Income. This is Bloomberg Surveillance.
I think people are paying attention now to what we're doing in a way that wasn't happening 5 years ago. I think the convergence, not just of the hardware investments, but the AI investments in particular, have been the real watershed for us in helping people understand why we've always believed having these devices be wearable and having sensors and having context in the world around you has been so important. And it's like, oh yeah, of course, now that you realize there's going to be a potentially super intelligent assistant that's operating there, you want it to have, for free, all the context on what you've heard, what you've seen, what you're doing, so it can help you the most out as you go about your day and try to accomplish what you're trying to accomplish. So we feel a lot of vindication on that. I think the question is, will it be us? Will it be a competitor? That depends on our execution and their execution. I have a lot of confidence that the paradigm that we're in right now, which has been stable for a long time, right? The phone that you all have in your pockets now is roughly the same as the phone you had in your pocket 4 or 5 years ago. There's not really a lot of new innovation happening at that scale. There is a lot of things. The phone is the greatest consumer electronic device ever built, and yet there's also a lot of things that we wish it could do better or different. And I think with AI and integrated context with the world around us, that becomes more and more obvious. So I'm very confident that the paradigm will shift in that time frame. And you all know the saying, we get a lot less done in 1 year than we think and a lot more done in a decade. That really is going to be true, I think, when it comes to these shifts.
the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
As Bloomberg's global financial correspondent, I get to meet the people shaping the way money flows around the world. And I want to bring you with me.
Now we're playing.
Yep, now we're playing. First and foremost, I am a capitalist. The capitalist system is the best system in the world. There isn't another one that works as well.
Citigroup moves $4 trillion a day.
5. Wall Street used to be a place.
I love all these new Wall Streets. Y'all Street, Wall Street South.
Now it's more of an idea.
The optimism here is infectious.
You think our New Yorkers are negative?
Yes.
Anything that trains people to understand probabilities and just think through things with a greater degree of nuance is a service to humanity.
I hope you survived the day.
I did. It was a busy day.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
The US has a dynamic economy, a strong labor market, and it will outperform a lot of peers.
There are sufficient signs of weakening.
You see consumers cutting their spending back, but continuing to get jobs.
Job growth is slowing down. You could see a bigger slowdown starting even in the next jobs report.
Unemployment rate has been the most important data point you get, for a while now.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning. Welcome back to Bloomberg Surveillance. 30 minutes away from the July payrolls report, a bang to kick off August. And no, it is not just data. It is not just earnings, but also a deluge of new tariff rates on the U.S.'s trading partners. And Danny, right now, the focus turns very much to what we see in the next 30 minutes ahead of that payrolls report, given some of the strength that we've seen in current data.
And part of it is because the tradability of the tariff story itself has really diminished. We've come to accept some of these rates. So in turn, what happens is we need to see the consequences of it, the legacy, the changes that happen because of uncertainty, because of tariffs. And that's where the data matters. This market is numb to the headlines coming in. Potentially what it's not numb is to things like jobs data, the next 2 months of data that the Fed said that it's going to be so important for them. So that's where this focus turns. Even if this morning we're a little bit weaker, but not falling off a cliff like we did on April 2nd.
Really setting up today's data was the Fed meeting on Wednesday. The idea that you had a Fed chair that said he still sees a stable, a strong, resilient labor market, and then you had two dissents from Fed governors who cited labor market weakness. That's really highlighting how important it is to see whether any of that weakness shows up in 28 minutes' time.
Especially when Jay Powell said that the most important number for him, the main number, is going to be the unemployment rates. That's where everyone's going to be looking at. And then you have the president this morning talking about the fact that, yes, he called Jerome Powell too late once again, but he said if he continues to refuse to cut rates, quote, the board should assume control and do what everyone knows has to be done. Potentially the president here is signaling, I see you two double dissenters, I take this on board, and maybe we should get some more dissenters at the FOMC.
Right now, a lot of turmoil, you bleed it through the markets, and you get softness after a lot of record highs, coming off very high valuations, which have raised some concerns about whether things have gotten stretched. S&P futures lower by about 1%. NASDAQ down around the same amount. You're seeing in the bond market yields just creeping slightly higher at the long end, ahead of what could be stronger than expected data if you believe the whisper number. And you can see that 30-year yield at 4.93%, up 3 basis points. And then in the currency space, it really has been all about dollar reclaiming some of its haven status after the biggest monthly gain going back to 2022. Right now, we do want to head over to Michael McKee, who has some breaking news. After we get there, we're going to be speaking with U.S. Trade Representative Jamieson Greer. But Mike, before we get there, what are we hearing about what Mickey Bowman and Chris Waller said about why they dissented on the Fed's meeting on Wednesday?
Well, the Fed's blackout on speaking has lifted, so we are getting statements from both of those Fed governors this morning on why they dissented, essentially saying the same thing, that they see the cracks in the economy as a bigger danger right now than other members of the committee, perhaps. Chris Waller, he had laid out a rationale for his dissent earlier in the month of July, and he repeats most of that today, that the labor market looks like it's starting to show signs of weakening. He says, I believe the wait-and-see approach is overly cautious and, in my opinion, does not properly balance the risks to the outlook and could lead to that policy falling behind the curve. When labor markets turn, they often turn fast. If we find ourselves needing to support the economy, waiting may unduly delay moving toward appropriate policy. Mickey Bowman's statement is pretty much the same thing. She takes the same tack about the idea of getting behind the curve, saying that she sees the risk that a delay in taking action could result in a deterioration in the labor market and a further slowing in economic growth. Taking a proactive approach in moving closer to neutral would avoid an unnecessary erosion in labor market conditions and reduce the chance that the committee will have to carry out a significantly larger policy correction at a future date. Both of them are careful to say they respect the opinions of the rest of the committee. They're going to work with everyone on the committee. There's no hard feelings here. They just think that it's a little more important to sound the alarm now and maybe be a little premature than wait too long.
Michael McKee, stay close. Thank you so much for that analysis as we wait for the labor market data to show whether this is something that is a slow-moving train and then all at once when it comes to weakness. Coming up this hour, we're going to be speaking with U.S. Trade Representative Jamieson Greer with President Trump's tariff deadline arriving and then sort of being pushed out. Question of how much we continue to negotiate. Nadia Lovell of UBS with stocks on a 3-day losing streak. And Stephanie Roth of Wolfe Research reacting to this morning's payrolls report. We begin this hour with stocks falling as traders await jobs data out in just under 30 minutes time. Nadia Lovell of UBS writing a strong payrolls number would put downside risk to our September rate cut call. But what continues to be more important for equities is the structural growth story in AI and electrification. Nadia joins us now. Nadia, great to see you. Thank you so much for being here. And we will get to the AI story, but let's start on how hinged this equity market is to the idea of rate cuts. Do they matter?
I don't think that it matters that much. And the reality is, if we don't get a rate cut, it's an indication that the economy is still in good shape. I mean, Powell has said that we're at full employment. If we do get a rate cut, it probably means that the unemployment rate has moved up and the economy is showing signs of weakness, which can cause, some other parts of the markets to rally to finally we're getting a rate cut that can help those interest rate sensitive areas of the market. Right now, we're thinking that, look, if you get something in the unemployment rate that's ticking up closer to 4.5%, that obviously is going to cause a reason for concern. So we could see a bit of a growth scare in the market like we did last year when we saw a 5% pullback in the market. Positions are getting a little bit full, but it also accelerates the magnitude of the rate cuts. And Powell still has time to message that at Jackson Hole.
Well, isn't bad news potentially good news when it looks at the rate trajectory? So if we get a 4.5 unemployment rate, what does that mean for equities?
Temporarily, you could see a knee-jerk reaction because, again, people are leaning into the fact that, growth still remains strong. And so this could be an indication that maybe the Fed is too late, right? And it will take some time for the market to absorb that. Oh, this is an outlier. We know that there are issues around labor supply as well that could be causing some distortion in the labor market. So if you see continuing claims, as we remember, initial jobless claims has been well behaved. So if you start to see that tick up as well in coming weeks, that could cause the markets to lean into some more that maybe the Fed is too late. But the Fed put is still there to come in and sort of save the day, if you will.
Yeah, S&P 500, you say, is trending towards your upper end guidance. Yeah. What kind of catalyst we need to see to get to your year-end target?
I think you need to continue to see the momentum in the AI trade, because at the end of the day, off of the April low, that is what's been driving the market, even throughout this earnings season. And so if that trade continues, you can see the market push up. At the same time, you need those cyclical areas of the market to sort of hold in there, and that's what's been happening. We're not ready yet to call that 6,700 on the S&P. We do think that near term, there is some risk. The market feels a little bit extended, and we're also entering a period of low, liquidity in August, and so small things can move the market. So near term, you can see the market pull back, where for now maintaining at 6,200, we would be buyers at 6,000. But I think in the in fourth quarter, when we get more clarity around trade and monetary policy, you can make a run for that 67.
I was going to say, does any of this matter as long as the hyperscalers are spending like $400 billion every single year in building up infrastructure?
Yeah, and next year we think it will be 500 billion, and it could even move higher from there. And there is question marks about monetization of that, and you are seeing signs of that. You're already seeing some signs in terms of advertising efficiency and so forth, and you're hearing things from Microsoft in terms of Copilot and AI agents to come and things like that. So you are seeing the monetization picking up. And remember, the bottleneck is not only in terms of AI chips. I mean, quite frankly, you heard Amazon say overnight, what's really constraining them is on the power side. So this story is beyond tech. It also includes utility, who has benefited from its pickup in AI spend, and parts of industrial. So it's not just a semi-tech story. It's broader than that, and that's healthy that we're seeing that broaden out of the AI trade.
It's interesting because on the utility point, Neil Dutta has been arguing that it's actually going to be a stress on the consumer. There's not enough energy for the AI players. They use more of it. It becomes more expensive for households. They also have to pay that more expensive bill. Have we fully thought out some of the ramifications of this increased spend in build out from the big AI players? Are there going to be some consequences that maybe put some more pressure on things like that, like the consumer?
Potentially, and you're hearing some of the states talk about that as well, the need to build out. And you have companies that are going direct. Some of the hyperscalers are going directly to the power generators, and so that could help alleviate some of the pressures. But again, these are still known unknowns that needs to be figured out, and there's a potential for upward pressure on electricity prices. But ultimately, these companies do have deep pockets, so we think that the cost will be spread and end up on that side.
Meanwhile, we are just careening toward that jobs report, and it raises the question how much it matters, right? I mean, you're talking about all of these things, whether it's investments in energy, whether it's investments in AI, that might not actually help add jobs all that much, some of these aspects. Meanwhile, there's a real question from the White House about whether there is a real weakening in the underlying labor economy. President Trump just putting out on Truth Social, strong dissents on the Fed board. It will only get stronger too late. How much is there a relationship, and how much is it broken down between the labor market, what we get in 20 minutes time, and the stock market performance, particularly in large caps?
Look, we all know that on Jobs Friday, there's always knee-jerk reaction to the data, and so look, you could see if the numbers are weak, you see that knee-jerk reaction heading into the weekend. We're heading into summer vacations, taking some risks off of the table after a very strong rally. Wouldn't be too surprising to us. But again, I do think that at the end of the day, what's going to matter for this equity market is the earnings growth. And this for second quarter, we're seeing very strong, trailing, trending towards 10%. And in fact, when you look forward to the third quarter earnings, it's actually holding in there in terms of the forward estimates. And that's bucking the historical trend when normally you see, trims to the forward estimates. So I think that's encouraging from the standpoint, and a lot of that is being driven by tech, comm services, and financials. There's still that deregulation story that needs.
We've all been trying to wrap our head around this, and I know that that Anne-Marie as well as Danny have been talking about this, the idea that some of the efficiencies that we've been getting from the technology come at the expense of workers, right? That the cost savings that have added to the revenues that have mitigated some of the effects of the tariffs have come from artificial intelligence taking over certain roles that humans used to play. How much could you see ongoing expansion of margins with a labor market that continues to soften and become more difficult for people to find jobs?
I don't think that that's a today issue. It's a future potential issue that we need to address. You're not seeing it in broad spread areas of the economies. Definitely not seeing it in UBS, and we are an active user of Copilot. Microsoft has mentioned it a number of times on their earnings call. So not seeing that yet, but do think that it is a future problem that needs to be solved. But like any technological innovation, innovation that usually comes with new areas of jobs being created as old areas get, less emphasized. And so it remains to be seen what the overall impact, but I think it's too early to tell what it will be.
The past week, the past month has been about American exceptionalism reasserting itself for all of these reasons. How much are you leaning into that versus going the other way, just on a valuation story?
Well, valuation, as we know, it's not an indication of sort of where the market is going to go over the short term. Like, is valuation getting to the high end of that range again, 22.5 times for the broader market? Yes. Does it start to, have the market pull back? We don't think so, because the earnings growth is there to support that. And I think the American exceptionalism comes down to our technology here, the innovation. And now you have an administration also that is leaning into that and supporting that and removing some of the restrictions around semiconductor chips and AI technology. So we think that, American exceptionalism from a technology standpoint will continue. And you're starting to see the dollar gain a little bit as well this year. So don't think the story is over. The margins are envied by the world, and we don't think those margins are going away.
Nadia Lovell, thank you so much for being here. Happy Friday. I'm allowed to say that today. Nadia Lovell of UBS. We appreciate it. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Lizzie Burden. Lizzie.
Hi, Lisa. President Trump unleashed his latest round of tariff announcements just hours before his August 1st deadline. Most countries are facing a baseline 10% tariff rate, but Trump slapped 35% levies on Canadian goods not covered under the USMCA. The new tariffs will take effect August 7th to give US Customs and Border Protection time to prepare. And shares of Amazon are falling in the pre-market, the online retail giant projecting weaker than expected operating income. It's also trailing the sales growth of its cloud rivals, leaving investors wondering whether its huge investments in AI are actually paying off. CEO Andy Jassy said it's very early days in AI and that the company's efforts to lower the costs will draw more customers over time. In contrast, Apple shares are trading higher in the pre-market. The company reported its fastest quarterly revenue growth in more than 3 years, with revenue rising 9.6% to $94 billion. Strong iPhone sales and a rebound in China helped beat estimates, despite a projected tariff hit. And that's your Bloomberg Brief. Lisa.
Thank you so much, Lizzie. Up next, we'll be speaking with U.S. Trade Representative Jamieson Greer as President Trump's tariff deadline arrives with quite a bang. That's next. This is Bloomberg Surveillance.
Is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
We talk as if tariffs drive the entire U.S. economy.
They don't. Goods subject to tariffs represent 9% of GDP. I don't want to minimize the impact, but tariffs don't drive the entire U.S. economy. The consumer is doing just fine. Hey, we have fiscal spending that, in our minds, is going to be stimulative.
That was Sebastian Page of T. Rowe Price as we try to assess just how important some of these tariffs are going to be for the trajectory of growth going forward for the U.S. economy. Right now in markets, we do see a bit of softness as markets digest the new tariff rates, as well as sort of disappointing news from Amazon. It's hard for me to call it. They did beat. You see S&P futures lower by about 1%. You can see a more pronounced weakening in the Russell 2000. Really, the dollar strength has been notable, the sort of reassertion of whether we are seeing American exceptionalism once again. 114 on euro dollar, and yields marginally higher, 3 basis points higher on the 10-year as people look ahead to potential resilience in the labor market and the U.S. economy. Turning to our top story out of Washington, D.C., President Trump announcing new tariff rates around the world set to take effect next week. I am so pleased to say that U.S. Trade Representative Jamieson Greer is joining us now. Jamieson, Ambassador, thank you so much for being with us. I know you've been incredibly busy. I can imagine you haven't slept much. I am curious how much we're seeing the end of negotiations or the beginning of the end, as there still seem to be some loose ends to be tied up.
Well, I would say that, we've spent the past 120 days negotiating with dozens and dozens of countries, and with some of these countries, the deals have been good enough that the president's been willing to accept them. With other countries, they're just going to have a tariff. But we have, you can look at some of the information that's gone out there. We have fact sheets. We have a joint statement with Indonesia that gives some details. We'll be finishing the paperwork in the next, weeks and maybe a couple of months. But these deals are pretty much set. They are set, right? We wouldn't make an agreement unless we all knew the contours of it, and the countries knew it. And it's an exciting time because the president has essentially reset the global trading system, and so we'll be, finalizing everything that's been agreed to on paper and then monitoring compliance going forward.
Ambassador Greer, can you help us understand how you landed on some of these rates? Specifically, a country like Switzerland, it went from 31% on Liberation Day, April 2nd, to now 39%, even though you and your colleagues were in negotiations with the Swiss trading partners.
Sure. Well, so first of all, the rates are largely determined by the trade deficit of a country with the United States and what the country's willing to do to address that trade deficit. Switzerland, this is surprising to some to hear, but we have a nearly $40 billion trade deficit with Switzerland for a country of 9 million. Now, we value our relationship with Switzerland, certainly, but during our discussions with them, we weren't able to reach agreement on the best way to reduce that trade deficit. At all, right? They ship enormous amounts of pharmaceuticals to our country. We want to be making pharmaceuticals in our country. So this is a challenging situation, and so we have high tariffs, not just on Switzerland, but many countries where we weren't able to fully resolve a path forward on reducing the trade deficit and opening markets.
My understanding was that the U.S. and Switzerland actually had a negotiated text, and it was just waiting on sign-off from President Trump. Is that accurate?
I think that's an overstatement. I mean, the reality is all of these countries, you trade back and forth paperwork, and then you take it back to your leaders to get guidance from them. And so nothing's agreed until everything's agreed. That's what every trade negotiator knows. So, the reality is we negotiate with lots of countries. Listen, there are a lot of countries that didn't get a deal that we've been negotiating with. And they, of course, they all want a deal. They all want to deal with the United States. So I can understand that, folks may want to try to manifest a deal in the last minutes. But we just have to do what's right for America, and the president understands that, too.
I'm thinking of other countries like Taiwan, which that rate went down. India, Switzerland, of course, we know you are in negotiations with. So between now and August 7th, could some of these countries that you spent a lot of time with your counterparts get a deal?
Well, that's not my focus. I feel like we've been able to get everything set on August 1st. Of course, any country that wants to talk to us, they can always talk to us. And I'm sure some will be eager to find ways to reduce the deficit, open their markets, et cetera. But we're really focused right now on implementing the deals that have been reached.
Well, on implementing those deals, Representative, you mentioned that you would be looking and monitoring them for any violations. How will this administration judge what is a violation and what the consequences of that would be?
So, for example, we put out a fairly detailed joint statement with Indonesia, and we're finalizing the underlying agreement. And in there, you can see that they've made commitments on tariff levels where they're going to remove all of their tariffs. They've made commitments on non-tariff barriers with respect to, agricultural inspections and the way they, treat certain digital trade. And so our office, which has hundreds of people, the Office of the U.S. Trade Representative, they watch this and they make sure that Indonesia actually does what it's supposed to do. And if they don't, the president has his tariff authority. I mean, all of the deals are premised, and the modified rates for these countries are premised on them actually opening their market, making the investment and purchase commitments they've agreed to. And if you don't, you can have the tariffs go back into place. This is basic trade enforcement. That's what we intend to do here.
Ambassador, right now there are a number of countries coming out and saying this is part of a negotiation, and they plan to keep talking with the team over in the trade organization and trade representatives from the United States. Is that just messaging to their own political constituents, or is that reality?
Well, listen. They certainly have their domestic constituents they have to talk to. You can be sure that I woke up this morning to a number of trade ministers texting me and emailing me, and I'm sure they're reaching out to my colleagues, Secretary Lutnick, Secretary Besson, et cetera. And my job is to talk to these folks. I'm always going to talk to these folks, and if they have proposals, I'll talk to them and I'll brief the president. We're focused on implementation and doing what's right to change the trading system to one that benefits American workers.
How much are you also hearing from U.S. companies concerned about certainty and whether they're going to get clarity on exactly what the rates are going to be, whether they will stick, whether there will be adjustments, and how some of these things will work with transnational shipments of getting penalized 40%?
So with respect to certainty, President Trump has been talking about a new tariff program for literally years. Decades in some instances. He has tariffs from his first term that are still in place. So sometimes when companies say we want certainty, what they mean is we want a different outcome, right? And by putting, the market has baked in a lot of the tariffs we've put in. The new tariffs that we issued last night are firm. That's why we put it out in a very clear list. Everyone can see it and understand. With respect to transshipment, that's always been illegal. And so we're just going to put an additional 40% tariff on that. So, I understand that there are going to be edge cases where companies have to change their supply chains, and no one wants to do that. They just want status quo. But we can't have the status quo. The status quo is what led to offshoring and the loss of some of our key industries. So during that supply chain shift, that can be challenging for some companies. And I talk to a lot of these folks. I want them to understand the president's trade policy. I want to hear about any unintended consequences. But the president's trade policy is moving forward, and we're shifting from a 70-year policy based on purely efficiency to a new policy based on fair and balanced trade, and the world is agreeing with us.
Ambassador Greer, what about the unintended consequences of what's going on with the sectoral tariffs on autos? The Ford CEO was on Bloomberg television yesterday talking about the price disadvantage compared to auto companies if they're making a car in Japan because of the input costs of 25% on those inputs that they need to make the car coming into the United States versus the 15% rate that Japan now has. What's the point of the auto sectoral tariff if basically it's going to be bilateral now with country by country?
So first of all, there are only a handful of countries that export cars to us, right? It's essentially, Germany, Japan, and a couple of countries of the European Union. We also have Canada and Mexico, and we had our domestic producers, choose over a couple of decades to offshore a lot of that production to Mexico. And so naturally, there is some challenge as they continue to reshore that, and we understand that, right? I mean, our goal is long-term. We're not looking at quarterly earnings as policymakers. We're looking at a way to make sure that we have a strong, robust industrial base here that provide good jobs for our workers and support the national security. So, we're in constant contact with the domestics, with the unions, and everybody. And, I understand that the auto companies are receiving a credit for content that's made in America, which is how it should be. That's what we're trying to incentivize.
When you're looking and you're thinking long term, are you preparing for a Supreme Court ruling against using IEEPA for these tariffs? And if so, what's the plan B?
So the case is at the federal circuit right now. We had the arguments yesterday. Lots of questions, a lot of preparation. DOJ did a great job. We had a great team out there. We feel very confident in the case. If there's still questions coming out of the federal circuit or further litigation that goes to the Supreme Court, we're confident there that this statute clearly says the president has the authority to regulate imports. That's the language. No, not my words. That's the statute's language. in case there's a national emergency, and the president's declared a national emergency. So we feel confident, if it goes the other way, then we'll manage that. The reality is, the countries understand the type of leverage that President Trump has created. That's why they're doing these deals, and they're going to stick regardless of what happens in litigation.
That's where I wanted to finish, and we just have a couple of minutes. We are out of time with you, I know, but I am curious what the game plan is should there be some sort of overruling of IEPA. Do you already have Section 232 and others lined up?
Well, listen, we always have all kinds of plans, and I'm not going to go deep into our strategy here, mostly because we're pretty confident on the current plan, but we will do whatever it takes to make sure that the president can continue to rectify the trade deficit and change the global trading system. And this is a historic thing. This is once in 100 years that you have the chance to reorder global trade like this, and we're doing it, and we'll use whatever tools are necessary to do it.
U.S. Trade Representative Jamison Greer, thank you so much for being with us. I'm not sure when you sleep, and we've been talking about that with you and Scott Bessent as well. Ambassador, thank you for your time. I appreciate it. Really a slew of changes at a time when there are some real questions over what the ramifications will be, but historic in terms of magnitude, that's for sure.
Oh, yeah, historic. These are the highest tariff rates we've seen since the 1930s. What was interesting, he said that a lot of these countries want to manifest deals now. I want to know, I think the market wants to know between now and August 7th, I think the market's trading on this, they are still in negotiating mode. He said he woke up to a number of text messages from his counterparts, from negotiating partners, wanting to get to end. Potentially, is this the final moment where we can see these concessions the administration has wanted from places like India, maybe when it comes to things like Russian oil, from Switzerland, maybe things like pharmaceuticals, from Taiwan when it comes to semiconductors. Is this the final stretch for some of these big trading partners?
Meanwhile, we are just about a minute away, less than a minute away from the payrolls data, and a real question, Danny, about how much the ramifications from any of what we've seen on the headline turmoil that we've seen has filtered into labor.
It hasn't filtered through yet. Will it start to change? That is a question, but the fact it hasn't filtered through yet means that a lot of this market has been able to look through some of the drama and not necessarily trade it because it's not showing up in the economic data quite as much as we expected.
What we are expecting is 104,000. That is the median in a survey of economists for the number of jobs created in the month of July. We're also expecting the unemployment rate to tick up by 10 basis points, 4.2% from 4.1%. The whisper number is 120,000. The potential of what is the break even going into that right now. S&P futures are lower. Right now, let's head over to Michael McKee with the numbers. Mike, what do you see?
Well, we got a very disappointing number here, and this is going to get Wall Street's attention. 73,000 jobs created during the month of July. The forecast, as you said, was for 104, and we came down from 147 last month, looking to see what the revisions are. Right now, the three-month revisions add to payrolls by 35,000, so that has to be factored in. Private payrolls, 83,000. They were 74,000 last month, so it looks like government has subtracted from the overall level of jobs, and that would be a rebound or a going back basically to the seasonals issue that we saw in June. Unemployment rate, 4.2% as forecast. We'll look at what the three-digit number is in just a second. Average hourly earnings up 0.3 as forecast. Average hourly earnings on a year-over-year basis at 3.9%. They were 3.8% the month before, so it looks like a little bit of a gain overall for people. I'll dig into this some more and let you figure out how the markets are reacting to this disappointing headline number.
Mike, that sound that you hear, that whoosh, is the two-year yield plummeting, and that is what we're seeing, down more than 10 basis points in response to this weaker than expected number. You can see equities have maintained some of the losses that they saw from earlier, but across the board, a bid into bonds is the big trade. 10-year yields down 5 basis points. The two-year yield, this really is the key moment, down 12 basis points to 3.84% as people take a look at what this labor market report means for the Federal Reserve. In the currency space, we had been seeing quite a bit of dollar strength on expectation that the Fed would have to remain really strong with policy. We see a complete reversal, the euro bouncing versus the dollar, 114.81, as people assess that maybe this will be a Fed that will get pushed into cutting rates sooner and faster. Really, the idea that you could see the number come in softer as well as the unemployment rate also ticking just slightly higher, concerning or at least provoking a response that would imply more rate cuts. Mike, you've had some time to dig through some of the numbers. Really notable to me that the change in private payrolls came in slightly lower than expected, but manufacturing so much lower, actually a contraction there. What stands out to you?
Yeah, you got 11,000 jobs lost in manufacturing, and we had seen signs of this coming in some of the ISM reports, and we do get ISM for July coming out at 10 o'clock this morning. But it does suggest that the companies in manufacturing at least were not ramping up at all. They've lost a few thousand. Construction, only 2,000. There were 13,000 that were supposedly found by ADP in their numbers on Wednesday. So construction, not really a surprise given the circumstances and what we've heard about construction overall. Service-producing jobs, 98,000. That's a low number, but in line with the fact that service-producing jobs are the majority of jobs in the economy. And then, of course, the number that really has set the tone here is the government jobs. We see 12,000 jobs lost at the federal level, and that's going to just start picking up because a lot of people who left the federal government under DOGE got some sort of severance, and they don't count as unemployed as long as they are getting severance. So we'll see more of that. Overall, government, including state and local, down 10,000, and that is a rebound from last month's 74,000 jobs created, most of those in state and local government because of education, and economists think that was mostly because of a seasonal adjustment problem. I didn't mention earlier, but we should point out that the average work week rose by 0.1%, 34.3, and that may suggest that even though companies were laying some people off, to keep up with business, they had to work others harder. So a little bit of a buffer on the other side.
As you speak, Mike, we're seeing the two-year yield just plunge that much lower. Michael McKee, thank you so much. So if you are just joining us, here's the state of where we are. We did get the non-farm payrolls report for July. 73,000 is the number we got. 104,000 was the expectation. We see that increase in the unemployment rate as expected from 4.1% to 4.2%. We did see average hourly earnings still go up by 0.3%. But as you parse into the numbers, here is what is accelerating that downward shift in yields, that upward shift in expectations for Fed rate cuts. The revisions in non-farm payrolls for the month of June came in at 14,000. That is downgraded from 147,000. I had to do a double take, Danny, if that was accurate or not. But you really see that downward revision in the prior month coming into play in a massive way.
June goes down to 14,000. May goes down to 19,000. That makes 73,000 today look all that much more weak. I think that's going to be the thing that catches a lot of attention this morning, not necessarily the number that just comes in, because if the revisions continue to stack up that way, what is 73,000 actually? Is that even a lot more weak?
Neil Dutta of Renmac goes right to Twitter. Waller looks vindicated. It was Christopher Waller that on this program talked about just weeks ago, before he made this dissent, that he is seeing cracks in the labor market, and we are seeing that today when it comes to this unemployment report.
Yeah, and I'm sure that we'll get some more Truth Social posts on this. Joining us now is Stephanie Roth of Wolf Research. Stephanie, you've had a couple minutes to look through this. Is this a terrible jobs report, or is this a little bit more complicated?
It's pretty bad, especially in the revisions. I think that's the biggest thing. I mean, the 258,000 of negative revisions to the prior 2 months is pretty eye-opening. Of course, we're all watching the unemployment rate because that's what, for a couple of reasons, that's what Powell is telling us to focus on, which remains, up a little bit, but fairly steady. I think what we're seeing is the massive impact from immigration having important implications on the labor market, and that's what's driving at least some of these negative revisions.
When you look at the market reaction, though, it looks like they're pricing in September and October for Fed rate cuts. If we see another weak job report, is that what you would expect?
I think there's certainly a chance of that. That said, the inflation data are also going to be pretty elevated in the next couple of prints. So it makes it a really tough backdrop for the Fed in this landscape. And this is something we've been warning our clients about for quite some time, that risks are quite elevated over the summer because we're going to be in an environment where immigration is going to have very negative impacts on the net hiring of this economy. The unemployment rate might remain okay, and inflation is likely to be quite elevated. And that's a really toxic backdrop for the Fed to be able to cut.
We do have, though, 73,000 for non-farm payrolls, weaker than expected, 4.2% unemployment rate ticking higher. What is the line in the sand for this unemployment rate that Jay Powell is saying is what he's mainly looking at, the main number?
I think we're talking somewhere between 4.3, 4.4, 4.5 for sure they'd be cutting, but I think it has to continue to creep higher throughout the course of the summer in the backdrop that inflation is going to be quite elevated.
Is this Waller vindicated, what we're looking at right now? Is this the dissenters saying that the labor market is weak? Is this a hat tip, a vindication of that?
I still kind of think that it was a little bit political. However, the data do happen to be consistent with that message.
So if it's consistent with that message, but it's still political, how much weight can you put into that? If they continue to go forward, and you have President Trump, who was on Truth Social this morning saying that the board needs to take over, that they should be the ones dictating policy. If you start to get more of the dovishness from the board, do we have to continue to write it off as political? Do we just put less weight in it from here on out?
I think if you see other members continue to get more dovish, I think that's important. We all knew that the dissents were going to come from those two board members, right? So if you start to hear more dovishness from the rest of the committee, I would imagine Powell will also feel the same way, because that would be consistent with the actual data. Those two members in particular were known to be, having some sort of more political leanings to some extent in recent times. The rest of the members, if they start to become more dovish, I imagine Powell will be right alongside them. And that will be because the data continue to show that the employment backdrop is weakening.
Meanwhile, we're looking right now at markets, the two-year yield continuing to fall down 15 basis points to 3.8%. You have seen it come in even more. I just wonder if this really does set up September in a way, Stephanie, that is unassailable in terms of cutting rates, given the fact that especially the revisions, that tends to be a leading driver of the direction of travel. Isn't this something saying September has to be back on the table in a massive way?
Yeah, I think that's totally fair. And if you look at the details within the household survey, the main driver of the sort of the softness this month in employment was foreign-born population. So I think this is exactly what we're seeing, the massive implications of the immigration policy having effects on the labor market.
Stephanie Roth of Wolf Research, thank you so much for being with us on this non-farm payrolls day on this Friday. I do want to get back to Michael McKee, who's been parsing through all of the details. Mike, what have you found as you've gone through it?
Well, Stephanie was just talking about the issue of immigration and how that might have affected the numbers overall. We did see a drop in the labor force of 38,000 and a revised drop from last month of 130,000 in the labor force. Now, of those who dropped out of the labor force this time, 341,000 in the foreign-born category. So a major drop in the number of people who are either legal or undocumented in their participation in the labor market. And that, I'm sure, has a role to play overall in what we're seeing now.
Mike, stay close. I'm sure you'll get more as we parse through all of that. Joining us now is Michael Collins of PGIM Fixed Income. Really fascinating point there by Mike on the immigration side of things. From your perspective, how conclusive is this labor market report about September and a rate cut then, and frankly, about deterioration in the U.S. labor market?
Yeah, Lisa, good morning. Right now, there are two full cuts, again, priced in for the rest of this year, from only about 35 basis points priced in an hour ago. So big shift, obviously, in expectations, and I think that does make sense. I think it is justified, but this is a trend that Powell talked about actually a lot in his press conference that we've been talking about. In fact, we discussed it a month ago, Lisa, that maybe we're in a world, given the immigration and deportation policies, that a 0 to 50,000 monthly gain in jobs is the new normal. That's the new run rate. And here we are with those revisions, as you pointed out. We are kind of in that world. Interestingly, again, as Powell pointed out, the unemployment rate is pretty sticky. The hours worked ticked up, the earnings, the wages ticked up, right? So there really aren't signs that the labor market is weak, that there's a big offset in supply and demand. It's just that the supply has shrunk a lot, and it will continue to. And it's, obviously the government jobs is a demand story, but we're just kind of decelerating into a lower run rate of jobs, which of course translates into a lower run rate of GDP, right? If you look at consumer spending so far in the first 6 months of this year, Lisa, we're running just below zero, right? Real consumer spending, which is obviously correlated to GDP. So we're kind of in this really low growth world right now that we've been expecting.
Well, the participation rate is down. As you say, unemployment rate up in July, despite the exit of people from the job market. Isn't that worrying for the Fed? Are they potentially behind the curve right now?
You know, it really depends, right? This is the conundrum that the Fed has, and I actually give Powell credit for talking about this, that if job growth is weak, but the unemployment rate, the balance between the supply and demand for jobs isn't that out of whack, meaning the unemployment rate ticks up to 4.5 and stabilizes there, you know, that's something I think the Fed would generally characterize as relatively full employment. I think it's when it starts to shoot toward 5, and certainly if we see a 5 handle, they'll probably be cutting in earnest, you know, not talking about 25s and 50s, but, you know, getting that funds rate down to 3 really quickly.
Even so, Mike, just looking at some of the details, it looks like healthcare accounted for 75% of the gains that we saw in this employment report. It was the main engine of growth. Is there a concern about the breadth of jobs being added? Should we add that to the ledger of reasons to be concerned about this labor market?
Yeah, absolutely. This is something that certainly my colleague Tom Porcelli has been speaking with you about for months now, that if you take away government jobs in healthcare, i.e. the kind of non-cyclical, you know, structural jobs, the cyclical job growth has been really weak all along throughout the whole year. And this is just really a continuation of that trend.
So what do we do from here, Mike, if we are still in this period where there is some weakening, but it's not weakness? The rally that we're seeing in the front end, is that something that you'd want to chase at this moment?
Yeah, you buy bonds, right? I mean, it's a big, beautiful bond market, and returns have been substantial, and they're going up, right? Yields are really high, and we've been certainly advising clients, you know, take advantage of these rates while they're high. I mean, you know, the old adage is don't fight the Fed. You know, my new tagline is don't fight the triumvirate, right? You have a president, a Treasury secretary, and ultimately a chair of the Fed that all think rates should not be, again, 25 or 50 basis points lower, but potentially hundreds of basis points lower. And I think that maybe will be realized over the next few years.
Mike, certainly people are buying bonds today. We can see that across the curve, although much more so on the front end. When you say buy bonds, I am curious which bonds. At what point you can really start to extrapolate out longer term, 10-year, 30-year rates and say it's a good time to lock that in at a time where there still are longer term questions about the tariff rates that we got last night, how long-term inflationary it'll be, especially if the Fed is prompted to cut rates.
Yeah, I mean, really across the whole curve. Obviously, as you're seeing today, that 2, 5, 7, you know, 10-year, that kind of short intermediate part of the curve comes crashing down the most. That's where you get the most bang for your buck, Lisa, meaning, you know, you don't have to take a lot of interest rate risk to get a lot of benefit. But the whole curve, you know, right now the funds rate that's priced in for the rest of our lives is 3%, meaning the Fed gets to 3 by the end of 2026 and keeps it there and actually increases it a little bit for the next, you know, decade. You know, what's not priced in is a 2-handle or a 1-handle funds rate, right? So that realization could cause a whole curve to kind of come crashing down. So you don't want to just lock in a 2-year here, because then you have 2 years of duration, you know, 2 years of reinvestment risk effectively. And we've been encouraging, you know, investors to inch out on the curve.
From the previous 3.7%. You can see right now across the board, there are still signs that things are solid. You know, even the unemployment rate, yes, it ticked up, but not to the significant degree that some people were worried about. What is the inflationary risk here longer term at a time when the Fed is being prompted to cut from a number of different reasons, and there still are these tariffs in the system?
Yeah, this is a challenge, because the data that we're seeing is largely appears to be driven by immigration, and that actually tightens the labor market for blue-collar workers. So what we might see is a labor market, which is something that was kind of known heading into this event, but it's now the reality. It's kind of painful, because what we're seeing is job gains that have slowed down tremendously. It results in upward pressure on wages, and then upward pressure from tariffs. So it's like a stagflationary type of shock, which we're starting to see play out in the data. It's just a really complicated mix for the Fed to kind of deal with from here. So it looks like the labor market is okay. It's not as weak as these numbers today suggest. This is largely driven by immigration in an economy that's hanging in there.
Mike, to that point, maybe the economy is hanging in there, but on the margins, is this buy government bonds, sell corporate bonds?
You know, corporate bond spreads, as you know, as we've all been talking about, are really tight, meaning you're not getting a lot of extra yield to buy corporates and high yield bonds. And obviously you're seeing a little bit of a knee-jerk reaction, a negative reaction in the stock market as well. And this, you know, this whole tariff theme is definitely one of not only inflationary, you know, as you know, we just talked about the stagflationary risk is real, but it can certainly result in margin pressure for companies. And I think that is still to come. And I think we are starting to see some early evidence of that. And obviously that could put some pressure on corporate earnings. That could put some pressure on credit quality and on corporate spreads. So yeah, I think higher quality bonds and adding duration are the two themes we've been sticking here. The big question for the Fed, right? And Stephanie, you kind of talked about this. If let's say growth is 0 and the unemployment rate is 4.5 or 5, but inflation is at 3. You know, what does the Fed do in that world, right? That kind of stagflationary world. And my gut is, you know, the Fed and even Powell, who is a labor market dove, would err on the side of saving the economy, saving jobs, saving the labor market, and write off this inflationary risk as being a one-off. So I think that's the kind of the risks, the way they're skewed.
Mike Collins of PGIM Fixed Income, thank you so much for your time. And before we got this number, we saw a 40% chance of a rate cut being baked into the market for the month of September. And right now we have a 71% chance of a rate cut in September. Joining us now is Jeff Rosenberg of BlackRock. We heard there from Mike Collins, buy bonds. Is that your takeaway?
Well, it's certainly the market takeaway because the market's repricing September, and it makes a lot of sense, and you guys hit on it, and I think it is the takeaway from today's report, which is it's the revisions story. Remember, there's been this undercurrent of a debate about whether non-farm payrolls in the labor market report is really mismeasuring the deterioration, and you see that in these first prints versus the revisions. Waller's talked about it. It's a little bit of indication here, and that's basically saying his argument may hold sway or convince more people to come on his side of the argument. And, you know, maybe they missed the opportunity in July, but it certainly raises the odds that you get it in September. And that's why you're seeing the big move, as you pointed out, in the front end of the curve.
Well, the president agrees with you. He took to Truth Social and said strong dissents on the Fed board and will only get stronger. Given the revisions, the downside revisions, is this now a trend of this fragility we're seeing in the labor market?
Well, it was one of the numbers that Mike highlighted at the beginning. You know, when you take the revisions into account, you know, the 3-month average change on non-farm payrolls drops from 150,000 average, which is really a very, pretty strong labor market, to 35,000, which is, a dramatic shift. Now, as Mike just mentioned, maybe we need to reset what we think is break even. But with the revisions, it's a dramatically different picture to what the labor market is saying. And as also Mike was talking about, you have a pretty strong year-over-year average hourly earnings figure, wage inflation. The market is not caring about that, because I agree with Mike. I think in the debate between the dual mandate of inflation versus full employment, they're going to err on the side of full employment. And that's why, again, I think you're seeing this big move in the front end of the curve, but despite, what we're not really talking a lot about, which is the wage number.
Yeah, Jeff, I just wanted to jump in because we had heard from Powell this week, who de-emphasized the non-farm payroll numbers themselves and said, pay attention to the unemployment rate. And we were just talking with Stephanie about this idea of it being impacted more by labor supply and things like immigration. So given that, couldn't you say, maybe for this bond market, I shouldn't get over my skis in joining this rally, because we did have things like PCE yesterday, which showed a stubborn rate of inflation?
Yeah, it's a really good point. And But he also said in that press conference that the slowing in the labor markets, even if it's both demand and supply with the equilibrium, raises the risk that the downside risk would be to labor markets. It was a little bit of a tell on, yes, we're in equilibrium now because you're getting both the supply and the demand side falling, but the risk is that the supply side sort of stops falling and the demand side continues. And I think that's kind of what the market is looking through here, particularly around this trend with the revisions, more accelerated than, say, what we've seen in terms of labor force participation, which you mentioned a minute ago, which actually ticked down here again a tenth, but maybe you start to see that stabilize while the demand side doesn't stabilize, and that's the risk that the market's pricing in right now.
Jeff, not all markets are pricing in things equally. I just pulled up what the future session is doing. You actually, just looking at the line chart, would not even have any idea that we had any big economic piece of data come out. S&P 500 futures are basically at the level they were before. Is this a market that's not paying attention to the jobs numbers, or it's just not bad enough for them to react, or maybe it's smooth sailing because it means that we could get cuts? What do you make of how risk is not reacting?
Well, and I looked at some of the futures, and they looked like they were reacting and down. I think when you look cross-market, we talked a lot about this earlier this week, you've got to be a little bit careful about reading into the equity market. This is very much sort of a macro conversation, Fed policy, macroeconomic performance. The stock market is not the economy. And the stock market is not even the S&P 500. It's really the S&P 7 or 6. And then you've got the 493. There's tremendous differential. Look at sort of small cap performance versus, S&P 500 performance, which is, again, it's sort of more dominated by the tech story. So those stories, and we're in the middle of earnings season, they can be much more dominant and reflective of those issues than they are what we're talking about here in the macro data. I think when you look at the 2-year, that's mapping to Fed expectations, and that's a pretty good message. I think when you start looking across into the equity market, you got to be a little bit more aware that, there's other factors going on in this environment of very concentrated equity valuation within the indices that can kind of lead to a misread across from the macro data.
Jeff Rosenberg of BlackRock, thank you so much for being with us. And as Jeff was talking about, the chances of a September Fed rate cut were increasing yet again to 76% now from 40%. Stephanie Roth of Wolfe Research here with us. For a final thought, you've been parsing through all of this. Notably, the 3-month average of the net change in jobs has fallen to its lowest level going back to July of 2020 or June of 2020. What's your takeaway?
I think the labor market has softened. A big part of it has to do with immigration. Another big part of it has to do with government. About half of the revisions are driven by the government sector. So we're looking at an economy that's holding up. Labor market has cooled down, and inflation is going to be heating up. This is a really challenging backdrop for August for risk markets.
And Marie, the president's responding. He's coming out on Truth Social.
Yeah, he's not exactly saying what's happening in the jobs market, but he's signaling this is the reason why he thinks the Fed is, quote, his words, too little, too late. Powell is a disaster. Drop the rate.
And meanwhile, the S&P not even responding. It's all about big tech.
No, not responding at all. Again, you would have no idea that this piece of data came out. It is the bond market that is responding, sending us to a more than 70% odds that we will get that rate cut next decision.
Stephanie Roth of Wolfe Research, thank you so much. Coming up on Monday, Ed Yardeni of Yardeni Research, Michael Gapin of Morgan Stanley, Michelle Meyer of the MasterCard Economics Institute, and Vinu Krishna of Barclays. This was Bloomberg Surveillance.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
A cidade estava sitiada.
Isso é o começo, eu tremi, não sabia o que fazer.
Foi a mais terrível que eu passei na minha vida.
temo, né, que o Brasil se torne, num futuro próximo, um narco-estado.
Porque no final, tudo é dinheiro.
People back home they are suffering, and someone is driving it. Is my money.
I think she's a scam up to now.
It's some of the world's most desperate people who are getting ripped off.
Repeat after me. I am a winner.
I didn't know how big it was. I didn't really understand what I was getting myself into.
If you tell me you have a vision of being $1 billion business, then you're going to have to do what it takes. And if you're not going to do that, everybody's going to suffer.
Una batalla a muerte.
Money can do a lot of good. It can really transform people's lives, but it can also hurt them.
In case you missed it on Bloomberg Insight.
Losing a few people is not actually that unusual. These companies are constantly pulling people, in both directions. The real question is, can it turn around Meta's fortunes? It's about who is leading in terms of adoption, in terms of B2B use cases, B2C use cases in different countries. And we're seeing Chinese companies certainly making a strong showing across many of those fields, even if, I would say that the US is still generally in the lead. But what we've seen at the company level and at the product level is actually that continued decoupling. So I think it's a pretty safe bet that is going to continue to be the case.
Not to bring up the past, but you've criticized Sam Altman. I'm just wondering whether you've made peace with Altman on the back of that drama.
So we haven't actually interacted since the time. I'm sure at some point soon we'll end up at the same event, and the AI world is pretty small, but no, haven't had a chance yet so far.
Don't miss Bloomberg Insight live weekdays.
Bringing you up-to-the-minute energy news whenever and wherever it happens. I'm Joanna Bersecci in Vienna, and this is Bloomberg.
Non-farm payroll revisions drop 30 minutes until the start of trading. I'm Matt Miller.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, a downside surprise in July's payroll, helping make the case for the Fed to resume rate cuts. President Trump's tariffs kick in. The U.S. rates on goods across the world are set to rise to the highest level since the 1930s, and Amazon disappoints, while Apple surprises to the upside, wrapping up a blockbuster week for corporate results. Katie, you're watching.
Let's take a look at what those shares are doing, because Apple, it reported its fastest quarterly revenue growth in more than 3 years thanks to strong iPhone sales. It expects tariffs to add $1 billion in expenses this quarter. Amazon, for its part, it's trailing the sales growth of its cloud rivals as investors look for results from tens of billions of dollars in spending for AI products. You can see Apple shares actually up a little bit pre-market. Feels like we haven't seen that for a while. And then you take a look at Amazon really taking a beating right now, down about 7.7% in the pre-market.
I feel like I cared a lot more about that before 8:30 this morning. But we are focused on stocks, 30 minutes until the start of stock market trading. And Figma is one that was a massive success story yesterday. Or if you look at it a different way, they left so much money on the table, extending gains today after a 250% IPO pop yesterday, giving the company a market cap now above $50 billion. But Katie, it's really the jobs numbers that are front and center for this market.
Absolutely. 2 points. I feel like Figma CEO Dylan Field still made out okay. I think he's doing fine. Let's get back to that
Just
jobs
left $3 billion on the table. No big deal.
Yeah, it's okay. He'll make it up. Anyway, this morning's jobs data came in much weaker than anticipated at 73,000, but it's the revisions that people are really focused on. Those downward revisions put the average rise in payrolls at just 35,000 over the last 3 months. Let's take a deep dive into the data with Michael McKee, Bloomberg's international economics and policy correspondent. And Mike, we were talking off air about how there's always a margin of error when it comes to these figures, but boy, those revisions look really ugly.
The revisions are really ugly and really interesting. We had just 14,000 jobs created in June, according to the revised numbers from the BLS. It was 147,000, took everybody by surprise when we first got those numbers. Private payrolls, only 3,000 in June, 83,000 in the month of July. Private payrolls were 74,000, half of what was created last month. So it is a major, major downward revision to the strength of the labor market, which was something that Jay Powell was touting at Wednesday's news conference. Now, the unemployment rate is just 2 basis points, less than 2 basis points, really, from 4.3%, almost a bigger jump there. We went to 4.2, which is a rounded number, 4.248. It does show you that we did have a lot of people losing jobs during the month, and we almost got a much bigger move, except for the fact that the labor force went down significantly again, 38,000 after 130,000 in the month of June. The only good news was that we saw wages rise a little bit more than anticipated, and that may be because if the supply isn't there, you got to pay up a little bit. The interesting number in terms of the labor force, though, 341,000 people who are foreign-born left the labor force. Not all of those were deported, obviously, but people staying home perhaps because they're afraid of getting arrested. The biggest changes that we saw were in the federal government, down 14,100, manufacturing off 11, administration and support 19,800. We have seen companies announcing that they were going to be losing some administration staff, sort of the middle managers in their companies as they cut back. Restaurants and bars lost 300. That's unusual. The only real gainer, the usual category of healthcare and social services, 73,000. And I want to turn back to something Chris Waller said in his dissent memo this morning as we leave this issue here. When labor markets turn, Waller said, they often turn fast. If we find ourselves needing to support the economy, waiting may unduly delay moving toward appropriate policy. So we are seeing that kind of reaction in the Fed funds futures market. And Waller may be taking I don't know if he'll be happy about it, but a victory lap in terms of what his forecast was.
Well, I'm very much looking forward to your interview with Beth Hammack, which is just coming up in just a few minutes. These numbers, I would say, are pretty shocking, right? I mean, absolutely. If you look at we have a function on the Bloomberg terminal, ECAN. You may be familiar with that. And if you look at that, you'll see a big green bar that just continues to grow over time, and that's healthcare jobs. And if you didn't have those healthcare jobs, you would have seen negative numbers in May, negative numbers in June, negative numbers, a loss of a massive amount of jobs in July. So it's only healthcare really that's keeping us up, and as you draw away these foreign-born workers, it's got to be upward pressure on wages.
And I think that would be unintuitive to a lot of people, that a lot of that strength was coming from healthcare. I will say you can see the surprise in markets right now when you take a look at the 2-year Treasury yield, now down about 18 basis points. People really recalibrating their Fed bets right now. Yeah, absolutely. I mean, if you look across the curve, it's obviously focused on the front end, but massive drops in the 2-year, in the 5-year, even 10-year yields are down at 426. So pretty amazing moves. Michael McKee, thanks very much. You're going to be right back with Cleveland Fed President Beth Hammack. And I want to get to trade now because President Trump unveiled new tariffs across the world, some of those shocking as well. They won't take effect until after midnight on August 7th. So you have like a week to rush out and get a Swiss watch or Swiss chocolates because it's a 39% tariff on Switzerland. Joining us with more on this is Brendan Murray. He's our global trade czar. And Brendan, I guess some of these were unexpected, but we knew that tariffs globally would rise to about 15%, right?
Yeah, exactly. That's where we wound up. The bigger surprise, like you said, was Switzerland, and we just heard Jamison Greer interviewed saying that, yeah, they couldn't put that deal together, but the Swiss thought they really had it all together. But something happened where they couldn't get it over the line by the deadline today. There were some other surprises. India didn't get over the line either. They're getting hit with a 25% tariff. Taiwan was also close, but didn't get there. Theirs is 20%. 20%. So there are some key U.S. trading partners that are heading into the next, the foreseeable future, paying high tariffs if they can't get a negotiated deal. It sounded like Greer said, we're in the implementation phase of these tariffs now and out of the deal-making mode. So, it didn't sound like the door was that widely open for more talks or talks that they think can happen over the next coming days before that August 7th deadline.
All right, Brendan, great reporting. I know it's been a very busy week. That is Bloomberg's Brendan Murray. So taken together, if these are implemented as announced, as our graphic showed, the U.S. TAVR rate on average would be 15.2%. For those keeping track at home, it was 2.3% in 2024 before Trump took office. There's a lot to get to this morning, including earnings. Let's talk about Apple posting strong iPhone sales and a solid outlook, but it expects a $1 billion hit this quarter from tariffs. Amazon, meanwhile, is plunging as profit and cloud growth estimates fell short of expectations. Bloomberg Tech co-host Caroline Hyde joins us now with the details. I feel like we should talk about Amazon. I mean, it's nice to actually see Apple in the green this morning, but Amazon, what a wipeout. A lot of disappointment here, especially when it comes to cloud.
And to be fair to Amazon, it met expectations from the street and actually exceeded them on the fiscal quarter that they reported. And indeed, the forecast was looking good, but its operating profit was the weak point, the amount they have to spend. And as you say, the cloud growth was 17%, exactly what the market thought they'd see. When you compare it to 39% growth over at Microsoft's Azure, when you're thinking about 32% growth over at Google's cloud, why is the juggernaut with all the market share just seeing such a lower pace of growth in the cloud area? Why is the capital expenditure not reaping the rewards that we saw at the rivals? I think that's the anxiety.
Well, they're being graded on the curve, then they're not doing well, right? Because everybody else is doing so much better. They expect operating profit, I think, of up to $20.5 billion in this quarter. And the street's estimate was only for like 19.2. So they could eclipse the estimate, but the street now, after we've seen Microsoft and Meta, wants to see Amazon do a lot better.
Yeah, I think they just wanted perfection. And with that operating profit going from $18.5 to $20.5 billion, that midpoint, well, I think it's $15.5 to $20.5, that midpoint is below where the market wanted to see it more broadly. Look, Andy Jassy is quite often a more cautious kind of a guy. He's also willing to invest and say profit tomorrow, profit the next year, but not right now because I need to invest in my business. For them, it's an issue of infrastructure. They're saying we need more power. We need the issue of getting these things online when it comes to data centers. But we probably wanted to hear a little bit more about how they're managing to win over with the chips that they offer, how many more clients that they're managing to bring onto AWS. And at the moment, he didn't have that much fighting talk. He just said, look, this is a point in time. People don't want that to be the reflective. At the moment, the stock market is reflecting a point in time of the worry that they're slightly behind in this race when it comes to generative AI. Actually, I think one that is unfair on Amazon, given the strides that they've made with their own large language models and their own investment cases.
Well, to that point, if these losses hold Amazon on track to wipe out its year-to-date gains, let's talk briefly about Apple here, because Apple actually, a surprise to the upside. Sentiment was so low on this stock, but they actually had some good news to talk about.
They did, and actually the shares are only popping about 2%, so I don't think it's like off to the races. There's still anxiety about tariffs, which both of you have articulated so well. They're saying that's going to be about $1 billion cost in the next quarter. They managed to come in less than their worst case scenario for the fiscal quarter just gone, $800 million of a cost. But we know that Tim Cook and his team are very good at supply chain. Where they're lacking is innovation. They did manage to get China back buying, whether it's the lower priced iPhones, whether or not it's also they're doing well in some of the other areas. The Mac sales in particular, they saw strength. The #1 selling product really when it comes to computers in China. But what about the next iteration? They were woeful in China. iPads was down. We saw generally the smartwatch and the home appliances not doing well. We need to get that foldable phone. We need to get the latest watch out the bag. We need more AirPods.
All right, we need more AirPods. Good to leave it there. Caroline Hyde, thanks so much for joining us. She co-hosts Bloomberg Tech. That kicks off at 11 a.m., so just an hour and 48 minutes from now. Coming up, Cleveland Fed President Beth Hammack discusses the state of the economy and pressure from the White House to lower interest rates as the jobs market kind of does it for her. Plus, we'll speak with Labor Secretary Lori Chavez-Dreamer after the huge payrolls miss and big downward revisions. This is Open Interest.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
As Bloomberg's global financial correspondent, I get to meet the people shaping the way money flows around the world. And I want to bring you with me. Now we're playing.
Yep, now we're playing. First and foremost, I am a capitalist. The capitalist system is the best system in the world. There isn't another one that works as well.
Citigroup moves $4 trillion a day.
5.
Wall Street used to be a place.
I love all these new Wall Streets. Y'all Street, Wall Street South.
Now it's more of an idea.
The optimism here is infectious.
You think our New Yorkers are negative?
Yes.
Anything that trains people to understand probabilities and just think through things with a greater degree of nuance is a service to humanity.
I hope you survived the day.
I did. It was a busy day.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Well, we welcome our Bloomberg TV and radio audiences worldwide. I'm Michael McKee. Joining me now is Cleveland Fed President Beth Hammack. And Beth, if we only had something to talk about this morning.
I mean, it's been a really quiet morning.
It's been a quiet morning.
Yeah.
Were you gobsmacked by these numbers?
It was a disappointing report, to be sure. But when I look at the data, we don't try not to make too much of any one individual report. And so we look at the confluence of data, we look at the longer term picture. What we have is a labor market that is showing signs that we should be watching carefully. Having the headline numbers come down makes sense to me, given what we've seen happening on the immigration side. And the headline number on unemployment, which is the most reliable indicator we have, is still within that 4.1 to 4.3 range that it's been at for the past year. So it looks like a healthy labor market that's still well in balance, but with some disappointing signs that we should watch very carefully.
Well, the one thing that caught everybody's attention is the revisions. We went from 147 in June to just 14,000. And I want to point out the statement from Chris Waller earlier today on why he dissented. He had a line in there that said basically, when labor markets turn, they often turn fast. Does that suggest maybe that you made a mistake by not moving in July?
I feel confident with the decision that we made earlier this week. We have to look at the whole picture of the data. When I step back and look at where we are, I see a labor market that is largely in balance. Again, today's report is just one report. We'll watch it carefully. We'll look to see if the dynamism in the labor market is picking up, because that's been something that we haven't really seen. If you have a job, you're able to keep your job, but if you don't have a job, it's harder to find one. But in aggregate, we're still seeing unemployment in that 4.2 range where it came out today, but it's been 4.1 to 4.3 for the entire year. We're seeing pressure on the inflation side of our mandate. That's where our miss has been bigger, and it's been lasting for longer. We haven't hit on inflation in 4.5 years. And when I'm out talking to people across the district, whether it's Wheeling, Toledo, Cincinnati, what I hear from people is that the pain of inflation is really biting. They're making very difficult choices. They're trading down from buying ground beef to buying hot dogs. The $400 emergency fund that they have, they're not able to stretch as far as they used to. And so we have to balance those two sides of our mandates when we think about setting correct policy. And we have to look at, if we're missing, by how much, and for how long do we expect those misses to last? And right now, we're missing by much more on the inflation side than we're missing on the employment side.
That was basically sort of the message that Chairman Powell gave on his Wednesday news conference. But we're looking at backward data always, of course. Looking forward, to get back to what you were saying about when you're talking to people, what are companies telling you about their plans? Let me put a two-part question. Does the poor job numbers that we got for the last 2 months now comport with what you had been told by companies? And what are they saying about what they're going to do about tariff price increases?
So what we've heard from businesses consistently is that uncertainty has been high for all of this year. They've had a difficult time making investments, executing on the plans that they had going into this year because they just didn't know where the economy was going to go. They didn't know how tariffs were going to impact their businesses. What we've heard consistently is that they fought really long and hard to get their labor force together, to train employees and make sure that they were really able to help produce, and that they're loath to let them go. But that can't last forever if demand ticks down. And so they're watching carefully to see if they're able to continue seeing that demand, if they need to pass on price increases to keep their margins where they need to be. And so I would anticipate that we could see some weakening. It's something we've been talking about and watching for, that we could see some weakening on the labor side of the picture. And if we see that, it would be something that we might want to respond to. Again, having to balance that against the inflation side, where we continue to really mess on that side of the mandate.
Well, what's the inflation outlook, basically? Are companies saying we can't absorb too much of this, or are they going to try to hold off as long as possible? Americans going to feel the tariffs sometime soon?
Yeah, I mean, my expectation, my forecast is that we will see the inflation numbers tick up. The $30 billion a month in tariff revenues is being paid by someone. It looks like it's more being paid by importers and consumers at this point. I think importers have borne a lot of that to this date, and it's likely that that will start to get pushed. We're hearing from the businesses we talk to that they can't absorb those costs anymore, and they will start pushing that out into prices to consumers. If you look at some of our forecasts, if you look at my forecast, I do expect that we're going to see inflation continue to tick up into the end of this year, and I expect that we'll see the labor market weaken into the end of this year. And again, how we need to manage that really depends on by how much and for how long we're going to miss on each side.
Well, let's talk about your forecast. Were you a 2-dot person or a 1-dot person for 2025?
There are other choices than that. There were 7 people at no dots. I don't usually disclose my dot, but part of my view has been that we see an economy that's operating right around full employment. We've been reasonably close, not all the way where we need to be on the inflation side of our mandate, and the growth numbers continue to do well. So to me, I think that the economy is operating right around a neutral long-term rate. We're a little bit restrictive. I think I said modestly restrictive, but I don't think we have much further to go to get to a neutral Fed funds rate.
I know that you're going to say 1 month's data are not determinative when I ask you this question, but I've got to ask because the markets are posing the question. We went from 40% chance of a rate move in September to over 70% after these numbers came out. Is September a realistic possibility now?
1 month's data is not determinative. I will in fact say that. But I enter every meeting with an open mind. I think my job, and I think all of my colleagues around the table walk into every meeting with an open mind to make sure we're looking at the data, and we're going to get an awful lot more data between now and the September meeting. We'll get another jobs report, we'll get 2 inflation reports, and there'll be a lot more time to be out in the district talking with business leaders, talking with community leaders, understanding their experiences to try to put everything together. So I walk into every meeting with an open mind to make sure that we can support the American people and that we can have an economy that's working for everyone.
Well, obviously, the markets today are looking at the labor situation, and you were referencing the inflation situation. If inflation's going up, you can't cut rates. If the economy's collapsing, you have to cut rates. So how do you balance the two right now?
Yeah, this is a really tricky time for monetary policymakers. This is when both sides of our mandate could potentially be in conflict, and we'll really have to look at what is the size of the mess and for how long do we think that is going to persist. And so, again, it will take a lot of conversations with businesses, with community leaders. It'll take a lot of careful analysis of the data, and it makes sense that there can be disagreement at these particular moments because this is really the most challenging time for monetary policy.
Well, I've talked to a lot of your colleagues around the country, and basically they're saying companies are on hold. Now we've got the tariff numbers. Do you have any indication of how fast companies are going to make decisions about what they're going to do in terms of staffing, in terms of investment?
Companies have been making decisions all along. I think they've been delaying or postponing or scaling back from what I've heard. So we have a franchisee who was looking at building new stores, and they decided instead they were just going to renovate existing stores. And so they were kind of downsizing their plans, if you will. Hopefully with more clarity around tariffs, and hopefully the policies that we have are durable policies, because that's really important to the businesses that I talk to, that they have certainty in what the policies are going to be against which they're making decisions. So it's possible that we could see some more investment being spurred here, given more confidence in the overall picture.
The other issue that is hanging out there, of course, is Fed credibility and the pressure you're getting from Washington. Donald Trump tweeting this morning that if Chair Powell continues to refuse to lower interest rates, the board should assume control, leaving aside the fact that the board doesn't take, this is not a banana republic kind of situation. How does the board and the Open Market Committee feel about Chairman Powell?
I have the enormous respect for Chair Powell. I know him to be a person of incredibly high integrity, and I know he walks into every meeting and approaches every day making sure he can do what's best for the American people, just like I and all my colleagues around the table do. And so I think each one of us goes into a meeting with an open mind. We have a really rich discussion. We learn from one another. We listen carefully, and people reading the exact same data can disagree. That's what makes markets, and it's no different for, you know, economists or policymakers. But it's a good conversation. It's very collegial. It's very collaborative, and we make sure that we're doing what we think is in the best interest of the American public.
Now, I can't really say what the president is thinking, but he tries to give the impression that if only this meddlesome priest were taken care of, interest rates would go down. You'll be a voter next year. If you get a new chair appointed by the president who comes in and says, I want rates to go down, how will you vote?
I will look at where the data is. I will look at how the economy is performing, and I will approach that the same way that I've approached it all of this year and all of last year, which is to make sure that we're hitting as close as we can on both sides of our dual mandate of maximum employment and stable prices.
Do you worry that the Fed's credibility has been damaged by all of this in the public mind or in business mind?
I've been really reassured by a number of business leaders and the Treasury Secretary who all talk about the importance of monetary policy. There is a large body of literature about how economies that have independent central banks have much better economic outcomes for their population than ones that don't have that level of independence. What you've seen across the globe is a bigger move towards independence, and so I'm encouraged that our leaders, our business leaders, and hopefully our government leaders recognize that that's critically important for the American people.
Beth Hammack, thank you very much for joining us.
Thanks
the
for having me,
president
Mike.
of the Cleveland Federal Reserve. We'll turn it back to you.
All right, our thanks to Bloomberg's Mike McKee for that fantastic interview. Let's take a look at what markets were doing while that interview was happening. You can see the S&P 500 now down by more than 1% pre-market. Big tech taking an even bigger leg lower with the NASDAQ 100 off by about 1.4%. But honestly, most of the action this morning is in the bond market. As you can see, the short end of the yield curve really declining this morning. That 2-year yield down 19 basis points. The 10-year yield down 11 basis points. Let's bring all of these questions to BlackRock's Chief Investment Officer of Global Fixed Income, Rick Reeder, who joins us now. Rick, it's great to have you with us on such a big day. And with the benefit of hindsight, taking a look at the numbers that we got at 8:30, taking a look at the revisions, which are starkly lower than what many were expecting, do you think that the Fed should have cut rates on Wednesday?
I mean, I do. I mean, listen, I think there's a couple things that are salient here. One, the housing market. I mean, look at what we got this week. You know, there are parts of this economy that are not interest rate sensitive, and there are parts that are. The housing market is interest rate sensitive. We're seeing mortgage applications, housing starts, building permits at an all-time, literally all-time low in many of those metrics. So I think that's a big deal. Second, if you actually strip these numbers apart, and I think Mike McKee said this, if you look at what actually the 3-month moving average, healthcare has actually created on average 68,000 jobs. The total payroll is 35,000, meaning it's created 200% of the jobs, meaning you have a service economy. You think about it, is healthcare interest rate sensitive? It's demographically sensitive. So you don't really, I mean, you think the interest sensitive parts of the economy are under some pressure. Lower income, who are the borrowers in this economy, are having a tough time. So would I have cut? Yes, I would have cut. And I think, you know, the tail risk is, by the way, I think the economy's in pretty good shape, and I think that's really fair. I think there's some impact from inflation and productivity that's going to pull it down with a little bit of an uptick for tariffs. The big picture, though, I think is you can cut the rate. You can get 100 basis points off this interest rate and still be above where inflation is tracking if you look at where break-evens are pricing. So I would have, and I think they will in September.
Do you think they'll cut? Is there a chance, Rick, that they cut by 50 basis points in September? Because I realize it's just one report, but that's what it feels like they need to do this morning.
You stole my thunder. Yes. Yeah, I would. I mean, I think you got to get, listen, I think you should get the rate down. And I think at the end of the day, you know, are you going to stoke more inflation? By the way, tariffs are not exactly interest rate sensitive. I mean, you have this near-term jump on it. Would I get that rate down to something and then see where you are? Yes, I think that's a possibility. I don't think, I've heard people this morning say you could get an intra meeting. I don't think you would get an intra meeting. I don't think the economy requires that sort of intense movement. But could you do 50 to get, similar to what happened last year? Could you get that sort of movement? Yeah, I think so. And by the way, I think the economy can handle it. By the way, I'll throw one thing on consumption. High income is what's driven savers. Wealthy, higher income is what's driven a lot of consumption. And you think about higher interest rates, it actually augments their ability to spend. So this idea that you cut it, I just don't think it'll have a debilitating impact on the economy whatsoever, or on inflation, I should say. I don't think it'll have any debilitating impact.
And Rick, I do want to point out, I mean, we keep hearing that it's just one report. We can't make too much out of just one report, but you think about the revisions. I go back to the revisions, really shocking revision when you consider the June numbers being revised down to $14,000, or not dollars, 1,000 jobs. And then you think about what it looks like over 3 months. It doesn't feel like it's just one report here, Rick.
So, man, I think Fed President Hammack is super smart. The smartest I've known him for a long time. The smartest people I've met. And I have a somewhat different view in that and by the way, comments about inflation, I thought were dead right. The thing I believe, though, is if you actually take the broad context of where labor is today, so you look at the JOLTS report, you see job hiring that's way down. But then you don't see the layoffs come off that much. Yeah. You basically have an economy or a hiring market that's pretty stagnant. Companies are sitting on their labor today. But gosh, if you look at the context, by the way, the reason why claims doesn't move up is because companies aren't really laying off. But if you look at the hiring numbers, gosh, they're pretty soft today. So again, It's not a bad economy. I just think, it's not a 1 month effect.
I just want to point out we're looking at the opening bells here on the New York Stock Exchange and the NASDAQ market site. You're going to see big drops in stocks at the open. Obviously, futures were down bigly, and you have yields coming down at the same time, which is pretty interesting. So it does look like investors are selling out of stocks after this jobs report and using that money to buy bonds because I guess the elementary explanation is they expect the Fed to cut rates just like Rick says they should have and will. And so you want to get in at these levels because the next levels will be lower.
A rotation trade underway. It's also the first trading day of August. We're coming off of 3 straight months of gains on the S&P 500. So a little bit of a drawdown to start August.
62.73.
Yeah.
Wow. In basically one fell swoop, actually a couple of days, we're down from over 6,400.
Yeah, it has been quite a consequential week. Also a consequential week on the earnings front. And let's talk a little bit about Apple because it reported its fastest quarterly revenue growth in more than 3 years, thanks to strong iPhone sales. It did say that it expects tariffs to add $1 billion in expenses this quarter. Maybe that's why you're seeing sort of a restrained reaction in the stock, not a restrained reaction in Amazon because it's trailing the sales growth of its cloud rivals as investors really look for results from the tens of billions of dollars in spending for AI products. That has been sort of the existential question hanging over these big tech names. When are we going to see some ROI here? Amazon shares down about 6.7% at the opening bell, Matt.
Yeah, Amazon down, NVIDIA down, Broadcom down, Meta down. So you're seeing a big drop. Alphabet down as well. Figma on the other hand, is extending gains. It was up 250% yesterday and a huge pop on the first day of trading. The company now has a market cap of above $50 billion. And let me just put this question to Rick, because I know what you think about it, Katie. Rick, Figma goes out and sells stock at 33 bucks, I think a share it was. Now it's trading at 137. They raised like 1.2 billion, but they could have raised 4. I know it's good to get $1.2 billion, but if you look at it like you could have had 4, doesn't that make you a little bit mad?
You know, that's a hard question. I mean, I spent a bunch of time. I can't talk about individual companies. I did spend a bunch of time looking at this company. There's some amazing technology companies, this one included, coming to market that are, I just think we're going through this extraordinary innovation, technology, productivity. You look at companies like this that have the ability to change, you know, how we do certain parts of software, et cetera. Listen, I'm blown away. I think I said on Wall Street Week last week, and I was in LA the week before visiting technology defense companies. The world, by the way, this is part of my thesis around productivity and innovation, and inflation is going to come down on the backside of it. But yeah, I mean, I think it's the most exciting time I've ever seen to invest, because you're seeing so many of these new technologies like this one that are game changing, I think.
All right, Rick, hang tight. We're coming back to you in a couple of minutes. That is BlackRock CIO of Global Fixed Income, Rick Reeder. But right now, we want to turn back to the labor market. The U.S. economy added just 73,000 jobs in July, below almost all estimates. And joining us now, I'm pleased to say we have Labor Secretary Lori Chavez DeRamier. Great to have you with us, Secretary. Let's just start with these numbers, because the figure that we got, that was below all estimates in the Bloomberg survey of economists. To start, what's your reaction?
Well, certainly we know they could have been better. But, you know, we look at the positive, because we still have a net positive, almost 500,000 new jobs since the president took office. Where did we see some of these, gains? We saw them in healthcare. We're seeing them in construction. We are seeing the revisions, I know, is something to talk about. And they were unexpected, those revisions. But most of those, 62% of those, were in education and seasonal workforce. So, you know, we sometimes see the numbers catch up to what's on the ground, but I can tell you why we're positive is because the president is delivering on these trade deals, these tariff deals, understanding new countries are moving forward and wanting to be at the table. And why does that matter to the American business owner? As you all know, I've been on my 50-state tour. I just returned from several states. A lot of these business owners had some uncertainty in understanding what was going to happen. But now that the One Big Beautiful Bill is done, I feel like the table has been set, and we're seeing those investments happen. So we've seen positive job growth for sure, and they've been for the American workforce. Native-born workers are taking the lead. All job gains have been native-born workers.
I mean, with all due respect, the positive job growth, the most positive months you saw were still what the Trump administration was calling the Biden economy, right? For the first few months when we saw those big numbers, that was the Biden economy. Now that the Trump policy is taking effect, you're seeing downward revisions of 258,000 over the last couple of months. Only 73,000 jobs added. And it looks like, not just to me, but to participants in this market, that today's weak payroll numbers are a direct result of the conscious policy to limit immigration. And I'm just wondering if that trade-off is delivering the kind of benefits you want to see to U.S.-born workers.
Well, I can tell you this. I've been a business owner for 20 years. When we make decisions, we look at all aspects, and there's certainly snapshots. But what has happened on the ground? The One Big Beautiful Bill by Congress, the president leaning in and keeping the promises made by negotiating fair trade deals for the American workforce. And now what we need is the Federal Reserve to jump in and lower those interest rates. I talked to businesses just yesterday who said, you know, we've invested in our American workers. We're paying attention to our facilities. We're wanting to invest and borrow more money, but they're concerned with borrowing that more money. So that's another leg of the stool that can be done. We should all be rowing in the same direction.
But is it the only leg of the stool that matters, Madam Secretary? Because we had a 3-month run rate adding 150,000 jobs. And now that those policies that this administration has put into effect are active, we're looking at a 3-month run rate of 37,000. So it's drastically fallen. And what it looks like is the policies that you're putting into place are reducing job growth.
Strong job growth has happened, 3.9% over the last year. Consumer confidence is up. Unemployment is holding steady. Again, almost 500,000 new jobs have been added since President Trump has leaned in. I can tell you this, it's not the only leg of the stool for interest rates, but it's one of the important legs right now, because as businesses now know that the table is set with the One Big Beautiful Bill, they know that they can have the write-offs for their businesses. They understand that they will have the skilled workforce. My job on the ground is to provide that workforce. They're asking me, and I'm asking them, to invest in their workers, invest in their companies, invest in their businesses across the country to grow this economy, and that's what they're looking for now. They want those interest rates down, and Jerome Powell should do that. The president has leaned in for a reason, and that's to keep those promises that he made. We're going to continue to see over time those numbers go up. But what we have seen, federal jobs have been down. That's what the president promised. We've seen local economy. We've seen 84% of the job growth has been in the private sector. Why? Because the president has said that he is investing in the American worker first. That's what we're all about. I want these workers trained. We're seeing it in AI. We're leaning in with our federal and state partners together to say, let us give you the workers that you need for market demands in your respective states.
Right.
I think that that's the focus that needs to be.
Well, Secretary, I want to talk about some specific industries here. One of the interesting stats out of this numbers report is that without healthcare, actually the last 3 months of payroll gains, it would have been negative in May, negative in June, and negative in July. And then you take a look at manufacturing, shedding another 11,000 jobs. You take a look at the 6 months change, shedding 28,000 jobs. What are the specific policies that the administration has and is putting in place to revive the manufacturing sector? Because so far it looks like it's continuing to shrink.
Well, I think that that's probably what we just talked about. Those trade deals are now coming online. Again, I was just in Japan last week with the Secretary of Treasury, and that trade deal came in. We see the European Union has come in. We're seeing other countries as well. It's that certainty that we have to give businesses that that is being done. And then as well that they're going to have the workforce. So what do we have to do? I'm working with the Department of Education. I am working to skill those that workforce. We're working with our community colleges, our technical schools. Businesses are investing in centers of excellence. They just need a quarter turn for those workers to be trained and ready to go. One of those ways is executive orders to work with our state partners in order to get them trained and really lean in and have them right there on the ground. So when you see the uncertainty or the numbers drop over time, it's a snapshot in time. It doesn't make a trend. We're seeing it over time. The president has this right. The American business owner is believing in what they see. And now with this One Big Beautiful Bill, and if interest rates drop, I think that you're going to see more and more investments. I really couldn't be more clear when I'm talking to these business owners on the ground. I've visited 20 states. They are all excited. They all understand their marching orders now, and that's to invest in the American worker, and we're going to continue to double down and do just that.
Well, it does look like we're going to see interest rates cut at the next meeting. At least the market is pricing that in, Madam Secretary, and we're looking at rates drop really across the curve. Today, the 10-year down around 425 is relatively low. With that backdrop and the tax policy of the One Big Beautiful Bill and the deregulation that this administration has promised, what kind of jobs growth do you expect us to get back to this year?
Well, I'm making the assumption that with all of those being in play, when I think about the deregulatory framework that the president also has asked us to do, the Department of Labor has just issued 63 deregulatory actions. In Trump administration 1, 30 deregulatory actions were done over the 4 years. We've already done 63 in the first 6 months. And we're going to be looking to our companies to weigh in on this, because what does the president want? Modernization, streamlining, cost cutting. He wants to be an ally for the American workforce, not an adversary. And for far too long, the Department of Labor or any other agency has not said, we're going to be your partners. So we will continue to go around the country. We will continue to lean in on interest rates, on investments from companies, on the worker, because we want to keep more money in their pockets. And we're seeing that consumer confidence. Wage growth is up. So there's a lot of positive here. We'd like to see better numbers, but we're going to continue to double down so those numbers continue to grow.
All right, Secretary, have to leave it there. Really appreciate your time this morning. That is Labor Secretary Lori Chavez de Remer. Meanwhile, we're back now with BlackRock's Chief Investment Officer of Global Fixed Income, Rick Reeder. We've already talked about revisions, but I want to talk about them a little bit more. There's a great stat from our Bloomberg Terminal Top Live blog that if you account for the big downward revisions to the last 2 months, payrolls have risen by just 35,000 jobs on average over the last 3 months. That is the weakest pace of hiring since the onset of the pandemic in 2020. If you were just taking the numbers that we get at 8:30 on the first Friday of every month at face value, it's a totally different picture when you get the revisions a couple of months later. And with that in mind, Rick, I mean, how much faith do you have in these figures?
So there's a lot there. So first thing I would say, further comment earlier, 68,000 of the 35,000 is healthcare. Like that, it's just remarkable. Like you said, these numbers are softed. The one thing I will say, people say, "My God, this economy is slowing dramatically." Well, I'm sure people come out with recession talk again, which will be wrong. The one thing I will say is you have an economy that is in a little bit of just wait. Like, well, you're not seeing layoffs pick up. You're seeing the claims data in pretty good shape. So listen, part of why I think we should cut rates is there is a risk you do get stall speed in hiring. And because I think that inflation is temporary, and I think you'll see these productivity dynamics playing. But listen, I'm not really worried about the economy. But listen, I think the rate threshold today is not consistent with what I think it should be. I don't think being restrictive today is the right posture. One man's opinion.
I mean, we're spending 7% of our GDP in deficit, so it's unlikely that we go into a recession, right?
Yeah, I mean, there's a series of tailwinds to the economy. By the way, looking at the numbers, there was disappointment on Amazon today. These numbers, I mean, you think about what we just saw this week, the CapEx, the AI, the cloud, the new company that you talked about, new companies that you talked about. The economy, the foundation of the economy is pretty darn solid. I'm not really worried about it. It's, it's created, I did a presentation yesterday called Potholes versus Sinkholes. This is, by the way, this period of time, July is historically the weakest month for payrolls, and actually August is second. So, and the data tends to be weak during this period. People shouldn't overstate that, what it means broadly. So, you go through these periods, you'll get some potholes. The fact that volatility was priced so low over the last few days was pretty remarkable. I mean, the ability to actually put some insurance in the portfolio for this near-term softness was pretty profound over the last few days. But I'm not worked up about, gosh, we got a tough economy coming. Particularly when you see the numbers you're seeing on CapEx and R&D spend.
I want to go right there to CapEx and R&D spend to some extent. AI CapEx has been nutso, like just eye-popping numbers, 85 billion from Google, 70 billion from Facebook. Next year, they want to do 100 billion. Is that money going to really power the U.S. economy? Is that like when we built railroads and highways? Or is it something else, Rick?
Listen, I shouldn't overstate it, but I think that the amount of money that's going into more efficient technology, by the way, you think about what's going into space technology, you think about the power required to actually create this and what it means for different parts of the power infrastructure. Listen, the numbers, like you say, are staggeringly large. I went through it on this call yesterday. I went through the sheer numbers we're going to see and the acceleration of numbers you're going to see. What does it mean? And by the way, you can get into the discussion, is there some near-term inflation as he's put this money into the system? 100% possible. You hit the other side of the mountain when you see and by the way, I think we're seeing it today, some of the productivity enhancements. So the numbers are big, but they're not just the numbers you spoke to, but which are large. It's how do you think about compute, cloud, energy, et cetera. And I mean, listen, I think this is one of the most extraordinary technological evolutions, similar to telephony, similar to internet, similar to rail. I do.
Rick, we probably only have time for one more question. You've been so generous this morning. So I want to take a pretty dramatic left turn here and talk about the concept of privatizing Fannie Mae and Freddie Mac. There's been a lot of talk of that. Our reporting shows that President Trump met with some of the big bank CEOs this week to discuss that topic. You own a lot of mortgages when you take a look at BINC. That is the ETF that you managed. When you think about this possibility, are you concerned at all that it will be executed in a way that could cause MBS spreads to widen?
So a couple things. By the way, y'all have been kind enough to give me a break, so I've been trading in this market, which is which has been interesting, exciting to say the least. It's like an incredible trading environment. So am I worried about? No, I'm not. I think, whatever happens to the GSEs, I'm pretty confident that people understand the preservation of a housing market that, quite frankly, today could use some commercial push. I think is, but to maintain some form of implicit or true guarantee, I think people understand that has to continue, and so though I'm not worried about it at all. It'd be interesting, the developments around what happens, how it happens, how they build capital over time, and what those entities look like in terms of other things at their disposal. But the one thing I'm definitely not concerned about is, gosh, the credit quality of our mortgage position, of our agency mortgage position. By the way, not concerned about our non-agency mortgage position either, given so many things around HPA, et cetera, in the housing market.
All right, Rick, we'll let you get back to trading in this market. Good luck out there. Have a great weekend. That is BlackRock's CIO of Global Fixed Income, Rick Reeder. Meanwhile, let's take stock of this stock market. We're about 17, 18 minutes into the session, and boy, it's an ugly one. You do have some gainers right now, some companies fighting to stay in the green, actually about 112 of them. Take a look at what's leading in this market. On a points basis, you have Eli Lilly punching up here, AbbVie as well. Some of these interesting names that normally aren't in this plum position, but you have a lot of tech weakness today, and that's why you see this mix-up here, because NVIDIA currently down 3.5%. That's taking almost 18 points off the S&P 500. Amazon, Broadcom, Meta, JP Morgan as well, really dragging this market down. The S&P 500 now off by 1.6%, a really ugly start to August. Let's take a look at the sector breakdown. It's going to be broadly similar. There is going to be a lot of red on the screen. This isn't typically a screen that we look at. This certainly isn't the sector screen, but trust me, there's a lot of red when it comes to that sector breakdown as well, Matt Miller.
All right, a lot to talk about in these markets on the stock level for fixed income, labor data. Coming up, we're going to talk more about AI spending. The question is it going to pay off? Are we going to see, as you rightly asked, Katie, a return on investment here? Because Mag 7 companies are spending hundreds and hundreds and hundreds of billions of dollars. This is Open Interest.
I'm Alex Rodriguez.
And I'm Jason Kelly.
And we're back with more episodes of our show, The Deal.
The theme of this season, On the Road. We're bringing you more behind-the-scenes conversations with the biggest names in sports, business, and culture, like Melody Hobson.
I started to study women's sports like an 11-year-old studies baseball statistics, and I got dangerous in seeing up arrows, up arrows.
Susie Wolf.
When you're competing, you're not thinking about any fear or any worries of what could happen.
Josh Harris.
You can't do a good deal with a bad person.
Jay Batt.
At the end of the day, there's never been a better time to be a student athlete.
And more. Stay tuned.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this going to be normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
up-to-the-minute energy news whenever and wherever it happens. I'm Joanna Bersecci in Vienna, and this is Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling.
Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
This is Bloomberg Open Interest. I'm Matt Miller. Let's take a look at what stocks are doing after that big miss for the non-farm payrolls number. You can see the S&P 500 off 1.7% to 6231. So still at a relatively high level, but what a big drop. The NASDAQ down more than 2% right now. And you can see that we have rates coming down, the 10-year yield at 425. The problem is a lot of red on the screen here, including NVIDIA. NVIDIA's off 3.5% today. Amazon is down 7% after really disappointing with numbers out yesterday. And then Figma, it's up again 1.5%. That's nothing though, Katie, like the 250% gain we saw yesterday when they just left billions of dollars on the table after their IPO.
Yes, but they did have a big, beautiful one-day pop, so maybe that's a consolation prize there. We'll continue to discuss that at length throughout the day, so don't go anywhere. Let's talk about the big tech earnings that we got yesterday, though. It wasn't all about Figma. Bloomberg Tech co-host Ed Ludlow joins us now. And Ed, I actually want to start with Apple, because Apple had a good report. It was a beat and a raised quarter, but you can see that the stock actually turned lower. Where is the caution still lurking?
Yeah, it's the questioning of whether there was or was not pull forward in the June quarter because of tariffs and whether that will continue, right? So absolutely beat handsomely across every metric in the June or fiscal third quarter gone. And the guide on growth, mid to high single digits percentage growth going into the September quarter was a pleasant surprise. But Apple was very granular on the issue of how tariffs impacted consumer behavior and purchases of iPhones in particular. It was all in the month of April. It was largely in the United States, and it contributed just 1 percentage point in the 10 points of growth that they saw in that period. And during the call, analysts asked time and time again about pull in or pull forward. And the market this morning has given up the game. Some notes out there and some questions about whether we accept that there wasn't this great pull forward or in, as it was quantified by Tim Cook and Kevin Perek.
I want to ask about Amazon, Ed, because you know, they did better than had been anticipated, but so everyone else did so well that they didn't do. They didn't keep up with the crowd, so to speak.
Exactly right.
And but how much of this is just a problem of Amazon's, you know, tap on, tap off spending? Over the last 25, 30 years, you know, they've shown an ability to ramp up when they want to.
Well, you asked the question earlier, when does it pay off, or will it pay off? You know, both of those questions are relevant in Amazon's case. The market's trading lower on an operating income guide for the current period that's seen as weak or conservative. But AWS did grow in the period gone. This is all about AWS. Forget Amazon.com for the time being. Even though it makes up the majority of revenues, the majority of operating income is cloud, and that's the domain that AI is coming. AWS growth of 17% is nowhere near the growth that we saw from Azure, for example. And so there's a concern that it's not paying off, but the spending commitment is more cautious too.
All right, Ed, looking forward to your program because there's a lot to talk about. Bloomberg Tech's co-host Ed Ludlow there talking about Amazon and Apple earnings. We've had the M's, we've got the A's. NVIDIA takes like months and months, right?
Yeah, yeah. Sit tight on that one.
Next hour, economist Kathy Bostjancic joins us, as well as Craig Moffett from MoffettNathanson.
When I got there, they have the sushi like...
This is Clem.
villa. Very traditional. A lot of things of the past.
I live my very first independent life in the farmhouse. And I built it by the memory of the farmhouse, the philosophy they believe, yin, yang, 5 elements, the concept of the life, of the happiness. They build this kind of roof, like boat, and man and woman, and bowl of rice. Everyone should be happy if have somewhere to live, something to eat, and someone to love.
So you're defined a lot by your past experiences.
Yeah, actually, I'm a lucky man because not everyone should have the experience of the war and peace, poor and rich, technology progress, a change during my life, rich by experience.
There's an appreciation for what you have now.
And therefore, peace is the most important thing for today, for Vietnamese, and I think for human being, for the world.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question.
Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Bringing you the latest in tech and AI news whenever and wherever it happens. I'm Tom McKenzie in Paris, and this is Bloomberg.
This is CBS News on the Hour, sponsored by Progressive Insurance.
I'm Deborah Rodriguez. Stocks are tumbling in early trading. Dow's off 660 points. That's 1.5% after the Labor Department released a much weaker than expected jobs report for July and revised the numbers downward significantly for May and June. CBS News business analyst Jill Schlesinger.
Those 2 months of revisions means that we had 250,000 fewer jobs than previously reported.
Economist Gus Fauché.
There's a lot going on. There's a lot of uncertainty about the tariffs. We see government spending cuts that are having a drag. We've seen consumers turn more cautious. We've seen businesses turn more cautious.
President Trump upped the ante in his trade war, announcing a new round of tariffs on dozens of countries, hours before his first round was set to take effect last night. Correspondent Ed O'Keefe.
This was supposed to be the start of a major reordering of global trade. The fact now that just late last night they said, actually, no, wait, 70 countries have 7 more days to try to cut a deal, and we're going to give Mexico 3 more months, and we're hoping we get 3 more months to negotiate with China. All of it means that uncertainty that businesses have been seeing across the country is going to get delayed even more.
New tariffs take effect next Thursday at rates of up to 50%. A 28-year-old teacher just made a court appearance in the murders of a couple at an Arkansas state park.
You're in front of me today, sir, for your first appearance at Arkansas Rule of Criminal Procedure 8.1.
Andrew McGann was charged with 2 counts of capital murder after he was arrested at a barber shop. CBS's Omar Villafranca.
Investigators say McGann stabbed Clinton Brink first, and his wife rushed their daughters, ages 7 and 9, to safety. When she returned to help him, she was also stabbed to death.
They absolutely protected those girls to their fullest extent.
McGann was reprimanded to prison this morning with no bond. They're cleaning up in the Northeast after massive flooding that submerged highways, train tracks, and canceled and delayed thousands of flights. Correspondent Nikki Batiste is at LaGuardia Airport in New York.
Yeah, everyone should still be careful today. The threat for the East Coast isn't over yet, particularly in the Carolinas, where we could see some heavy rain there today and possibly more flash flooding.
Ford is recalling 300,000 trucks and SUVs. WWJ's Jeff Gilbert.
Yeah, everyone should still be careful.
The power assist can fail on the brakes of certain 2025 Expeditions, Navigators, Broncos, F-150
F-150s and Rangers. That can extend stopping distance and increase the risk of a crash. The problem is software related and will be fixed with a software update.
Dow now down 780, NASDAQ off 532. That's 2.5%. This is CBS News. Prosecutors are going for a longer prison term for music mogul Sean Combs.
In a new court filing, prosecutors say they expect Combs' sentence will be substantially higher than the 4 to 5 years federal sentencing guidelines suggest. He was convicted of 2 counts of transportation to engage in prostitution. Each count carries a maximum of 10 years in prison. Celebrity lawyer Chris Melcher lays out Combs' potential arguments.
He has no criminal history before. He's going to talk about things that he learned while he was in detention and why he'll lead a different path going forward.
Combs will be sentenced on October 3rd. Michael Wallace, CBS News.
Obese people on Medicare and Medicaid might get access to pricey weight loss injectables. Documents obtained by the Washington Post show the Trump administration is planning a 5-year experiment that would cover drugs like Ozempic, Wegovy, Mounjaro. Right now, Medicare covers the drugs only for patients with type 2 diabetes. Deborah Rodriguez, CBS News.
This is Bloomberg Intelligence with Paul Sweeney.
The real outperformance has been the U.S. corporate high yield. These are 2 big-time blue-chip companies. One person's chaos is another person's animal spirits.
Breaking market headlines and corporate news from across the globe.
Our view is that the economy is slowing down.
There is the possibility of a death spiral.
Both quantum computing and AI are going to power the future.
People are just buying everything with tech.
Bloomberg Intelligence with Paul Sweeney on Bloomberg Radio, YouTube, and Bloomberg Originals.
All right, good Friday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We're streaming live on YouTube as well. Alex Semenova joining me from Bloomberg News. She's going to be with us for the next couple of hours. A lot of economic data here today, and none of it looks particularly good, whether it's jobs, whether it's ISM manufacturing, whether it's UMISH. We're going to break all that down today. Brendan Murray is going to join us here, Bloomberg Global Trade Editor, get the latest on all this trade talk. Damian Gardet, Bloomberg News health reporter, talks about the healthcare stocks. They're under pressure. President Trump is talking about lower prices for imported pharmaceuticals, and that's a big thing coming out of Europe. Kate Duchesne, CEO of RGP, will get her thoughts on this weaker than expected jobs number and what it means for markets. Angelo Zeno, Senior Vice President, he's an equity analyst over at CFRA. Talk to us about those Apple numbers. I don't know. I thought they were pretty darn good if I'm Apple. They got a lot of cash, too. So a lot going on the earnings front, a lot going on the eco front. We're going to get it all to you over the next 2 hours. Right now, let's kick it all off. John Tucker and a Bloomberg Business Flash.
All right, this Bloomberg Business Flash brought to you by IBKR. Will August 2025 be the warmest August on record? At IBKR Forecast Trader, the yes was recently at 36%. Start predicting today at ibkr.com/forecast. Last trading day for this contract, September 11th. And right now, we are data dependent. Let's get right to it. ISM Manufacturing Index lower than expectations, coming in at 48. That is contractionary territory. The expectation among economists surveyed by Bloomberg was for 49.5. And the University of Michigan Sentiment Index coming in lower than expectations, 61.7. We were expecting 62 from the survey of economists tracked by Bloomberg. Maybe more importantly, the one-year inflation expectations coming in higher than expectations, 4.5%. The survey was for 4.4%. And then it was a weak jobs report. The revisions to the prior month's real eye-openers this morning. In the last 3 months, employment growth, that has averaged just a paltry 35,000. That's the worst since the pandemic. So the immediate impact is to what I'm going to call the policy reactive 2-year yield. Right now, 24 basis points lower. We are 371 on the 2-year Treasury. The jobs report poses further risk to a slowdown in consumer and business spending that's actually already underway in the U.S. economy. Dollar DXY, that is down 1.1%. Now for equities, 8 of the 11 major industry groups in the S&P 500 down. Consumer discretionary, the biggest drag, that is home to, let's hear it everybody, Amazon. And we'll have details on that in just a moment. Break that down, those earnings. S&P 500, 117 points lower, down 1.8% at 62.23. The Dow Jones Industrial Average down 748 points. The tech-heavy NASDAQ 100, 477 points lower. Right now, that is a decline of over 2%. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Allison Paul.
John Tucker, thank you very much. We appreciate that. Alex Semenova, you pick a heck of a day to join us here today with all the economic data.
A really eventful week for markets, one that could perhaps shape the rest of 2025. And of course, we're heading into the seasonally worst period for stocks, August and September of the year. So it could be pretty volatile ahead.
All right, it's interesting. We've been saying, hey, we haven't really seen it in the hard data. Seen what? Seen a slowing economy, maybe some inflation creeping in there, but maybe this some of the data we got today in terms of non-farm payrolls, ISM, that's some hard numbers, and we'll see how that plays out. But the markets are certainly reacting today. Let's take a look at some of the stocks on the move today. I'm Paul Sweeney alongside Alexander Semenova, and we're joined by Bloomberg's Tatiana Darrier. Tatiana, what are you looking at today? Lots to choose from.
Yeah, looking at a combination of consumer and tech stocks. Obviously, we'll start with Amazon, the big mover to the downside, down 6% right now after weaker than expected operating income and trailing growth in its cloud division. Of course, after such strong results from Google and Microsoft, those results aren't digested very well by investors. And even though the CEO said we're in the very early days of AI, investors just not really convinced that all that spending is paying off for Amazon after what we've seen in the results here.
And Tatiana, it's been pretty incredible to see what a mixed bag the tech results have been. Obviously, on the flip side, you have Apple that was doing much better yesterday than Amazon.
Yeah, Apple here was up, now has kind of lost that move, is slightly down, we'll just call it flat on the session here. After seeing its fastest quarterly revenue growth in more than 3 years, a really solid quarter for Apple. Tim Cook saying that the company saw an acceleration of growth around the world, in China particularly, and in other EM markets. Services was really good for them, a record quarter, and then their revenue growth forecast was also better than analysts expected. I also looked for the impact for tariffs, because remember that was the big worry for them, and they did incur an $800 million hit. They said they're going to incur another $1 billion in the coming quarter, but so far they still managed to pull gross margins at the high end of their guidance despite all this tariff impact. So all these big companies are finding ways to offset the tariff impact.
Yeah, you wonder how long they can take it in the margin before passing along to consumers. How about Kimberly-Clark? That's one that obviously a lot of consumer products side of the business, you think you might see inflation.
Exactly, you would think that, but no. Kimberly-Clark here leading gains in the S&P 500, part of the very few stocks that are rising right now. Up 7%, your ticker is KMB. After reporting the strongest volume growth in 5 years, organic sales jumped after consumers retreated in the first quarter amid tariff concerns where they're coming back. And Kimberly-Clark also saying that tariffs or the impact will be less than they thought originally. And analysts asking how were you able to offset some of that impact? They pointed to favorable effects with the weaker dollar and some other actions like depreciation and amortization. So far it looks like these big companies do have a lot of levers to pull to offset the tariff impact.
Good for them. We're seeing that in some of these numbers here. Tatiana Darrier, thank you so much. We appreciate that. Strategist for Markets Live. We're at Bloomberg News. For more conversations like this, subscribe to our new Stock Movers Reports. Listen For 5-minute audio reports on the biggest winners and losers in the stock market, subscribe to Stock Movers on Apple Podcasts, Spotify, and anywhere you listen. So, Alex, it looks like we've got, I guess, clarity on maybe where some of these tariffs might shake out. I mean, August 1st, this was kind of the drop-dead date. We had a lot of flurry of announcements yesterday from the White House. Let's see where we are here. Brendan Murray, Bloomberg Global Trade Editor. I love this headline coming out of Bloomberg News. Trump boosts tariffs across the world, comma, reshaping global commerce. That is an all-encompassing headline that says a lot there. Brendan, what did we learn over the last 24 hours here? Are there winners and losers? Are we done? What's going on here?
Well, I'll tell you what the International Chamber of Commerce says is there's clarity now on the direction of travel with global trade, but there's still no clarity and indeed a lot of uncertainty about how to implement all these tariffs. We're looking at essentially 5 tiers of tariffs. You've got 10% for some countries. You've got 15% for around 70 countries. You've got Canada and Mexico. They're on separate tracks. You've got the U.S. and China. Those are also on separate tracks. Then you have the goods that are deemed to be transshipped through certain countries that are looking at an extra 40%. So you've got this complex web of back office bureaucracy that companies are facing. And it's not just the big companies, it's small companies. The National Retail Federation says some of their members, the small retailers, are not going to be able to survive in this kind of environment.
Brendan, one interesting element of these trade policies is that countries can come to Trump to the negotiating table basically any time and try to find a better deal. How much does this delay when we get clarity on what the final tariff framework might look like, given this could be months, years ahead of negotiations?
Well, Jamison Greer, the U.S. Trade Representative, said on Bloomberg TV not long ago that they're moving into the implementation phase. The time for deal making was the past 4 months, and if you didn't get it over the line by today, it doesn't sound like there's much of a window left to do that. So there's always a chance, he said. We're always willing to listen, but they sound like they've got their plan and they're pushing ahead with it.
So, Brendan, I don't know. I guess I was under the impression that trade deals take months, if not years, to negotiate, and they're like thousands and thousands of pages. What's going on here? What is an agreement? Yeah. Is it a term sheet? Is it a handshake? Is it a wink and a nod? What are these things?
Yeah, I mean, these aren't even really codified in any legal sense yet. But you're right; they do take months and years and armies of lawyers to go over the fine print, and you go back and forth with industries to make sure you get it right for businesses trying to do international commerce. But these are what one Trump official called it's a settlement. It's almost a legal term to say we're settling this score with you. We're settling this disparity that we have with you. So these are, call them what you want, call them frameworks, call them deals, call them agreements, call them Sharpies scribbling on the back of a napkin. But this is what the Trump administration is pushing ahead. This is the America First trade policy in real, hitting the real economy now.
Is there a sense that countries like Switzerland and New Zealand have been targeted extra hard here, that something went awry in the conversations that they had with Trump?
Yeah, that's what it seems like it must have happened, because Switzerland especially had assurances that it had a deal, and then the final step of that is to have a conversation with the president, and we don't know what happened, but apparently that they didn't get to a point where they could announce an agreement. So New Zealand is another interesting case. You've also got the situation with India, where there's some geopolitics wrapped into that, involving their purchases of Russian exports. So it's a complicated web of economic grievances and geopolitical issues that President Trump is trying to settle with these tariffs.
30 seconds, Brendan. If I'm an import dude at the port of Los Angeles, am I stamping taxes on these things, tariffs on stuff coming in today?
Well, yeah. I mean, you know, they take effect on August 7th, but
Okay.
you're probably racking your brain right now trying to figure out how to apply all these different tariffs to products that might have come from from different parts of the world, and it's just it's really impossible to kind of figure it out in any sort of timely way. So it's just going to bog the system down here for the next few months until it can work through it.
I'm front running on my Barbaresco today. I'm heading out and I'm stacking up on that stuff. I don't want that pay extra for that coming out of Italy. The Nebbiolo grape. Brendan Murray, global trade editor, Bloomberg News. He's over in London. He's trying to make sense of what's going on here with the global trade. So we've got clarity, I guess. We kind of know what the numbers are. We'll pay attention going forward. Stocks selling off 1.5%.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker, the Bloomberg Newsroom with this Bloomberg Business Flash. And we are being brought to you by Oracle. Attention, growing businesses. Oracle offering to cut your current cloud bill in half if you move to Oracle Cloud Infrastructure. This is for new U.S. customers with minimum financial commitments. See if your company qualifies at oracle.com/Bloomberg. U.S. factory activity that we got at the top of the hour. Just adds to the poor data that we got. So this for the month of July. It contracted factory activity at the fastest pace in 9 months, and it is in contractionary territory. Again, below 50. 50 is the dividing line in the ISM survey between expansion and contraction. Short-term yields, that's where I'm going to go first. They're down 21 basis point. The 2-year yield at 3.74. So the yields posting their biggest drop at a year. This comes after the softer jobs data prompted traders to boost bets that the Federal Reserve is going to cut rates as soon as next month. The S&P 500, 99 points lower. That is down 1.5%, 62.41 on the index. The Dow Jones Industrial Average is down 615 points. That's a drop of 1.4%. The NASDAQ 100, 409 points lower. That is down 0.8%. Amazon shares right now, they are down 6.4%. This has to do with their results after the close yesterday, projecting weaker than expected operating income, again, also trailing the sales growth of the cloud rivals. Apple reporting its fastest quarterly revenue growth in more than 3 years, so that easily topped analyst estimates on Wall Street. But again, Apple, it was up earlier, but now tracking the rest of the market lower down 1.3%. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Alex Paul.
All right, John Tucker, thank you so much. We appreciate that. Alexander Semenova, Paul Sweeney, live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. And Alex, I'm going back to what you said something earlier. Just some of the hard data coming in today, whether it's non-farm payrolls, ISM manufacturing. I mean, this is hard data. We might look back on today later this year and say, boy, that was the day when we really saw some of this economic data turn down. We'll see. That's kind of how the markets are reacting today. We'll see. But today is interesting. I look at the ISM employment number. That's also that jumps out at me. It came in at 43.4, really weak. It was 45 last period. The consensus was 46.8. So a weak manufacturing employment number. That kind of gets your attention here.
This seems like the be careful what you wish for moment that investors, they wanted rate cuts, and now you get weaker data, and you're going to have some pain in the markets. Mike Kantrowitz over at Piper Sandler, he said, you can't expect a free lunch.
Yes, yeah, that's a great point. As John Tucker was pointing at the 2-year, that's where we're seeing it here in that rate-sensitive 2-year down 21 basis points, 3.74%. The pharmaceutical companies, looking at them, some of their year-to-date performance down double digits, 20, 22, 12%. A lot of headwinds on the regulatory front. Damien Gardet joins us here, healthcare reporter for Bloomberg News. And Damien, I understand that President Donald Trump is sending letters to 17 of the world's largest drug makers saying, we need to cut U.S. drug prices. What's the status of that, Damien?
Well, it's fascinating. As you mentioned last night, the president sent out letters to 17 of the CEOs of the largest drug companies in the United States and in the world saying two things. One, drugs are too expensive here in the U.S. Two, they're too cheap overseas, and it's unfair. It's a bad deal, something the president, of course, famously abhors. And so what he did is gave them 60 days to meet a series of maybe impossible and questionably legally enforceable goals that he has, one of which is to lower the cost of medicines that they sell to Medicaid, the government's program for lower-income Americans, and then also to normalize the price of new medicines, the U.S. prices with those offered to wealthy nations overseas through a policy called Most Favored Nations that has been floating around for a while and actually something that the president tried and failed to implement back in his first term. It's a lot of threatening language, and getting kind of a nasty gram from the president of the United States is probably not something a CEO would want. But the reaction among analysts has been pretty tepid in that this is an escalation of something the president has described, but it's also something that has so far proved to be fairly toothless. The legal basis for mandating drug makers do this is pretty murky, and it doesn't seem to be within the aegis of the executive branch. But it certainly expands this narrative that pharma is kind of under fire regulatorily in the United States.
Damien, is it clear whether this would actually save U.S. consumers money, particularly since the proposal mostly affects newly launched drugs?
Right. That's a great question. And the answer is no, it isn't clear, because what the White House is really focused on is not so much the price of medicines in the US, but rather the differential between what they cost here and what they cost, for example, in Germany or the United Kingdom. So one way to basically answer the president's demands would be to effectively just raise the prices charged overseas, in which case, you know, that might constitute a better deal for America as an entity, but wouldn't actually lower the prices in the United States, and it certainly wouldn't lower the out-of-pocket costs that patients pay.
So, Damien, is there an opportunity here for some of these companies to maybe just show some, I don't know, at least some minor price cuts to appease the president, or is there something more fundamental that they need to do? Because, I mean, every American would love to pay lower drug prices for sure.
I think there are some ornamental things that drug companies can do to, I don't want to say pay lip service, but to kind of try to meet the White House halfway. We've seen early versions of them. One of the things that the White House has asked for is companies to offer direct-to-consumer channels for basically patients to buy drugs directly for them at the prices that are, or at prices that are equivalent to what insurance companies negotiate down. We have seen companies do that. Eli Lilly and Novo Nordisk have done it with their GLP-1 weight loss medicines, which obviously are in huge demand. And then recently Pfizer and Bristol Myers Squibb did it with Eliquis, which is a blood thinner that is widely used. Each of those has an asterisk that kind of cuts against the idea that this could be some like shift change in American drug pricing. For Eliquis, for example, it's a single-digit percentage of people who take that drug who don't have insurance of some type, either commercial or through Medicare, to get it. So the notion that the company selling it at this discounted rate off of its list price has some kind of sea change in the way this goes is, I think, a bit of a stretch.
All right. Damien, thanks so much for your reporting. Appreciate that. Damien Gardet, he's a healthcare reporter for Bloomberg News. Again, this president is putting some pressure on pharmaceutical companies to lower the price of drugs. We'll see how that plays out going forward. Again, today really dominated, I think, by some of this economic data, which shows some fundamental weakness in the labor market, in the manufacturing side of the U.S. economy that is certainly getting investors' attention here, both in terms of the bond market and the equity markets as well. Let's get the latest on reading on all of that. Kate Duchesne, CEO of RGP, a consulting company, joins us here. Hey, Kate, when you look at the numbers here today, it's kind of the first time we see some real hard data showing some meaningful weakness in the economy. Does that jibe with what you hear when you talk to your clients at RGP?
Yes, thanks for having me on. Glad to be here. I think we're still seeing mixed signals. So in some ways, yes, it does, because this is telling us that the labor market is not as hot as we once thought, but it also tells us we have just surveyed a group of CFOs who plan to increase investment in workforce strategies. So there's clearly a trend here that people want to work differently. And that means that we'll be working with more technology and AI as we move forward. That can displace some human talent, but we're seeing mixed signals.
Kate, on this point of mixed signals, there are so many cross currents within this report. You have the headline number trending down for 3 months, but at the same time, the unemployment rating is 4.2%, still healthy. Wage growth is growing. How difficult does this make it for you to get a big picture sense of how the labor market is doing?
I think that you're spot on. I think it's hard to draw any firm and solid and consistent conclusion from the data today, because it does point us in different directions. I mean, certainly everybody thinks this morning it will point in the direction that the Fed will act in September because the labor market is cooling. But you're right, more people have left the labor market too, it looks like. And wage growth was pretty strong in this report still. So there are so many mixed signals. I think, you know, what we're hearing in our clients is that in order to stay resilient, there are still initiatives that have to take place to respond to this trade uncertainty and uncertainty in general in the marketplace. And so skilled workers will still be needed to do that work in our client base. You know, we tend to focus on finance and the office of the CFO, but that's gotten much broader today with technology, with, you know, data, work that needs to be done, and lots of automation and AI coming into that function.
Call me a cynic here, Kate, but I happen to be in the camp that says AI is going to take jobs away. What are your clients telling you?
Well, I think they are going to take some jobs away. So when you look at rules-based jobs or repetitive, more commoditized jobs, yes, those jobs are going to go to AI. But then the humans in the room have the opportunity to do higher value work. And if you look at, let's take finance and accounting. I think we've talked about this before. We aren't producing enough accountants or financial experts anymore. We just aren't. And so in order to stay as productive as our economy needs, we need to embrace automation and AI for certain of the functions. It doesn't mean it will displace all specialized skills. So again, I think if you're in the labor market today, you really have to pay attention to the skills you can bring to the marketplace so that you don't get displaced.
Policymakers talk all the time about how they don't want to put too much emphasis on one single data point, but is today's report enough to perhaps make Chair Jerome Powell reconsider that hawkish posture he took on Wednesday?
I think so, and I think the chorus around a rate hike is going to strengthen meaningfully after this report.
So, I don't know, real quickly here, we heard a lot of companies over the past 6 months withdraw their financial guidance, put ranges around it. Do you get the sense that C-suite folks are holding back on CapEx, holding back on M&A, or is that kind of calmed down?
Well, I think it's still mixed. I think some still are. We have certainly seen projects, even when we've won the work, get delayed a little bit. August is always a hard month in consulting or professional services because a lot of people take vacation. We have a business in Europe too that tends to be more impacted. And people say, if I'm on vacation or my client's on vacation, let's wait and start this in September. So I do think we'll see more activity pick up as the fall moves forward, as we get, some increasing transparency around what's happening in this trade disruption, or people get better at working through disruption and figure out how they're going to remain resilient amidst continued chaos.
Right. Kate, thanks so much for joining us. Really appreciate it. Kate Duchesne, CEO of RGP. I don't know, Alex, I think about my early days as an investment banking analyst. I'm talking first 2 or 3 years. Like 95% of my work could be done by AI. I mean, I'm just putting pitch books together, modeling companies that'll go nowhere, sitting at the printer on Lower Greenwich Street in Lower Manhattan, reading a bank loan agreement.
So you would have been put out of a job.
Out of a job. I mean, completely. So I just think about the early days, man. Talk about repetitive rote work. Maybe who I am today. This is good.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Let's start with Amazon, leading losses in the mega caps, kind of an underwhelming profit outlook. You also have the VIX, what we'll call the fear gauge on Wall Street, kind of broaching 20, or at this point, 19.85. So that's elevated. S&P 500 at 89 points lower. That is a decline of 1.4%, 6250 on the index. The Dow Jones Industrial Average down 542 points. That's a decline of 1.2%. The NASDAQ 100, 359 points lower. That's down 1.6%. And really, taking the headlines this morning, the data, that has the two-year yield 21 basis points lower, 374. Remember, prices up, yields down, so running for the safety of the perceived safety of the treasuries. Now, a softer U.S. jobs report in the driver's seat as well. The last 3 months, employment growth has averaged 35,000. That is the worst since the pandemic. And again, the immediate impact of the policy reactive two-year yield. Also, dollar DXY down over 1%. The jobs report does pose further risk to a slowdown in consumer and business spending. Kind of leading me to the best performing stock in the S&P 500. That belongs to Kimberly-Clark, the guys who make Kleenex. It is up 4.5%. The company's making inroads with the cost-conscious U.S. consumers. You also had factory activity contracting in July at the fastest pace in 9 months. And I like this quote from Mike Collins, portfolio manager at PGIM Fixed Income. He says, all this is making for a big, beautiful bond market.
Nice.
We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. Alex and Paul.
All right, John Tucker, thank you so much. We appreciate that. Alex Semenova from Bloomberg News. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker studio, streaming live on YouTube as well. All right, Apple stock down 1.5% today, down 18% year to date. I thought their quarter last night was really good, the fastest quarterly revenue growth in more than 3 years. Revenue's up 9.6%. People are telling me this is a low, maybe mid-single digit growth story. I don't know, it looked pretty darn good to me. They said China was even pretty good. And for me, one of the biggest headwinds for Apple story has always been, how are you going to operate in China? So I thought it was a pretty solid, if not actually kind of really good quarter. Angelo Zeno, he's the pro. He'll give us the lowdown here. He's the Senior Vice President, Equity Analyst at CFRA Research. Angelo, what was your takeaway from the Apple print last night?
Yeah, so thanks for having me. I think overall, to your point, the results were really good, better than I think we anticipated and anybody else out there. And again, to your point, I mean, this was probably the best growth rate we've seen since late calendar 2021. And again, with China, the return to growth, the first quarterly growth rate that we saw in 2 years, all kind of positives here for Apple. And I think to me that the biggest takeaway or the biggest positive on the call was actually the services number. They grew 13% year over year. They actually didn't give guidance 3 months ago, due to some fears, whether it had been related to the Epic Games case or what have you. And they actually provided guidance for the September quarter as far as services is concerned, also about 13% or consistent with the June quarter. So the services, we think, continues to be the key growth story and why we like it. But I will say this, as far as the guidance is concerned, and what they had to say forward-looking in nature, they didn't really answer or kind of alleviate the concerns out there that some of the bears have. And I'd say the biggest thing is really the fact that when they did provide guidance, it essentially assumes no changes to tariffs. And we think that's unlikely. We actually think there are going to be changes to tariffs because you're going to get something from the 232 semiconductor investigation likely in the next couple of weeks. And when you do see that, that is going to have an impact, we think, on Apple, probably their decision on what they're going to do in terms of pricing and their margin strategy.
Angelo, speaking of tariffs, how sustainable is that revenue growth number that we saw? How much of it is related to a tariff-related pull-in?
I mean, for the June quarter, they said it was 1 out of their 10 points, right? Whether or not you want to believe that, is up to every individual out there. We thought that when we originally saw the print, we would have bet on the fact that it probably would have been more than that. Again, for the September quarter, the guidance of mid to high single-digit growth, where we were looking for about 3% growth, it just seems like the growth rates, at least right now, for these 2 quarters, you can call they obviously attributed it to the fact that the iPhone 16 cycle is seeing maybe better upgrades than what we saw in prior cycles, but it's just hard to imagine that's all that's happening, because you didn't necessarily see those type of growth rates right in the December quarter and the March quarter when the cycle first started. So it's probably a little bit more than what they're leading us out to believe, but again, we'll get better clarity as we kind of go into the iPhone 17 cycle in the December quarter.
Angela, one of the headwinds for Apple, real or perceived, I'm not sure, is the belief that they don't really have a solid AI play or AI angle to the story. A, do you believe it? Do you agree with that? And B, what do you think they should be doing on that front?
No, we believe it. They don't have. They're not. This is the problem, right? When you kind of look at some of these other stories across the tech space, there are much better stories as far as investing in AI. We know AI is going to be a huge disruptive trend here over the next decade and longer than that. But if you're not in this AI kind of ecosystem and you're not playing a role in the whole AI space, you're missing out, and investors are going to get frustrated with that. The biggest issue with Apple has been the fact that they haven't made good on their promise. Back in June of 2024 at the developers conference, when they essentially said by this year we were going to see AI or Siri integration across that app store, and we just haven't seen it yet. What we did like last night on the call was Tim Cook seemed like he remained committed that we are going to see it at some point here over the next couple of quarters. We continue to say they've got to get this right by the time we hit the developers conference in June of next year. That's the absolute latest that they can get this AI story right. We think they will get it right. They've got all the money in the world to kind of throw at it. And whether it be done internally via partnerships or some M&A strategy, all which it seems like they were open to on the call last night, we think they'll get it right.
Obviously, a lot of investors want to hear what companies are doing on AI, but does Apple actually risk losing customers if they don't come up with an AI strategy, or will they be okay with using the ChatGPT app on their phones?
That's a great question. I don't know if they really risk losing, customers at this point in time. I do think it's going to have a huge impact on the upgrade cycle. If you see them get this AI story right, and we see some really cool AI capabilities, integration across the App Store, get these developers to really developing some, really great apps out there, you're going to see consumers really start to upgrade, and Apple's going to benefit from a monetization perspective on the hardware side, and we think they're also going to be able to charge some nice features from a services perspective as well. So that's how they can make money from an AI standpoint on both hardware and services. But maybe to your point, are consumers all of a sudden going to depart? Not necessarily, but listen, Samsung is a formidable threat out there. They've got some decent people out there as well. They've got some really good integration with Alphabet. So we'd rather see Apple get it right and not have to necessarily worry about that issue.
Angela, 30 seconds left. I kind of like the acqui-hire kind of strategy that we're seeing across the tech space, where companies will buy a majority stake, not the whole thing, so the regulators don't jump down their throat. Is that something Apple would consider, do you think?
I mean, it doesn't seem like it's in their DNA right now. And when we kind of see, some of the moves that they've made as of late, they've actually been, hurt by the acqui-hire strategy, right? Just given some of the key departures that we've seen. But yeah, I mean, Apple's got they've got the ability to kind of benefit from that theme. My guess is, again, they're going to have to get this AI story right. So they could use it towards their advantage. But I agree with you. I like the whole acqui-hire theme for the broader AI space ecosystem and the tech sector.
All right, Angela, thank you so much. We appreciate that. Angela Zeno, Senior Vice President, Equity Analyst at CFRA Research. I mean, take a look. It's not like they don't have the money, folks. Apple's got $130 billion of cash on the balance sheet. They can borrow whatever they want. They're going to have free cash flow, north of $100 billion over the next several years, $120 billion. So it's not like they don't have the cash to go all in on AI. The question is kind of what's their strategy, and that's still kind of up in the air for a lot of investors. I'm not sure we're going to get much clarity, but as Angela was saying, that needs to come. Coming up, Poonam Goyal, we're going to talk about Amazon. That's coming up. This is Bloomberg.
Listening to Bloomberg Intelligence with Paul Sweeney on Bloomberg Radio.
All right, Alexander Semenova, Paul Sweeney, live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube. Head over to youtube.com, search Bloomberg Radio, Bloomberg Live Radio, Bloomberg Live Podcast, anything. That'll get you where you need to go. I'm looking at Amazon. Stock's down 7.2% today. I don't know. Anytime I see Amazon trade down like that, I'm like, boy, if I were a portfolio manager, you got to be thinking about this is a good time. It's flat year to date, so it's certainly underperforming the marketplace here. They put out some numbers last night, a little bit disappointing on their guidance, and some questions about the cloud and kind of the growth rates there and all that kind of stuff. Poonam Goyal, she follows the company, she follows the stock. She's a senior U.S. e-commerce and retail analyst for Bloomberg Intelligence. Poonam, what did you take away from the quarter last night?
Yeah, thanks, Paul. So I think, the quarter had two mixed reads. The first, on the retail side, things were actually pretty well. Sales grew double digits on the retail front, and that was higher than we expected. Shows that value is driving shoppers to Amazon.com's retail platform, and prices aren't going up, so shoppers are still buying, at least on Amazon.com. The second side of the story is Amazon's AWS business, and I think that's where you're seeing the sell-off come from. They were disappointing, plain and simple. We saw Microsoft and Google, they both outperformed when they reported, and Amazon was just in line on the sales side, but operating margins were much weaker, 32%. That's off of 39+% in the last quarter. The guidance was also weak on the margin side, and I think that's really what's causing the stocks to slide today morning.
Anyone who was watching shares post-market yesterday after their results watched them fall, so much during that earnings call during Andy Jassy's comments. What did he say that was so concerning to investors?
I think It was basically that it's a slow and steady climb from here. It's not overnight, right? Amazon is not getting the benefit of like the ChatGPT that Microsoft is seeing. They are investing in enterprise clients, the B2B side of the cloud business, and that has plenty of growth ahead. But that growth isn't going to come overnight. It's going to come year by year. We're still very, very optimistic that Amazon has a long runway for growth here, both on the cloud and the retail side, and also advertising, which grew nicely at over 22%. So the results to us, suggest a small slowdown, but we think Amazon's earnings will ebb and flow, but the path forward is still up in our mind.
It's August 1st, so I guess I have to ask this question. I hate to do it because I'm a person who believes that, hey, we're only halfway through summer here. But the reality is back to school spending. What's Amazon saying here about back to school spending here?
So they're not saying much yet, but back to school is clearly the second largest holiday shopping season of the year. We think given Amazon's outperformance year to date on the retail side, they will continue to draw in back to school spending. At this time, consumers want value. They think prices are going up. Prices are going up to some extent, but they haven't gone up that much, which is why retail's holding up. When you're looking for school supplies, you're going to Amazon, you're going to Walmart, you're going to where you can find value.
Poonam, how much of this reaction in Amazon has to do with the fact that it was just bad timing for them, that they're facing much tougher comparisons after some of the other mega caps reported results?
Comparisons are going to remain tough on the cloud side for years to come because you will continue to see growth in the double-digit range. I think more of it has to do with just Amazon's results were not bad. They were pretty good. It's just they weren't as good as Microsoft and Google. And that does go back to what I said earlier. They don't get the benefit of the C2C side of cloud growth that those two competitors get.
So on the retail side here with tariffs, we now have a clearer picture of kind of how the tariff situation might shake out. I got to feel like Amazon, nobody's got more, buying power than Amazon. So I can't, somebody tries to raise the prices on me, I'd be like, go take a walk. What are they saying?
Yeah, I think, clearly prices are going to rise slightly. Is Amazon more shielded than the rest of retail? I think absolutely yes, to your point, Paul. $700+ billion in global GMV. 40% of the business, or less than 40%, is first party, which means that's the inventory that they own, and that's the inventory where they have pricing control over. Still sizable, and therefore they do have that buying power advantage, and they also have other offsets, right? Amazon has more than just retail in its house. It's got AWS, it's got advertising, which are very, very high profit margins. So could they eat some of that cost? Absolutely. Will they pass them along? Yes, but not on the basics, right? Retail 101, you don't raise the price of milk, you raise the price of something else. So the items that draw you to the platform, they're not going to raise the prices materially there, or we don't expect them to. And on the third party side, that's not Amazon's problem. They have over 200 million sellers. You can go between the sellers. I'm sure that there will be intense competition as prices may rise there for shoppers to have choices.
We have more clarity on tariffs than we did before, but there's this idea that tariff policy is still in a flux and the final framework could change. How much do you think that will impact Amazon's decision-making from this point?
I think for Amazon, tariffs right now, the way we look at them is they're changing. China's still on a 90-day pause, right? So we don't know where things will end up in China, and that's a very, very important country to watch for. So I'd say we're very much in flux. Vietnam, the tariffs have gone up from the 10% pause to 20%. They're also going up in other Asian countries. India's speculated or set to be around 25%. Right. These are countries where the last round of tariffs, companies had moved out of China into many of these countries, right? Yep. So while the tariff rate is still better, right? 20% is still better than the 30% pause, and who knows what it'll be a month or 2 months from now.
All right, Poonam, thanks so much. Poonam, thanks so much. Appreciate it. She covers all the retail for Bloomberg Intelligence, including Amazon. For our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM Channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio is on Sirius XM Channel 121. It's presented to you by Oracle. Stay tuned for the latest market news and industry research. The next hour of Bloomberg Intelligence starts right now.
is Bloomberg Intelligence with Paul Sweeney.
The semiconductor business is a really cyclical business. The market's telling me, here's another AI play. Just bid it, buy it. Is the market over their skis? Are people just too exuberant out there?
Breaking market headlines and corporate news from across the globe.
This was a big success story for Apple.
We like bonds. We think bonds are attractive.
Private markets have become very diverse.
What we're telling people is be cautious here.
Bloomberg Intelligence with Paul Sweeney on Bloomberg Radio, YouTube, and Bloomberg Originals.
All right, Alex Semenova, Paul Sweeney, live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. Coming up in this hour, Joanne Shu, University of Michigan. She does the surveys out there, and the UMich data came out today. I'm going to call it weaker than expected. It goes along with some of the other weak economic data we saw today. We'll break that down. Jessica Kriegel, Chief Strategy Officer, Culture Partners, discuss the July jobs report there. Danielle Moran, Bloomberg Municipal Finance Team Leader, she's going to talk to us about the municipal bond market. Why? Because it's Friday, and we always talk municipal bonds on Friday. Vince Piazza, Bloomberg Intelligence, he covers all the energy stuff for Bloomberg Intelligence. Chevron, Exxon, we got a lot of the big oil majors reporting numbers. We'll get the breakdown there. Looking at WTI crude oil, it's weaker today, off about 2.7%, $67. We'll get John Tucker to give you the gasoline report from the Route 36 Wawa in New Jersey. That's coming up soon. But right now, let's go to Charlie Pellet and get a Bloomberg Business Flash. Charlie.
Hi, thank you very much. Jobs and tariffs on this Friday. We got a lot of moving parts to today's trading, but the bottom line here, a lot of red on the screen. The Dow, the S&P, NASDAQ, all declining right now. S&P down 104, right to the numbers, down 1.6%. Dow Industrials down 603 now, a decline there of 1.4%. NASDAQ down 451, drop there of 2.1%. Bloomberg Intelligence has got you covered on the jobs report with a 10-year currently yielding 4.25%. Treasuries are jumping. We've got the 2-year 3.74% with the 30-year at 4.82%. Gold. The price of gold right now up 1.6%. Spot gold at $33.42 the ounce. West Texas Intermediate crude down 2.7%, $67.41 for a barrel of WTI. All about jobs. Payrolls increasing 73,000 last month after sharp downward revisions in the prior 2 months. Jobless rate ticked up to 4.2%. Kate Duchesne is the president and CEO of Resources Connection, and she was a guest last hour right here on Bloomberg Intelligence.
Certainly, everybody thinks this morning it will point in the direction that the Fed will act in September because the labor market is cooling, but more people have left the labor market too, it looks like. And wage growth was pretty strong in this report still.
Kate Duchesne, who is the president and CEO of Resources Connection, interviewed right here on Bloomberg Intelligence. Earnings news, Apple down 1.7%. Amazon after earnings, we were just talking about that stock down now by 7.7%. Also out this morning, ExxonMobil and Chevron. They posted better than expected results, but shares of both oil giants are lower. ExxonMobil down 1.7%. Chevron right now down by 0.3%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie Powell, thank you so much. We appreciate that. Alex Semenova, she's from Bloomberg News, sitting in with me, Paul Sweeney, live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube. A lot of economic data out today with the payrolls disappointing, ISM disappointing. UMich came out kind of in line. The UMich sentiment survey came in at 61.7. Consensus was 62. Let's break it down with Joanne Shu. Surveys of Consumers Director at the University of Michigan. Joanne, what was your takeaway from the data coming out of the University of Michigan surveys?
What we saw basically confirmed our preliminary reading from earlier this month. Consumers are feeling definitely better than they were in April and May when they were expecting kind of a worst case scenarios coming from the extremely high tariff announcements at that time. And so they're definitely heartened by how things have cooled off before then, but they hardly feel optimistic about the future. They're still bracing for a return of inflation. And I do want to note that our interviews closed this past Monday prior to the tariff developments over the last couple of days.
Joanne, we're always talking about the bifurcation between higher and lower end consumers. Is there a disconnect in how those two groups are feeling about the economy and the impact of tariffs?
So right now, higher and lower income consumers are broadly in agreement that the outlook for the economy is not great. They're both all ends of the income distribution are feeling like inflation is going to come back, that business conditions are going to weaken. There is a difference, though. People at the top of the income distribution feel a little bit better, though not great, as I mentioned, because they're being supported by strength in stock markets. So folks with high levels of stock holdings, they're feeling a little bit, they've been feeling a little better over the last couple of months. People who don't own any stocks, their sentiment actually declined this month.
Joanne, where would you like to see this indicator? Again, at 61.7, where would you like to see it? What's a healthy level?
A healthy trend would be continuously a few consecutive months of going on the upswing. We have been on the downswing for most of 2025. That level of decline that we saw between January and May, April, May, has been extremely poor. So it's definitely a good sign that we're not as bad as we were in April and May, but we're hardly out of the woods yet. I would like to see a few more months, multiple months, lifting off that low.
All right, Joanne, thank you so much. Always appreciate getting a few minutes of your time. Joanne Shu, Surveys of Consumers Director at the University of Michigan out there in Ann Arbor. I went to a football game there. It's just awesome. It's definitely a bucket list. All right, folks, lots of selling out there in the marketplace. Let's take a look at some of the stocks on the move today. I'm Paul Sweeney with Alex Semenova, and we're joined by Bloomberg Natalia Kenyan-Javich in our studio. I got Russia on my left, Russia on my right. They're speaking back and forth in Russia. They're probably talking about me. I don't know. Figma, that was
positive things.
Exactly. Figma, that was a phenomenal IPO yesterday, wasn't it?
Huge IPO, yes. Let's talk about today's price action first. The stock is up by 4%. At one point earlier in pre-market, it was up by as much as 23%. The ticker for this stock is FIG. Overall, we know that the stock was priced at $33 per share. On a two-day basis, the gain is still sitting above 260%. Also, this trading gives Figma the largest first day trading gain in about 3 decades, guys, for a U.S. listed traded company, which raised more than $1 billion. It also made its CEO one of the world's richest people. So, and when it comes to fundamentals, Bloomberg Intelligence and some other analysts are saying they are strong. The company is growing fast. Net dollar retention is also really solid. And the next big test for the company, of course, comes with analysts' initiation and the next earnings report.
And also looking at Moderna here, one of the highlights of today, their stock is down more than 7% right now. What is driving that reaction? What did they say in their earnings?
Yeah, so the stock is down by 8%. The ticker for this company is MRNA. Couple metrics disappointed investors. So first of all, second quarter sales were down by 41% on a year-over-year basis. Of course, it was driven by lower sales of COVID-19 vaccines. But keep in mind, guys, that typically demand for vaccines picks up in the second half of every year. But I think more importantly, Moderna also lowered high end of its revenue forecast for the year. The company attributed that to a shift in timing for contract revenue that it moved to the first quarter of 2026. To BI's Sam Fazeli, it underscores actually cash flow risk for the company if its cancer program with Merck falls short.
We got one more. Coinbase, talking a little crypto here.
Crypto, very interesting space. We see that the stock is down by 15%. The ticker is COIN. We know that Bitcoin itself and cryptocurrencies are moving down, but this move is specifically related to companies' earnings reports. So when we look at results, revenue for the second quarter actually increased 3.3% on a year-over-year basis, but it missed analyst expectations, and the company attributed that to a slow spot trading volume, not just in the US, but around the world as well. And of course, we know that crypto market capitalization was basically flat on a quarter-over-quarter basis. Bloomberg Intelligence, I'm going to cite them again, they are saying that the company can actually post better third quarter revenue for the next quarter, right? So we will keep an eye on that. And of course, crypto space is very volatile.
I mean, going back to this Figma story, you know, back in the day, that was my job to take companies public. And if I priced something at 33 and it closed the first day of trading at like 118, my boss would have come over with a rolled up newspaper and smacked me on the nose. I mean, that you left so much money on the table there for the issuer. I mean, it's just crazy the demand they had there, and I don't know. I just think they did a bad job. I'll call them out. It was JP Morgan and Goldman Sachs. It was all the big investment banks. So I mean, what do I know? But boy, it's just amazing how that thing just took off.
I think the companies are just trying to be really cautious in this volatile environment because we see really bad performance among some of the IPOs, which priced stocks at a little bit higher range. So it's a debatable question, but I get your point.
Good for them. Good for the IPO shareholders. That's very good. All right, Alexander Semenoa. No, Natalia Kniazevic. There we go. I mean, it's just come on. Thank you very much for bringing us all that kind of cool stuff there. For more conversations like this, subscribe to our new Stock Movers reports. Listen for 5-minute audio reports on the biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere you listen. Again, I would say the story of the day is this labor market data came in materially weaker than expected. I think the revisions also caught a lot of people by surprise. The revisions downward. Let's check in with somebody who really cares about this stuff. Jessica Kriegel, Chief Strategy Officer for Culture Partners, joins us live here in our Bloomberg Interactive Broker Studio. Are you based in Sacramento?
I am.
You're far away from Sacramento.
I sure am.
Well, thank you for coming. We appreciate being in our studio there. Jessica, what did you make of the data here? I know it's only one data point, 1 month, but boy, it's kind of spooking the market a little bit.
It's actually more than 1 month because we're looking at revisions for multiple months, and those revisions are astronomical. And what it's interesting to me is what that means for, do we trust this data? What do we, I mean, 73,000 jobs, okay, 4.2%. Is that really the number? I mean, these revisions are getting bigger and bigger. And so the politicalization of these numbers is going to increase because the people who want to say that the economy's been great are going to lean into the fact that this data isn't valid. And the people who are saying the jobs market is weak, they're going to say, well, look at how bad it's been. So that's going to make it more and more confusing for business leaders, more and more confusing for the public to understand where are we headed with this economy.
It's safe to say that it's not just merely moderating at this point. We're seeing a trend where growth is substantially slowing. Is this enough to kind of change the Fed's stance around cutting interest rates?
Well, that's such an interesting story. The pressure that Trump has been putting on the Fed to cut the interest rates, I think, is actually working against him because the Fed has to maintain independence or perceived independence. Otherwise, an interest rate cut could actually be really bad news, right? The bond markets could jump, mortgage rates could increase. And so by Trump pressuring the Fed so much, it's actually probably preventing them from cutting rates as soon as they could. You saw this difference of opinion within the governors, right? The dissenters. I think Trump needs to surrender if he wants to actually get what he wants.
I don't think that's in his vocabulary.
It's probably not, but it's something that we've been leaning into a lot of culture partners is there are so many leaders who are stuck in the action trap, trying to do more. I want to get this result. Let me get people to do more. And it doesn't work. It just, people need to think more deeply about what beliefs do people hold? How can we shape those beliefs in order to get the results rather than just what do we have to do next? It's very reactionary thinking.
So again, it's a weak payroll number. We also had the ISM manufacturing kind of come in materially weaker than expected. So that part of the world's still hurting here. When you talk to your clients at Culture Partners, what are they saying about their willingness to, I don't know, do stuff, whether it's spend CapEx, buy a company, introduce a new product? I know that was really shaken earlier in the year. Is that still the case?
Yeah, I mean, business investments have been down, right? We saw that with the GDP number, 15% lower. I think right now it's a question mark. The big, beautiful bill has this idea of expensing immediately. Yep. So that may or may not move quickly. We're waiting and seeing. I think most leaders are pausing. They're pausing because the uncertainty is so high. And leaders, remember, are people who are also worried about keeping their jobs. If they make big bets right now and they're wrong, they put themselves in danger. And so a lot of fear-based decision-making is happening right now.
When you look underneath the surface of today's labor market reading, is there anything at the sector level that you're seeing that perhaps suggests that the picture is even worse than the headline number suggests?
Healthcare is propping it all up, right? Social assistance, social services. So, I mean, without that, if you're a 40-year-old nurse right now, the labor market looks great.
Wow.
I would love to be a 40-year-old nurse right now.
Yep.
But for everyone else, the lived reality of most Americans is it's been feeling like this economy is going down, and now we have the numbers to back it.
So wages are still strong here.
Yeah.
Is that healthy? I kind of feel like a 3.5%, 4% wage increase is pretty good for the economy. Is that inflationary potentially?
It's not keeping up with inflation, right? So it's still hard to pay for gas. It's still hard to pay for groceries for many Americans. And what this jobs report, I hope people realize this, what it doesn't account for is the people who end up leaving the job force altogether because they've either given up, because looking for a job has just become too hard, or they've accepted some kind of part-time work and they really wish that they were working full-time. Those people aren't reflected in this. So this 4.2% historically low number isn't actually as good as it sounds.
When you look at the cross currents here, as Paul mentioned, wage growth that is still solid, the unemployment rate is still solid, but also growth is slowing, and you look at some of the other economic data we've got, how hard does it make it to get a picture of the totality of the data and how the economy is doing broadly?
Really hard, and I think a lot of people spin their wheels trying to understand who's to blame for all of the circumstances that are making my life hard right now, whether that's a CEO or a frontline worker, and that's absolutely the wrong mindset. That's what something we call below-the-line thinking. You're just playing the blame game. All of the energy that you're spending on trying to figure out why you're a victim, it's not doing you any good. So a lot of our work is trying to get people above the line, we call it, which is taking accountability. Taking accountability is making a personal choice to focus on what you can control. You can't control the economic data. You cannot control the volatility of the markets or the tariff decisions or even what your executive team has decided. What you can control is, what am I going to do to better myself, to position myself as a top performer? I'm probably going to be spending some time educating myself on AI. I want to understand what the business needs are. I'm going to position myself to make an impact on those business needs, measure that, communicate that to the executive team. Those are the things that job workers should be focused on, because there's so much that's out of their control, and spending time there is really just a disservice to you.
AI, real quick, about a minute left. Net creator of jobs, net neutral on jobs, or net destroyer of jobs?
Anyone who says they know the answer to that question is trying to sell you something. Okay. I tend to be fairly pessimistic about AI right now, frankly, but that's just a personal, for new college graduates, it's bad, okay? New college graduates are having a really hard time getting work right now because AI can already do most of what they contribute to the workforce. So for some, very bad. If you're a phlebotomist, very good.
That's right. Those are people
You're
that take the blood?
You're going to keep your job, yeah.
Okay, very good. All right, I need to get correction there. All right, Jessica, thank you so much for joining us. Jessica Kriegel, she is Chief Strategy Officer for Culture Partners, based in Sacramento, California. Spent a long time in Sacramento looking at a Fox television station back when Fox was brand new. We ended up buying it. Great market. She's joining us here in our Bloomberg Interactive Brokers studio. Looking at the markets, the sell-off continues here, folks. We've got the S&P 500. Boy, it's off 98 points. It's 1.5%. The NASDAQ loss accelerating there, off 437 points. That is 2.1%. And we're also seeing big moves in the yield space. Two-year treasuries off 21 basis points. We're now at 3.74% on the two-year treasury. So a lot going on there. Coming up, we're going to talk about municipal bonds because it's Friday and we love talking munis. That I tell you, the tax equivalent yield in places like Sacramento and New Jersey, very attractive. We're also going to talk to Vince Piazza. He's the energy dude for Bloomberg Intelligence. He's been covering the industry for decades. ExxonMobil, Chevron, some of the big companies reporting. We'll get the latest. This is
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:21 on Wall Street. We do check markets all day long here at Bloomberg. Jobs Friday. Stocks selling off. The Dow, the S&P, NASDAQ, all in the red. Stocks are extending their weekly slide. Investors also weighing the impacts of President Trump's sweeping tariffs on the economy. Here's where we stand. The Dow down 573 points now, down 1.3%. It's the S&P 500 index that's down 100 now at 6238, down another 1.6%. The NASDAQ Composite Index down 448, tumbling 2.1%. Apple, Amazon after earnings, both lower. We got Apple down by 1.2%, down by 2%. Amazon down by 7.7%. The 10-year 4.24% this Friday. 2-year 3.73%. Gold up $60 the ounce. Spot gold up 1.8%. 33.50 the ounce. And West Texas Intermediate crude down 2.7% right now. WTI 67.39 a barrel. Bottom line here, the Dow, the S&P, NASDAQ all declining. This Bloomberg Business Flash brought to you by Oracle. Attention growing businesses, Oracle's offering to cut your current cloud bill in half if you move to Oracle Cloud Infrastructure. For new U.S. customers with minimum financial commitment, see if your company qualifies at oracle.com/Bloomberg. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Now on Bloomberg Intelligence, Munis in Focus.
All right, the focus on munis today is brought to you by BAM Mutual. Put America's strength to work in your portfolio with BAM insured municipal bonds. Protect your investments with an added layer of security and guaranteed income. Invest with strength. Build a stronger tomorrow with BAM Mutual. A lot going on in the world of muni bonds. There's a lot I can choose from here today. But here's one I saw a mile away before anybody else, any of the rating agencies. I said this train line between Miami and Florida, that's never going to work. People down there, they drive cars and they don't, Fitch downgrades Brightline municipal bonds again on weak finances. I want to get to the bottom of this. Danielle Moran can help us here. She's a municipal bond portfolio reporter for Bloomberg News. Talk to us about Brightline. What's going on down there?
Well, Brightline is a passenger railroad that is in South Florida. Right now, it connects Miami to Orlando. It has ambitious plans to extend over to Tampa, and it's a privately operated system. So unlike the MTA or NJ Transit, this is run by a private company. It's primarily backed by Fortress, but they have a ton of debt outstanding. Corporate bonds, municipal bonds, and the system, as you said, it's been difficult to sort of convince Florida residents to take a train. They're not used to it. So that area, the corridor, is pretty crowded, and Brightline has consistently missed ridership projections. And so that is now bleeding into their bond rating.
Those of us in the tri-state area around New York City, including myself who ride New Jersey Transit for 36 years, that's part of our DNA. It's no big gig. We'll get to point A to point B, wherever we can do it faster, usually mass transportation. But in the rest of the world, the rest of the United States, that concept is totally alien. I think people don't even think about riding a train.
I think it's definitely a psychological shift in a lot of places that just don't have the mass transit history that we do up here. I am also an NJ Transit rider. I grew up in New Jersey, so I understand it. And what's interesting about the Florida line is that the long haul between Orlando and Miami, that ridership is increasing, and people are going. It's the shorter legs that are having a little bit of trouble, but it is a popular choice for folks who are working in that area, getting from one area to another if they've got meetings. And it's also, if you look at some of the photos, it's kind of a pleasant ride. The seats are cushy, they have drinks, it's nice.
Speaking of transit, I've just been seeing video after video of subways flooding with this inclement weather that we've gotten.
Yes.
Is the MTA having a hard time dealing with, the storms that we've experienced?
Yeah, the MTA isn't having a great month. We had the flooding that sort of just rippled across social media earlier this month. 2 times this week, the power substation at the power system at West 4th Street had some issues, which caused delays on several subway lines. The MTA also is planning to raise fares early next year, which they announced this week. So there is definitely an infrastructure issue with the MTA. It's quite old. They have a $68.4 billion capital plan that is from the 2025 to 2029 fiscal year, which includes $700 million in anti-flooding investments. So they are working on this, but there is a lot of other factors that are kind of outside the MTA's control. The sewer system, for example, in New York City is also quite old and isn't reliable for the amount of rain we have been getting in the short periods of time.
Congestion pricing, is that still a thing? Aren't they collecting revenue?
Congestion pricing is still a thing. They are collecting revenue. It is in a bit of a legal battle right now that we're still waiting to see how will pan out. But they're aiming to collect about $1 billion a year, and that is on track.
And then, but that $1 billion just doesn't go to the MTA. That goes, and then the MTA borrows against that?
Yes, that's
so
right.
Have they begun going to the bond market and getting funds against that?
Not quite. There has been, there's a plan to do that. They need to have a certain amount of revenue collected in order for investors to feel comfortable knowing what the revenue stream will look like. So it might be a little further down the road that we'll see a long-term bond issuance against the congestion pricing deals.
Real quickly, William Jessup University. What's going on?
Oh, yeah. So we've seen this a lot in small colleges. This is a school in Northern California. It says that it doesn't have the immediate cash flow in order to pay bond investors on August 1st, which is actually today. Okay. So they say that they'll be able to pay by the end of the month, but how that money comes in is still a bit unclear. So this is a school that has a lot of debt outstanding for a smaller college. It's been struggling with some enrollment pressures, and we're seeing that happen at schools across the country. There's enrollment challenges because there's just less kids going to college. The birth rate declined after the Great Recession, and there's fewer students to put in seats.
Yep, that's an issue. You know, a lot of the smaller schools that don't have the big endowments, they live paycheck to paycheck. You know, the tuition revenue funds operations, funds everything else, and so that can be a challenge for sure. Danielle, thanks so much for joining us. Danielle Morin, she is Bloomberg Municipal Finance Team Leader. Awesome. So joining us here in our Bloomberg Interactive Broker Studio on our weekly discussion of the municipal bond market. And as somebody who lives in New Jersey, works in New York City, the taxes are just brutal. I mean, they tax the heck out of us. So when we can get a little bit of a shield off of interest income, we'll take it anytime. All right, let's switch over to the energy biz. I'm just going to quote WTI crude oil because I watch Landman for a season. I know all about the oil and gas business. Is down $1.87, $67.38. Chevron, Exxon, they've reported some numbers here today. Let's break it all down for the big oil companies. Vince Piazza, senior equity analyst. He covers all the energy space for Bloomberg Intelligence. He's done that for decades on both the sell side and the buy side. Hey, Vince, what'd you see? What did you learn from the Exxons of the world, the Chevrons of the world?
Hey, so today, what we definitely picked up is, you know, the view that Exxon and Chevron are closely mirroring one another. So, you know, Permian Basin growth for both Chevron and Exxon was there. Chevron topped out at 1 million barrels a day in the Permian, but you know, going forward, that will likely sort of temper down a bit because of just, you know, the indecision of around WTI and just the energy environment in general. So we'll probably see some more free cash flow flowing out of there. More importantly, though, for Chevron, Paul, the Hess deal closed. Yeah. So now the hard part starts for Chevron to integrate this very large footprint after, you know, almost 2 years of legal hassles with Exxon. The good news here is that both parties are now partners in what is the most prolific offshore international asset that we've seen in decades. And so I think going forward, what you see here for both of these entities is the upstream side of the equation, shining more of a light on the upstream side because of not only developments that they've had offshore, but also here, shorter cycle, Permian growth, which will likely provide cash flow going forward for both of these entities.
Vince, one thing that stood out to me is in addition to the profit surprise, Exxon said it's keeping an eye out for more acquisitions after its $60 billion takeover of Pioneer Natural Resources. What do you think that this activity will mean for the company?
Well, look, they have been very proficient in picking up pieces. First, the XTO several years ago, now Pioneer. This is not a play just for volume. It is strategic. The Permian Basin can still use some consolidation. There aren't very many pieces of size left. There are a lot of other smaller entities. So for Exxon, in order to move that needle, it would need to make a very sizable acquisition. They're still out there, and they do have some scale. The issue here is this isn't just about volume. It's also about consolidating and expanding the resource play within the Permian. And there are a few of size in the region that would make sense, but we're not going to lead the witness and tell you what's coming up in the next couple of weeks for us.
So, Vince, I think about the Chevron deal, and I know, from talking to you and reading your research, a big part of that attraction for Hess being bought by Chevron was Hess had a stake in a big property or find down in Guyana. Tell us about that, because that was a real opportunity.
Yeah, I think that is the crown jewel of this acquisition. And that's what the arbitration really was about. It was about Exxon's right of first refusal to that particular asset. Of course, that decision went in favor of Chevron. Guyana is a very large asset. The Stabroek Block is a very large, prolific piece. There are more than a dozen developments that will be ongoing, and that asset base will provide decades of production growth that will facilitate the short cycle development, short cycle production here in the U.S. in the Permian Basin for both Chevron and Exxon. So having two very large entities that understand these longer cycle, large developments, I think is a positive. And it's also a positive that both have fairly deep pockets and good experience doing these types of things.
Vince, thanks so much for joining us. Always appreciate getting a few minutes of your time. Vince Piazza, he is the go-to voice at Bloomberg Intelligence for all things energy, oil and gas for Bloomberg Intelligence. And again, on the landman front, you got to watch it if you want to be an expert like I am now in oil and gas.
I'm still learning a lot about oil and gas every day.
I don't know. It's a tough life. That's one of my takeaways. I mean, that's hard to get that stuff out of the ground is not easy. And these companies make huge investments. Again, Exxon spending $60 billion for Pioneer, Chevron buying Hess. I mean, it's a tough business.
A lot of M&A activity.
They are filming season 2 of Landman, so it is coming. So that is cool. I'm all fired up for that there. So looking at the markets here, boy, the sell-off continues. Maybe accelerates a little bit. S&P 500 off, let's call it an even 100 points, 1.62%. NASDAQ's off 450 points. That's 2.1%. Coming up, we're going to check in with George Ferguson, Bloomberg Intelligence Senior Aerospace, Defense, and Airlines Analyst, and Bruce Einhorn, Bloomberg Editor and Space Reporter. We've got a liftoff of SpaceX coming up.
listening to Bloomberg Intelligence with Paul Sweeney on Bloomberg Radio.
All right, Alex Semenova, Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube. And tell you what, the next 20 minutes, heck or high water, we're doing space.
Very excited, Paul.
Because there's supposed to be scheduled a space launch of the SpaceX mission going to the International Space Station. That's supposed to happen in just minutes, but there may be some weather issues, some clouds and things like that. We do have a live feed here, so we're looking at it. It's all fired up and ready to go. And we want to bring that to you if it happens. But let's walk up to it a little bit. We can do it with some people who know this stuff a little bit better than Alex and myself. George Ferguson, Bloomberg Intelligence Senior Aerospace, Defense, and Airlines Analyst, and Bruce Einhorn, Bloomberg Editor and Space.
Come off the rocket, so it looks like a lot of clouds went off it as well. But
so, Bruce, talk to us first about this mission. What is SpaceX looking to do in this mission?
This is part of a regular series of missions that SpaceX does for NASA, taking astronauts to the International Space Station. This would be the 12th such trip by SpaceX. 11 are full-fledged missions. The first one was a test. This would be significant also because it would be the first time that SpaceX has flown something like this, this particular spacecraft, more than 5 times. This would be the 6th time. The original goal was only to do 5, and now NASA wants to be able to use them even more frequently. And so this would be the first mission of its kind like that. One word of caution, as you just mentioned, is the weather. This launch was supposed to take place yesterday. It got scrubbed yesterday because of clouds, and so we're just waiting to see whether we'll have better luck today.
Bruce, SpaceX has said over and over again that the goal of this is to benefit humanity on Earth. How close are we getting to actually getting palpable results on how successful they are in doing that?
They are critical for the U.S. in getting astronauts to and from the space station. The U.S. Was hoping to have another American company capable of providing that. That was what Boeing's Starliner craft was all about last year. You will recall the 2 astronauts who got stuck on the space station for a long time because there were some problems with their Boeing spacecraft, and they had to wait for SpaceX to get them home instead. So SpaceX is really important for the U.S. space program. Other than this spacecraft at the moment, or things from SpaceX, there's the Boeing, which is problematic, and then there are also rides from the Russians. Russia is a partner in the International Space Station, and so U.S. astronauts do still occasionally go up to the ISS on Soyuz rockets.
Looking at the countdown clock now at 49 seconds and counting. Hey, George, in the aerospace industry, how is the aerospace industry participating in space these days? What companies and what are they doing?
I mean, all of the companies participate in space, right? Boeing makes satellites, as Bruce just mentioned to you. Boeing, also made a capsule, the Starliner. Airbus makes satellites. Everybody, has a heavy interest in space. I think everybody sees a lot of growth and opportunity there. Typically, it's just a small portion of their financial results. So I could tell you in the financial community, we spend a lot more time focused on how many Airbus A320s, Boeing 737s are.
All right, we're clear. Hey, George, we're counting down here. 4.
Sorry.
Let's listen.
3, 2, 1. Mission. Mission's full power and liftoff. Go Falcon. Go NASA. Go Crew 11.
Together we rise as NASA's SpaceX Crew 11 heads up to the International Space Station.
Vehicles pitching downrange.
Rockets firing.
1.7 million pounds of thrust.
Propulsion is nominal.
Propelling Falcon 9 as the vehicle pitching downrange.
It really doesn't. I wonder
and making its way up the East Coast. And will soon join Expedition 73 aboard the orbiting laboratory. So far, getting good call-outs on that first stage performance.
We are now T plus 35 seconds into the Crew 11 mission on board Dragon and Falcon 9. The Falcon 9 engines
Stage 1 throttle down.
Are throttling down to help
Power and telemetry are nominal.
To help pass through the period of max Q, or maximum aerodynamic pressure on the vehicle during ascent.
Max Q.
We just had Max Q right there.
Falcon 9 is supersonic.
1 minute, 9 seconds into what is a little bit more less than a 9-minute flight uphill as Dragon continuing.
Stage 1 Bravo.
Copy, 1 Bravo.
And that 1 Bravo, again, that's the abort zone, that last abort zone for stage 1 if necessary. The crew already pulling over 2 Gs. Next, we're going to have a couple of events happen in rapid succession. We'll be getting ready for the second stage to warm up and have the second stage MVAC chill. And then we'll also have MECA, or main engine cutoff, where the 9 engines on the first stage will cut off ahead of the first and second stages. Will then be separating from one another. And then the single Merlin vacuum engine on the second stage will ignite and continue to carry Crew 11 to orbit, while the first stage begins its journey back to Earth, as we're now 1 minute and 56 seconds into today's flight.
The 9 Merlin engines are starting to throttle down and are standing by for MECA, or main engine cutoff.
MVAC chill started.
And we just heard that call out for MVAC chill. And coming up in under like 20 seconds, we have 5 events happening back to back. MECA,
Stage 1 throttle down.
stage separation, stage 1 flip, SES1, and the start of boost back burn. It's going to be pretty quick, so keep a close eye on the action and the mission event
Main engine cutoff.
tracker at the bottom of your screen.
Main engine cutoff.
Stage 2 Alpha.
Stage separation confirmed. Alpha. MVAC ignition.
All right, we are watching, listening to
There you see stage
the,
1 pulling away,
SpaceX.
ignition of the lone Merlin vacuum engine for stage 2. And again, those happening in quick succession as we continue to get great views of that Florida coastline and the eastern seaboard there, as Crew 11 continuing its path to orbit, now approaching 3 minutes into today's flight. Still a little ways to go, about 6 minutes left, as they continue to climb their way up and eventually track down the International Space Station.
Like that track.
And there, great see, you see the Merlin vacuum engine, the second stage on the right-hand side, and great views.
All right,
of
that
the
is just
first
extraordinary.
stage
I've been
that's
watching
making
these things
its
since
return
the
to Earth
late
on the left.
60s, and I'll tell you, they never, ever get old, these, because we know the risk-reward there is huge. George Ferguson, Bloomberg Intelligence Senior Aerospace, Defense, and Airlines Analyst, joins us, along with Bruce Einhorn, Bloomberg Editor and Space Reporter. Hey, Bruce, can you explain to me and to our audience the relationship between SpaceX and NASA? How do they work? How is that relationship kind of structured here? Because that seems to be the future.
Yes, NASA depends on SpaceX to a large extent for missions, especially for crewed missions like this one to the International Space Station. NASA also relies on SpaceX for cargo missions to the ISS. There are other ways of getting cargo to the ISS, but when it comes to people right now, it's either SpaceX or Roscosmos, the Russian company. SpaceX also has a contract from NASA to work on deorbiting the International Space Station. The space station is scheduled to reach its expiration date at the end of the decade, after which it's going to have to come out of orbit, and SpaceX has the contract to work on that. That's one of the things that the Russian Space Agency chief, who's in the U.S. right now, is going to be, or was discussing yesterday when he met with Sean Duffy, the Secretary of Transportation, who's also the interim head of NASA.
Hey, George, this is the start of a planned 6-month stay in orbit for NASA. How does this stack up against previous missions in terms of the length? Is this kind of the standard?
So actually on that one, Bruce is probably a better person to give you a sense, but I think 6 months isn't it's sort of a, maybe a typical time in orbit. But Bruce, I don't know, do you have any?
That's right, George. Yes, it's a typical stint for astronauts is 6 months at the space station. Unless in the case of the Starliner duo who got stuck there after their Boeing craft didn't work out, they had to stay there longer just because of scheduling issues. But typically, it's 6 months.
Hey, Bruce, what are some of the milestones? I mean, big milestones for just the space policies, strategies for the U.S. over the next, 3, 5, 10 years?
Just
in broad strokes.
There's a lot of uncertainty right now. As I mentioned, the head of the Russian Space Agency is meeting with his counterpart. His counterpart is the Secretary of Transportation at the moment because there isn't a full-time person in charge of NASA. There was a nominee, Jared Isaacman, who had his nomination pulled by President Trump just shortly before the confirmation hearing, and we're still waiting on word on who's going to be the full-time person in charge. There's been a lot of people leaving NASA. Thousands of people are gone or in the process of leaving. The administration has proposed some major cutbacks to NASA spending, especially in areas of science. We're still waiting on that to find out what Congress will do on that. But there are a lot of question marks, at least in the short term, about what's going to be happening with NASA going
George,
forward.
kind of on that front, in terms of just scientific advancements as it relates to aerospace and defense, how much do kind of the companies you cover, the defense contractors and aerospace companies, how much do they depend upon government funding, whether it be at the university level, whether it be at the corporate level? How does that relationship work?
So for sure, some of the initial technology that's developed is very heavily, if not fully, government funded, and so I think government funding an important incubator. I think where we're starting to get though in space travel, and not necessarily research, but the travel portion, is the handoff has definitely occurred to the commercial side. As we're watching here now, we're watching the SpaceX thruster sort of re-land,
which is very cool in and of itself.
And it's an important part of the equation as I'm, sort of talking to you about the commercial side of this, and that is that, I think the private sector has really come in here, SpaceX has really come in here and focused on driving down costs, which gets us as a nation, us as an economy, more access to space, right? And so the phase, I think, where we are in space transportation is kind of, the private sector is ready to pick up the mantle, and it has, and it's pushing, the cost equations and such so that we can do more in space. And I think that's absolutely the right way forward. I think when it comes to the pure science side, companies just aren't good at, being altruistic and spending money on that pure science side, and that's where you still need a good NASA budget to focus on, some of those important things we need to learn from space and learn how to live in space.
Bruce, what are other important takeaways from this mission that you want audience listeners to know?
Well, this is the first such crewed mission since the public feud erupted between Elon Musk and the president. There was a lot of concern at the time. At one point, I think Musk made some comments suggesting that maybe they would just stop operating such flights. The two sides do really need one another. SpaceX does get a lot of its money from contracts with NASA, from the Department of Defense. And the U.S. Also needs SpaceX because at the moment there really aren't a whole lot of viable alternatives. So notwithstanding any bad blood between the President of the United States and the CEO of SpaceX, the two are still going to be working together for the foreseeable future.
And Bruce, where's Jeff Bezos and his space efforts today? Give us an update there.
That's a good question. So a couple of things there. So one, there's the rocket company Blue Origin. Blue Origin is working on a rocket that's supposed to be similar to in size the Falcon series that SpaceX uses for launches such as this one. They did have their first launch. I believe that was beginning of earlier this year. They were supposed to have a second one. They were originally hoping to have that second one sometime in late spring. That's been pushed back until sometime later this year. We're still waiting on when that's going to happen. Not an ideal situation for that rocket. That's called the New Glenn. A lot of companies are depending on that for launching satellites into orbit. So question marks surrounding that. The other big thing backed by Jeff Bezos, of course, is Amazon's satellite network that is called Project Kuiper, and that's a low Earth orbit communications network that's supposed to compete with Starlink, which is the SpaceX network that has, I think the latest number is around 6 million users worldwide. It's very popular in a lot of places. Also delayed, they have started launching some of those satellites. They're hoping to have some sort of service up and running by end of the year, but they're well behind Starlink. Too early to write them off because it is backed by Amazon, and Amazon has, of course, deep pockets. But there's a lot of space that they need to recover, given how big of a lead Starlink now has.
Bruce,
maybe.
Sorry,
Go ahead,
please
George.
continue, George.
I was just going to chime in here. I mean, I think that's key. I think, SpaceX, look, right now we're looking at a NASA mission, but SpaceX is becoming or is critical to both NASA and DoD efforts, Defense Department efforts to get satellites up in orbit. Starlink really has jumped out in the lead here with low Earth orbit constellation, which is super important to communications and observations. We have a group we work with called Mach 33, and they're out of Florida. They do research on, spend a bunch of time on SpaceX, and they're of the view, as are we, that the majority of the money generated really inside SpaceX is probably Starlink and not from Lift, and so they're using Lift really to get that low Earth orbit constellation up, which should create internet access around the globe, communication capability around the globe. I think it was an important jump ahead to get that constellation in place.
George, are Musk and Bezos seen as competitors here in this space, or are they kind of working as separate entities for the greater good of space exploration?
I think that Kuiper is going to be a competitor to Starlink, and so I see the two as competitors. I don't know if Bruce would agree or not.
Oh, for sure, yes.
Yeah.
All right, guys, thank you so much for joining us. Really appreciate it. As you look at that SpaceX launch there, we now have the aircraft in space, and I think it was one of the commentators from the Mission Control said chasing the ISS and going to be docking with that soon. So George Ferguson, Bloomberg Intelligence, Senior Aerospace, Defense, and Airlines Analyst, Bruce Einhorn, a Bloomberg Editor and Space Reporter. Live coverage of SpaceX's mission to the International Space Station. Very cool. Again, I've been watching these things since I was a little kid in the late 60s, and it's always awesome to see those things lift off. Let's get back to the markets here, Alex. Still the sell-off off the lows of the day. The S&P's down about 82 points here. That's 1.3%. It had been down more than 100 points earlier. The Dow's off 480 points. That's 1%. And the NASDAQ off 1.7%. It's 365 points. So clearly, the economic data coming in, Alex, kind of spooked this market here.
Yeah, I have an incredible stat for you, Paul. Actually, the entire month, the S&P 500 has gone without a move of 1% in either direction. So if we do see losses accelerate into the close, today will be the first time in a very long time that stretch hadn't happened before since June 2023. So really incredible, showing the tranquility of this market and perhaps raising concern that investors have become too complacent, whereas when disappointment like this kicks in over the data.
And Tom, from the Upper East Side, asking for a VIX quote here, almost 3 points here. So we're just below 20 on the VIX. Had a low earlier today, about 17, but clearly some risks, some angst coming back into the equity markets, again on the back in large part of this weaker than expected economic data. Again, the headline being the change in non-farm payroll came in at 73,000. The consensus was 104,000, but it was also the revisions were down sharply. Prior month, 147,000 jobs revised all the way down to 14,000 jobs. So that's something that gets people's attention. And we're seeing it in the short end of the bond market. 2-year treasuries off 22 basis points, 3.73%. All right, for our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Again, sell-off in the equity markets, bond markets, the yields falling sharply. Again, the 2-year treasury is down 22 basis points. The 10-year is off 13 basis points. So a little bit of steepening in that yield curve here. Gold selling off now at just about $67 a barrel. Gold higher in bit of a safe haven there. Stay with us. Your top stories and global business headlines are coming up right now. Happy Friday.
This is CBS News on the Hour, sponsored by ZipRecruiter.
I'm Cammie McCormick. U.S. employers added just 73,000 jobs last month. That is much weaker than previously reported. The Labor Department's revision shaved 258,000 jobs off May and June payrolls. Analyst Mark Hamrick.
This is one of those reports that we see only, once every several years, where you have to ask the question, are we at an inflection point in the U.S. economy? And the inflection point would be one where the economy is weakening substantially.
It comes after the announcement of new tariffs on dozens of countries, many starting August 7th. CBS's Jill Schlesinger.
These tariffs range from 10% for the UK to up to 40% for some smaller Asian countries. The executive order confirmed that any country that was not included in the list will face a 10% tariff, though there are a few exceptions, like Brazil, which is facing a steeper 50% tariff.
A Justice Department official whose husband operated an app that helps immigrants locate ICE agents has been fired. Details from correspondent Scott McFarland.
Carolyn Feinstein of Texas was a bankruptcy auditor for the U.S. Department of Justice and last month became the latest in a series of firings from that agency. She says she was terminated because her husband runs a controversial app called ICE Block, which allows people to track immigration enforcement activity in their neighborhoods. The Department of Justice told CBS News that app endangers the lives of immigration officers. Feinstein acknowledges she owned a 20% stake in the company.
President Trump's Mideast envoy made an unusual trip to Gaza today. Linda Gradstein has more from Jerusalem.
Steve Witkoff traveled to Gaza to inspect one of the distribution sites run by the U.S.-backed Gaza Humanitarian Foundation. The UN says more than 1,300 Palestinians have been killed trying to access food aid since March, most of them by Israel. Israel says its fighters are not responsible for most of the deaths and that they fire only when they are surrounded by mobs of Palestinians.
A U.S.-Japanese-Russian crew is on its way to the International Space Station. The SpaceX liftoff just moments ago.
3, 2, 1, mission. Engine's full power and liftoff. Go Falcon, go NASA, go Crew 11.
Parts of the Mid-Atlantic and Northeast are recovering from torrential rains yesterday. Nikki Batiste is watching the weather.
The flood threat for the East Coast isn't over yet. We could see heavy rains in the Carolinas later today with the threat of more flash floods there.
Stocks are lower today on Wall Street after that jobs report and the announcement of more tariffs. The Dow off 452 points. This is CBS News. Chicago's lakefront is rocking as Jennifer Kuiper reports.
For Chicago wins its street closures, a heavy police presence, and staffed-up emergency rooms as thousands of music fans head to the city's Grant Park to sing along with and dance to over 170 artists. They've been doing it here for 20 years now. Vampire! Olivia Rodrigo and Korn will headline tonight, the second of the four-day Lollapalooza festival. Saturday night's headliners are Twice and Rufus Du Sol. Wrapping up Lollapalooza on Sunday night, A$AP Rocky and Sabrina Carpenter. Jennifer Kuiper, CBS News, Chicago.
Florida officials have released a plan for evacuating the so-called Alligator Alcatraz Detention Center in the event of a hurricane, but large portions of the plan, sometimes entire pages, have been blacked out, including alternate facilities that could be used. Critics are pressing for more transparency. I'm Cammie McCormick, CBS News.
Live from Washington, D.C., this is Balance of Power with Joe Matthew.
Jobs Day brings signs of slowing growth. Welcome to the Friday edition of Balance of Power, as the day to give President Trump a whole new round of firepower in his call for lower interest rates. We'll look under the hood with Bloomberg economics editor Molly Smith coming up. It's not only Jobs Day, it's Liberation Day Part 2, as the president announces tariffs for nearly all of our trading partners. We're going to get into what this means politically for the economy and, yes, also interest rates. The view from the Fed here when we sit down with Bloomberg Politics contributor, former Republican Congressman Patrick McHenry. Analysis from our political panel today. Democratic analyst Jeannie Shanzano is with us alongside Republican strategist Lisa Camuso Miller. And we start on this Jobs Day, as always, with a look at Wall Street. He's back with us today. The Friday Trade with Charlie Pellet at World Headquarters in New York. Charlie, how's this going on?
Thank you very much, Joe Matthew. Not just a Friday Trade, Jobs Friday. Always a big deal for us here at Bloomberg and indeed financial markets around the globe. The Dow, the S&P, NASDAQ, all in the red, but we are off session lows. Right now, looking at a loss of 73 points on the S&P, 62.56 where we stand now. That is a drop of just about 1.2%. We've got the Dow down 419, a decline of 1%. The NASDAQ Composite Index down 336 for NASDAQ, a drop right now of 1.6%. Our Mag 7 Index tumbling by 2.3%. Among those names in the index, Apple down 1.9%. Amazon lower now by 7.5% after earnings. The 10-year at 4.24%, with the 2-year currently yielding 3.73%. Spot gold is up $55 the ounce to $33.45, surging 1.7%. And West Texas Intermediate crude down 2.2%, $67.77 for a barrel of WTI. Friday's weak jobs report is bolstering bets on Fed rate cuts. Payrolls increased by 73,000 last month after sharp downward revisions to the prior 2 months. The jobless rate ticked up to 4.2%. We got a whole lot more on the jobs report coming up in just a moment with our Molly Smith. But reaction to the jobs report from Beth Hammack, president of the Cleveland Fed.
My expectation, my forecast is that we will see the inflation numbers tick up. The $30 billion a month in tariff revenues is being paid by someone. It looks like it's more being paid by importers and consumers at this point. I think importers have borne a lot of that to this date, and it's likely that that will start to get pushed. We're hearing from the businesses we talk to that they can't absorb those costs anymore, and they will start pushing that out into prices to consumers.
Cleveland Fed President Beth Hammack interviewed this morning on Bloomberg Radio. Traders, meanwhile, quickly boosting bets on Fed rate cuts. They're now pricing in 2 quarter-point reductions this year. Again, recapping equities lower. S&P 500 index down 1.1%. Balance of power continues right now. Jobs Friday back. We go to Washington. And once again, your host, here he is, Joe Matthew.
Yeah, Jobs Friday, Charlie, the key word there being Friday. Welcome back, by the way, Charlie Pellet. He'll be back with more on the market reaction to the data, to the tariffs, and whatever else happens between now and 2 o'clock a little bit later on this hour. You made it to Friday. Welcome to the threshold of the weekend here on Bloomberg Radio, satellite radio, channel 121. You can watch us on Bloomberg Originals or on YouTube. Search Bloomberg Business News Live if you want to watch the radio show. What a concept here at Bloomberg. I don't know where to start. We go jobs, we go tariffs. They kind of meet in the middle here because there are a lot of questions today about the way Washington policy is impacting the economy, the job market. Is this the beginning of the deterioration that so many people have been predicting in the hard data following so much outcry about the anecdotal evidence here, which we'll talk about in a moment with Molly Smith? What we ended up with is 73,000 here. 73,000 jobs in July. Now, Molly told us a couple of days ago, remember, it was going to be in excess of 100,000. That was the expectation, and that's the whole game here, expectations. Slower growth, uncertainty about the direction of our economy, and an unemployment rate edging slightly higher to 4.2%. That is what we have this morning. And we're apparently not hearing from President Trump. Maybe we will when he leaves. There's almost nothing on the schedule today. He's just wrapping up his intelligence briefing based on what we saw on the schedule. He's out of town this afternoon for a weekend of golf at Bedminster. Yep, he's going up to New Jersey and will stay there for the weekend. Labor Secretary was out today, however, and that's the job once a month for Lori Chavez-DeRemer. Listen to her framing of the data this morning on Bloomberg TV and radio.
Certainly, we know they could have been better, but we look at the positive because we still have a net positive, almost 500,000 new jobs since the president took office. What has happened on the ground? The one big beautiful bill by Congress, the president leaning in and keeping the promises made by negotiating fair trade deals for the American workforce. And now what we need is the Federal Reserve to jump in and lower those interest rates. I talked to businesses just yesterday who said, we've invested in our American workers. We're paying attention to our facilities. We're wanting to invest and borrow more money, but they're concerned with borrowing that more money.
Yeah, so it's going to be a big story about interest rates today, right? Donald Trump saying, I told you so. I told you to cut interest rates. And he's back on Truth Social doing it today. We've been getting these long, very dense copy, it's just 2 lines for this one. Too little, too late. Jerome Too Late Powell is a disaster. Drop the rate. The good news is that tariffs are bringing billions of dollars into the USA. That's it. Too little, too late. Of course, Jay Powell chose just this week, along with his colleagues, -2, to not cut interest rates. There are a lot of questions, though, about where they're going to be in September, and if data like this keep coming in. By the way, we're going to talk about downward revisions for the past couple of months. Then maybe we are talking about some cuts in September. Molly Smith comes back now, second time in a week. Who do I have to thank for this? Producer James. Bloomberg News economics editor from World Headquarters in New York, Molly Smith. It's great to see you. You were up early today with the jobs data. Is this being reflected properly? Because, boy, this number was a far cry from what we expected, isn't it?
Yeah, and it's been a pretty ugly market reaction, as Charlie Pellet has told us all about today, that the stock market's been open a while. Pardon me there. So stock market not having a great day, seeing treasuries rally, seeing everybody reassess those bets on if the Fed's going to cut rates in September. I think the last I looked, those were well north of 80%. When Powell spoke yesterday, they got down to below 40. So that's just a massive shift in the last 2 days from what Powell on Wednesday had said is a very solid labor market, one that's broadly healthy, broadly balanced, to now today, we see one that not only was July a weak month, but also May and June substantially weaker than thought. So that does, what you were saying, Joe, maybe give a little vindication here to Fed governors Bowman and Waller, who dissented on Wednesday. They were in favor of cutting rates this week, were ultimately overruled, but their arguments were in part because of this weakness that they said is going on in the labor market. Certainly could see that at play today, and looking more likely that, again, with what we have in hand today, certainly a bit of time until the September meeting, but certainly makes a cut then will look a lot more likely.
Talk to us about these revisions. Everyone's going to obsess over the headline number today at 73,000, far cry from what was expected, but the prior 2 months revised down by almost 260,000. How are we so far off, Molly? And are you going to tell me it has to do with uncertainty over tariffs, or this is unrelated?
Unrelated to tariffs, but I will tell you that I have a story coming out on this very soon, so stay tuned, everybody. It's in edits now. But the main picture here is on the revisions is that, at least for the month of July, what we saw was that it really was, a lot of it had to do with seasonal adjustment issues. And I know this is super nerdy, so I'm not going to get too into it, but it's basically how BLS, that's the Bureau of Labor Statistics, who puts out this report, it's how they adjust for patterns in the seasons that might distort data otherwise from month to month, so that you can look at it a little bit more smoothly throughout the year. Sometimes the seasonal factors call for an increase of a certain amount or a decrease of a certain amount, and sometimes the actual numbers just aren't close to what that seasonal factor might estimate. So we had a bit of an issue with these factors in the June data, particularly around state and local government education, which were a huge reason of why the June payrolls number at the time was such a good number. But then we saw today that that was largely revised away. And when I asked BLS about this, they did say that this had to do with seasonal adjustment. And this, it's also because they collect more data over time. This data is collected not just in the actual month of sampling, but also 2 months after that. So there is more data that can come in. And the broader issue of what I've been reporting on with this is that those initial response rates, though, in that first month have gotten very, very low. So that when you then collect data more in 2 and 3 months after, it can really change that initial result.
Wow, isn't that fascinating? A little peek inside Molly Smith's world there. And it's extremely helpful for us to understand what's going on. By the way, nice tease on the story. I thought you were the economics editor. Who edits the editor's copy here?
Oh, someone far more senior than me.
Wow. I don't even know this. I mean, you're going to have to bring me in on this at some point. Participation. This is something we always talk about. And in this case, it fell quite a bit here, the lowest level in nearly 3 years. Does that imply that we're getting near full employment, or people are sitting on their hands?
So this is what was also just one of the more sore spots with the report today, to see that labor force participation. So this is the share of the workforce that is currently working or is actively looking for work. So you want to see that number be pretty healthy, obviously more reflecting more people who are employed. But this also points to the labor shortages that have really been going on since the pandemic, and labor force participation just generally has not recovered broadly in the way that we would like to see, particularly for what we call prime age workers. So those are people aged 25 to 54. So in the broader scheme of things, this is really not good when you see that there are fewer people participating in the labor force. And you would think then that, like, if you see a drop in the overall labor force, that should help to keep a lid on unemployment, right? Because you think this is an equation. The numerator is the number of unemployed people. The bottom is the number of people in the labor force total. If the denominator is smaller, that should keep a lid on unemployment. But the problem is you also had more people who simply lost their jobs.
This is a seminar with Molly. I didn't know what I was in for today. This is like, so I would have been copying off of Molly's work if we sat near each other in school, obviously. What's the next most important data point then on the calendar? This is a big week. We could talk GDP and a lot of other stuff here coming off this Fed meeting, but what's the next clue to finishing this puzzle?
We could take a little bit of a breather next week, thankfully. Yeah, this week was really heavy. I mean, personally, I'm already looking to the next CPI report, which is in a little less than 2 weeks from now, particularly just regarding some of these data collection issues that the BLS is having. They put out a notice on their website about it earlier this week, too, that they're reducing sample even more so than we previously thought. And a lot of this is because of the budget and staffing cuts that have come from the Trump administration, that they simply just don't have the resources to go out and collect data the way that they used to. So to see how that's going to come through in the inflation data, perhaps more so in the jobs data, too, going forward, is going to be really interesting.
Wow, great stuff, Molly. Thank you so much. Happy Friday to Molly Smith. She started early with the jobs report today and bringing you the great analysis. We get granular with Molly Smith, Bloomberg News economics editor. Let us know when that story publishes, Molly, and introduce me to your editor. Unless his name is Ed Duffner, I know him. I'll have much more ahead. Patrick McHenry is on the way on Bloomberg.
It's 12:21 on Wall Street. We do check markets all day long here at Bloomberg. Tariffs and jobs front of mind for Wall Street today, and we are seeing red on the screen. A sell-off underway. We are off session lows, but the Dow, the S&P, NASDAQ, they're all declining. Traders driving stocks toward their worst session since May. Weak jobs and manufacturing data reviving concerns about the U.S. economy. The S&P down 76, drop there of 1.2%. The Dow is down 451 now, a decline of 1%, and NASDAQ is down 355 for the NASDAQ Composite Index. That is a drop right now of just about 1.7%. The 10-year, 4.23%, with a 2-year currently yielding a 3.72%. Spot gold is trading higher right now. We got gold surging $53 the ounce. Gold at $33.43, up 1.6%, and a retreat for crude, down 2.6%, $67.43 for a barrel of WTI. President Trump has sent letters to 17 of the world's largest drug makers, including Eli Lilly, Novo Nordisk, and Pfizer, insisting they immediately lower what they charge Medicaid for existing drugs. Shares of all three right now are advancing. We've got Lilly up 2.6%, Novo Nordisk up by 2.2%, Pfizer shares up by 0.4%. Again, stocks lower with the S&P down 1.2%. And for on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. And back we go to Washington. Once again, your host, here he is, Joe Matthew.
Okay, Charlie, welcome back today. Great to have Charlie Pellet at World Headquarters in New York, the voice of Wall Street and the New York subway. There's only one Charlie Pellet. And the market's a big part of the story today in Washington as the tariff rates are rolled out. Charlie just mentioned it. We got a big pile of paper. End of the day yesterday, more of this rolled through the evening here, and we got a whole new date. I was going to say, Happy Liberation Day or whatever this is, but circle August 7 on your calendar. That's the actual date. I guess this takes hold at 12:01 a.m. August 7. So you got a week. You still want to make a deal. Of course, this was all supposed to take effect today, but we understand that the extra week was needed for Customs and Border Protection to update the tariff schedule with all of these new numbers. 15%, the big industrialized economies, European Union, Japan, South Korea, we talked about that. Those with a small trade deficit get 15%. Countries with which the U.S. runs a trade surplus get 10%. And if you're Canada, well, I don't know, call back another time. Jameson Greer was on Bloomberg TV and radio this morning. The U.S. Trade Representative, of course, had a lot to do with the outcome. Here's what he said.
We'll be finishing the paperwork in the next weeks and maybe a couple of months. But these deals are pretty much set. They are set, right? We wouldn't make an agreement unless we all knew the contours of it, and the countries knew it. And it's an exciting time because the president has essentially reset the global trading system. And so we'll be finalizing everything that's been agreed to on paper and then monitoring compliance going forward.
It doesn't look like Wall Street is in love with this. Not that a lot of this is a surprise. We've got jobs data that you've been hearing about kind of confusing things a little bit too, but it's decidedly lower today. The S&P 500 is down 75 points, more than 1%. NASDAQ's down 350, 1.5%. We've got a big move in the bond market here. The VIX is back above 19. Even the companies with good earnings. Look at ExxonMobil turning negative, down a couple of dollars. Apple had a nice story to tell. It's down almost $5. And if you miss estimates, boy, you're going to be punished. Amazon, not inspired by the forecast. It's down $18 or 8%. So we've got a lot at play here. But we want to talk about the fact that we actually have these numbers now, the tariffs, and as well, what's happening on Capitol Hill with our good friend Patrick McHenry, Bloomberg Politics contributor. I always love saying that. The former Republican congressman, former chair of financial services, who actually held the speaker's gavel for a short time. Mr. McHenry, great to see you. Happy Friday. The president was talking about Jay Powell earlier today on Truth Social, as he's been known to do. Too little, too late, he writes. Jerome Too Late Powell is a disaster. Drop the rate. It's funny, Donald Trump never, I guess, talks like this to his face. But is he starting to sound like he's on the right side of history? It's time to start cutting. What do you think?
Well, I think it is. But look, the Federal Reserve is an independent monetary authority in our system. Yeah. It's well designed that way. The Supreme Court agrees. This is longstanding practice for the United States. That's one. Two, there is the political effect here, which is when the American people see an economy that they don't like, who is to blame? And the president's reminding them to blame the Federal Reserve, not the Republicans they elected to run Washington. So that is a useful political tool that is at the president's disposal, that this president has used more than other presidents, but he's not the only one to have used this. They complained to the Federal Reserve System. The LBJ and FDR were quite notable in using it as well. So he's not the first, but he is obviously the loudest and the most adept at stoking those flames.
We tend to think of Patrick McHenry as an old-style conservative Republican a la Ronald Reagan. Correct me if I'm wrong, Congressman.
That's about right.
Tariffs are not part of that ideology. Where are you with this tariff regime now that we actually have the numbers, and how worried are you about what happens to the economy in the second half of the year?
Well, there are two issues here. One is allowing China to come into the first world trading regime, but getting the rules of the third world. And so I think some of our trading agreements have benefited other countries to a much more substantial impact to them than to us. We've given away a lot of our native industries in some of these deals. So while you can be a free trader, you don't have to necessarily agree with the contours of each one of the trading regimes that we set up, each negotiation. The president's resetting that, and he believes by resetting these tariffs, we are going to get back to a much more normative set of competition and in this global trading regime. So some of this is quite practical. This is why you haven't seen Hill Republicans who are free traders speak up in any organized fashion. So that is what he's speaking to. Now, how he does it, of course, look, I mean, as somebody who thinks we have benefited overall by being the biggest trading partner in the world, that has given us the ability of a strong dollar policy, it has made us the reserve currency for the world, has given us a greater borrowing power. There are a lot of benefits that have come from our strength as a trading partner. I think we have to maintain that edge, and we have to be the place that people want to come to, that people, intellectual property, come to, a place for capital, and also a place that leads the world in trade. And we don't want to undermine that. So that's the countervailing piece that I think has not been hotly pushed back on this administration. I think it should be sharpened up.
Interesting. Well, we love talking to you because you have a real sensitivity to the economy here. And of course, following your chairmanship, you have such a good sense of what this means for the Federal Reserve when we start talking about interest rates, the idea that this could creep into the data. But we've also got this softer than expected jobs report today. And a lot of people, the narrative out there is Jay Powell would have been cutting in February if it were not for Donald Trump himself and the tariff regime. Do you believe that? And do you think that we do see some kind of inflation spike in the next few months?
Well, I think that's what the market's trying to figure out. But the president's been given the benefit of the doubt by elected officials, like by other Republicans in Washington, because you've not seen the economic harm of this tariff fight. And I think there's a notion and understanding that the real culmination of all of this discussion about tariffs is the trading relationship with China and the world. And everything that the president has done this year with national security, international presence and security negotiations and endeavors, and tariff conversations are all laying the predicate for a big deal with China. And so they want to see that. They want to see that big deal. And they're willing to go along with, less optimistic economic data in order to get to that deal. I think the markets see that. But the data is now showing that this uncertainty and this cost structure is creating a burden on the U.S. economy. The question is to the extent And I think that's why the market is I think that's why you're seeing VIX up and Congress is out. And so I don't think you're going to hear much until September about tariffs or any discussion about the effects.
Well, of course, the whole conversation when members come back is going to be about a shutdown. I know you're hearing this as well as we are. Democrats say they're out because of the rescissions package. Do you think we shut down in the fall?
I think so. I think you need Democratic votes through the Senate, United States Senate, in order to keep the government open. I think what you'll see is a move for a continuing resolution to keep the government open, and that passed the House. And then it gets to the Senate, and it's really up to the Senate minority, the Democrats, on whether or not they're going to allow that to go to the president's desk. I think the incentives right now for Chuck Schumer and the Democrat leadership in Washington is to show they have some fight, that they're going to fight President Trump. And so they're going to try to lay the blame of a government shutdown at the president's feet. Right. It's going to be a huge battle for the fall, and I think that will cloud the rest of the debate, the public policy debate, that could otherwise be quite bipartisan.
It's amazing how predictable this seems to be here. Patrick McHenry, I have to ask you about what's going on in your home state before you leave us. There's a new poll out on the North Carolina Senate race. Now that your former governor, Roy Cooper, has jumped in here, Emerson College polling finds Cooper with a 6-point lead in this race over Michael Whatley, 47 to 41%. You've got 12% undecided. Does this sound right to you? And how much of an uphill battle will Michael Whatley have in this race?
So two things. There's something for everyone in this poll. If you're Roy Cooper, you say, well, look, I'm leading. Got in the race. Now you have a Democratic lead for what is a current Republican-held seat. So they get to have that narrative. But the Republicans have the narrative of saying, we've got a guy who's never been elected to anything. And he's within 6 points of a popular 2-term Democratic governor. And so therefore, what we know is that this will be a very expensive, probably the most expensive Senate race in the country this election cycle. And it will be a nasty dogfight based off the fact that we are a North Carolina is a narrowly divided state. So watch out. It's going to be long and nasty.
God knows it. We heard from Donald Trump on this. He posted about this as well on Truth Social. Michael Whatley has my complete and total endorsement. This is the bottom of a very long post. He will never let you down. All caps, exclamation point. We're going to have to keep talking about this one. Patrick McHenry, I hope you're having a great summer, and thank you for chiming in, as always. Bloomberg Politics contributor, former Republican Congressman Patrick McHenry, with his view on the Friday edition here of Balance of Power. Really fascinating to look at these polling results in, again, what will likely be the most expensive Senate contest. It's going to have to be between North Carolina and Texas here, right? The primary for sure in Texas. I'm Joe Matthew in Washington. Happy Friday to you. We're going to assemble our political panel next. Jeannie Shanzano is with us, along with Lisa Camuso Miller, with our eyes on the state of Texas, aforementioned redistricting, and much more to talk about on the fastest show in politics. It's all ahead on Bloomberg.
It's 1240 on Wall Street. We do check markets all day long here at Bloomberg. The Dow, the S&P, NASDAQ 100 Index, Russell 2000 Index, all in the red, down by 1% or more. Jobs Friday. Traders driving stocks toward their worst session since May. Weak jobs and manufacturing data is reviving concerns about the U.S. economy. The S&P down 85 at 62.54, a decline right now of 1.3%. The Dow off-session lows down 505, down 1.1%. NASDAQ Composite Index down 388. For NASDAQ, that is a drop of 1.8%. Our Mag 7 Index, of which both Apple and Amazon are a part, we've got the Mag 7 Index down 2.7%. Apple after earnings down 2.2%. Amazon after earnings plunging 7.9%. The 10-year at 4.23% with a 2-year 3.71%. Spot gold is up 1.6% to $33.41 the ounce, while West Texas Intermediate crude now down by 3%, $67.20 for a barrel of WTI. Investors are weighing the impacts of President Trump's sweeping tariffs on the U.S. economy. He has unleashed a new tariff salvo, slapping a 39% levy on imports from Switzerland. According to Bloomberg Economics, the average U.S. rate on goods from across the world is at 15.2%. U.S. Trade Representative Jameson Greer was interviewed this morning on Bloomberg Surveillance.
These deals are pretty much set. They are set, right? We wouldn't make an agreement unless we all knew the contours of it, and the countries knew it. And it's an exciting time because the president has essentially reset the global trading system, and so we'll be, finalizing everything that's been agreed to on paper and then monitoring compliance going forward.
U.S. Trade Rep Jameson Greer interviewed on Surveillance. By the way, you can watch the full conversation on YouTube on the Bloomberg podcast channel. Again, recapping lots of earnings, but among some high-profile tech stocks moving to the downside, Apple now down by 2.3%, and again, Amazon lower by 7%. Balance of Power continues right now. Back we go to Washington. Once again, your host, here he is, Joe Matthew.
All right, Charlie. Thank you so much. Not a great ride here in the markets today, and it has a lot to do with the news coming out of Washington, whether it's jobs data or tariffs, even companies, as we mentioned, topping earnings estimates, beat and raise, still trading lower today. If you look at what's happening with Apple, case in point. I want to point you to something 1 hour from right now that you're going to want to hear. A little bit earlier, actually. It's going to be at 1:20 p.m. Eastern Time. If you're listening to us on 92.9 in Boston, all the more reason to stay where you are. The governor of Massachusetts, Maura Healey, is going to be joining us for a special conversation, again, coming up at 1:20 p.m. Eastern Time. I said an hour from now. It's closer to a half an hour at this point. She's got a new plan to funnel hundreds of millions of dollars into research in the state of Massachusetts, knowing, of course, that the city of Boston alone is packed with dozens of research hospitals and universities that could stand to benefit from this. So much of the job market in Massachusetts depends on it. We'll be talking to Governor Healey, the former Attorney General of Massachusetts, coming up in our second hour here on Bloomberg's Balance of Power. We've got our eyes on what's happening in Texas today. We've been talking about this redistricting story a lot. It started on Monday, our conversation with James Tallarico, the Democratic state rep, who's given this a big thumbs down, as, well, all Democrats are around the country. In fact, Democrats in Texas might leave the state so they can't get to a quorum, and things will get real interesting if that happens, because there's a threat to have them arrested in that world. But today, people are finally getting their hands and their eyes on this new congressional map proposed by State Rep Todd Hunter of Corpus Christi. They're rolling it out today in committee, and this is the opportunity to finally get specific here. The committee is going to be hearing public testimony, and everyone will have a chance to weigh in. Ted Cruz weighed in right here on Bloomberg last evening. He showed up on the late edition of Balance of Power for a great conversation with Kaylee and I, and we asked him about this effort underway in Texas. You may not be surprised by his answer, but I just want to remind you that we heard from a Republican yesterday, Congresswoman Nicole Malliotakis of New York, who said, I don't care if it's Democrats or Republicans. Gerrymandering is bad for America. Ted Cruz disagrees. Here he is.
I'm in particular amused at the Democrats who are clutching their pearls, because the Democrats have always been much, much more ruthless in gerrymandering. I'll give you an example. The state of Massachusetts. State of Massachusetts, about 35% of Massachusetts votes Republican. About 60 to 65% votes Democrat. Do you know what percent of Massachusetts congressional delegation is Republican?
I believe it's 0. Yeah.
They drew it,
We
so
also
not a
saw the
single
redistricting.
Republican is elected.
Let's bring this to the panel. Jeannie Shanzano is with us, of course, Bloomberg Politics contributor and senior democracy fellow with the Center for the Study of the Presidency and Congress. And look at that, Lisa Camuso-Miller is back with us today, Republican strategist, former RNC communications director, and the force behind the Friday Reporter podcast. All right, here we go. Jeannie, is Ted Cruz right about that? He says you've been a lot more ruthless than Republicans when it comes to redistricting. So what's your major malfunction?
I wouldn't say it's me exactly, but I seldom agree with Senator Cruz, but I do agree with him on this. This is a bipartisan problem. There is no question Republicans and Democrats have done it, and they will continue to do it, which is why we need reform in this area. But in doing this, Texas really is taking a very big chance as well. They're going to do it. They have the numbers to do it. Democrats won't be able to match them in my state or any other state, but they're taking a big chance, which is this assumption that the Latino vote is going to go the way it went in 24 for Trump. And if you look back, Beto O'Rourke, despite losing to Abbott, won 17% of the Latino vote. So it is a big, big risk that they are taking in redrawing these maps, not to mention they make their own representatives have to compete in districts that are much more competitive than they otherwise would be. They'll do it, but it's not, a done deal, because you can't read what's going to happen in the future.
Well, that's true enough. We heard from Hakeem Jeffries, as we told you. He traveled to Texas this week. He's going to make his way to California as well, where the big threat from Gavin Newsom is to do the very same thing. If Texas redraws the map, passes this into law, then California would be the most likely to do so. Hakeem Jeffries framing it this way yesterday. Listen.
Republican politicians want to choose their voters. We're going to do everything possible to support the Texas legislators as they consider the best ways to push back. It's an all-hands-on-deck moment, and all options should be on the table to protect the people of Texas.
How you feeling about this, Lisa? Hakeem Jeffries, the Democratic leader in the House, says Republican politicians want to choose their voters when, of course, voters are supposed to choose their politicians. Is there truth to that?
I mean, Joe, I sat on the redistricting committee in New Jersey and watched this happen. This is like, I've seen people compare redistricting to a colonoscopy. Nobody wants to do it more than once every 10 years, okay? This is not fun. This is not a fun way to do business. However, I will say, Jeannie's point about it being a little bit risky is not far off and not inconsistent with what the minority leader has said here. We are going off of 2020 census data. That's a long time ago, 5 years, and Texas has had a tremendous amount of growth in its population. So it will be interesting to see. The other thing, too, to keep in mind is that the Voting Rights Act, while it has been weakened to some degree by the courts, it's still in place. And so thereby there will be consideration for African-American and Latino voters in the consideration of the drawing of the map. And so I have to believe that those kinds of protections are in place for a reason and will serve well. And also, too, even in Texas, this is 25 out of 38 districts that typically vote and maintain a Republican majority there. This adds 5 more, so 30 out of 38. That's a very real threat if California decides to consider doing the same after Texas does this.
Wow. Would 5 more seats keep the Republican majority? Is that fair, Lisa, or it's just not as simple as that?
You know, it's really hard to tell, Joe. I mean, midterms historically do not move and do not operate in favor of the candidate or the president that's sitting at the White House. So thereby, it means that Democrats will absolutely pick up seats. So even if 5 is the number that they think they're going to pick up in redistricting and potentially in the midterms, there could be losses all across the country. We've got this big, beautiful bill that potentially could hurt people in rural hospital regions where we've got healthcare concerns. Between now and next year, the opportunity for mischief as it relates to the issues that matter in the ballot box will be tremendous. And so it's really hard to tell if just 5 seats will make that much of a difference.
All right, Jeannie. I'm curious to see if Texas pulls the trigger on this, how Democrats will handle their appeal to Latino voters in the state, because the assumption is that Latino voters in Texas are going to go Republican. You still have a chance, even with these 5 new seats, to turn the tide on this. Will all of those 5 seats be red?
It's hard to tell. Lisa mentioned the shifting demographics. It's a really important point. This is a risky bet. And of course, you have the reality of what is going on in the country today. I mean, we have a jobs report out today that doesn't look very promising. We have higher costs coming down the pike as a result of these tariffs. We have an increasingly unpopular immigration policy by the president. He has long owned that issue, except many people feel he's gotten over his skis in terms of deporting children, this alligator asylum in Florida. I mean, the list goes on and on. So it depends on the politics of the moment as well. But, what's so fascinating about this effort is for the first time in history, it's being driven by the president. And he is a lame duck. So you have a lame duck president that concerned about what's going to happen, right? He should be in 2026 because he's been here before. And last time he lost the Congress, he had 2 impeachments and got nothing done. He doesn't want that again. So if anybody thinks Donald Trump is going to just go quietly into the night, that is not the case. He is pushing hard to retain this Congress in the Republicans' favor so he can do all of the things he would like to do. And we've never seen this from a president pushing states to redraw districts or redraw their lines in the midterm or mid-decade.
Jeannie, making news that Donald Trump, I guess, is not running for a 3rd term. Okay. I want to ask you both, we're talking about we'll see, Jeannie, about Democratic messaging here, because this is one of any number of issues that Democrats are trying to frame arguments around right now, kind of testing things before we get real about the midterms. And while they're home for August recess, the big target here is the big, beautiful bill. Now, Lisa, you know what it's like to get in a room and craft talking points. We got them these are Democratic talking points that came from the group Third Way. We talked to Jim Kessler and Matt Bennett and others from Third Way. There are 3 cell lines here from Third Way and GBAO that were tested and stood out to be the most effective, we hear. Number 1, criticizing Republicans for cutting $1 trillion from Medicaid. That number is important. 2, focusing on the law's impact on the national debt. And 3, homing in on the impact of Medicaid cuts in rural hospitals. If you listen to this show, none of these are going to sound new to you. My question, I guess, Lisa, is will they work?
Well, I mean, that's why I brought it up in the first few moments of our conversation, Joe, is because I think that those are factors that very well could be. That's about the time that we'll start to really feel that pinch as it relates to our healthcare expenses and the impact.
Lisa,
that Medicaid
I hate to
can
interrupt
happen.
you here. We have an absolutely incredible headline that just crossed the terminal. I'm sorry to interrupt you, Lisa. And Jeannie, listen to this. The Corporation for Public Broadcasting says it is shutting down. We've got a press release here that producer James just put in front of me. The Corporation for Public Broadcasting addressing operations following the loss of federal funding. It is dated August 1, 2025. CPB announcing today it will begin an orderly wind down of its operations following the passage of a federal rescissions package and the release of the Senate Appropriations Committee's 2026 Labor, Health, and Human Services Education Related Agencies Bill, which excludes funding for CPB for the first time in more than 5 decades. This is the organization that we've talked about a lot with the rescissions package that funds PBS and NPR. It's unclear how either of those two networks will be able to exist without the Corporation for Public Broadcasting, certainly without some significant reforms. This is a big deal that is just breaking right now. The Corporation for Public Broadcasting is shutting down operations following 60 years of service. We're going to have a lot more on this, I suspect, and I'm waiting to hear from the president. We'll keep our eyes on Truth Social here. We'll get into this with the panel as well. Jeannie Shanzano and Lisa Camusa Miller are with us as the headline crosses the terminal. The CPB is going to close down. Live from Washington, I'm Joe Matthew. Kaylee Lyons will join the conversation in our second hour. The panel stays with us, and we'll welcome our global television audience to the fastest show in politics, the Friday edition. Stay with us on Bloomberg Radio.
From Washington, D.C., this is Balance of Power with Joe Matthew and Kaylee Lyons.
Jobs Day collides with new tariffs, and Wall Street is in a bad mood. Welcome to the Friday edition as job growth falls short, prompting A new round of calls for interest rate cuts just as the White House details tariffs for most all of our trading partners. I'm Joe Matthew alongside Kaylee Lines in Washington. And Kaylee, we're going to get to all of these stories over the course of the next hour on Bloomberg TV and radio, as well as a massive breaking story. Just moments ago, you heard it happen here on Bloomberg. The Corporation for Public Broadcasting is closing down, Kaylee, after the defunding rescissions package that just passed a couple of weeks ago.
Yeah, that rescissions package, of course, clawing back billions of dollars in funding. While it's a drop in the bucket when we think about overall federal expenditures, for the Corporation of Public Broadcasting, it's shutting down could mean that it basically directly hundreds, if not thousands, of local stations across the country could be shutting down. It's one of the very concerns that were raised by those who were reluctant to support the rescissions package, like the Republican Senator Mike Rounds.
Mike Rounds and others from rural districts specifically were very concerned about what they described as a lifeline for people to get emergency information suddenly disappearing. And there was quite a bit of talk with the White House to actually cut a deal with Mike Rounds to help fund Native American NPR stations that are near tribal regions of the country in states like his. There's no paper on that. We're not sure exactly how that would work. And to Kaylee's point, this could in fact result in the closure of dozens, if not hundreds, of radio stations. The way PBS works with the Corporation for Public Broadcasting is a bit different, and you could see individual programs, whether it's Frontline or Sesame Street or anything else, being impacted on that level as well. It looks as well, Kaylee, like we have another breaker here that's coming from the White House.
Yeah, another red headline just crossing the terminal based on a True Social post from President Trump, who says he has deployed 2 nuclear submarines, citing specifically what he calls the highly provocative statements of the former president of Russia, Dmitry Medvedev, who is now the deputy chair of Security Council of the Russian Federation. He says those nuclear submarines will be positioned in the appropriate regions. So layer that news geopolitically on top of tariffs, on top of this jobs report, we've got ourselves quite the Friday news day.
Well, isn't that right? It's going to be interesting to see how all of this lands on Wall Street, by the way, already upset with some of the news that we've had. It looks like we might be reaching a new lows of the session, Kaylee.
Yeah, and the bond market moves are nothing to sneeze at either. So let's get a check on that now as we turn to Charlie Pellet up in New York. Hey, Charlie.
Hi, thank you very much. Lots of developing stories. We got you covered here at Bloomberg. Right to the numbers here. Fast-moving markets to the downside now, with the S&P tumbling 106, down 1.7%. We've got the Dow down 611 right now, down 1.4%. The NASDAQ Composite Index down 485 for NASDAQ, a drop right now of 2.3%. Our NASDAQ 100 Index down 2%, and the Mag 7 Index is tumbling 3.2%. 2 of those names after earnings, both lower. Apple right now down 2.7%. Amazon after earnings now dropping by 8.2%. Traders driving stocks toward their worst session since May as weak jobs and manufacturing data revive concerns about the economy. Our Stuart Paul's going to have a whole lot more on the economy coming up in just a moment. 10-year currently trading 4.22% with the 2-year 3.70%. Spot gold surging $58 the ounce, up 1.8%, $33.48. And West Texas Intermediate crude down 2.4%, $67.64 for a barrel of WTI. Bitcoin down 1.5% at 114,746 on Bitcoin. Earnings news. Lots of companies reporting. ExxonMobil and Chevron posted better than expected results after record oil production cushioned the impact of lower crude prices. ExxonMobil down now by 2.2%. Chevron down by just about 0.4%. Again, a number of developing stories at this hour. President Trump deploying 2 nuclear submarines, citing a threat from Russia, and the Corporation for Public Broadcasting winding down operations. Also, just getting word that Blackstone here in New York City will be reopening its New York headquarters on Monday after keeping the office shuttered in the wake of that shooting spree that killed 4 people, including one of its senior executives. Stay with Bloomberg for the latest on these developing stories. I'm Charlie Pellet. Back we go to Washington. Once again, your hosts, Joe Matthew and Kaylee Lines.
All right, Charlie Pellet, checking on these jobs day markets. Thank you so much. Obviously, both the equity and bond market having a strong reaction to today's non-farm payrolls report. Just 73,000 jobs added, downward revisions. Also something to pay attention to as we're looking at over the course of the last 3 months. On average, the slowest jobs growth we have seen since back in the pandemic era. Raising the question as to whether or not maybe it was Governor Waller not Chairman Powell, who was singing the right tune at the Fed's decision this week to not lower interest rates. Waller, of course, was citing concern over the labor market. And as we consider the overall state of the labor market, we actually had a chance here at Bloomberg TV and radio to catch up with the Labor Secretary, Lori Chavez-DeRemer, earlier today, and this is how she characterized the figures.
Certainly, we know they could have been better, but we look at the positive because we still have a net positive, almost 500,000 new jobs since the president took office. What has happened on the ground? The one big beautiful bill by Congress, the president leaning in and keeping the promises made by negotiating fair trade deals for the American workforce. And now what we need is the Federal Reserve to jump in and lower those interest rates. I talked to businesses just yesterday who said, we've invested in our American workers. We're paying attention to our facilities. We're wanting to invest and borrow more money, but they're concerned with borrowing that more money.
So how did everybody get this so wrong? Stuart Paul joins us from World Headquarters in New York. Bloomberg Economics U.S. economist. Stuart, it's not just this month, the worst 3 months for job growth since the pandemic. And when you look back to the past couple of months here, massive revisions, prompting the question, how could we be so far off for so long?
There are a few things to keep in mind. The first is that, yes, payroll growth has been marked down. We always knew that payrolls were being overstated. In particular, we knew that private payrolls are being overstated. They still probably are being overstated. We saw 83,000 additional jobs added in the private sector. The revisions that we saw to past months' data and the weakness that we saw in the July report was mostly because of government hiring. Now, as you spoke with Molly Smith earlier today, and she has a great story about this on the terminal, there are seasonal adjustment factors at play that are affecting particularly state and local employment in the field of education. When those workers were marked as being on payrolls in the month of June, it didn't fully interact with the seasonal adjustment factor perfectly. So it's not a true shock that either payrolls are being marked down or that there are peculiarities in the interaction between actual headcount and some of the seasonal adjustment factors that are estimated at the Bureau of Labor Statistics. Yes, the labor market is cooling. Yes, today's data validates some of the arguments that we heard from Governor Waller just 2 weeks ago today on Bloomberg TV, where he was warning about a cooling labor market. But all things considered, a 0.1 percentage point uptick in the unemployment rate is really going to be the thing that matters for the broader swath of members of the Federal Open Markets Committee, for our monetary policymakers. And as we heard just this morning from from Regional Fed President Beth Hammack, she said, look, hot inflation right now means that the Fed is failing more on the price stability side of its mandate than it is on the maximum employment side of its dual mandate with just a 4.2% unemployment rate. So I don't think that either the headline numbers, the revisions to the headline numbers, or the balance of risk for the Fed has really materially changed with today's report. I see that markets are pricing in a bit more risk, considerably more risk, that the Fed would move in September. But all things considered, our base case is still for a December move, just 25 basis points in December.
But where could the labor market ultimately be by then, Stuart, if the Fed stands pat for that long?
Well, look, we've been expecting the unemployment rate to continue rising. It would not come as a major shock to me to see the unemployment rate reaching, let's say, 4.5% at that point. That still puts us relatively more bearish on the labor market than most forecasters out there. But in terms of where we are in managing the Fed's balance of risks, with persistent core inflation, even a 4.5% unemployment rate might not be enough for the Fed to move. And if it's the case that nominal GDP growth is still running, well above what would be consistent with, let's say, the 2% target, that 2% inflation target, plus maybe 1 percentage point of real growth, I think it's fair to say that the Fed would remain on hold even if we saw a 4.5% unemployment rate.
All right, Stuart, we appreciate it as always. Stuart Paul is a U.S. economist for us at Bloomberg Economics, here with us on Bloomberg TV and radio. And joining us now for more in our Washington, D.C. studio is Ben Harris. He's Vice President and Director of Economic Studies at the Brookings Institution, also former Assistant Secretary for Economic Policy and Chief Economist at the Treasury Department. Ben, great to have you back here and to see you in our studio. As we consider these jobs figures today and the downward revisions, knowing that just days ago the Fed made the decision not to ease policy, maybe that would have been a different decision had they had these figures in hand. Do you think Chairman Powell maybe made a mistake this week?
I don't think he made a mistake this week. He's been put in this impossible position. You've got a labor market which is clearly in freeze mode. And so my interpretation of today's report is I don't remember a jobs report that provided so much clarity, because it's not just about the past month, it's about the past 3 months, right? So with the revisions, we are clearly in a situation where employers are freezing hiring, they're taking care of the workers they have, but we're only adding 35,000 jobs or so a month, and most of that is the healthcare sector. So you've got a labor market which is frozen, but on the prices side, it's very clear that we're in the middle of an inflationary episode because of tariffs, right? And so you would expect the normal lag to be 3 to 5 months after tariffs are implemented. The Fed is in an impossible position. Prices are rising. The labor market is stagnant. So I don't think that Powell made a mistake, but he's been put in this position, a position he did not ask for.
How's it going to feel in September if this kind of deterioration continues?
So if the labor market stays the same and we see the hikes that we're expecting in prices, yeah, it's sort of like, what is the worst case? What's the worst shock? So are we seeing prices rise more than we thought? Are we going to see core PCE go above 3%? If core PCE is above 3%, how can the Fed possibly start cutting? It can't, even if the U3 is at 4.3, 4.4, 4.5.
Yes, okay.
And so if prices continue to rise the way we expect them to, I don't think the Fed can cut, and markets disagree right now. So you see this big one-day change between yesterday and today. Yesterday, markets thought the Fed will cut between 1 and 2 times between the end of the year, between 25 and 50 bips. Now markets are certain the Fed will cut by at least 50 bips, maybe 75. But I think that maybe they're misinterpreting the impact of these higher prices owing to tariffs.
Well, so let's talk about those tariffs. Obviously, it's August 1st.
Yeah.
While the levies aren't actually going to be collected until August 7th, so there's still a bit of wiggle room here. We're looking, according to Bloomberg Economics, at an aggregate tariff rate on average that's going to move up to 15.2%. What difference will that ultimately make in the prices people see at the store and how it actually tracks into inflation gauges?
So the rule of thumb is that for every percentage point increase in the average tariff rate, you see a 0.10 increase in the inflation rate. So if you're going from around a rate of around 3%, like we saw at the beginning of the Trump administration, up to 15, we're talking about 1.2 percentage points increase in inflation, which is a lot in a short period of time. And you're starting to see prices get passed through in exactly the way we would have predicted. So you can look at things like recreational goods. You can look at things like home furnishings. These are things we import from China, and those prices are rising. And so it's very clear that the tariffs are having an inflationary impact.
We're going to talk with Peter Navarro on the late edition of Balance of Power. He has sat in that chair and argued, and he would fight with you right now on the idea that tariffs are inflationary. And you've heard this line from the White House, that when you have a one-time change in prices, that it's a different phenomenon. You're seeing a trend, though, that will continue.
So I don't agree with Peter Navarro on almost anything.
I understand.
But I do agree that it is a one-time shock.
Okay.
And so when I look at tariffs, I think that the real concern with them is not the inflationary impact, for the reasons that Navarro says. It's a one-time shock. That's bad news. It's terrible timing. It's a time when you'd like to see the Fed be able to cut, and it can't. Okay. The real problem with tariffs are that it has eroded the United States' credibility as a trading partner. And you're seeing that in terms of not just trading, but also investment. Investment has been stagnant despite this $4 trillion bill. And so if you look at sort of the average tariff rate on China, they're all over the place. Tariffs started off at 10%. They went to 20%. Yeah. They're 104% for a while, 145. Now they're down to 30. I don't know what they're going to be in 3 months. Neither does Peter Navarro. Neither does President Trump. Who would want to trade with someone who's rapidly switching prices like that so frequently? So it's not this one-time price shock from tariffs that really concern me. It's the erosion of our credibility as a trading partner.
Well, when we consider the investment question which you raised, the White House would contend they've had trillions of dollars in investment pledges coming in from various governments or companies announcing they're going to be building more manufacturing capacity in the U.S., even if some of that money had already been previously announced as well. Even if it does materialize, how long does it actually take to translate into more demand for labor, more American jobs, if it were to work as they say it's designed?
So the White House has no credibility on this point. The White House has no credibility on this point because we have an example in the first Trump administration. We had that phase one deal with China.
Sure.
We had hundreds of billions of dollars of commitments that China had no intention of fulfilling, and that the administration did nothing to ensure that it was fulfilled. There's outstanding confusion around these trade deals. Let's just be clear about what these trade deals are. They're frameworks. So the USMCA bill that was signed in the first Trump administration was 1,800 pages. The trade framework with the UK, which was the most comprehensive so far, was 5. These are not trade deals. There's massive confusion. You can look at the Japanese trade deal, $550 billion of investment pledges. Japan said, you know, these aren't really investment pledges. These are loans at market rates. That's
the White House called it a blank check.
Yeah, and
so what happens 6 months to a year from now when they're trying to draw down this cash?
No one knows. No one knows. And so if I was going to characterize the U.S. economy right now, it would be chaos and confusion. And you're seeing that in businesses. You're seeing businesses, you're seeing from business leaders. They're saying, I don't know what's going to happen with trade. I don't know what's going to happen with the regulation. So what I'm doing is I'm standing pat until there's some clarity. This is really bad for American business.
Well, so should it be bad for American markets or U.S. equity markets? Because until today, where, yes, you are seeing some significant downward pressure, we were hovering around record highs. It seemed like everybody was in a pretty good mood, or at the very least, willing to look through the president's latest tariffs.
Yeah, I think the reason for that is during the transition between administrations, the way that economists and the way the financial markets were looking at the Trump administration was this kind of fight between, on the good side, you have this massive tax cut coming, and you've got widespread deregulation. And a lot of executives are really excited about that. And then on the other side, you have pretty stark tariffs and a really aggressive anti-immigration platform. And so you have this fight between these two different factors. It's clear that the negative impacts of tariffs and going to zero immigration, which we haven't talked about yet, but I think is a real factor, is beating the positive impacts of this really expensive tax package and deregulation. So I think that's what you're seeing in equity markets today.
Participation in the jobs report today fell to the lowest level in months. Does that suggest full employment? People are sitting on their hands waiting for something. You add a number of mass deportations. What's that number going to look like, say, the end of this year?
So in terms of participation, when I'm looking at some of the alternative labor market metrics, you're seeing there are a lot of people who want to work who aren't. And after you spend enough time looking for a job, you're eventually going to start dropping out. And so you can expect that to happen. That's what happens, as you guys know, when economies weaken. In terms of immigration, I mean, the answer has to be, I don't know. So going back to 1990, outside of COVID, we have added in net migration in the United States between 1 million and 1.8 million people every single year. This happened during the first Trump administration. It happened during Clinton. We're about to go close to zero. So you look at estimates coming out of my colleagues at Brookings, we think we're going to be anywhere between minus 500,000 and plus about 150. Okay. We have never seen anything like that. And I don't know what that means. I don't know what that means for housing markets. It's probably bad for certain industries like agriculture, fishing, some manufacturing. But this is an unprecedented experiment, and we're all going to go on a bit of a ride here.
We need to stay in touch on a lot of things here, Ben Harris. It's great to have you back.
Thanks for having me.
With Brookings, now, of course, a veteran of the Biden administration's Treasury Department. Great analysis on this Jobs Day and Tariffs Day. What are we calling this? Is this Liberation Day again, or that's a week from now?
If it is, it would have to be like
August 7 is when they take effect.
Right.
Okay, so we'll call it that again.
Yeah.
In a week. We'll assemble our political panel next. Alongside Kaylee Lyons, I'm Joe Matthew. This is Bloomberg.
It's 1:21 on Wall Street. We do check markets all day long here at Bloomberg. President Trump says the U.S. is moving to nuclear submarines to respond to what he's calling highly provocative statements from former Russian President Dmitry Medvedev. Stay with Bloomberg Balance of Power for the latest on this story. And just moments ago, we told you the Corporation for Public Broadcasting says it will begin to wind down operations after President Trump signed a package of spending cuts that ended its federal funding. U.S. stocks are moving lower right now, making a run for the worst level of the day. Jobs Friday. Traders are worried about jobs weakness and the impacts of President Trump's tariffs. Stocks lower across the board here with the Dow, the S&P, NASDAQ all in the red. Right now, we are looking at a 110-point drop on the S&P 500 index, down by about 1.8%. For the week, looking at a loss in the S&P right now of just about 2.5%. The Dow now down by 620 points, a decline of 1.4%. The NASDAQ Composite Index down 2.3% right now. Our Mag 7 Index, full of big tech names, right now that index is down 3.1%. Among those names, both out with earnings after the bell yesterday, Apple and Amazon. Apple right now down 2.6%, and Amazon now down by 8.3%. The 10-year yield 4.22% with the 2-year, 3.71%. Gold up 1.8% to $33.48 the ounce, and West Texas Intermediate crude down 2.6%, $67.49 a barrel. President Trump has sent letters to 17 of the world's largest drug makers, including Lilly, Novo Nordisk, and Pfizer, insisting that they immediately lower what they charge Medicaid for existing drugs. Lilly shares, they're up 2.5% right now. Novo Nordisk, that is up by 2.3%. Pfizer up by just about 0.8%. Again, recapping, S&P down 1.7%. For on-demand news, 24 hours a day, subscribe to Bloomberg News now, wherever you get your podcasts. And back we go to Washington. Once again, your hosts, Joe Matthew and Kaylee Lyons.
All right, Charlie, many thanks. We'll get back to Charlie Pellet for another drop on the markets here in a short time from now. We've been having a little trouble on Wall Street following the jobs report this morning, the earnings news that you've been hearing Charlie talk about, and what a busy Friday this has become. Friday news dump. The Corporation for Public Broadcasting is closing down. We did learn that today, along with the tariff rates that will be taking effect a week from now. One of the more important stories that you may not hear about, and I'm looking at you, Boston, if you're listening to us now on 92.9 FM, it's called Drive, a new initiative by the governor of Massachusetts, and it has everything to do with federal funding, or the lack thereof. Drive stands for Discovery, Research, and Innovation for a Vibrant Economy, and Governor Maura Healey is pushing this idea right now. Joining us live from my former hometown of Boston, Governor Healey, it's great to see you. Welcome back to Bloomberg TV and radio. You've carved out $400 million here, an investment pool to help create jobs, to help fund research. Anyone who's been to Boston knows the dozens of research hospitals that are there, never mind the scores of universities that you have in the city and across the state. Is this a direct response to the cuts that have come from the Trump White House?
Well, Joe, thanks for having me on, and I'm really excited about this. This is what this is about. This is an investment in the Massachusetts economy. It's about job creation, and it's about the recognition that 1 in 10 research and development jobs in the United States, 1 in 10, are here in Massachusetts. We have the highest percentage of STEM graduates. Per capita, we receive the greatest amount of venture funding. We also receive the greatest amount of NIH funds. Research drives and powers the Massachusetts economy. And in the face of some uncertainty from the federal government, and sure, funding going away in some respects, I thought it was really important to lean in and to send a message, not just to the United States, but to the world. If you're an innovator, an entrepreneur, a scientist, a researcher, Massachusetts is where you want to be. We will continue to be a place that powers the world with our research, with our science. We will continue to be the place that incubates all those cures and treatments and discoveries that have really transformed the world. And that is the message that I'm trying to send with this public investment in research. which we hope to leverage with additional private dollars to really make this thing go. I'm very excited about it and what it's going to mean, not just for Massachusetts, but for the United States.
Well, Governor, that's what I wanted to ask you, is you talk about this being about job creation, but in some degree, if funding is going down, it also has to be about protecting existing jobs. So do you see the need here for this $400 million to actually grow to something much more substantial? Does that number need to get higher ultimately?
Well, Kaylee, I'd love to see it grow. It's also the case, let me just explain, when I talk about research jobs, know that for every research job here that is funded, that is supported, that is spinning off so many other jobs in construction, in real estate, in hospitality, in restaurants, and retail. So it's such an important catalyst for so much. And when I think about our incredible teaching hospitals, our colleges and universities, they've had funding hits, as you know, and that directly impacts economic growth and progress, not just for Massachusetts, but for the United States, because we're competing against China. China is the one who's looking to recruit our scientists and our researchers and those who are in our labs today. I want those folks staying in Massachusetts, staying in the United States, and I want them to continue to be part of what has been so essential to American GDP and growth and dominance around the world.
I guess my question for you in this case, Governor, is would this be necessary if the federal government maintained the funding that Massachusetts was already enjoying? Or was this something that you wanted to reach for beyond the federal funding that you've seen come into Beacon Hill and do something more for research in Massachusetts? Was this idea underway before President Trump and the DOGE and the cuts?
Well, I'll say that the DOGE and the NIH cuts certainly put a focus on this and not only the primacy of research here, but the need now to make sure that is really supported. It's also the case that we did not see prior to Donald Trump's actions the efforts to recruit on our campuses, at our teaching hospitals, at our preeminent world-renowned research institutions here in Massachusetts, the presence of so many people from so many countries looking to lure American talent and intellectual assets away. So it absolutely has been precipitated by what we've seen from the federal government. That said, as governor, I would have wanted to make this investment anyways, because this is about growth and innovation in our economy, which has always driven Massachusetts' jobs and economic success here.
Governor, as you well know, President Trump and his administration are in a bit of a battle with Harvard University specifically, and there has been reporting in recent days that Harvard is looking to spend, or open to spending at least, up to $500 million to settle with the administration. A group of House and Senate Democrats have now sent a letter to Harvard suggesting there will be a rigorous investigation if the school ultimately cuts a deal such as that. What would you advise Harvard to do here?
Well, I haven't spoken with Harvard about this, and my hope is Harvard will make a decision that is in the best interests of academic freedom. I think that's really important and central to American higher ed. So we'll see how that goes. But, I have expressed my concerns about what the Trump administration has done in weaponizing, whether it's DOJ or other things, against Harvard and other universities in an attempt to essentially silence critics, silence academic freedom. And, that's just, to me, un-American.
Governor Healy, you've been pretty outspoken about your opposition toward the president's tariff regime as well. With Canada specifically in mind here, you launched the Tariff Response and Business Operations Support Initiative to support local business, and you gathered a bunch of Northeastern governors and Canadian premiers back in June to talk about this. Canada is really feeling it. They're at 35% now, it looks like, outside of the USMCA. We looked at the numbers here. Massachusetts exported $3 billion in goods to Canada in 2024, making it the state's third largest trading partner. What will these tariffs on Canada mean for your economy?
Well, tariffs are a tax. And, I'm a governor who is trying to build housing as quickly as possible in my state. My lumber comes from Canada, right? So, that's just one example of how reckless this is. Canada is our largest trading partner, of course, and the reason I brought together Canadian premiers and Northeast governors a few weeks ago was to send a message. We are your friends. We are your allies. We want to continue to do business with you. We want to continue to structure energy deals and, support tourism and support trade. I mean, it is so integral to our economies on both sides of the border. So, it's terribly disappointing, terribly frustrating to see the president continue to hammer on our great friend to the north. And it's going to hurt households and businesses here. And that's why I've tried to be proactive, reaching out, meeting with my Canadian allies and colleagues, working together with other governors on this issue, and also supporting our businesses here who are already feeling it. I'm all for reshoring, okay? Let's be sensible and smart about what it is that's practical to reshore and what isn't. And as governor, I'm very focused on this and just continue to be really dismayed at the devastation caused by this, because it's also the uncertainty, right? You don't have capital deployed in your state or in this country. You have people turning away from the United States for investment. That's not good for American competitiveness. That is not putting America first.
Well, when we consider the uncertain nature of the president's tariff policy, knowing how frequently, Governor, that they have changed or deadlines have moved, is it so simple for businesses in Massachusetts? The tariffs go away, okay, great, we can make a different decision, or do they have to think differently about that? I just wonder to what extent the impact will be permanent regardless of the decisions of the president.
Kaylee, that's a great point, because you have to make decisions, judgments in real time about orders, right? For parts, for supplies. You have to figure out how you're going to source things. And it has become incredibly difficult for so many companies to try to figure this out. It's hard for the largest companies, right? And imagine all the small businesses who have been affected in Massachusetts and elsewhere. I'll also give you an example, because looking out behind me is the beautiful Boston skyline. This is the time of year where we like a lot of people to come, tourists, visit New England, visit Massachusetts. All of us are getting killed. Tourism numbers are off in New England between 20 and 60% as a result of our mistreatment of our Canadian friends who we count on to come here. So I'll still reach out my hand and hope to continue to find ways to do business, working with other governors, working with Canadian premiers, encouraging that, because we are in a global economy. Massachusetts is certainly in a global economy, and we need certainty, and we need this insanity to be put to bed and end.
I want to ask you lastly, Governor, about the effort to redistrict in the state of Texas, and a trend that might become a national one as Republicans in Texas redraw the congressional map in an effort to generate 5 more seats that President Trump has asked for that are expected to be Republican seats, an effort to maintain the Republican majority, a very thin majority in the House. I bring this up with you because not only are you a Democratic leader in this country, but we talked to Senator Ted Cruz about this last night, and he brought up your state of Massachusetts. Listen to what he said.
I'm in particular amused at the Democrats who are clutching their pearls, because the Democrats have always been much, much more ruthless in gerrymandering. I'll give you an example. The state of Massachusetts. State of Massachusetts, about 35% of Massachusetts votes Republican. About 60 to 65% votes Democrat. Do you know what percent of Massachusetts congressional delegation is Republican?
I believe it's 0. Yeah.
They drew it, so not a single Republican is elected.
I reminded him of some of the other redistricting phenomena that have happened that redistrict a couple of lawmakers right out of their own districts. I'm just wondering if he has a point there, Governor, and where you'd put the Republican seat in Massachusetts.
Well, first of all, I'm not clutching my pearls, Senator. What I am is a governor who believes in fair representation, and what's going on in Texas is just, it's an abomination right now, the effort to redraw those maps. The senator himself made the point, which is that, 65% of the voters in Massachusetts happen to not be Republicans. So we end up with a delegation that is right now all Democrat. But, I will do everything as governor to always ensure that there is fair play and fair representation. Clearly, there are governors elsewhere, like Governor Abbott, working together with AG Paxton, that are not about that. They are about playing games right now and playing politics to try to retain a very thin House majority. That's what's happening.
All right, Governor, we thank you so much for joining us here on Bloomberg TV and Radio Live from our Boston bureau. The governor of Massachusetts, Maura Healey, here with us on Balance of Power, talking not just redistricting, but of course the economic impact being felt in Massachusetts by the policies of the Trump administration, be it cuts to funding for things like research or, of course, the tariff policy of the president, which is in focus today as we have the announcement, but not necessarily the collection yet of these duties on a number of our trading partners, tariffs ranging from a 10% baseline all the way up to around 40% going into effect as of August 7th, on the very same day that we get a softer than expected jobs report at just 73,000 jobs. So for more on this, we turn to our political panel. Jeannie Sheehan Zaino is with us, Democratic analyst, Bloomberg Politics contributor, and senior democracy fellow at the Center for the Study of the Presidency and Congress, alongside Lisa Camusta-Miller, Republican strategist, former RNC communications director, and host of the Friday Reporter podcast. Lisa, when we consider the president obviously stands by his economic policies, he has touted the strong GDP figures we got earlier this week. He believes tariffs are a good thing for America, not a bad thing. When you put them together with what we just heard from Governor Healey about how it's already impacting businesses and potentially hiring decisions with the softer jobs report, is he about to face the need to U-turn on this once again?
Oh, he'll never admit that what he's put in place is something that should be reversed, but he certainly will keep an eye on the markets and try to do everything he can to make it appear like he has won, that his policies are winning and that they're doing the right thing for the American economy. I think, though, that the market itself this morning reacted not only to the announcements that he offered last night as it relates to last-minute trade activity, but also this morning keeping a close eye on how that's going to all change and react in a real time. I think that the president probably is paying very close attention and will continue to retool, not in a retreat, but more in a way to say he's watching and he's paying attention. He's going to do whatever it can to make the economy a winner.
Jeannie, does Maura Healey have a model there for other states around the country to make up for the lack of federal funding, or is this a Massachusetts-specific issue when it comes to the many universities and research hospitals in that state?
Yeah, it really struck me listening to your conversation with Governor Healey. What a breath of fresh air. And this is what you hear more and more from voters. They are not turning to the federal government. They are turning to their local and state officials like Governor Healey to say, what do we do at this time of enormous uncertainty? And she does have a plan with this drive to address what has been taken from the state as a result of DOGE cuts and other things. And I think we will see other governors, left and right, Republican and Democrat, try to emulate that. But, even more than the specifics, I feel like listening to her in a very common sense, calm way, she's talking about what so many people are feeling today as a result of tariffs, the cuts to the Corporation for Public Broadcasting, so much unease going on. To hear that there are leaders on the ground who know what people are feeling and are prepared to address those is a reassuring and much reassuring needed conversation to have. So I was very grateful to listen to you all talk to her about what she's doing for her state so close to the Canadian border at this time of uncertainty.
Yeah. Well, we appreciate going overtime with our panel here. Many thanks to Jeannie Sheehan Zaino, Bloomberg Politics contributor, and Lisa Camuso-Miller, former RNC comms director. Look for her Friday Reporter podcast. Many thanks to you both for the insights. We've had a lot of breaking news today, including the winding down, the closure of the Corporation for Public Broadcasting, making that announcement since we took air. And President Trump as well now moving 2 nuclear submarines to respond to what he's calling highly provocative statements from former Russian President Dmitry Medvedev. We're going to have a lot more on that in a conversation with Bloomberg Intelligence. Straight ahead, we do want to check Wall Street because this has not been a fun ride today following the jobs report, the tariff news. Charlie Pellet has the numbers for us live from World Headquarters in New York. Charlie, how's it going?
Thank you very much, Joe and Kelly. Right now, a lot of red on the screen. In fact, we are making a run for the worst level of the day right now on the S&P 500 index. Right now, down 112, right to the numbers here, fast moving to the downside with the S&P at 62.26, looking at a loss now of 1.8%. Stocks extending that jobs-fueled slide. Right now, the Dow is down 641, decline of 1.5%, while NASDAQ is down 504. The NASDAQ Composite Index right now down by 2.4%. The Mag 7 Index down 3.2%, hit hard among some of the names in that index that are selling off today. Apple after earnings down 2.7%. Amazon after earnings now down by 8.5%. Jobs Friday with the 10-year, 4.22%. The 2-year, 3.70%. Gold up $59 the ounce, now surging 1.8%. The precious metal at $33.49 the ounce. And West Texas Intermediate crude down 2.6%, $67.42 a barrel. Bitcoin just below $115,000 now, down 1.5%. And again, repeating our top story, one we're covering right here on Balance of Power. President Trump says the U.S. is moving to nuclear submarines to respond to what he calls highly provocative statements from former Russian President Dmitry Medvedev. And also, as we have been reporting since the top of the hour when we first got word, CPB, the Corporation for Public Broadcasting, says it will begin to wind down operations. Balance of Power continues right now. Back we go to Washington once again. Your hosts, Joe Matthew and Haley Lyons.
All right, Charlie, we do thank you. We want to stick with this story involving Russia and the president's decision to move 2 nuclear submarines. He's talking, Kaylee, about comments from the former Russian president, Dmitry Medvedev. We've established that. So what did Medvedev say to prompt this? He took to social media earlier this week, writing, quote, "Trump's playing the ultimatum game with Russia. 50 days or 10. He should remember 2 things. 1, Russia is not Israel or even Iran. And 2, each new ultimatum is a threat and a step towards war." He goes on to write, not between Russia and Ukraine, but with his own country. Don't go down the Sleepy Joe road. He had more to say than that, prompting the president here on social media to make the statement, ordering 2 nuclear submarines to be positioned in the appropriate regions. He says, just in case these foolish and inflammatory statements are more than just that. We're joined for more on this by Wayne Sanders, Bloomberg Intelligence Senior Defense Research Analyst. Wayne is a retired Army colonel, and so it's always a pleasure to welcome Colonel Sanders back to the program. Wayne, where are these subs headed, and how important is this development?
So I think the fact that the president's talking about it does make it highly provocative, as you brought up. I think that's something that that he's using right now as a tactic, right? It is part of his information campaign to be able to say, hey, look, we have something off of your coast. Now, I think the important piece to understand, though, is that when you're looking at our nuclear submarine program, when you look at the Virginia-class submarine, Columbia-class submarine, that we are 10 years ahead of, from a technological perspective, of Russia or China. And it's very, very difficult to find out where these things are anyway. And because of the stealth technology, because of what we use and how quiet they are, they could be anywhere anyway. So it's an opportunity for the president to say, hey, this thing is over there. That is an overt way versus some of the clandestine way that these things move anyway. And it's something that we have always been able to position our capabilities where they need to be at whatever time. Normally, they're just not publicized.
Okay, so they're sneaky, Wayne, but what capacity do they have? What actually can these things hold?
They have quite a bit of armament between Tomahawk cruise missiles as well as additionals. We are building towards the capacity for hypersonic missiles to be able to fire out of their vertical launch systems, the VLS, on that as part of the Navy's conventional prompt strike program as well. But they carry enough to the Virginia class from that, the Tomahawks cruise missiles perspective, to cause a lot of damage. And then when you look at the Columbia class, you are looking at your ballistic missile capability as well that's fired from those platforms. And they can reach pretty much anywhere in the world based off of, especially from the Atlantic to Pacific or even through the Arctic.
So does this strike fear in the heart of the Kremlin? What does Vladimir Putin think of this?
Well, I think the fact that President Trump is saying it out loud is speaking volumes in that capacity. I think that Putin and crew would already know that we're going to have our capabilities within defense as well as strike range, no matter what. That's just part of why we have operational deployments of our naval capability to protect the U.S. Right? It is a strategic ability for force projection, as we call it in the military side of the house. Right? As they would call it. These are force projection measures to be where they need to be. You've seen President Trump use it normally on the carrier strike group side of the house that says, hey, I'm going to put the USS Gerald Ford in this area. I'm going to go and do this from an aircraft carrier. Well, along with that aircraft carrier comes a nuclear submarine. It's part of that package that normally goes out there. And so that's just part of the complement along with destroyers and other things. For him to say that, hey, I'm just talking about the nuclear submarine piece, I think is a tactic to go after some of the fear in that perspective and say, hey, I'm doing this and you don't know where they're at.
All right, Wayne, we appreciate you joining us on this breaking news. Wayne Sanders, who, of course, is a defense analyst for us at Bloomberg Intelligence, on this news that President Trump is deploying 2 nuclear submarines to what he calls the appropriate regions in a very direct threat to Russia. But of course, that's not the only threat he's issued against Russia recently. He's also threatening as soon as next week to impose secondary sanctions on Russia, or secondary tariffs, depending on what the president says at any given time, but specifically on buyers of Russian energy to try to choke off what is financing the Russian war regime. And while we await news on those secondary tariffs, we, of course, have gotten plenty of news today on other tariffs that are being imposed on U.S. trading partners, as it is Friday, August 1st, the date we have long waited for, though we may still need to wait even longer for these to actually become a reality, as these levies are not set to be collected until August 7th. But assuming they do go into effect and those collections start and importers start paying those taxes, Bloomberg Economics estimates that our average tariff rate is about to go to 15.2%. The question is, how will the American consumer feel about that, or the American voter specifically? And on that note, we turn to Frank Luntz. He is a politics and communications consultant, a pollster, of course, and also CEO of FIL Inc., and is here with us on Bloomberg TV and radio. Frank, welcome back to Balance of Power. Obviously, the president is very proud of his tariff policy. Yes, we didn't get the pomp and circumstance with this particular rollout that we got on Liberation Day on April 2nd, but how is it actually being received by the American electorate? Is that why we see his approval rating not doing so well?
It's received with a lot of questions. And what the public is asking for more than anything else right now is economic predictability. Tell me what prices are going to be like. Tell me what business is going to be like. Tell me what the economy is going to be like, because I don't need any more shocks. I don't need any more surprises. And you find this from those who work paycheck to paycheck, right up to the captains of industry. They simply want the predictability to be able to plan, to be able to prepare for whatever happens. And that's caused the instability of the tariffs, even though the economy is very stable, has had an impact on the president's approval ratings.
Look no further than Procter & Gamble, and I know you talked to a lot of major corporations, Frank, announcing this week that they plan to raise prices on about a quarter of consumer products because of the impact of tariffs. The idea of Charmin going up in price means what to consumers? Because we're hearing references to Joe Biden now when people are talking about Trumponomics. It might not be in the hard data, but people aren't feeling good about it. How do you deal with that scenario in the White House?
So I don't hear that at all. And there's a big difference between having to pay more for eggs, which the administration should acknowledge. It was not their responsibility. There was a health and safety issue with the chickens across the country, across the globe. But the public is acutely aware if gas prices go up or go down, because they're living paycheck to paycheck, trying to make ends meet. And that's something that we were not used to in the first Trump administration. I don't see any comparison to Joe Biden, who's suffering through interest increases, inflation of 9%, sometimes higher. But make no mistake, the public is attuned to this. They're having more and more difficulty going to the supermarket, going to the gas station. And it's not just there, it's also with housing and with health care. So all I'm saying to viewers is disconnect Trump and Biden, because it's not nearly as bad as what was going on. With that being said, make no mistake, if prices do go up, Trump's ratings will go down.
Well, of course, Frank, President Trump says that, okay, maybe prices will go up, but your taxes at the very least aren't going to go up. I made sure that my tax cuts from 2017 were made permanent through the One Big Beautiful Bill Act. Republicans are home in their districts right now on this congressional recess, selling that bill to their constituents, although maybe with varying degrees of success if you look at what's happening across town halls. What is the best messaging for it that Republicans can deliver or that Democrats can counter around?
Well, your point is a good one, that the Republicans have not been successful up to this point in communicating what's in that legislation. And the best in this area of taxes would be if the Republicans had not done what they had done, taxes would have gone up by record levels. And by Republicans doing what they did, the tax burden on the average American fell by thousands, multiple thousands of dollars. That's not being explained. It's not being educated to the public. And this is where the GOP has a great advantage. Their weakness is on Medicaid. Their strength is on taxes. If they had not done it, can you imagine what your tax bill would have been like next April? They should be saying it. They're doing it to some degree, but I'll tell you, from the work that we're doing, it is not being heard.
Interesting. Even though this is town hall season, in the throes of August recess, when we're also hearing a lot about Jeffrey Epstein, Frank, this is a tough story for the president, and I'm wondering your thoughts on how he gets over this, how he moves beyond it. Is it as simple as just riding it out?
Well, he has to move beyond it because the public is not focusing on the legislation. They're focusing on this salacious scandal. And it doesn't make anybody look good. It causes people to doubt the behavior, not just of politicians, but of corporate leaders, of people at the top 1/10 of 1% of American society. And that's not good for the people in power. The best way for Trump to deal with it is to simply let the public, they have information that they want, need, and deserve, and the Trump administration should be on the side of providing that information. Because if they don't communicate the legislation, they're going to have a problem 1 year from now when the midterms happen. The trend over the last 50 years is for the party in power to lose control. So the president and his political party have to be talking about anything but the Epstein crisis, Epstein scandal, I would call it.
Well, as we think about the notion of the Republican Party losing control, President Trump wants to avoid that outcome by having Texas redraw its congressional map so that they pick up 5 new Republican seats. Frank, how does the American electorate view redistricting, this issue of gerrymandering that risks spreading all across the country far beyond Texas?
It's more politics as usual. It's more politicians making the effort to protect themselves rather than put the country first. I'm not a Republican. I'm not a Democrat. My job as a pollster is to be straight about it. And it just reminds people that the politicians are more focused on their own preservation than the people that they're supposed to represent. And one other point about this. I promise you that if the Republicans do this now, the Democrats will follow. Just as what's happening now in the United States Senate, where the Senate Democrats are doing everything they can to slow down the nomination process, which once again is not good for the American country, American people. If the Democrats do that, the Republicans will follow. We are fighting an endless game, and it's not a game, and it's not a war. It should be about people, not about partisanship. And it's one of the reasons why the Americans are so pessimistic about the future and so angry with institutions right now.
It's been a long time, Frank. It's good to have you back. Frank Luntz, FIL Inc., of course, famed pollster with us here on the program today. One that has been featured by an enormous amount of breaking news here, Kaylee. The Corporation for Public Broadcasting winding down. The President of the United States moving 2 nuclear submarines in response to language and rhetoric from Russia. Tariffs taking effect. Jobs Day. Did I miss anything?
Oh, I think that covers it, maybe, although the day is still young.
Yeah.
I'm sure something else could very well emerge by the time we reunite at 5 p.m. for the late edition of Balance of Power. So we'll see you then, right here on Bloomberg TV and Trade.
This is Bloomberg Business Week Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Business Week Daily with Carol Masser and Tim Stenivek, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
And a very good afternoon, everybody. Carol Masser, Tim Stenivek, live here at Bloomberg headquarters in New York City. Man, what a Friday. Jobs Day, tariff deadline, President Trump deploying nuclear subs, citing a Russian threat. And Tim, we definitely have seen markets bouncing around to all of it.
Yeah, bouncing lower on the equity side right now. Charlie Pellet's going to have the details in just a minute, but suffice it to say the NASDAQ getting hit to the downside of about 2.5%. We're going to see 1% losses at least today, 1.8% on the S&P 500. Again, Charlie's going to have more. On the yield side, Carol, steepening of the U.S. rates yield curve, also a market update in just a minute.
Yeah, those charts very clear when it comes to U.S. rates. Hey, as we said, we are focusing on that jobs report, a recap of the data you need to know. A lot of data, actually, today. Also, Fed folks out there speaking. Fed policy, we're going to ask, does it still make sense coming off of that Wednesday decision, Tim?
Also, people all in on Apple and Amazon? I don't know. Amazon, not so much. Apple faded when it was higher earlier in the session. Needham's Laura Martin is back with us. She's going to give us some updates after those calls late last night.
Yep, and it ain't all about the Mag 7. We've also got some earnings from some of the big oil majors. Exxon and Chevron reporting results. Despite lower crude prices, they had record oil production numbers. So we're going to get into that. Ellen Wald, great voice on this. So she's going to join us in the next 60 minutes.
All that and more coming up this hour on Bloomberg Business Week Daily. But he's back, the man, Charlie Pellet. Hey,
Thank
Charlie.
you very much. And let's recap reset here. A number of developing stories. We got you covered on Bloomberg Television and Radio. President Trump says the U.S. is moving to nuclear subs to respond to what he calls highly provocative statements from former Russian President Dmitry Medvedev. Stay with Bloomberg for the latest. Also, the Corporation for Public Broadcasting says it will begin to wind down operations after President Trump signed a package of spending cuts that ended its federal funding. We've got traders now quickly boosting bets on Fed rate cuts. They're now fully pricing in 2 quarter-point reductions this year after this morning's jobs report. Right to the numbers with the S&P now down 113. We are close to session lows on the S&P, 62.25 where we stand, down 1.8%. The Dow down 645. That is a drop of 1.5%, while NASDAQ down 2.4%, tumbling 512 points. The Mag 7 index down 3.2%. Apple, which is one of the stocks in that index, down 2.4%. Amazon plunging 8.6%. We got more on both stocks coming up right here on Bloomberg Business Week Daily. Your 10-year 4.22%, with the 2-year 3.71%. Gold up $58 the ounce, up 1.8%, and West Texas Intermediate crude down 2.8%. Bitcoin down 1.8%, 114,369 now on Bitcoin. And word from Blackstone, it will reopen its New York headquarters on Monday after a shooting spree that killed 4 people, including one of its senior executives. Recapping S&P down 1.9%, I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, Charlie, thank you so much. As you just heard from Charlie, stocks definitely dropping back. U.S. Treasuries rallying, short-term yields posting their biggest drop in a year after that softer U.S. jobs data prompted traders to boost bets that the Fed will lower interest rates as soon as next month. Remember, we just had a meeting and decision on Wednesday. We also got some data when it comes to consumer sentiment. We're going to get into all of it. Keep in mind that blackout period for Fed officials is over following that Fed decision on Wednesday. On that, Fed Bank of Cleveland President Beth Hammack, a voting member of the FOMC, talking with our own Michael McKee this morning. She said the U.S. labor market still appears healthy, though today's fresh jobs numbers constituted a, quote, disappointing report, to be sure.
When I look at the data, we don't try not to make too much of any one individual report. And so we look at the confluence of data, we look at the longer term picture. What we have is a labor market that is showing signs that we should be watching carefully. Having the headline numbers come down makes sense to me, given what we've seen happening on the immigration side. And the headline number on unemployment, which is the most reliable indicator we have, is still within that 4.1 to 4.3 range that it's been at for the past year. So it looks like a healthy labor market that's still well in balance, but with some disappointing signs that we should watch very carefully. I feel confident with the decision that we made earlier this week.
All right, that, of course, was Fed Bank of Cleveland President Beth Hammack, voting FOMC member, with Michael McKee. Mike, of course, is Bloomberg News TV and Radio International Economics and Policy Correspondent here in TV. So she feels confident that with the decision that the Fed made this week. Did they get it right, Mike?
Yes, in the sense that as of noon on Wednesday, with the information they had.
So they didn't have this information.
They didn't have this information, and it doesn't necessarily mean they were wrong. It's not a great look for the economy at this point, but then it's always easy to look back in hindsight and say you should have done this or should have done that, but they still can move in September. And it's not like, because of the way monetary policy works, it's not like they're going to cut rates and all of a sudden the economy booms. It takes time for that to get into the overall economy, and there's still an enormous amount of uncertainty about what's going to happen because of tariffs. And so you could say that well, I would say Chris Waller is justified in taking something of a victory lap by saying he saw cracks in the labor market that he was worried about, because we do seem to have those. But Hammack said at the same time, you have to realize that we've all forgotten in the last 24 to 48 hours that inflation went up in the month, and inflation probably is going to be driven higher by tariffs. So does that mean you cut rates, or does that mean you hold rates because you want to bring inflation down?
Well, we'll get to more on the inflation part in just a minute. I want to focus on the labor market part of this, and specifically on the cracks that you referred to. What were the biggest cracks that you saw in this report? Was it a miss on the headline number? Was it revisions to the downside for previous months that were pretty ugly? Or was it, as Joe Weisenthal pointed out in his newsletter today, the concern about what sectors are actually doing the hiring, the low productivity sectors such as healthcare?
Yeah, that has been a concern for a couple of months. But the healthcare sector has been, for a couple of years now, the highest, the one that gains the most, because we have so many baby boomers hitting retirement and they need healthcare and all that sort of thing. It was the revisions that have really spooked the market and will give the Fed pause, because the labor market was obviously a lot weaker than they thought it was. And when you look at the revisions, it's definitely an issue. The question is, why did the numbers get revised like that? And it appears that it's a seasonal adjustment problem, because most of the revisions came in the areas that surprised to the upside last time. Government hiring at the state and local level, which is basically teachers and people at schools, and they seem to have a problem with when the schools get out adjusting for that. And this is something that we've seen a couple of times since the pandemic. So the pandemic, it's like one of those viruses you carry around that sometimes is dormant and sometimes pops up. So we're going to have to see if this continues, that kind of problem.
What about the unemployment rate? So it's an uptick from the prior month, bang in line, though, with what the street was expecting. Claudia Sahm was on surveillance earlier this morning, and she says, yes, weaker labor demand, some softening, but the workforce is getting smaller as folks age. You also have the borders, not people crossing the border, so immigration. And she said the Fed can't change labor supply. So are we going to continue to see a smaller labor pool, and so we will see folks maybe fighting for workers?
Well, demographically, yes. We have the generations following the baby boom are smaller, and they keep getting smaller. And so we're going to have just a demographic problem going forward. And that's something that people have been talking about, and how all this plays out with AI is a conversation we can have another day. But the other thing that's happened is we've run into this immigration situation now where the administration has been throwing people out of the country as fast as they can. We had 341,000 fewer foreign-born workers in the labor force in July than we did in June. Now, they haven't deported 341,000 people, but it does suggest that there are a lot of people who are hiding from either ICE or from the survey takers, and they are not letting people know they're in the labor force. So it does get harder to find workers. And we saw in some of those categories, like construction and manufacturing and leisure and hospitality, we saw job losses.
Right.
Mike, I want to end with one more reference back to your interview with Fed Bank of Cleveland President Beth Hammack earlier today. She didn't dismiss the jobs report, but she did, to remind everybody, said that she tries not to make too much of any one individual report. So between now and the September meeting, what would you say would be data that would cause her to vote to cut rates at that September meeting?
I think it's going to have to be a combination. You'll have to see in the next jobs report for August, which we'll get at the beginning of September, does this trend continue that we see the economy slowing down? And to Carol's point about the unemployment rate, yes, it came in at 4.2%, but it came in at 4.248. So if we'd had just a very slight move upward, we would have been at 4.3. And this, as I said yesterday, the speed of the change in unemployment is what would worry the Fed. But we'll also need to see inflation level out or slow down its rise, because if the graph is pointing up and to the right in September on inflation, then it's a very hard sell for the Fed to cut rates.
Listen, Jay Powell talked about risks to both sides of the mandate. So.
Well, that's their nightmare.
Yeah.
What do we do when either side is when they're in conflict?
Happy Friday, everybody. Mike McKee, thank you.
That's not even the worst news of the day.
Yeah. Now let's get to some other troubling news. Mike, of course, Bloomberg News, TV, radio, international economics and policy correspondent. Let's get to the trade journey. Today, the deadline, the extended deadline, remember, for countries to negotiate tariff terms with the U.S. Let's remind everybody of that journey. April 2nd was so-called Liberation Day. That set off a sell-off in global markets, followed 1 week later by a 90-day pause, excluding China, resetting the clock again until July 7th. Then in mid-May, the U.S. slashed the tariff rate on most Chinese imports, of course, a crucial trading partner with the United States. Early in July, the Trump administration gave another pause and another clock reset for countries to get deals done until today, August 1st. We got the latest terms last night with a start date of August 7th. It has been quite a journey. And U.S. Trade Representative Jamieson Greer was on Bloomberg TV and radio earlier this morning talking about the deals done thus far.
We've spent the past 120 days negotiating with dozens and dozens of countries, and with some of these countries, the deals have been good enough that the president's been willing to accept them. With other countries, they're just going to have a tariff. These deals are pretty much set. They are set, right? We wouldn't make an agreement unless we all knew the contours of it, and the countries knew it. And it's an exciting time because the president has essentially reset the global trading system, and so we'll be finalizing everything that's been agreed to on paper and then monitoring compliance going forward.
All right. Of course, that was U.S. Trade Representative Jamieson Greer earlier on Bloomberg today. Keep in mind that despite the August 1st deadline, there are extensions and exceptions for the likes of Mexico, China, Brazil, Canada. Maybe you've heard of them. They are important trading partners of the U.S. Not everything's wrapped up. A lot to get to. We want to turn to Jen Delowy. She's had a busy day already. Bloomberg News senior reporter covering the White House. She's with us from D.C. Investors care about all of this. They care about uncertainty, Jen. It's been a big day of stuff coming at the financial markets. I have got to ask you, though, first about a headline about an hour ago. President Trump deploying 2 nuclear submarines, citing a Russian threat. What do we know about that?
Well, this is really a case of the president. He's kept up pressure on Russia rhetorically anyway, and has obviously shrunk his deadline for the country to resolve matters with Ukraine unless they face sanctions. In this case, he's clearly engaged in some kind of war of words with Medvedev. His response or his comments on social media today saying he was mobilizing these 2 nuclear submarines to respond to what was in response essentially to comments from Medvedev that he called highly provocative. And it just seems that there's a clear incendiary war of words between these 2 gentlemen.
Escalation between now and the weekend. Obviously, nobody has a crystal ball here, but this seems like escalation on its own. What should we be watching for?
You know, I think beyond this, you know, we obviously are going to be looking for other telegraphs from the president about movement in military assets. But, you know, the president has said very clearly he expects to hit Russia with sanctions on August 8th. And I think, you know, we could be looking for any sharper words from the president as he travels to New Jersey later today, potentially speaks to reporters. Whatever he says there will send important signals. And of course, we're going to watch to see what he does with those sanctions. He could shorten the timeline even further.
I got to bring in, man, Jen, so much for a sleepy Friday in August. It ain't happening. President Trump out on social. I'm not sure if you're aware, so forgive me if I'm dropping this in your lap, but he just put out on social media. I was just informed that our country's jobs numbers are being produced by a Biden appointee, Dr. Erica McEntaufer, I think, the Commissioner of Labor Statistics. He writes, who faked the jobs number before the election to try and boost Kamala's chances of victory. So he's got a long post here.
He has directed the team to fire the Commissioner of Labor Statistics. He said he's directed his team to fire this Biden political appointee. He says we need accurate job numbers. The job numbers are being produced by a Biden appointee.
Jen, what's going on here?
Look, you've seen the president for weeks and months now complain about the Fed and Fed Chairman Powell. And I think this attack just in on what he says is a Biden political appointee, suggesting that there's some games playing with the jobs numbers. I think you could put it in that same bucket of criticizing the bearer of some bad news, whether it's a decision to delay rate cuts or in this case, some jobs numbers that clearly weren't something the president was hoping to see today, especially as he's in the middle of proclaiming tariffs on U.S. trading partners.
Jen, if you would, sit tight because we want to come back to you on tariff and get an update on that. But we want to bring back Michael McKee, of course, who covers the Fed and the global economy. Mike, who is this individual?
It is Dr. Erica McEntaufer, who is the Commissioner of Labor Statistics, basically. She was nominated by President Biden and confirmed by the Senate in January of 2024. She's only been on the job for a little over a year. But this is a kind of outrageous accusation by the president. The BLS is not fudging the numbers. I guarantee you they're not fudging the numbers.
Mike, it reminds me of something that we heard before the election from then Senator Marco Rubio, who was questioning strong jobs numbers and during the Biden administration and essentially coming out and saying, do we trust these numbers, and trying to cast them in a doubtful light when they were the other way?
Well, what this shows, I think, at base, leaving aside Trump's desire for revenge on everything, is that there are an awful lot of people who do not understand statistics and do not understand how to look at probabilities. The government in the report on jobs, the government notes that there is a margin of error of a little over 100,000 jobs per month. So we got 73,000. It could have been 173,000, or it could have been negative 17,000, and those would have been statistically valid results. You can't have a perfect number each time. We don't count every single person. Plus, it depends on how many companies send back their results at the right time, and that is that is a problem that we have seen more and more, that the government isn't getting the responses that they need. And then there's the statistical adjustment problem we talked about, where you're trying to account for changes in the labor force month to month.
And that's been true under President Trump, under President Biden, under President Obama, this statistical variation, that it could have been 100 more or 100 less. That hasn't changed.
That's been true since 1923 when they started doing these surveys.
Mike, we rely on this data, whether it's
the world does, to be quite honest,
absolutely.
Right? That our data is
investors rely on it, traders rely on it, macroeconomics professors rely on this. I mean, economists rely on this stuff. Over the last few years, when we've been talking about data from China, for example, sometimes we ask the question, can we trust the data coming out of a certain country? Is that an issue in the United States if this type of thing becomes politicized?
Oh, it's definitely an issue. The United States is the gold standard of economic statistics, and it has been eroded, the ability to produce the best statistics, because there's no constituency on Capitol Hill that is pounding on congressmen's doors saying, give more money to statistics. So every time they need to cut a little something here or there in the budget because they're spending on something else, they say, we'll take it out of the BLS or the BEA or the Census Bureau, and they won't notice. But they do. You end up with a degraded ability to get an accurate number. But that doesn't mean they're not statistically valid within the parameters of the margins of error, which are published. And all of the methodology for all of the statistics is published by all of these agencies. And the rest of the world would love to have the statistics that we have.
Is it unfair for me to ask that when the numbers came out in the prior month of 147,000, we pointed out they've been revised down significantly, but when they first came out, that the president didn't come out and question that number at that time?
Absolutely.
Is it fair to ask that?
Yeah, it's fair to ask that. And we've had this happen before, where you do get even larger revisions as the numbers come in and they work on. And Tim, you were talking about last year. What the government does is they survey establishments around the country for how many people are on their payrolls. And as I said, they don't always get all of them back, et cetera, and they try to make it as accurate as possible. But then what they do is once a year, but they do it every quarter, but they do a cross-check against people's tax records. So you can see how many people were on payrolls by what was withheld. And those numbers showed last year a significant overcount in jobs. And this year, they're expecting the same thing, that they have overcounted. And then they go back and they change the numbers and make them agree with the more accurate tax numbers. But that's just a normal statistical adjustment that's made. And we do that with GDP. You get an adjustment after 5 years because they look at tax records and they see what was actually happening.
Michael McKee doing double duty for us again on that headline. President Trump saying he will fire a labor statistics head after this morning's weak jobs report.
It's just outrageous.
All right. Yeah, we're going to keep following it. Mike, thank you. Want to go back to D.C. Jen Delowy's still with us, Bloomberg News senior reporter covering the White House, covering all of the trade. Jen, thanks so much for staying with us, because this is the other massive story that is coming at us again today, and investors. So where are we with trade, tariffs? How are you thinking about it? I mean, can we tie it up in a bow and say we're done? Because it doesn't feel that way yet.
I don't think we're done, and I suspect we're going to be talking about trade and negotiations for quite a long time to come. Of course, talks with China are continuing, and just yesterday, the president extended negotiations with Mexico for another 3 months. So don't expect anything to be ending anytime soon on that front. Really, what we've seen just in the last 24 hours is the president moving forward with his agenda and his plans to reshape the global commerce. We saw many trade partners with which the U.S. has a surplus in trade, generally being subjected to a 10% rate. Another bucket of countries got essentially a 15%. That's where the trade imbalance was lopsided, favoring them, but not maximally, not really bad in the eyes of the president, not a real problem. And then, of course, there were other countries with which the president had negotiated deals or set the terms, the EU, for instance, and Japan. And we saw all of that codified last night. But there's so much more to come, including details of how the administration is going to look at transshipment and even tariffs around pharmaceuticals and other sectors that are really important to the economy.
Well, even 48 hours ago, we were hearing Fed Chair Jay Powell talk about the uncertainty related to these tariffs and the latest on these. Give us just finally the president's end game, if you will. What is his ultimate goal here if we think about trade with the rest of the world? What does he want to see?
Yeah, no, I think the president has been really clear and his advisors have been clear. They want to see rebalanced trade with other countries. They want to address these imbalances and then also really start to tear down what they perceive as unfair barriers to U.S. goods being traded there. They're trying to lure more manufacturing to the U.S. And so far, the negotiations are winning some of those concessions. We've seen, greater market access promised for U.S. cars in Japan and Indonesia, for instance. It's of course, we shouldn't ignore that, the president and his advisors are clearly enamored with the tremendous tariff revenue that is coming in. Some of that is going to be from the 10% baseline tariffs, but already, it's over $150 billion this year. And, to the eyes of the president and many of his advisors, it's clearly a real opportunity to bring down the deficit.
Jen, amazing. You covered so much, and I know a lot coming at you out of D.C. and out of the White House right now. Jen Delowy, thank you so much. Bloomberg News senior reporter. I got to just point out, Jen and two other members of our amazing global team here at Bloomberg did a morning live conversation about tariffs and trade. We covered a lot of ground. You can find that at bloomberg.com/live Q&A. So I highly recommend you check it. All right, we're going to talk Mag 7 in just a moment with the one and only Laura Martin over at Needham. But right now, a check on trading and your top business stories with Charlie Pellet.
I thank you very much indeed. Very close to session lows right now, Carol. Do want to begin with a developing story out of Florida involving Tesla. A jury there has told Tesla to pay $329 million in damages over a 2019 autopilot crash that killed a young woman and seriously injured her boyfriend. Tesla shares down now by 1.7%. Treasuries rallied. Short-term yields posted their biggest drop in a year. The Dow, the S&P, and NASDAQ all in the red after this morning's jobs data. S&P right now down 112, down 1.8%. The Dow down 1.4%. NASDAQ hard hit down 2.4%. The Mag 7 index down 3.2%. Apple down 2.1%. Amazon, also a member of the index, down 8.6%. We've got more on Apple and Amazon coming up in a moment. 10-year jobs Friday, 4.22%. The 2-year, 3.71%. Gold is surging $58 the ounce, up 1.8%, while West Texas Intermediate crude is down 2.8%, $67.29 a barrel. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, folks, let's get now to certainly something that the equity markets have been focusing on, all week, and that has to do with Mag 7 earnings. Right now, I'm looking at Apple shares. They're down about 2.1%.
They were higher earlier in the session, too.
They were. They actually showed some gains. That wasn't the case for Amazon today. It's been down as much as 9%, right now down about 8.6%. Both reported after the close last night. Apple posting its fastest quarterly revenue growth in more than 3 years, and yet Amazon projecting weaker than expected operating income and trailing the sales growth of some of its cloud rivals. So we definitely are seeing some impact. It's all against the Mag 7 that we've heard over the last 2 weeks or so.
Great to have back with us Laura Martin, senior analyst over at Needham & Company, whose coverage of the media, entertainment, and internet spaces are a must-read. She joins us from Los Angeles. Laura, I want to start with Apple and the pull forward or whatever we saw with the huge beat when it came to that iPhone number, and typically a time when people are not buying iPhones. How do you explain it? Was it all about pulling forward of demand to avoid tariffs?
Well, it is really that. I mean, that's what the market's telling you today. Apple admitted that 1,000 basis points, so 1% of their revenue growth, which was 10%, well above average, was from pull forward. And the market's telling you they think that number was like half of the gain, basically. And Apple also said they had $800 million of costs from tariffs in that quarter they just reported, and it's going to go up to 1.1 billion visibly in the September quarter. But I think the market's telling you they think that could be higher in the September quarter.
Oh, so does this mean that we'll see fewer iPhones bought in the first fiscal quarter, but Apple's December quarter, which typically is its biggest quarter, as a result of the pull forward that we saw in this quarter?
I think it's worse. It's faster. So the June quarter over-delivered because they pulled forward demand from the September quarter. Those are all old iPhones.
Okay.
And then in late September, you typically get the new iPhone, and then you start this new annual cycle of the new iPhone. And one of the things they said that's hurting the stock today is that Siri and Apple Intelligence will only be integrated next year, by which they're probably talking calendar year, which means the earliest we'll see, generative AI features drive an upgrade cycle for the iPhone would be not September of 25, it'd be September of 26. So then that tells you, so this is dead money again, right? There's nothing driving. And there's risk here. Not only China's subsidies drove a really nice China growth number, 4.8% China revenue growth. People are worried that that is also like that subsidy isn't going to recur. And we've had a couple negative litigation regulatory decisions, right? We've got the fee, $20 billion a year is what Google search pays Apple to be the default search engine on all iOS devices. I think that's pretty clear from channel checks in DC. That is not going to be allowed to persist. So that's $20 billion that will come out of services if it isn't allowed. And then similarly, we have the Epic. Apple got a negative Epic Games, which allows consumers to pay directly to apps and not have Apple share 30%. So that's an App Store risk that over the next 12 months, not immediate, but over the next 12 months.
Laura, we've had the luxury of talking with you in the last week or two and talking specifically about Apple. You've got a hold rating on it. It doesn't sound like you have a lot of concerns, I guess I should say. Why not put a sell rating on it?
I think so. One of the issues is when you look at the other Mag 7, they basically have a singular strategy, which is envision. Generative AI is disruptive. Everyone else is going to spend $85 to $100 billion in CapEx in 2025 alone, and we're going to grow at 20% in 2026 every one of them has been pushed on what is that return on capital, incremental capital. They all say, we don't know. We just think it's going to be big. If you don't believe that, if you're an investor and you think that generative AI is overhyped or the economics are further off into the future, Apple is a great place to hide. They are spending $20 billion a year, not $85 billion a year. Generative AI is sometime in the future. They're not hiring people like Meta is for $100 million each to work on superintelligence. Apple is a great place to hide if you are an investor that doesn't believe in generative AI changing the world.
Well, it's interesting that you say that. I can't remember who was either on surveillance this morning with Tom and Paul, but it was just something to the point that, well, wait a minute. Apple often isn't, first mover on some big changes, right? We talk about this.
They didn't create the tablet. They didn't create the music player. They didn't create the smartphone, but they created the best of all those things.
Exactly. So if they're saying, hey, guys, go ahead and spend, your billions or trillions or whatever the heck it is, figure out this AI thing, and then we'll come in and we'll collaborate or partner with somebody. Maybe that's not such a bad strategy.
So it's risky business. So on the call last night, Tim Cook got this question. And what he said is, I don't see a world where the consumer doesn't have an iPhone, which is basically a computer, in his pocket. Okay, that's a vision of the future that Johnny Ive, who's gone to OpenAI, is trying to displace. Johnny Ive, who developed every Apple product you have in your pocket while he was at Apple for 20 years, is now saying he regrets creating the screen because he thinks it makes people not pay attention to one another. So he's trying to move the next device with generative AI backing to not be a screen. So that may not work, but if it does, Apple, that's a problem for Apple. That is an existential risk problem for Apple. So long as an iPhone and a screen are going to be sort of the user device of record and they're going to persist in 10 years, you might be right. That might be possible, what you just said. Apple can copy the best of Android, which will have Gemini, because Google has Gemini in every product now. That will work. But if Jimmy Ive and OpenAI are right and screens are going away, that's problematic for a smartphone maker.
I guess that's maybe where whatever they're working on for a face computer could come in. Laura, I want to go back to what you said about Gemini and Android because of the way that Gemini is baked into Google devices now. You say in your most recent note that Apple is a single product company. Its valuation risk is material if iOS falls too far behind Android. Would you say that iOS is already behind Android right now?
Oh, I would. Absolutely, I would. I mean, when you look at Google's, its revenue is accelerating over at Alphabet and its costs are going down. So its productivity per employee is going up. Why? Because 80% of engineers are using Gemini to do their first draft of code for new products. They're introducing new products faster. They're integrating, they over-delivered on advertising because they're integrating all these better both Meta and Google, because they're using generative AI to increase the conversion rate. So yes, Gemini is being integrated into everything at Alphabet, Android included.
Does it matter? Like two comments here. One is the network effects that Apple has, and we're speaking with Laura Martin over at Needham, if you're just joining us. The network effects that Apple has, at least here in the US, are really strong, right? The blue bubbles for when you're on iMessage and the other Apple products that you have that ideally are supposed to work seamlessly with that. Plus, doesn't Gemini have an app that you can just use on your iPhone? So if you want to use Gemini as sort of a co-pilot here, if you are an engineer, you can just do it on your iPhone, but through an app that you'd get at the App Store.
Right, if it's standalone. But I mean, I think my guess is where Alphabet's going is they're going to integrate Gemini into everything on your device. It's going to know where your appointments are. It's going to know who your friends are. It's going to be a personal assistant integrated into your Android phone. Right, it's going to be a bigger idea than just a separate app where you go to it. It's going to be like, even if you listen to the meta vision of the world, super intelligence is about having a robot friend that does everything for you better than a human can. Make you, I mean, it's just, I think these are bigger ideas than an app store. By the way, some CEOs' visions of their apps are disappearing. So then you say, so what replaces them? Well, I don't know. Used to be websites. Then we went to apps. What's next? It may not be apps.
All right. You mentioned, I want to just get to Meta and Amazon. What about Meta? You know, in terms, I mean, that stock was just off and running following its quarterly update. Those ad sales numbers certainly catching everybody's attention. A mega spend when it comes to AI. What is your hot take on that one?
So, stock up strongly, really strong fundamentals. 60% margins, 22% revenue growth, and a huge company, which was the fastest of the group that the big tech companies we call, really strong fundamentals. We are cautious on Meta, and that is because they took their CapEx to $70 billion this year and $100 billion next year. Again, no return in sight, and their stock comp per person is going through the roof as they hire super intelligence employees, with press reports saying they're paying $100 to $300 million over 3 years for each of these people.
Pretty good work if you can get it, I'll say.
Yeah, my guess is they're trying to change the world, right? And they believe in super intelligence, which this isn't a vision of making you and I more productive. This is about replacing human beings with machines that teach machines. So it's literally Terminator, like life imitating art type of stuff.
Doesn't sound like you're pro AI in that context.
Let's stick to Meta as a stock.
Yeah.
My concern is that we're losing $5 billion a quarter on Reality Labs, and we're still funding the metaverse, and we're funding Quest goggles, and we're funding AR glasses, Ray-Ban glasses, and now we're funding a Gen AI competition with companies twice their size. All of that feels like a lot of capital spending to me, and actually cost to me, without a clear sense.
But investors are saying they are okay with it up to now because they believe that Mark Zuckerberg has this vision for superintelligence, which, to be honest, nobody has actually articulated to me. Well, what does that world look like that Meta wants to create and thinks will be so profitable?
Aren't they okay just because the ad sales number came in really strong? Like, if it didn't, might everybody be like, maybe not okay?
Yes, absolutely. He is buying the right to spend money like a drunken sailor because his fundamentals in his core business are strongly over-delivering consensus estimates. The day that stops, the music stops. And suddenly people are going to take a hard look at these. You know, he's making 5-year commitments for these super intelligence employees, and he's making 10-year commitments with the money he's spending on data centers. So all of this money, he has a free pass so long as his core business is growing 22%.
Okay, totally makes sense. Sort of the free pass, like Elon was, allowed to be CEO of many different companies, and investors were fine with it until they weren't. Jack Dorsey, the same thing, right? It works until it doesn't.
Yep.
What about, though, the promise of this being profitable in the future, all this investment ultimately paying off beyond making ads more efficient? What is that vision? What does that world look like in your view, at least articulated by Mark Zuckerberg?
So again, Mark is just, he has got a big idea. He wants to replace Apple, that's for sure. So does OpenAI. So Apple takes a 30% tithe on every dollar earned on its platform. And that hurts Mark Zuckerberg, not only because Apple gets paid for a lot of work he is doing on Facebook and Instagram, but also it allows them to change policies and procedures like around security and safety and privacy that cost Mark Zuckerberg $10 billion in revenue 3 years ago. And since then, Mark Zuckerberg is all about replacing Apple or that piece of hardware with Ray-Ban glasses or Quest goggles or something, or the metaverse. He's trying to displace Apple, and he wants to be the backbone that everybody has to pay 30% to. So that's his main economic mission. And now generative AI comes along, which I think, I think many CEOs thinks it changes everything. Even Apple said it's the biggest technological disruption of our lifetime. And they benefited from mobile, which you would have thought they would have thought was bigger than Gen AI, but apparently not. So I guess the question is, Meta is saying, we think they're super intelligence. We think every human being is going to have a robot that they hold on to, maybe without a screen. We don't know, we don't know what the form factor is, but that does things for you, where you see the world differently and it helps you get through the world. But I don't think we know what that is yet, and he doesn't either. That's why he's hiring 50 smart people to have robots, train robots faster to do stuff humans can't do.
Well, nobody can do what you can do. We want to ask you about Amazon.
Sure.
This stock down still more than 8% here in the aftermarket. And I think there is concerns about kind of the cloud spend comparison, among the big hyperscalers. Amazon's still the biggest when it comes to, we think about what's going on in terms of the cloud. What's your take here, or what we kind of need to be thinking about with Amazon? Because investors seem pretty disappointed. Are you?
So I think here's what I think is going on with Amazon, to answer the first half of that question. So they had very strong revenue growth, up 13%, which was like, we were 4 percentage points below that, and very strong EPS and margins. But the problem is they gave very tepid guidance, so people are really worried about tariffs impacts here. So they're worried about the next shoe to drop. Their advertising grew very robustly at 23%, which is great. And I think that would have been higher had not Temu and Xi'an stopped advertising, sort of on April 10th because they lost the de minimis rule exception. So I think that would have been higher, but that's a fabulous number nobody's focusing on today. And I think investors we've talked to are frustrated with capital spending on Kuiper, which has no revenue. Capital spending for 10 years so far on Alexa, no revenue. And they're going to urban delivery same day. And I think people don't understand their core business of e-commerce. I think people don't understand that as use of capital. At the same time, they just raised their CapEx guidance when you do the numbers to round numbers 115, 120 billion this year. The next closest is Microsoft and Google at 85 billion. So they're quite a bit above everybody else on this generative AI thing. And then AWS has anemic revenue growth, 32% margins in the cloud business, and they were 39% 90 days ago. Like, what the heck? And they say they're capacity constrained. So then we would forgive them if they only report 17% revenue growth, but then why aren't your margins 60%? Why aren't they 40% again? Why not sell to the highest bidder the last, 1 gig of capacity? So we saw that in both Azure over at Microsoft and in Google Cloud. Slower, growth rates, but really high margins. And that just didn't play out at Amazon.
All right. Around the world we went. Thank you so much, Laura. Always appreciate it. By the way, Laura's got a buy rating on Amazon with a $265 a share price target. The stock right now just below $215 a share. Laura Martin, have a great weekend. Senior analyst at Needham & Company joining us. Keep in mind, we're going to continue talking earnings in just a moment. It's not all about the Mag 7. We had some of the integrated oil majors reporting this morning, so we're going to get into that with Ellen Wald, author of Saudi Inc. That's just in a few minutes.
Before that, though, a check on the day's trade top business stories. Here he is, Charlie.
Thank you very much, Tim. Right now, ExxonMobil down 1.9%. Chevron among the companies out with earnings this morning down 0.2%. Apple, Amazon, just talking about those companies with Needham's Lynn Martin. We got Apple down 1.7%. Amazon down by 8.2%. President Trump says the U.S. is moving to nuclear subs to respond to what he calls highly provocative statements from foreign former Russian President Dmitry Medvedev. S&P 500 index off session lows, but still down 1.5%. On this Jobs Friday, the Dow down 1.1%. NASDAQ is slumping 2%. The 10-year 4.22%, with the 2-year 3.70%. And spot gold up $61 the ounce, up 1.9%. West Texas Intermediate crude down 2.8%, $67.32 a barrel. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right. Thank you so much, Charlie. Both ExxonMobil and Chevron posted better than expected results after record oil production cushioned the impact of lower crude prices. This is coming in a week where we've got oil headed for its biggest weekly jump since Israel attacked Iran in June. Let's get to it. Longtime oil industry watcher, Dr. Ellen Wald, is back with us. She's president of Transversal Consulting and senior fellow at the Atlantic Council. She's also author of Saudi Inc., which talks about the history of Aramco and Saudi Arabia, joining us from Boca Raton, Florida. Ellen, great to have you back with us. Exxon Chevron's result last quarter, was it full of special caveats and nuances? Walk us through what we got from those companies and what it tells us about kind of the oil market and the oil business.
Yeah, exactly. Both of them, they reported earning drops. I think that was very much expected given how low oil prices were this past quarter compared to last year and even the first quarter. So that was very much to be expected. But at the same time, both of these companies are looking very strong, going forward. We've got Chevron's acquisition of Hess is finally has passed its final legal hurdle and is going through. And then, with Exxon's acquisition of Pioneer Natural Resources, it really looks good. They've got a lot of really good acreage in the Permian, which is considered highly profitable. Both companies are working together on offshore projects in Guyana that are also expected to be highly profitable. Chevron, its project in Kazakhstan also looks good despite all of these, slight snafus in terms of OPEC and production. It's generally looking good, especially as OPEC is expected to increase its production. The big question that we see going forward here, I think, is mainly oil prices. And the big question here is really, what is going to happen with this tariff business? I think the resolution or the deal with Europe has definitely brought some more stability to that. With this resolution of these tariff issues or these trade issues, come the expectation of more trade, and more trade is good for oil demand. So that's where we're kind of looking in terms of the market with that. I also think that the energy part of that deal is very, very good, obviously, for oil companies, especially in the U.S., considering how much oil and gas and other energy products Europe has agreed to buy from the United States. Really, the question is, can the U.S. actually supply all of that oil, given the fact that the amount that they're talking in terms of the dollar amount is basically like the total amount of oil exports that the U.S. exports already. So there's some questioning there, but overall, it definitely looks good for American producers and oil companies in the United States, even if the exact details of that, I think, remain to be seen and have to be hammered out. The other big question coming up is just this tariff and secondary tariff issue with Russia.
So that's the trade side of this. I'm wondering about the U.S. economy side of this. And it's kind of front and center today, at least when it comes to the jobs market, given the headline miss and the revisions that we saw over the last few months from the BLS numbers that we got earlier today. What, in your view, does a potentially weakening job market or cracks starting to appear in the job market due to the long-term demand picture for oil?
Yeah, so weeks in the job market, cracks and fissures there are definitely not a good sign for oil demand in the United States. And I think that we saw that with the weekly EIA report as well. There was some kind of, we would have expected higher consumption and higher demand for this time of year. Generally, the summer months tend to be higher demand. And what we saw was actually kind of weak. And in fact, some people were actually questioning whether this was a reliable number. But I think given kind of the revisions in the jobs report, I think we have to say that, yeah, this is definitely concerning. I think that it depends what we see going forward in terms of oil consumption, particularly as we're leading up to kind of end of summer, the summer finale. Generally, oil consumption goes up around then gasoline consumption goes up. Will it go up as much as expected, I think is really the number we're looking to see.
Ellen, I want to go back to something you said about, what we get in terms of possible sanctions from President Trump. when it comes to Russia. He has said he expects to hit Russia with sanctions on August 8th, so a shorter deadline for Russian President Vladimir Putin to basically halt the war in Ukraine. Those sanctions, as we've been reporting out, would likely take the form of tariffs on countries that buy Russian energy. So I'm just curious, tie together the importance of Russia in the oil energy markets, but also the complicated relationships, whether it's Russia, China, Russia, India, because it all kind of comes together.
Yeah, exactly. I think that, this is a really
just
big
about
ask.
a minute left, so I just want you to be able to manage that
This is a
time.
really big ask. I think that if we do see any kind of secondary sanctions on countries that buy Russian oil, either we're going to see these countries dropping their purchases of Russian oil, and that's going to put more demand on other oil sources, the U.S., OPEC, Saudi Arabia, etc., and that could definitely cause oil prices to go up in the short term. But if they decide that they don't care about this, then we're just going to see more purchases of Russian oil, and that could definitely cause prices across the board to kind of deflate.
All right, going to leave it there. Ellen, thank you so much. Dr. Ellen Wall, president of Transversal Consulting, senior fellow at the Atlantic Council. She's also author of Saudi Inc. If you want to understand Saudi Aramco, Saudi Arabia, when it comes to the energy markets. Want to point out, WTI crude futures are up about 3.4% this week overall, still down about 4.5% on the year. But nonetheless, as we mentioned in the lead to her, we definitely have seen a move up in WTI crude.
A move up in crude overall, but a move down in stocks today with the S&P down 1.5%, the NASDAQ down 2%. An update, too, on that story we brought you just in the last half hour. President Trump said he was directing officials to fire the commissioner of the Bureau of Labor Statistics after a report showed that U.S. job growth cooled sharply over the last 3 months.
An update on stocks on the move when we come back on Bloomberg Business Week Daily.